Welcome to the Wednesday edition of Forex Focus. I was almost jumping into my previous life of splashing the futures. Look at me. Want to talk a little bit about Forex markets today. It's an incredible amount. We had quite a ride yesterday in terms of activity, and we're seeing it play through right now in real time. So Chinese just announced they're rolling out another 50% of tariffs on U.S. products. So they're taking their 30%, adding another 50%, up to 84% on all U.S. goods starting April 14th. With that, we saw U.S. equities, which have been struggling to stage a little bit of a rebound, get slammed. U.S. Treasuries continue to get beat up. We have gone from, in the bonds, 122 down to, last night I think we printed sub 112 briefly before bouncing back into the mid 114s. But that is a huge, that's almost breaking the 5% bound for long-term debt. And remember, so the reason I mention this is a couple of things. We know we've been talking about the correlation of bonds to the Japanese yen. Also, we're seeing U.S. Treasuries move in a very unique way. We're seeing the long end of the curve, ZB primarily, and ZN getting sold very hard. Those yields, those long-term yields, are rallying very quickly, while the two-year yield is actually falling. So we're seeing the yield curve steepen, but this is not what we traditionally tend to see in a risk-off environment. We see what we saw Thursday and Friday. And Sunday night, we see bonds become that safe haven play where we had traded 117 up to 122 very quickly, to give that all back on 2 days where, yes, we had a rally yesterday morning in equities that lasted till about midday. Selling emerged and accelerated overnight, and just accelerated again. With that, we saw bonds not rally like they traditionally do, bond yields fall, but we saw bonds continue to get sold. Now, why? There's never just one thing. There is talk the Chinese are selling U.S. bonds. There's talk there's going to be more borrowing to be done to finance the budget, whatever it is. For me, the disconnect, which makes me become a little bit guarded, is the amount of selling that took place in the long end, ZB, the 20 plus 30-year long bond, we call it, has been unrelenting, one-sided, and completely disconnected to the rest of the Treasury curve. So something's going on where either an entity or a country or a group of individuals is having to liquidate a lot of bonds. So does it speak to stress in the system? Maybe. You guys know the last thing I am is a conspiracy theorist, so I don't want to run down any rabbit holes, but it is a very disconnected piece of behavior. So we saw that come out. We saw, again, the U.S. put in place the full tariff suite on the Chinese. The Chinese just announced their tariffs about 30 minutes ago. And that's where we saw the reaction in U.S. equity markets. Now, the bonds, again, sitting somewhere around ZB right now is sitting, where are we? 113.18. So no big bounce there. We're still 2 full handles lower on the day after falling almost 7 handles yesterday. It's a big move. 9 handles from 122 to 113. Really 112 is a huge move in a couple of days in U.S. Treasuries. So let's take a look at a couple of our markets. Now, what we're seeing a little bit is a little bit of consistent dollar weakness across all the dollar pairs. And we're going to go through that a little bit. And the thought being a little bit of, we have seen the Japanese come out last night and talk about continuing to hike rates. We look at a currency that continues to trade a little bit lower, but the one thing that we're seeing, which is a little bit disconnected, we're seeing a higher yen or a lower dollar yen with lower bonds. Now, we've been looking at this over the previous 2 weeks, and we've picked up on the correlation. It tends to be on an up bond day. i.e. yields are lower, dollar yen tends to get sold. When yields are higher in the U.S., bonds are lower. Dollar yen tends to get bought. We saw that play through all through this end of March, last 2 weeks of March, start of April. We saw that really work through. What we're seeing now is a complete disconnect from the long end of the market to yen. So we talk about correlations come and go, and they are things we watch and we're mindful of, but this correlation seems to be in the short run broken. So the fact that the bonds are down 2 points today, given our previous discussion, you would say, oh, at some point, this downtrend in yen to 140, sub 145, that's got to be an interesting place for me. If I want to be a little bit of the range trading contrarian and pick up something that is getting marked down, that might be an interesting play right now. I think, again, there's always a confluence of effects driving markets. Yen acts traditionally as a flight to quality. So we often see in times of stress, dollar yen being sold. We didn't see that play through at the start of this down move, but we're seeing it play through now. And the interest rate piece, the difference in rates between the two nations, isn't necessarily playing into the same fold here. So this is a case where, yes, dollar yen is being sold pretty aggressively. We're almost down 1% on the day. But I am not taking it of the mind that I'm that interested in necessarily picking a bottom down here. And we take a look at the hourly, and that move, all of yesterday and today, has been pretty consistent. And remember, when we look through yesterday's action, dollar yen selling took place. And remember, in the morning, at this point, 10 o'clock in the morning, U.S. equities were on a tear. I think NASDAQ was up 400, the SPUs were up 150, and there were still sellers in dollar yen. NASDAQ and Euro, NASDAQ and SPUs collapsed at the end of the trading day. There was still selling in dollar yen. Little bit of a reprieve overnight, very quiet, and then more selling takes place as U.S. equities release again on the Chinese tariff news. So we talk about, typically, we've talked about setups. You look at this. This is our, 1, 2, 3, 4, 5, 6 time at roughly 145. And each time we've pierced it, but that piercing has lasted, again, these are hour count, has lasted less than an hour, and we've recouped to trade a little bit higher. We are not seeing that right now. So now you could argue though, we're seeing another piercing of it. If it doesn't last for more than a day, maybe this is an interesting range area. It could be for that contrarian, but I think some of the things I look at that have worked over the last couple of weeks, if not months, are a little bit disconnected now. So I'm a little less inclined to trust that this 145 value level will hold. So I'm going to be a little mindful to watch how the tape action unfolds today, and whether or not we're able to pop our head back above 145. Because if we do, then this is basically the same thing where we spend a little bit of time below it, not much, and we're able to base from that. But we're going into the start of the day below 145, not by much, 16 pips. But if we end up continuing to plumb this lower end of the range, I would be very mindful at that point that the contrarian in me that wants to buy this 3-handle, 4-handle pullback, it may not be the right play. So we're going to keep an eye on that as we move forward during the week. Sterling, obviously off that spike high of 132, but we're seeing a little bit of a bid come back into sterling, into euro. Now, if you're thinking, and we're seeing it play through a little bit stronger in euro, back up to 111.62. So not quite at those highs we were at last year, but we're getting back to that level. Euro is, again, the second most traded in terms of volume and liquidity. When we talk about sources to go shelter in a storm, so to speak, the dollar's always been thought of that. It's a deep pool of liquidity. It's a relatively stable environment. If that stability is getting questioned right now by the markets, and they can be harsh in their questioning. Wouldn't be surprised to see, yes, we're seeing that play through with dollar yen selling. People want to be long yen. I think we may see a little bit of that play through in people wanting to be long euros and sterling for that matter. So we may see, from a tape action standpoint, this had a decent pullback from its highs. And we are now getting in a position to possibly start to challenge those old highs above 112. So this continues to be an interesting market that gives us two-sided action, which is great, and outsized range. I think last time we took a look at the 30-day one standard deviation move, we were out to about 52 pips here. We're already 83 pips higher on the day. So we're already through that and actually had traded higher a portion of the, let me get out my daily to my hourly. So we've already had a nice run today, all the way up to 110.60 before we came back down to this 110.40 level. But from a structure standpoint, we're putting in new highs. We've kind of got to the upper end of this congestion range. The lows we put in are not anywhere near challenging old lows, and we seem to be building a little bit of energy. We know this can turn. Last time we saw tariffs announced, Euro, Sterling, Canada, Aussie, Kiwi, all got hit. Some of them bounced back more than others. Now we just had another round of tariffs announced and put in place. The U.S. to China, and China back to the U.S. We didn't see that we saw the time it was announced right at 6 o'clock. Euro downticked 15 pips, Sterling downticked 20 pips, and it was not 100, not like we've been seeing 110 pips. Tiny pullback that was immediately met with buying. So the idea that this escalating war is going to be continue to weigh on FX, I think that's starting to get challenged a little bit by the market. So we're going to see how that plays out and plays through. Let's take a look at the commodity currencies, because if we go back, and let's just look at our all FX pairs. Very different story for Aussie. Let's take a look at Aussie right now. Again, up 28 pips, so nowhere near the 85 pips in the euro. We are off the lows. We know we plumbed new lows yesterday at 59.13. With the tariffs announced, did we see a pullback? A bigger pullback in Aussie, 45 points versus the 15 or 20 we saw in sterling. So I still think this is a case where Aussie and Kiwi are both bearing the brunt of this. And yes, they are. I mean, when we look, and you don't see a lot of this, guys. Let's go back to the daily for context. Here's our Aussie daily chart. Here's our euro. We're seeing something that is, on the euro side, starting to challenge the upper end of the long-term range. If we go back, let's get out of the hourly, go back to the daily for context. Starting to challenge those multi-year highs at 112, where in Aussie, we're seeing the absolute opposite thing take place. We've taken out lows, multi-year lows, and we're not seeing a lot of relief here. So the pairs trader in me, the contrarian, thinks, well, I want to buy what's cheap and I want to sell what's rich. I want to buy some Aussie, I want to sell some euro. I'm not quite ready to do that. Is the spread in these highly correlated FX pairs, we know they all correlate well when dollar is part of the quote currency or the base currency. This is a dramatic divergence in that. We can take a look at Kiwi and see, even to the same extent, that same divergence. Now, here's a Kiwi daily chart. Not quite as technically damaged as Aussie, which is clearly through the lows. Kiwi sitting around these lows here that we had put in, 55.30, but neither one of these markets is taking whatever you want to perceive as good news or dollar bearish news and rallying with it, but they're certainly taking any bad news and leaning against it. So as wide as these spreads are, if you look at the value of sterling to Kiwi or sterling to yen, euro to Aussie, sterling to Aussie, and we can look at those crosses in a little bit. None of them necessarily speak to me that that's a pair I want to start building on now, non-dollar crosses. I think for me right now, the focus is staying in the dollar pairs twofold. The liquidity is the greatest there, and I don't think these crosses are ready to turn around. We could take a look at them, and let's just look at, we'll go ahead and track down Euro Aussie here. So, as you would expect, when you know, the contrarians out there look at this. I mean, this is a market that's run almost 20 handles. It is a huge move in a pair that has sat basically between 160 and 170 for almost 2.5 years. So an outsized move. So when we talk about, well, Pete, how do you know Euro is outperforming Aussie? Well, you can see on the chart that one's at the top end of its range and one's at the bottom. But what's great about FX is you can go right to that source and you don't have to do math and figure out, well, what is the ratio and everything. You can go right to the chart. And with 80 FX pairs, this is what I love, is the ability to look at these relative performances of these different currency pairs. Here, Euro Aussie is just taking out the dollar component. So it's the relative value of the Euro to Aussie. And this is a huge, almost 10 plus, 12 plus % move in the matter of a week, week and a half. Think about that in currency, which on average over the last 30 years, average FX moves in major FX pairs is 2.5% per year. That's the average. Sometimes it's more, sometimes it's less. That's start of the year to the end of the year, going back 30 years. So when I look at something that's moved 12% or 6 times that average in the matter of 7 or 8 days, it's an interesting extreme for me. I want to see, from an extreme standpoint, the pair is very, very interesting. I want to see how this plays out a little bit. But if you are that long-term structural contrarian, starting, number one, everything we're trading smaller size right now. We want to weather the randomness of these tweets. And again, if there's supposedly there was comments coming out this morning that there's good progress and a good announcement coming from Japan, South Korea, and Vietnam. Who knows what that is? Who knows if it'll have an effect? But we're all subject to these tweets giving us outsized movement, basically a day's movement in the matter of 30 seconds. So how do you handle that? Do you stop? No, you stay engaged, but you start and stay smaller. So if this is something that's interesting to you, this is something you can start by scaling into a little bit. Now, putting on some Euro Aussie is great because you don't have to weight the pairs. We do that for you. It's all there. The platform is fantastic about visualizing it and let you participate in it. You can start to layer in small shorts if you like the extreme. Again, you could have liked this at 180 and it continued to go right. Can we go to we're at 185 now. Can we go to 190? Sure. These markets are not bounded, but statistically speaking, we tend to see these non-dollar pairs have a greater reversion aspect to them than the dollar outrights. So what I'm saying is non-dollar pairs like Euro Aussie or Euro Yen or Euro Sterling tend to have more of a reversion aspect to them than Euro USD, Dollar Yen, or Sterling Dollar. So given that, 185 to 190 is an interesting area. Now, what I like about this from a trader's perspective too is I could take this extreme, and if I find it interesting, I could start to layer in a little bit of short Euro Aussie here and put a small amount in, kind of layer, let the market come to me a little bit. Don't be in a rush in this environment to use market orders. Let the market come to you and get paid, and do things incrementally. Don't put everything out. If your usual lot size is 1 lot, or let's say your usual lot size is 5 lots, max position sizing should be around 2.5 right now, just so you can weather the movements. It is something like that. If your max lot size is 2.5 per pair you're trading, maybe you're layering in at half a lot at each 10 or 15 pips. You're working your way in with the idea of, I'm going to layer this trade in, and then where am I going to manage it? If it prints for 190, I'm going to cover it, or I'm looking for a reversion back into something sub 180, 175-ish. What's great is you can put this on, leave it alone. Obviously, you've got your risk parameters set, but it doesn't prevent you from then going back in and trading Euro USD or trading Aussie USD. They're separate pairs, and they'll be on the position, on your positions tab in separate pairs. They'll be P&L'd separately, so you will be able to take advantage of those two pairs without it necessarily impacting whatever your assumption is around Euro or Aussie for individual scalping ranges, which is great. So easy product construction, easy ways to express an opinion. And guys, today we just touched on the dollar majors and one currency cross. And you can see we're living in a time where it's really, these are unique times because I have not seen divergences like this take place. And we know the backstory. We can attach Aussie's closely aligned with China. That's their primary trading partner. China's hurting. Aussie's going to hurt. And Kiwi is closely aligned to Australia, and that pain kind of translates across the water to New Zealand. Sure, that's part of the equation. The New Zealanders also lowered rates by 50 basis points to 3.5% yesterday. So they're continuing to soften their interest rates. Does that have a little negative bearing on the currency? Sure, in a vacuum. But remember, we don't trade in a vacuum. All these different things come into play. The markets price efficiently. We accept that. But within it, we find opportunity. And there's lots of opportunity here. And what I really like is the ability to be able to construct different sets of extremes and play both. You have the wonderful opportunity now to be both the contrarian and the trend follower, depending on the pair you're trading and the way you're trading it with it. So lots of opportunity out there. We'll continue to gauge with you around markets and continue to call out and highlight some unique non-dollar pairs that are interesting to trade. So thanks for joining me today. Coming up next is Tom, Tony, and Vanetta, and we'll see you back here tomorrow.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're #1 for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
One of the things that was most intriguing about the financial space to us is just that there wasn't a lot of vision. There wasn't a lot of innovation. After almost 20 years of open outcry standing in the pit trading, I felt like all the markets were moving to electronic trading. I saw the writing on the wall, and I wanted to be first. Building the best technology in the world for traders was one of the coolest things anybody could ever do. I loved every second of it.
Thinkorswim will always be my baby, but this one, it's different. We built ours literally from scratch. It's a much thinner, it's a faster, it's a slicker application. Everything's on one page. So you're always looking at the core page and then bouncing around from there to get to whatever you want to get to. We're here to support whatever you're looking to do. We have the tools that you need to be a successful trader.
Wolf! The first half of this year's market has been giving the good guys the business.
It's certainly been back and forth for sure, Pete, and I'm getting whiplash over here.
With good mechanics, we can see Team Tasty stay strong in the second half.
Absolutely. Let's check out our starting lineup.
Liz Deerking, Eastern Illinois University. Number 1, because dedication and motivation equals success. Being able to make that one trade that builds on the next is the very first step.
Matt Helmuth, Illinois State University. Number 30, because that's how many of Tom's credit card purchases I have to decline a week. Stop trying to buy a suckling pig online, Tom.
Bobby Shepard, School of the Art Institute of Chicago. Number 6, because that's how many revisions every piece of copy goes through.
Jenny Andrews, University of Illinois Urbana-Champaign. Number 18, because that's the average of the VIX over the last 10 years, and I cannot wait for it to get back there.
I like the looks of that lineup.
Well, be mechanical is always better than just trying to run plays and see what sticks, Pete.
When you got skin in the game, you stay in the game.
That's right. Now get off the couch and get into the game.
Watch Tasty Trade.
Dear Kaylee, hats off to you for being such a culinary genius. I don't think it has ever dawned on our kitchen staff to serve gazpacho hot. Sincerely, Bob.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
I don't want to fact check you with my vagina, but I will.
From the smart mouths at tastylive.
Tasty Trade is now on TradingView. Trade stocks and futures directly on TradingView charts with Tasty Trade's low commissions. Try it out and leave us a review.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
In the world of investing, a beast lurks between the numbers, ready to pounce. Some traders hide from it, some ride it. If that's you, join us on Tasty Trade. Genius loves company.
Woo! Get tasty, free market. Come on, you know it, can you feel it? We got some things to talk about. Free market. It's early, but not too early. Come on, wake up now. Pour that coffee down your throat hole. It's hot. Now you got a hole in your throat. Oh no, just call your boss. Take a crust from out your eyes. So tasty, not a coffee.
Me and you taking phone calls, 855-238-2789 or 855-BE-TASTY. That's the phone number to call. The number will be below in just a second if it's not there already. Sosnoff, I saw your trades last night. You were up early in the morning. You actually caught the market when it was higher at like 3 or 4 o'clock in the morning. What were you doing? What's wrong with you?
You know, it was really weird. I was mad last night. I
was scared yesterday.
You were scared yesterday? I wasn't scared as much as I was mad. I was sitting around. I answered emails till really late, and a lot of people were writing and stuff, and I was trying to be nice and, write back as much as I could. And
listen, I mean, that we've done this for 14 years. I mean, answering people back in the same day, typically within an hour of when they write you, because it's money on the line. You feel like people are looking
I understand.
for at least a sounding board to you.
Completely agree. And so because I was up and answering emails and focusing on markets, and I started to, I was also trading.
Yeah.
And
you were trading bonds all night long.
Bonds were crashing. They're still crashing. They're 112.22. They're 112.23. They're down 3 handles. 3 handles. And let's put all this in a little bit of context. Just 3 days ago, they were 122.
Yes. Yes.
So
actually, they closed. Forget about where they forget. They opened at 121 and change. Yes, you're 100%.
Yeah, trade up to 122. They're in the 112 handle. I actually bought some last night at 111.31, which I'm not ruling out trading there again this morning. And I was completely flat on the night at the end of the night and made a little bit of money trading bonds from the bond. I'm still long bonds are getting killed today.
Mm-hmm.
But anyway, so I'm watching this bond market and I was getting angry. Like, I don't get angry when I trade. I just don't get angry.
Yeah.
And I'm getting angry because I'm like,
because I talked to you when the market was imploding on Thursday and Friday when you were gallivanting around the world while I was taking care
and bonds were exploding.
Yeah,
because there was a flight to quality.
Yes.
And the entire situation has changed now. And no longer is there, forget about flight to quality. What's happening right now is the world is essentially, and because people.
No, hold on now. It's been this way for not for a while, but I mean there has
3 days.
What's that?
Yeah, 3 days.
Well, no. But bonds haven't really responded. Like when the market was going.
No, they haven't really responded. But right. you have to agree that and take out the rally up on the flight to quality on Thursday and Friday.
Yeah. Mm-hmm.
The bottom line is that after the market gave up whatever you want to say, $6 or $7 trillion in market cap. Usually, you recover some of the bond market. Usually.
Bond market's supposed to have a floor to it.
That's why the
market implodes.
That's why they have an inverse relationship.
That's right, and
in this case,
where is the plunge protection team, Sosnoff?
So in this case,
did Doge get rid of that too?
In this case, now you have something that I don't know if that I've ever seen exactly like this, but what you have is probably a destruction of wealth in the bond market of the last couple of days of probably about $5 trillion as well. Pretty close to it.
Yeah, okay.
I mean, it's
a little aggressive, but who cares? 4 trillion, 5 trillion.
It's a 10% move, almost.
Yeah, no, it's big.
Yeah.
Yeah.
So
and you usually have that, like you said, you have that inverse relationship.
Yeah.
So people will either park money and.
I completely agree. So you have this stock market,
You have no place to hide unless you go to cash.
No place to hide. And so the stock market, we've lost.
And the dollar's getting hurt. I mean, you're it's all over the place.
Today, the dollar's getting whacked.
Yeah.
But you have this $5-7 trillion of stock losses. You have $4-5 trillion in bond losses.
Hence scared.
Hence, even if they rally back now, bonds go back up, stocks go back up, nothing is the same. The entire world has essentially said, F the U.S., F Donald Trump. And because they've united together, which the scariest part about this for me is they have now exposed our weakness. Do you know what I mean? Like there's always been a time where the wonderful thing about what the U.S. had going for it for all these, I felt like decades, it doesn't matter who the leader was, is that we were never exposed. Because
we had 5% rates. I mean, you're almost 5% on the.
Of course.
We've had 5% yields in December of last year. I mean,
yeah, of course. I'm not.
I mean, it's not like we're not in like uncharted territory.
No,
we've never been.
Not at all. Not yet. What's scary is that rarely do we get both things to go in the same direction. Rarely do we get this kind of.
We got it on the same way. I'm sorry to interrupt you. We got it on the same way up. Let's go back years ago when bonds were trading the 150, 160, 170 level while the stock market was going higher. And we both talked about, and you said it on one of the clips that markets go to extremes. They go a lot further than you think they're going to go to the upside, a lot further than you think they're going to the downside. But we had bonds going higher, rates going lower, market going higher, step for step with each other. You may be in an inverse relationship here for a little while.
Yeah,
bonds go lower, market goes.
Yeah, I agree with that. But what I'm saying is we've been exposed. And the weaknesses, what the rest of the world never really knew. Here, I'll give you an example. Like, we all know that Putin's a creep, okay? Yeah. Always been a creep. He's a criminal. He's a murderer. He's always been a creep. He'll always be a creep until he dies. But nobody knew how vulnerable Russia was, how vulnerable their military was until they invaded Ukraine, and then they
should be a 3-day war, and
they were exposed as incompetent, as the just the sheer lack of discipline, the incompetence across the board, the unpreparedness of their military exposed Russia as this huge superpower. And it turns out,
knock them down a size a little bit, but they still have nuclear weapons. And
they still have nuclear weapons.
And this is a conversation
but what I'm
way
saying
outside
is,
my scope.
What I'm saying is they were exposed. When they went into Ukraine, they were exposed. The U.S. has never really been exposed before. And there was this fear around the whole world that,
Well, you could say the Vietnam War and stuff like that.
It's too far ago. It's too long ago.
Yeah. Well.
We've never been exposed. This most recent, which this is a self-inflicted crisis, because it didn't have to happen, has exposed us economically.
We asked for it.
What?
We asked for it.
Has exposed
the administration, the powers that be, the people that make the decisions. We asked for this. That's correct.
They've exposed the U.S. And what happened was now all these countries together have said, you know what? Because this is not.
So I asked you this question offline, and I said to you, so where? And I see the phone calls coming in: 855-238-2789 or 855-BTASTE. I've still got 4 or 5 lines open. Love to hear from you. When they light them up, when there's a couple more, I'll interrupt Tom and myself, and we'll go to your phone calls. I asked you this offline. I said, okay, so they sell our bonds. Let's say it's China, whoever it is, because it's not mom and pop. It's not the widow.
It's the totality of everybody out there.
Right. It's the totality of it. Okay.
Yeah.
How do they unwind? And where do they go now?
Who care? They don't care.
I see. I can't. I don't think you can answer the question. I don't think you can answer the question. That's how you answered it with me.
We were the single pool of liquidity in everybody's eyes. That's why nobody sold bonds until now. Now the entire world said, you know what? I really don't care. We'll put bonds. We'll go anywhere. We'll go to the European Union.
I don't. All right. Okay.
We'll go anywhere. It doesn't matter. But we're not going to support your markets. And
what are European bonds paying right now, Tom?
A little more than ours.
What's that?
They're paying more. There's just a different credit risk.
Right.
Yeah, I understand. But who knows what our credit risk is going to be now if we can't, our credit risks have gone, our credit has gotten worse, not better. But here's the other problem with it. What we've also done, and the reason
perceived to be worse, but yeah, sure, go ahead.
The reason we've inspired the rest of the world to sell all their U.S. assets is because.
But James, our producer, said he didn't ask for this.
The reason what we've done actually is we've also cost people all over the world lots of jobs. Not only have we cost jobs in the U.S., but we've cost jobs through all this tariff plans all over the world. So whether it's Vietnam, Cambodia, China, whatever it is. And so we're basically putting pressure on the rest of the world. For what? For what? We're already at the top of the food chain. So for what? So I don't blame anybody for saying, you know what? I don't want to own these bonds. Because I felt the same way about my Tesla. Mm-hmm. I don't want to own this. I don't give a crap if I sell it $10,000 below market. Okay, which I did. Mm-hmm. Okay, give me the only bid out there and I'll sell it. Because I don't care. And that's the same approach. Because it's optics. It's a statement.
That mentality is typically short-lived because that comes from a place of
it's an emotion.
Emotion, right.
Well, listen, there's
emotions usually run very high.
I got
and
that.
then money wins. I mean, in the end, money wins.
Here's the thing. So that's what you would think. So then you listen to just as an example, the Bill Ackmans of the world,
mm-hmm.
right?
Mm-hmm.
Huge Trump supporter, contributed to the campaign, and now all of a sudden,
money wins.
Still gutless because refusing to actually come out and call this administration out, but saying, "Hey, we need to do something." You know what I say to
because money's winning. I mean,
you know what I say to Ackman? F you, because you enabled this. Like, it's the same thing. I was on social last night, and I was listening to Dave Portnoy. You know, he does the pizza reviews, Barstool, sports stuff. And
just like those people who hate us, but they still listen to us. You get the people that love us.
I don't mind his pizza reviews, and I don't mind his his sports stuff, even though he's a there you go. Even though he's a Boston fan. But then he starts complaining about how much money his portfolio lost. How much money he's lost the last couple of days. You know,
money talks, Tom.
$10 million, $14 million, whatever the total number is. And he's bitching and complaining because, like, I didn't sign up for this.
Right.
Yeah, you did.
Yeah.
You did because you enabled a senile, incompetent fool with economic policy that has no right to be there. That's it, period.
True.
This is a disgusting display. This is a disgusting display by our country right now. That's all it is.
But loyalty runs deep, Saad.
Loyalty?
Yeah,
loyalty. They're already like rats on a ship jumping overboard.
I agree with you. You'll always have that. I mean, you know, I shouldn't probably say this out loud if the JJ's listening, but I would do this for free if you asked me to do this for free.
So here's what happens. Good people do good things, and that's why they're good people. Okay? Bad people do bad things, and that's why they're bad people. And I have a hard time understanding how good people can think that somebody who's done what this administration has done is good people.
Maybe we were on an unsustainable path. Maybe those jobs in Cambodia and here and there. Why are we supporting? Why we're so righteous? Why are we supporting sweatshops so we can buy products at
it's not a function of sweat.
At a cheaper price?
Assume it's not a sweatshop.
Assume
it's not a sweatshop. You're saying it's a sweatshop. What if it's just a regular manufacturing plant owned by a U.S. company?
Because their cost of living and what they make is not.
It's not a sweatshop. It's just that's life. Okay, they like what they're like.
You can't.
But I'm just saying you're saying it's a sweatshop. It's not a sweatshop. Just say it's a regular manufacturing job.
But it's. I don't believe it to be that way.
Well, that's a ridiculous. That's just.
Well, you can look up like what.
That's
what
just
Nike
a conspiracy.
Pays
That's not. There's no validity to that. You can't say.
Well, you can look it up.
Just because somebody has a job somewhere else in the world. Because somebody has a job somewhere else in the world does not mean that they're working in a sweatshop. The fact that somebody has a job somewhere else in the world, they could have a real job.
They could, but with that assumption, if they have a real job, they could have sweatshops too, right? I mean, you have to give me.
Of course, there could be, but that's not where most of the people don't work. Most of the people in the world don't work in sweatshops.
I think most of the stuff you get from Temu and everywhere else is from.
You don't know that.
I do not know that, but I could research it if you. I'm not prepared for that. That's not my.
That's a ridiculous assumption.
That's not my forte. That's not my area.
Of course, but that's a ridiculous assumption.
Why is it a ridiculous
because
assumption?
People all around the world have jobs.
You don't know the opposite. You don't know that it's a good paying, fair job for their economy of what they live in.
All over the world have jobs. Don't assume people are all in sweatshops. I mean, that's ridiculous.
Agreed, but there has to be some.
Who cares? So what?
You can't say who cares so what when I make a point. You can't do that.
It's not a. Okay. What do you want to say?
So my point is, maybe this was unsustainable. Maybe that we're us getting cheap goods when we're so righteous that we want to make sure we have human rights everywhere else. That maybe this is something that needed to be done. Maybe this was an unwind that had to be done for 30 years ago. For 30 years, who knows?
What needed to be done?
Maybe we needed to bring the jobs back to the U.S.
What jobs are you bringing back to the U.S.?
Oh my God, you won't see these jobs for 15 years if you even want to get them. By the time they pick a facility to build, where to build, how to build it, get it done, go through the permits, it'll take decades. I understand that point.
I hate this argument because there's not a single thing to support any of it's true other than this is a pure racist argument. It doesn't. It's a.
All I'm saying is this might have been inevitable to happen, and he's just this administration is the one that made it happen. Maybe it was inevitable. Maybe we've been leaning and teetering for decades, and it finally came to fruition today.
I don't even believe one bit of that. America's been exposed, and that's why our bonds are down 3 points today after being down 3.5 points 2 days ago.
At a 5% interest rate. The two of us have seen 20% interest rates on 30-year bonds.
Sure we have.
Right. It's 5% right now.
But the fact that we've seen 20% interest rates in 1979 has nothing to do with 2025. And in
No, of
2025,
course, every situation is different. All I'm
and
saying,
why should
relatively,
why should we say that
the problem I see is, everybody's talking about interest rates being brought lower. You're not getting interest rates brought lower with bonds at 113, 114, 111. That's not happening.
Oh, they're going to raise rates here, and we're going to talk about that as the day goes on. They're going to raise rates.
Yeah.
But the only point I was trying to make is, you essentially, in America right now, you essentially got what you paid for. There's the interesting.
Yeah, absolutely. And I don't know why you.
Interesting.
You didn't know what was going to happen, but yeah, he's done so far. He's been a man of his word. He's done everything that he campaigned for, pretty much. Now, nobody knew what the market was going to do. Nobody knew what the bond market was going to do. But he's pretty much. He is who he says he is.
I could not disagree more. I could not disagree more. But what's interesting, just because you said you're going to do tariffs and you implement tariffs, you can't. What's interesting about Trump is he can't even articulate what these tariffs are, or why they are what they are, or why they're in place. And beyond that, the people that supported him can't even articulate why these tariffs are in place. And now they're all. So I wonder if he went out right now and asked Elon Musk, who supported him, and says, "No, these tariffs are horrible now, and Navarro's a complete moron." Or what if he goes out and asks right now Bezos and Zuckerberg and everybody else, "Hey, do you think this was a good trade? Do you think our stocks being down 40, 50, or 60%, in some cases 70%, do you think this was a good trade for us? And do you think those guys are happy that they supported him with dollars? Do you think they're happy that they sold out their own ethics, that they sold out their own morals to support a creepy, senile criminal who's completely incompetent?" No, I'm sorry. The damage here is done. And you know this. It's just like an injury in sports. If you think you can come back from this, we're damaged goods.
And yeah, it definitely changed.
We're damaged goods.
No doubt about it. Now, you may not have the arm strength you had before, but you're going to have to get the foot speed. You're going to have to do something, and we always do. And that's the way I think it has to go for us to be.
I think especially financial firms were incredibly selfish when it came to, what they were looking for out of this administration during the whole process of, the whole election process. And that's why firms like Robinhood and Interactive Brokers and Schwab and a lot of firms that we compete with, Kalshi, and they all came out and supported Trump and supported all these ideas. And now all their stocks are down by 30, 40, 50, 60%. And they also sold out their customers because their customer balances are also down by 10, 15%, whatever the market's dropped by. So you know what? I say F them all, because you know what? They were not true to the things they believe in. That's the difference here at Tasty. We stayed true. We never supported that creep. We never supported any of those policies, and we stayed true to our customers. And that's important. And I don't think enough people talk about that. I also think the damage at this point has been done. Like what we saw last night.
Well, time will tell. You don't know. I don't know.
Of course
Nobody knows. You could talk about these companies being down 40, 50, 60%. How about flipping that same coin, what you just said? You're finally getting the billionaires, and maybe now the working person, the working man and woman can benefit from a market that's more in line. I mean, there's two sides to every coin. Is all I'm trying to say.
My bigger concern.
It's all I've ever tried to say on this network.
My bigger concern is you have somebody who is currently leader of the free world, who is not qualified.
He wanted to kill the billionaires. He's killed the billionaires.
He didn't want to kill the billionaires. But you have a leader of the free world that's not qualified to be probably the caddy master of his own club. And that's the scary thing.
With Biden out now, and an old...
Biden's been out for a long time.
Right. And his last year, did you feel that he could be a caddy master at a country club? Or do you feel that maybe the people around him, almost a la Bush, would protect him and make him make good decisions?
First of all, I wouldn't compare one to the other, but in the case of, was he a good
I was comparing their administrations.
I felt a lot safer with Joe Biden as president than I do with Trump.
But you didn't think he could be a caddy master in his own?
He wouldn't be my choice.
He wouldn't be your choice. Fair enough. That's all I'll take. 855-238-2789. I feel like I got a big win. I'm going to end on a big win. I'm going to go to my first phone call. We have phone lines. We have phone lines open. Agat Singh. I'm sorry if I butchered it. In Chicago.
No, you guys can hear me?
How are you?
I'm good. I'm doing good. How to pronounce the name is Ajit.
Sorry about that. I apologize.
No. Your political rant this morning made things so spicy. I'm fired up right now. So I had to write down my questions because, quite frankly, I couldn't remember them. I kind of wanted to get into it, but nonetheless, here we are. All right. So I have a two-part question, and maybe a third if you guys have the time. But if when you guys are trading iron condors, short iron condors, or short strangles, okay? Number one, in highly volatile markets like we have right now, what I like to do is I like to take the daily implied move, multiplied by 1.5 or 2 times, and basically set my short strikes that way, either on a strangle or on a short iron condor. Now, typically, I've seen this works really well, but how do you guys feel about that? Or do you guys have better ways to optimizing that in terms of 1.5 or 2 times? Because I will tell you, the past couple of days, I was getting close there. One side being hit or not. And then the second part of the question is, do you ever trade the middle? So, for example, let's take SPX. Okay, so if you're short in a strangle or short an iron condor, do you ever go long or short, long gamma, long calls or short or puts if one side is close to getting hit?
So you're saying you put a trade out at a standard deviation or a little bit outside of a standard deviation. You get to that level, and then let's say we're going to the downside because even the S&Ps are down 100. Do I ever buy a put at that point?
Well, if you see a direction, let's say, for example, okay, now I put on an SPX iron condor, a short iron condor, okay? So it's a heavily volatile market here. So what I will do is I'll take the daily implied move, I will multiply that by 1.5, and I will take the spot price plus that 1.5 and then minus that 1.5 and set my short strikes there.
I have no problem with that. That's perfect.
We're totally fine.
We do that. We do that type of trade.
I go 2 times the expected move all the time, especially on binary events, like an earnings play or something like that. But on a daily stuff, if you want to go, my default on daily stuff is at the expected move, and because volatility is so high, the expected move is pretty big right now. But if you want to go 1.25, 1.5, or 2 times the expected move, even on daily, that's totally fine.
Totally fine. But do you ever trade the middle via long options if you are looking to go direction? If the market is going direction, let's say it's going down, do you automatically, or would you automatically buy puts there just in case to protect that downside if let's say you're short strangles?
No.
I generally don't, but you certainly could.
Okay, gotcha. And then my final question is: so on the Thinkorswim platform, you guys give customers, or when you guys were with Thinkorswim, you guys gave customers access to Bookmap and then also the Live Squawk, which saves customers hundreds of dollars per month. Are you guys looking to get that in Tasty Trade?
What did you say? Which one? Which one?
There was a Bookmap and also the Live Squawk.
Live Squawk and
the live.
And Thinkorswim platform.
Yeah, the live Squawk. You mean do they still have that from the CME floor?
Oh, they not only do they have it, it saves hundreds of dollars. I don't have to subscribe to Benzinga now.
Yeah, so I was the one. I'll tell you a funny story. So I originally put that in the platform back in. Man, I don't even remember the year, and we hired this kid. He was on the floor of the on the CME. I can't remember his name right now. Was it Ben something?
Yes.
But it was the original. I put that in the platform because I thought it would be really cool. There's really no more floor left, so that's why we took it. That's why we don't have it on Tasty, because there is no real trading left in Open Outcry.
No, but there is a Live Squawk though. It's a Live Squawk similar to Benzinga, but this is even better because it's so customizable too. There's a British guy speaking all the time. He drops a couple of F's now and then.
Yeah, I mean, you know what? Back then, the reason we did it in the early 2000s was because there was order flow that was coming into the trading pits, and we thought it'd be fun if customers heard the stories. They could see the order flow coming in the pits and moving markets and stuff like that. But that doesn't exist anymore.
No, there's a news squawk is what I'm saying about live news squawk.
Oh, news. Oh, you're talking about news squawk? No, we have no interest in that. That doesn't. Okay. Yeah, that doesn't. That's not interesting to me. I mean that. Okay. I mean, we have Tasty. What do we need news squawk for?
Yeah, I am your squawk. What do you want to hear?
Yeah, come on. Why do I want to listen to some Yahoo talk about news? I can just go get Vecchio if I wanted that.
Fair enough. And what about Bookmap? No Bookmap either?
No, which one?
Bookmap. That's the liquidity order flow tool.
Liquidity order flow tool.
It's called Bookmap. Yeah.
I think he's talking about the spread book or something.
You're talking about the spread book?
Correct. Yep.
Oh yeah. Again, you got to remember, I put those in the platform because I built both of those
30 years ago.
I put those in the platform 25 years ago because at the time you couldn't. You got to remember, this is before spreads were officially offered, through a spread book on all the various exchanges. So what we did was we built a mechanism to allow customers to see what was working in the platform from the spread side. And then eventually, in one of the spread books on one of the exchanges. But that stuff's outdated now. It doesn't. I mean, I'm glad you like it, but it hasn't been useful for 15 years for us because there's so many different spread books, and and everything's so fast and so electronic, and virtually no orders end up going to the exchange floor before they get executed anymore. The entire business has changed. I wrote that.
That is one of the most highly subscribed to platforms in the world today. I don't know if we're talking about the same thing. Go to bookmap.com, and it is a incredibly useful tool.
Okay, I'll check it out. Maybe we're talking about two different things.
Okay, and final question real quick. How do you guys like, or what do you guys think about thoughts on the prop firms these days, like Top Step or Apex or something like that, to enable traders into the futures market, but they're on sim accounts though?
Yeah, I mean, we don't like it. We also think the regulators are going to shut that down, so I don't like it. I don't think. Fair enough. I think the exchanges are working right now to get that all shut down. I don't think that has any long-term viability.
Gotcha. All right. Thank you guys for everything that you do.
Okay,
I'm
thanks.
a big
Thank you, man.
fan, so thank you.
Thank you. Good luck to you out there.
I don't know that piece.
I don't know
of
if we were
technology.
talking about the same things there.
Something called Bookmark. I got to look at it. I'm not sure what it is.
I just looked up bookmark.com. It wasn't what he was saying, but I don't know.
I got to look it up.
855-238-2789 or 855-BE-TASTY. If you were on YouTube and you couldn't chat in or something, just refresh your chat. It should be there. Drew in Pensacola, Florida. What's up, Drew?
For having me on here. I love your guys' content so much. Just a quick note, he was mentioning book map, like a map.
Got it.
That's that's like order flow sort of stuff. So my question, this is my first time like in a major correction with a significant amount of capital. I'm new to wheeling, selling options. I've studied price action for the past 2 years and everything. And my question is how, should I be waiting for some sort of signs of some sort of supports? The sell-off is quite significant, and the velocity of it is quite strong. And should I be waiting for some sort of larger supports to be put in place before I start writing some puts and stuff like that? And how much of my portfolio should I be allocating to more risky, let's say leveraged ETFs and stuff like that, compared to stocks that I actually want to own if I get assigned? Sorry if this question is vague.
I don't.
You know what? I think that Drew.
Yeah.
There is no bell, right? So this is a tough one because I mean, there's a lot of times when I feel like when the market's going up, we've reached a level of what you would call resistance and what I would call price extreme, and yet it goes on for another month or 2 months. I think there's times when into this down move where Tony and I both would have felt look 5,200, 5,100, 5,300, 5,000, that all of those would have been really solid levels of support, especially, like double bottoms and all this kind of stuff. I think one of the things that we learn when we see moves like this is his question was, how do you know when you're at like,
got it. Oh,
and I think, Drew, that one of my takeaways from this move in both the bond market and the stock market is that you can I've never seen a better case for throwing fundamental and technical analysis out the window.
Right.
Because you can say anything that you want about fundamental analysis and you can say anything you want about technical analysis. Everything has been completely, cyclical analysis. You can throw it all out the window. And I don't really think when you get markets like this, it kind of normalizes everything because nobody really does know. And I just don't think that's possible. I think there's at some point you have to get to a level where you think, you know what, I just like the risk reward here. And that's what I am. Like I'm gonna probably buy a little Apple this morning if I can get it, in the 160s.
But wait a minute, we cried on the way up and we cry on the way down because we're traders. That's what we do.
But he's asking how do you know? Right. Like I don't know. I'm saying I'm probably gonna buy some Apple on the opening today at around 167-ish if it trades down there, or 167.5. I have no idea if that is a good stopping point. If that's a good support level for Apple, I have no idea. I just feel like I'm risking $2, but I can make $6. So that's why I like it at these levels. So I think that's how you have to look at things. It's a little bit different than maybe a more traditional way of looking at it. Does that help at all?
Yes, absolutely. And thank you. I'm just sitting on a significant amount of cash and I'm just not sure should I be utilizing all this cash right now to start generating some premium, or, should I be
Sir, jump right in. The water's fine. You too could be as miserable as me. Get the hell in here, man. What you waiting for? Sitting on significant cash? No, listen, all kidding aside.
Sure, why wouldn't you?
You gotta dip your, you don't gotta. I said it yesterday when we were higher. I said it yesterday when we were near the lows. I'll say it when we're at the lows now, new lows, lower than before. If not now, when? I don't say jump all in,
right?
But if you've got 60, 70, 80% in cash, I think you kick yourself if you don't do anything. You never kick yourself if you do something. If you go in with 10, 15% and you nibble on some stocks to the long side by selling some puts further out of the money, and they go against you and you lose money on that, you say, hey, well, I put 10% in, it stinks, but I like these companies and I got them 30, 40% cheaper than I thought I was ever going to get them. And if you do that, I think you're happy, and you will kick yourself if we are higher and say, I only put 10 or 15% in the market, but at least you did something. The worst you can do is do nothing, in my opinion.
100% agree with Tony. The worst you can do is do nothing. This is the kind of market where I'm doing it myself right now. I actually talked myself in just buying some Apple at 169 pre-market because I feel like you don't have to go. This is not an all-in market right now at all.
I'm not Euro crap.
But it's a market that I like the risk reward, and that's just how I'm leaving it. Thanks, Drew.
Right. Yeah, thank you so much. Love the content and hoping patience and discernment for everybody in this time.
Thanks, man.
Thank you, man. Really appreciate it.
Take care.
Take care. Bye. You too. 855-238-2789 or 855-BE-TASTY. Come back to Chicago. I got Mohammed in Chicago. What's up?
Hey, guys. I'm your truck driver friend, and I just went past your office on 96 in the morning.
Oh, very nice. Our old office. Our old office.
That's the old office, because I looked it up in Google, and I was like, a few feet away, like a few hundred feet away from your office. Went past that.
Was there a big cherry on the building?
I didn't see it. I was on 90, so I didn't see it. But I saw it on Google that I'm really close to you guys.
Yep.
You're in the neighborhood.
Yep.
Got it.
What's up?
Oh yeah. So I was almost scared to call. I dialed twice and then I hung up because Tom was so angry. I was like, I don't know whether I want to be on this call.
No.
I'm not angry.
No, never feel like you can't call. He's not angry.
Yeah.
We'll have a conversation, and 2 minutes later, it's about something completely different. I mean, you're allowed to have opinions one way or the other.
I get angry sometimes. Yeah. I get angry at our industry because I feel like they're gutless. And I feel like there's a certain amount. At Tasty, we work really hard goodwill-wise. We do stuff that nobody else in the world would do. We'll spend our entire day today just talking to customers all over the world and answering emails to customers all over the world. We don't ask for anything. And yet the rest of the industry is a bunch of greedy MFers who don't give a rat's ass about anything, who helped to define this policy and who helped to support this guy. And I feel like it's just a waste of time and money. And I think it's time that everybody in this industry just steps up and provides a little goodwill.
I totally get that, Tom. But don't you think that there's a possibility? Look at the brighter side. It's a financial regime change, and maybe there'll be more people like come out of this rubble or this destruction who are more Tasty trade like than the ones who are in charge right now. I mean, there's definitely something inherently wrong with the system for it to break down like this, right?
Sure. Well, and you're right.
That's the half full. That's the half full argument. That's the
you're
argument
absolutely
I try
right.
to make.
I'm a positive drift guy. And at the end, when it's all said and done at the end, everything's always going to be better. Like there's never going to be a time when we're going to, we're not going to put ourselves in a position where
there's two sides to this market. You can get shorted too.
We're not going to put ourselves in a position where everything goes to hell and nothing ever comes back. Everything's going to come back eventually, and it's going to be stronger than ever. But you don't need to put yourself through this. That's all.
Exactly. That's beautiful. Now, my question is, I already know the answer to the question because from my military days, there was a master sergeant once teaching people about landmines, and one of the soldiers asked a question. He said, "What's the procedure if I step on a landmine?" He said, "The procedure is really simple. You go 6 feet up in the air and come down in 30 pieces." So my question is, my short put spreads, which are deep in the money now, what do I do with them? Do I let them expire, or do I sell them and come back to fight another day?
So
we both have thoughts on this. I'll let Tony go first.
So I'm going to go twofold. You said they're deep in the money. Volatility is higher today, and I know it's going to be a small positive, but that spread, let's call it $5 wide. That spread that, should be trading at $4.85 because it's so deep in the money, and the probability of the stock getting back up there, because if volatility was less, is so small that spread's going to trade basically for a full loss. That spread at $5 right now may be $4 or $4.10. Now, you can look at that and say, well, this is the benefit of high implied volatility. I didn't lose an extra dollar on this spread. I can close it and do something else. At this point, at those numbers that I just put you, I probably would sit in the spread because, man, it looks like anything can happen here on both sides of the market. Tom, I'll let you answer.
I've received a lot of emails from customers, again, all over this country, all over the world. And my response to this is whether it's a deep in the money put spread or a deep in the or deep in the money puts at this point. There's three ways that we approach this. And again, because the market's moving around so much, if you wanted to wait a couple of extra days to see if there's, a bounce or something, I'm totally fine with that. But what I've been recommending to everybody, and I've been very consistent about this, is if you can, I think the most important thing to do is when you get a chance to reduce a little bit of the size of your positions. And there's a reason for that. Because if you reduce a little bit of the size of your positions, it frees up some cash so that you're not forced into a situation where you have to decide what you want to do. It gives you more optionality and a little bit more flexibility. That's number one. Reduce the size, just get a little bit smaller. The second thing is, if you like the position, try to roll it forward, even if it's for a debit, whatever it is, or if it's an in the money put, roll it forward, just so you don't have to deal with being assigned the stock, and so you can hold the position a little bit longer to see if this market straightens itself out. If it's something that you're not sure about, you don't like, of course you can close it. We also are very comfortable selling calls if there's any premium anywhere up and around those strikes. So like, for example, if you're short a put spread and it's in the money, because volatility is so high, you might be able to sell a call spread above it and collect a little bit extra money. So there are some options. Reduce size is my number one thing. Roll out in time to buy some duration is my second thing. And then my third thing is to sell an opposing call or call spread against a short put or short put spread. On a short call, you can be inverted. On a short put spread, you can't be inverted. That's the only difference.
Got it. Thank you, guys. Thank you very much.
Yep. Thank you.
And again, there's no Magnificent 7 anymore. There's no Mag 7 anymore. So we'll probably have a new Mag number, and most probably Tasty Trade's going to be up there, and they're going to be good people that are going to come out of this.
100% agree with you, my friend.
That
feel the same way.
Mohammed, that we all agree upon.
Yeah. So let's not be angry, Tom. Let the dust settle down. Let's see what happens.
Here's the thing. I'm angry that we got here because it's all about greedy bastards that got us here. And I hate the fact that everybody's so damn freaking greedy and we don't have to be here. Like, it's one thing if it's natural causes, it's organic. It's another thing if it's all done by greed and by ego, by spite. That pisses me off.
Okay, Tom, I've heard you on this network when we've had other financial.
Hey, listen, I'm allowed to give my opinion.
100% in 2008 and other years when you would talk about how we should just let the market be what it is, burn the forest so that we can be a better place tomorrow.
100%. This is different.
No, it's never different. And because I've always heard you say that too.
Exactly what it is. They're burning the forest, Tom. That's what they're doing. They're burning them.
You're doing exactly what you asked for. You just don't like. You just don't like the messenger.
You burn the forest down when you have to. You don't burn the forest down.
What was any different? 2008, we were at the top of the world there too.
We weren't.
Who's ever been on top of the world before, other than us for the last 75 years?
There's a difference between pure stupidity as the driving force and economic cycles as the driving force.
What happened to nobody knows nothing?
That's the difference. Listen, you could believe what you want to believe. I'm telling you what I believe.
Exactly. That's why
there's
the part that I play.
That's why there's a market.
You're a good man, my friend. I hope we meet someday.
All right. Thank you. Thank you, guys. Bye.
Even the S&P's down. I haven't talked about the market here at all.
It just rallied 20 handles.
Yeah, even the S&P, which means nothing. I mean, listen, we rally 20 handles today with volatility, up to 35 today, 32. Now 20 handles means nothing. I watched them yesterday go 20 handles at a clip. You watched them all night long going 20 handles at a clip. But anyway, even the S&P's down 80. NASDAQ down 208, Russell down 40. Russell, the weakest of the group, continues to be the weakest of the group, and I mean of the four between the Dow, the NASDAQ, and the S&Ps. Dow down almost 2%. That's $700. Volatility up 90 cents, although it is off of its highs of 35. I don't read anything into that.
I don't read anything into that too. Can I also say that crazy move this morning in. Did you say crude oil? Did you get that?
I have not. I was getting there, but you interrupted me. Crude oil, $56.
Yes, crude oil, $56. And there's one other thing. So I've been trading some NASDAQ futures all night long.
They were talking about potential wars the weekend that you were gone. You would think that would be, people were writing into me, isn't that going to be bullish for oil and everything like that? I said, listen, I don't know what's going to happen.
I don't know what war they're talking about, but sure.
Me either. But I mean, listen, people have an assumption. I mean,
all I want to say is I've been trading NASDAQ futures all night. And I have a couple of thoughts about the way markets are trading right now. Number one is, if you're trading NASDAQ, first use the micros.
I'm almost on ESA. I've been waiting for the pump prices to come down to fill up my tank. That hasn't happened.
I can't believe they haven't come down. But anyway, NASDAQ futures, I've been trading them all night, and I've been up like 100 points and down 100 points.
On the same trade, you're saying?
On every single trade.
Sure.
And
that's why you got to trade a lot smaller, and you've got to open up your parameters.
And I've waited each one out for until they go your way.
That's why they call you the Great Eight.
Yeah, the Great Eight. Yeah.
We're gonna go to Mark the trainer in Cocoa Beach, Florida. What's up, Mark?
Oh my God! It's time I call in. All right, I got 3 points and a question. Number one, having this extended call-in session shows what a class act and the integrity your company and you guys have above and beyond everybody.
Thank you,
okay,
Mark.
it's a really great thing you're doing. Phenomenal. Point number two, Tony.
Yes, sir.
Never go against the creator.
100%. I'm not going against the
Point
creator.
number-
He's allowed. He's allowed to have.
I try to bring the other side because I think it's fair. I mean, I can't be Dylan
All right.
Radigan and sit here all day and agree with Tom for an hour and let Tom just spew BS, whatever it is. This is different, that different, change this, it's not the same. I can't do that. I'm not Dylan. Dylan's great at that.
Okay, point three. In your defense, Tony, you'll know Rockefeller Center, they have that atlas holding up the world. There's a principle, a concept, some kind of idea called Atlas Shrugged. Look into that.
Okie dokie. Thank you, brother.
Okay. Point number four. Tony, you did on your show on Tuesdays and Thursdays.
Yep.
You did a trade on the SPX. Was it Broken Wing Butterfly where you're
done a few of them.
Okay, it was an SPX where you bought the market maker move. You sold 52 of the 50 difference, and then 100
right, I went
after that.
Right, I went
Okay,
1
now,
by 2 by 1.
What
yeah, good.
Yeah, 1 by 2 by 1, but the back end was twice as wide as the first. I did those trades a day later. Okay.
Oh, you did them way better than me, and I apologize that I even showed you that trade. But go ahead.
I just want you to know on 4-7, I opened up a trade, and on the call side, I took a 480 credit, and on the put side, I took a 460 credit, and I closed them out the next day because we had the rally.
Yep.
At 50 cents and 350, so I made
nice work.
Really good.
Nice work
on those trades.
Better than me.
Now, when should you look into taking profits on or losses on that particular trade? And if you could,
I look at it as a defined risk trade, and like most defined risk trades, this one's all on one side of the market, it's not both sides. You pretty much make your bet on entry, especially in the type of markets that we have right now that don't give you any time to do something about it. If we were in normal markets where we were moving around 50 handles a day, I would probably answer that a little bit differently. I would say you have a $5 or $50 wide call spread that you can sell and not use any additional buying power. I would look to sell that call spread. You can still do that today, but I've had hands in pockets and I've paid the price for it.
Yeah, so basically on a 940 credit, I covered for $4.
It's great. Great trade.
Yeah, it was great. Do you see anything happening? You know, what should I look for in something like that today? Because I'm comfortable in those type of trades. You know, I got plenty of buying power and stuff like that.
Well, you know, if you've been watching my option trades today for the last week and a half, they've all been horrible trades. So I'm gonna call you up after this is over and ask you what to do. Because I haven't been right.
I'm going in a day later.
Well, I'm gonna do my option trades today from now on Wednesday and Friday, so I'll get better pricing. I'm gonna let you go, my man. Great phone call, and I appreciate all your continued support.
Thanks, Mark.
All right, thank you, guys.
Thanks, Mark. Thanks.
Be well. Bye.
North Carolina, Jamie in North Carolina, what's up?
Hey, good morning, guys.
Thank you for everything you guys do. I have a question around collars.
Sure, go ahead.
I'm primarily trading in a cash account and a retirement account. So I don't have margin, and I've basically been assigned a few stocks that I've been okay to hold during this period of time, and I've been selling calls, and I've been doing okay. And then I've been dipping my toes and doing collars on days that, just out of pure luck, there's been a lot of velocity and moves.
Yeah.
So I'll take like $1 or $2 out of the collar, and I'll close it. I'm not really using any like specific strategy. I'm not looking at expected move for the day. I'm just getting lucky. And with everything going on, so I'm putting it on in the morning. I might close it by the middle of the day as long as I've made something out of it.
Sure.
Do you guys have research or thoughts on, like, is there a more mechanical way that I should be thinking about it? I'm trying to use up that call premium and do something cashless.
Yeah.
And it's working, but it's only been tests, so I'm not as confident with it.
You know, the whole thing with the cashless collar like that is that you don't have a lot of options usually, because what we shoot for is, I mean, and again, especially these kind of moves, but I don't think it really changes regardless of the scenario. We shoot for as wide as you can go to get as long as your net credit. So some people prefer the bigger credits. We prefer the width over credit. So, but it's got to be a credit. So when we're doing a cashless collar, which is not, I have to tell you, I've done like 2 cashless collars this entire year. So I don't do it very often. But there's 2 approaches to a cashless collar. One is to keep your call a little bit closer, so you have a bigger credit, and you move your put a little bit further out, so you just have a bigger credit. And the other one is to take a lesser credit, but move your strikes wider. And we usually opt for the wider strikes and the lesser credit. But whatever's been working for you, I would stick with that. There's no real mechanics around a cashless collar, because usually there's only like 1 or 2 choices that really make sense.
Got it. So interestingly enough, when I did like the first few, I went for bigger credit, closer to at the money. I can't even recall exactly.
Yeah.
And then I got burned twice, and then I've gotten wider, and it's been way, less credit, but a lot more comfortable.
Well,
I appreciate that.
That's the way. That's the way we do it, Jamie. We always go a little bit wider. You know what? The extra cushion, it's worth it for peace of mind, not having to deal with having to worry about adjusting. And I think it's just easier to make a little bit of money when you go wider.
Yes. And thank you so much. That's my question. I just had like a thought, and I don't really have it like all constructed, but I've noticed in the last couple of years, in the last couple of decades, when we've had these type of issues, whatever you want to call them, there's been a lot of commentary about how time has shortened, how we've sort of jumped back quicker than expected when we look back historically on different crises.
Sure.
I'm curious, are you guys thinking in terms of, like, again, nobody knows what's going to happen tomorrow, and these things are pretty structural on some of the stuff that's happening. So who knows how long that takes, but do you think of that? Do you think of the factor of time, how easy financial markets are to access today versus, 30 years ago, 20 years ago?
Well, I mean, of course.
Because I think about that.
Of course. There's more liquidity today. There is more urgency today. Everything we do in today's world is shortened, and it's quicker. And I don't think
even my Saturday nights.
I don't think that people have the patience anymore. They don't have like a 1 or 2 year perspective. They have a 1 or 2 month or week perspective.
Or a minute.
Yeah. So I do think you're right about that. And I don't think that, I think the last time we've seen anything that's really been drawn out was probably 2008, 2009. And every other sell-off since then has been relatively short-lived. I would think that we're thinking the same thing here. Like, I don't think this is going to be, I'm hoping this is not going to be, months and months and months and months. I'm hoping it's going to be short-lived. We normalize, maybe over the summer or something. I just think there's some internal damage that's been done, but I don't think it's going to be, I'm not looking at the next 6 months or 18 months and thinking, we're going into this prolonged bear market type thing. I don't see it.
Gotcha. Well, thank you guys. I appreciate it. You guys are awesome.
Sure. Thanks, Jamie.
Thank you very much. Appreciate it. 855-238-2789 or 855-BE-TASTY. We go to Atlanta. I got Steve. Steve in Atlanta. Thank you so much for holding.
My pleasure, guys. And let me go on record as saying I think you've got Tasty Trade is the best brokerage, and you guys have the best content, and I'm not here just schmoozing. Y'all are the best on the planet, period, for what you do. Go on record as saying that. Tom,
Thanks.
You were the great disruptor when it came to forming Thinkorswim and then Tasty Trade. You're an innovator. You're a survivor. So hear me out for a moment.
Let me add, I get to fit his head through the door every day. That's my job. His head is so freaking big that I have to squeeze it through the door, and I get to do that every day. It's been a pleasure.
Don't listen to him.
Please continue.
I completely understand. All right, so let me propose something, or let me just give a different perspective, if I may. And
sure.
Trump is the great disruptor. Good, bad, or indifferent, whatever your political leanings are. You were, in a sense, a disruptor, and you've made a very big success, and you've helped the brokerage market evolve into what it is today, and I'm grateful for it. I think you've done the public a huge service.
Thank you.
Your mantra is mostly selling premium. We do strangles, we do condors, et cetera.
It doesn't matter. I understand.
It doesn't matter.
Sure.
All right. So my point is this. And you're a smart guy, and you and I are not that many degrees different culturally. That's all I got to say about that. So here's my thought. Let's say Jeff Bezos decides he wants to get into the brokerage world, and he figures out a way to do what you're doing, and in some fashion is able to get a slight leg up on you in whatever way he's able to do that. He's a great disruptor as well.
Sure.
He goes to China. Now, he changed our entire economy by going to China, sourcing products in China, and offering them for sale on his platform. It comes to your home in minutes, and it's cheaper than you could do by going to Nordstrom or any mall on the planet. If there was a brokerage that came, or just Jeff Bezos that came and he one-upped you in some fashion, I bet Tom Sosnoff, and with the help of Tony, because you couldn't do it without my man Tony, would figure out a way to fight back, to adapt, and to survive and win. So my point is this. If Tom Sosnoff was running Tasty the way the U.S. government runs its budget, you would make some serious changes to the way you do business, and you'd figure out a way to make it work. So Trump, good, bad, or indifferent, again, has looked at the eye of the tiger, in this case, China, and he's decided, or the rest of the world, he just decided, I'm tired of running a deficit. I'm tired of making my children, my grandchildren, my great-grandchildren have a deficit to look at for the foreseeable eternity, and I want to start having money coming into my business as opposed to out. So I want to change the dynamic. What he's done is he's turned the world upside down. I'm not saying he's done this in a very elegant way. He's definitely effed up the markets. But my point is this. You would change if you had a threat to your business model, and you'd figure out a way to make it work. You would also, I'm thinking, and this is what I'm waiting to hear, you guys sell premium, you stay market neutral, which is fabulous, and I'm in love with your whole mantra. Isn't there, looking outside the box just a little bit, because you adapted from the floor, being market liquidity providers, you came into the electronic world, you found a beautiful way to help the world make a living or to have passive income. Can't you look at a different method to adapt? And let's say this lasts for another 5 years. Isn't there another strategy or just a way of looking at the market, whether it's buying poor man's covered puts or doing something where you're buying a little bit of premium, something to adapt to this condition, because you're a survivor, you're brilliant people, and instead of whining, and I'm not saying you're a whiner, but I understand you're pissed, I'm pissed, everybody's pissed, to make this work for us, for you, and to adapt to the environment that we're in. You guys are awesome. Love you both. Y'all are the two, the couple that makes it work. You're like mom and dad, but just in with the same color shorts. But anyway, love
Thanks,
you guys.
Steve.
And I'll just shut up and listen.
Totally agree. But like kindergarten, I have to play the man going into the house. Sosnoff has to play the woman. Okay.
Steve, thank you. It was very well said. I have a long rebuttal to that, but I'm going to spare everybody right now because we got a slew of callers. But hopefully we'll get it. Hopefully we'll get to it later on. But I appreciate you calling in. Good stuff as always. Thanks, man.
Okay,
thank you, sir. I believe we're going to Ohio. I got Jeff in Ohio.
Hey, TNT, how are you monkeys holding up?
Monkeys are holding up good, man. Swinging mighty low right now.
Jeff, it's been a long time. Thanks for calling in.
And blessed Beth, hello, and to my team.
We're all still here, man.
Hello, Jeff.
And to my Team Theta cousin Sharkman out there in the weeds. Hello.
Absolutely.
It's been a while
it's
been a while since I heard the Team Theta, but I miss you guys.
Yep.
Oh, I miss him a lot. I'll tell you that.
Yeah, I'm sure.
Last night about 3 o'clock, just before 3 o'clock, I opened it up. I turned on Bloomberg and Dow's down 500. NASDAQ about 250, S&P about 80. Yeah, and I go over to programming and watching replay a football game at 3. I come back during commercial and everything is up.
Yeah.
When Europe opened, everything was up.
Right.
And then, of course, China retaliates and we got what we got. But here's what I've been doing lately. This is like not really the hasty mantra, but I've been buying some leaps on the XSP, and I got these are 5,600, and I got some of them below $20 the other day. And what I've been doing is taking SPX spreads and just selling calls against it as collecting a few thousand a day.
I like that play, Jeff. I think that's like a classic poor man's covered call type of thing.
Yeah.
I think Tony and I both like that play here.
Yeah, and then these are out to March. My leaps are out to March, so figure if I can, I've been selling them for about $1.
Yeah.
And, you collect $1 a day. And I figured by next March I ought to be smart enough to get those that I could roll those for pretty well free.
Oh yeah. I mean, as long as you can keep managing them, I like that play. As long as vol stays high, you can sell enough premium against that. You'll probably own them for free. I agree.
Yeah, man. And I forgot what I was going to say just there. So anyway. But that's what I've been hanging on, and it's been fun because it brings in a lot of income every day. Just and usually I got a glimpse into the future yesterday when we climbed above 5,200 for a minute, and I looked at my P&L. I go, holy moly!
Mm-hmm. Yeah.
Of course, we crashed right back down overnight. But
I had that same day yesterday. I looked at my P&L in the morning, and I go, holy moly. I looked at it in the afternoon, I was like, holy moly, but it was for two different reasons.
Yeah, man, and but I got a little glimpse into the future, and I liked it, and I've been going, at least 150% above each daily expected move. And if I don't get $1, I get something. And it's been really nice having that cash flow. And we'll get this paid down, and we'll see what happens in the next 6 months.
Thanks, Jeff.
Appreciate it.
Good to hear from you.
Appreciate hearing from you, man. We're gonna go.
Take care, man. Bye.
Be well.
Crazy rally here in the NASDAQ. It was just up on the day, which I think it's wrong.
It's basically unchanged at down 27.
It has been moving in like 400-point range. Like there's no,
no rhyme or reason.
If you sell it, just wait. If you buy it, just wait. Because both sides have gotten paid. I feel it's easier to be on the buy side, believe it or not. I feel for me, it's been easier to buy them.
Sure.
We bought that Apple. I bought that Apple pre-market. It's up $4 already. I bought it $169 while we were talking.
$169 even, yeah.
$169 even. It's $173 right now.
Crazy.
How's that for insanity in just 16 minutes?
That's right.
I haven't sold it yet, but still.
Illinois, Mark in Illinois. What's up, my man?
Good morning. In this current market where you have to question everything, I see the action in the Treasury bond markets and wonder if sideline money held in the SGov ETF might be exposed to losses. What are your thoughts?
Held in which one? Which ETF?
SGov.
Oh, SGov. No. You're talking about
it's like BIL or SGov.
SGov and BIL. Mark,
it's the under 3 month.
But they're 90 days or less.
Right.
And when you're talking about 90 days or less, if you go to what's the euro quote right now?
Not LIBOR.
No, it's the euro quote. What is it? SG.
It's 4.3%. Are you trying to figure out what the percent is?
90 days. Just the shortest term. The euro.
Sorry.
It's the future. I don't trade it. Is it SR? I'll come up with the symbol in a second. But no, there's no risk on those. This is not 2008. The last time we saw risk in a money fund was 2008, and those were longer dated corporate money funds. I mean, they were trading corporate paper along with government paper, and they were doing like repos and longer dated stuff. SGov and BIL are just 90-day treasuries.
90-day paper and treasuries. That's what
there's literally no risk to those.
There's no buying of real estate or anything else.
There's no corporate paper. Right. There's no munis. Right. There's nothing longer dated. They're all AAA government stuff. There's no risk in those things.
Yes, that's correct.
And so Mark, no, those I wouldn't worry about. And again, the only things that got in trouble in 2008, when 2008, 2009, when we did have some of those money funds trade under parity, those were because they were doing a lot of overnight repos and corporate paper, and the liquidity and the short-term stuff really dried up. That does not exist today. I mean, that risk is, you're not in any of those things. Those are just pure government, and it's like being in a T-bill without the minimums. So no, I'm not. Those have no risk.
So this other treasury bond, that negative action that's going on shouldn't affect this.
Yeah, I mean, when we talk about the treasuries on this show, we're talking about the basket of 20 to 30 year bonds, and I mean, there has been a big move in the 10-year over the last 2 weeks. It's moved almost, what'd you say, 60 basis points, Tony?
Yeah.
It's moved over 60 basis points from like 384 to like 444 in the last like week or two. That's the 10-year. But when you get down to the to the 90-day T-bills, those things don't move much. So no, there's no risk in that.
Good to hear.
Yeah.
Okay.
Yeah.
Thanks
Sure.
a lot.
You got it,
Hang
man.
in there, guys.
Yeah. There's like we're really careful because we don't actually even use money funds at Tasty.
That's correct.
We only on the platform, on the Tasty platform, there's actually a new tab, and you can see all of the T-bill rates right on the platform. Let's see. It's fixed income. Yeah, it's a fixed income. It's a fixed income play, and you can see it right.
All you got to do is go right below activity to that little squiggly line there. Go down. You got research and news and watch list, Tasty Live charts, so on. You go down to fixed income, and click on that, and then you'll have your T-bills.
And you can choose
all the year-to-date percentages.
Yeah, the cool thing about Tasty is
and the maturities.
I actually don't think any other platform does this. I could be off. Maybe there is somebody that does, but I don't think there is. We actually let our customers go directly and purchase these T-bills directly. So if you want to, and those are.
And if short-term 0 to 30-day paper like SGov or a bill. Yeah. There won't be any trading. There won't be any.
Oh, right.
If there's something happening, the whole world is imploding. And
so you can buy T-bills on the platform, or you can use the SGov or BIL, but there's no risk in any of those trades. Yep. Zero. Okay, thanks, Mark.
Thank you, my man. Appreciate it.
Bye-bye.
We're going to go to St. Louis. I got Sam. Sam in St. Louis. What's up?
Hey, guys. How's it going?
Hey, Sam.
I had a question kind of about iron condors / I really do iron condors because I'm a smaller account size and just for buying power reasons. But I've noticed sometimes, like when volatility increases, but I'm still inside, my range, I might still see losses when they expire. And I'm just a little bit confused. Is that because the call side is, the theta is just going so much faster than the sold calls and puts?
Sam,
he's saying he still can't get outside a standard. I think his question is he still can't get outside a standard deviation with his iron condor, even with volatility higher. And you're not going to be able to collect 1/3 the width of the strikes. Is that what you're trying to collect?
Yeah, well, more my question was when I expire inside like my range, and it's not, outside of, it's not, none of my call side or put side are in the money. When I expire inside of there, sometimes I might see a loss if volatility is increased.
So are you saying when everything goes all the way to expiration, you're not making what you think you should be making?
Not necessarily, because it'll see the max loss and the max profit right there when you set it on. And obviously if volatility is spiked, but I'm still within the range and it's not dead in the middle, I'm not going to make that max profit. I know that. But sometimes I'll still see a little bit of a loss, and I'm just kind of confused if I'm still inside the range. I feel like I should have collected enough to cover that.
That's there are about 10% of the time volatility will expand. And as volatility expands, there's a very good chance, especially if it's happened in the last 2 weeks, there's a very good chance that Iron Condor will be marked against you, even though you're inside. So what you're saying is you're inside of your short strikes, but you're still losing money, and you don't understand why. And the reason for that is just because volatility expanded. If you were to wait till expiration or wait as long as you can, you will make money on that trade if it stays in there. But in the interim, volatility can fluctuate and it can move and it can price the spreads against you. Absolutely.
Gotcha.
Yeah, it's very frustrating because it's hard enough to be to be right and land in the middle, and then when you do,
not getting paid for it.
When you do and you don't get paid for it, you're like, damn, this sucks.
But if time goes by, it will come back in spades.
Yeah.
But again, that's the problem with that's the other side of having such high implied volatility and volatility going higher each day. I mean, I didn't think we were going to get 3 or 4 days of higher highs of volatility. That premium doesn't come in. But on the first, like you saw when we were up 300 handles just yesterday, volatility came in pretty nicely in a lot of positions, at least a lot of positions I had. And you will see the same thing too. But you need that uptick.
Yeah.
Oh, that's sideways action. Yeah, right. I know.
It
Big ask.
The same thing with I've noticed with call and put spreads too, where you could still stay, out of the money and be good, but if it comes back down towards your strike, you start to be in the red there a little bit, and it's very annoying.
Yeah, no, listen, we hate the same. Every trader hates the same thing. You do everything right, and the damn stock, and it doesn't work. That just pisses us all off. I completely agree.
Yep.
Yeah. Sorry, I didn't understand the question at first. Yep. All right. Thanks, Sam.
Of course.
You got it, man. Thank you so much for your time. Appreciate it. I appreciate everybody holding. Going to go to San Ramon, California. Ravi?
Oh, San Ramon.
Yeah.
Hey Robbie. What's up, man?
Can you hear me?
Yeah, sure.
Yeah. Hi, Tom. Hi, Bat.
Hey.
You guys do a fantastic job, so thank you for that.
Thanks.
And if nothing else, this whole experience, this down move has been a learning experience. I've been trading about a year, and so it's not been too long, but it's been a learning experience.
And by the way, we hate everybody hates learning experiences. It's just something I've learned over the years is I hate learning. If somebody says it's a learning experience, it's never a good thing.
Yeah, it's been tough. So I have a question about a position I have, a little larger than I had originally intended. I sold 30 contracts Iron Condor on a TQQ position, TQQQ.
Okay.
And it was it's a 99.94 on the call side and 60 on the put side, and it expires. It's coming up in 8 days. This is April.
So you're talking about TQQQ, did you say?
TQQQ, yeah, triple Q. TQQQ.
EQQQ.
No, T for this. That's the triple leverage.
Yeah,
T for
leverage.
Tom.
Yeah, TQQQ.
Yep.
Tom QQQ.
Now remember, this TQQQ, it goes up and down in percentages, not necessarily points.
Yeah. So your call spread is way out of the money, and your put spread is what's your short strike on your put side? 55.
55.60. Yeah.
Yeah. So I mean, this is, and it expires in April.
It is.
Yeah. So I mean, there's nothing here except, you need a 17-point rally in TQQQ. I mean, the stock is, let's just take a look. So by April expiration, the expected move up or down is about $8.50. So you need 2 times the expected move to the upside. You're going to have, you have a very, statistically speaking, you've got about a 10% chance of that call side coming back. I'm sorry, that put side, the underlying going back to where your short put strike is. The call side has absolutely zero value, and there's nothing you can do with rolling down, the call side, because you've waited a really long time. Obviously, when you put this trade on, it must have been trading around 70 or something, right?
Correct. It was.
Yeah. And it's dropped from 70 to 38. It's been a brutal move in there.
Yeah.
I mean, you've got, like I said, you've got a 10% or 14% chance of touching the 55 strike in the next 10. There's nothing you can really do. Here's the problem. Your call spread is worthless, and there's nowhere you can roll it down to, and you're running out of time, and you can't reduce the size of your position or anything. I mean, the good news is you only have a few pennies left to lose.
Yeah.
But the bad news is
it's never a good lesson.
You can't defend this. It's not. You needed to roll that call spread down, Ravi. You needed to aggressively roll that call spread down when the underlying TQQQ broke your short strike on the put side. As soon as that went under 60, you need to move your call spread from 90, 95 or whatever it is down to 70, 75 or 75, 80. You need to pick up some additional credit by rolling your call spread down as soon as this underlying broke under your short put strike. But now you've waited too long. There's just nothing you can do without making the situation worse. So I would just hope you get lucky, and again, it's a crappy learning experience.
Is it worth going inverted and going down?
No, you can't. You can't. You'll just lock in a loss. There's nothing you can do. You can't go inverted on a vertical spread. So, and if you were going to even roll it down, you would have had to do that a couple of days ago or a week ago or something. At this point now, you would need a huge rally. Here's the thing. If you get 1,000-point rally in the Qs, I'm sorry, if you get 1,000-point rally in the NASDAQ, which is entirely possible the way we're moving around, Tony, we could see 1,000-point rally in by the end of today.
Saad, the one-day move into tomorrow, the 10th, is 860 points.
It's 800-point rally. It's an 800-point expected move in NASDAQ. If you get 1,000-point NASDAQ rally, you may have a chance to make an adjustment to this position, but you need NASDAQ to rally 1,000 points.
Got it. So is it worth should I just close it down or just wait? Because I'm worried about assignment.
No, don't have to worry about assignment. Forget about, put that worry away. You have a defined risk trade.
Yeah.
And I don't even care how much money you have in your account. I don't care if you have hundreds of dollars in your account.
Yeah.
Put the assignment out of your fear world.
Yeah.
Worry about everything else but assignment.
Yeah.
You get assigned on one side, you exercise your other side.
Yeah.
You're completely done. It costs you $5 or something like that in a commission or whatever it may be, but that's your risk. A cup of coffee is your risk. You have no assignment risk on monetary gain or loss in this situation.
Yeah, you have a couple pennies left to lose on the trade, but forget about the assignment risk. You're better, the way this market's moving around in the next 10 days, you could get a rally of 10 or 15 points in TQQQ. It could.
Yep.
It could easily happen. So hang in there, Ravi.
Yeah, hang in there. I agree.
All right. Thank you.
Thanks, man.
You got it, man.
Thanks.
Good luck to you. And that goes for everybody. Assignment should be not even a thought. Expiration day, yeah, then you have problems. Not now. What were you going to say, Tom?
Nothing. I wasn't going to say anything.
And that TQQ is a very tough product to trade. I really think you should go someplace else. That would be my opinion. I mean, it goes up in percentages. I mean, it needs the Qs to go up 20%, 30%. I mean,
yeah, I don't usually trade that one, but I agree with you. Crazy.
You can't trade these things with like short premium, small time frame.
NASDAQ futures are up now.
They are. They're up $8.
What a crazy night. Bonds were just down 3. Now they're down 2. S&Ps were down 110 when Tony and I were talking. Now they're down 23. Gold's up 87. It's kind of been there all morning.
Yeah.
Some of these currencies.
Silver's up 70 cents. That's a big move in silver too, which silver hasn't had really too many big moves until the last couple of days.
Let's take a tiny short break so we come back for the opening bell.
You gotta do a little pee-pee. We'll take a quick 90-second break and come back. We got more Tasty Live after this with the opening bell next. And if you are on hold, we will get to you in that order. I can tell it so you know what you're doing. I'm gonna go to Belgium, Houston, Scranton, Tampa, and Virginia in about 90 seconds. This is Tasty Live.
Regulation time may have expired, but the conversation is just getting started. This is Overtime, the post-market scrimmage for market junkies. Join Chris Vecchio, Ilya Spivak, and me, Dylan Radigan, as we analyze the X's and O's for everything from earnings to politics to macro events and more. Nothing's out of bounds on Overtime. We break down the news to provide you a playbook for your trades. Watch Overtime Monday through Thursday only on Tasty Live.
The beauty of Thinkorswim was that we were different. From the name to the front end technology was clearly what we wanted as traders. Second time around, I think we did a better job. Yes, we are known for our ability to support complex derivatives traders, but we also have the tools for somebody who's brand new who wants to come in on the first floor and work their way up to the top of the building. The amount of time I spend interacting with our customers via email or anything else is pretty much my entire life.
To be so powerful and so valuable, and then to be that approachable, just amazing.
Where else are you going to be able to email a CEO, get response back?
But you know what? Before he even knew who I was just some idiot trying to learn how to trade. And he still would email and help me learn and everything like that.
Some people say it's nuts, some people say it's insane. That's what I do. Calling all traders. Are you using Tasty Live mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, Tasty Live has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you'd like a chance to share your trading journey and inspire others.
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tasty Trade. Genius loves company.
Tomas, we are back. I just got the worst news out of not even the S&P is going down 37 and NASDAQ down 70. I heard your mom is watching the show, and she says...
I was watching the show this morning. She's upset with you.
And what does she want you to do?
She wants me to sit down with you and explain how the world works.
Joan, come on.
She's not listening anymore. Okay, that was early.
Come on,
Joan. She only listens to the first 10 minutes, 15 minutes. And when she saw Vanetta wasn't on today,
I don't want to disappoint a mom.
You can't argue with my mom. You can argue with me, but
no, of course not. You kidding me? Whatever she says, I would agree with.
Yeah.
100%.
No, when she saw Vanetta wasn't on today, then she hangs up.
I hope she likes to watch Vanetta.
Well, she likes.
I got another guy that likes to watch Vanetta over here too. I can't give him Vanetta's email address because I think she blocked him.
She likes the chatter and she likes the, the news part of it because it's like she understands that.
Sure.
We start talking about options, it gets a little confusing.
Sure. God bless you, mom. Was she 90 something? Am I allowed to say her age? Because she was younger than you for many years. How old is she now? 90?
In her 90s.
What is she in her 90s?
Yes.
That's awesome, man. That's awesome.
I'm under contract.
That means, God bless, we're going to have you around for a long time too.
Well, I mean, my grandmother lived to 94 and she smoked about 4 packs a day. 94, 95. So
my father smoked a pack of cigarettes a day. He didn't make it to 70. So, I mean,
Either did either of my grandfathers. But grandmothers, yes.
Yeah.
But interesting how that works.
Hey, I know I promised we'd get to your calls, and we will get to your calls, but I want to get, do you want to take a call? We only have 2 minutes.
No, I think we should do opening bell, and I promise you, I know there's a lot of people on, and
I'm so sorry, Belgium, that we went to break before we...
Yeah, we have calls.
I didn't see it. I wasn't looking at the
We have calls from a lot of places around the world, so we will, we'll get to you guys first.
We will, I promise.
And we will get to everybody. We will take... Until Scott, even when Scott comes on, we'll take calls. So we have another hour and a half left of the show, and we got a ton of, really good stuff. This is so important. Like Tony and I were talking last night. We're like, and I'm watching the markets, and I'm like, Bat, we can't do our normal show tomorrow. We have to just talk to people because I'm sitting there talking to you.
Who the hell wants to hear about my assumption on a ABC trade, right? I mean,
well, also like I'm sitting there talking to you, but other people don't have anybody to talk to. So I think it's like people get to listen to.
It was the loneliest thing when I left the floor of the CBOE and started trading in my office to be alone with my own demons and my thoughts and everything else, and not. I felt like I wasn't hearing any noise. I wasn't hearing any noise. But there was no.
I miss the noise.
Ideas. I
miss the noise more than I miss what people are saying.
Yeah, I agree with you.
I
like the chaos.
I liked the chaos because.
But I liked hearing somebody bidding for puts, somebody offering calls. I like when you go, wow, look at these bonds. I wouldn't have looked at them, or look at the euro. I wouldn't have looked at that. Like I like hearing that, even though I don't even want to make a trade in there. I like hearing it.
You know what's weird? I like when there's multiple conversations at once.
I like it too because I can't hear it, but I'm going to change that.
No, but I'll be in a room and I'll be talking to somebody. Like I'll be talking to my wife, and then I'll be talking to somebody else, and she's like, "I was just talking to you."
By the way, I saw pictures of your wife at the wedding. Mink, yeah.
But
oh my God!
I'm just saying.
I never thought yellow could look so good on somebody. And the boys,
she'll be happy to hear that.
The boys, my God, bless it. Sound enough, you're a lucky man.
But the thing is, I'll talk to her and I'll go. I'll be like, she's like, how can you talk to him when you're talking to me?
I know.
She cannot handle.
I'm not listening to you. I'm listening to him.
There's your handle multiple conversations. I can handle 5 conversations at once.
There's your opening bell, Sadnov. Even the S&P is still down by 22, but we've had a huge range here. 300 points. 200 points, Sadnov, from 48 mid to 55,000 mid. NASDAQ basically unchanged, down 23. Russell down 15. Dow down 300 and change. The Russell's been the weakest of the group. Dow starting to take that up too. Volatility down 20. Sadnov, I want to mention something before you interrupt me. Oil, 57.09, traded down to 55 and change. There's one person on this network that said oil was going to go into the 50s. Sadnov, who was that?
It was me.
100% it was you, Sadnov. I cannot believe you've waited so long for me to give you your props. Usually you hurt yourself patting yourself on the back when oil would be in the 70s before it got to the 50s. You're 100% correct. It's 57, Sadnov. Great call on you. At least you had one good call. Gold up 89 and silver up 61 cents. Let's take a look at some of these stocks that are moving here. On the downside, Netflix down 15, Costco down 8 or 9, Meta down 3 and change, JP Morgan down 3, the SPY's down almost 2, that's SPY. On the upside, MSTR up 7 and change. We didn't talk about Bitcoin at all, but Bitcoin basically unchanged like the market, but as mirroring the market, Bitcoin got down to 74,000 and change. It's 77,000 and change right now. Carvana seems to be the most speculative stock in the entire world. Carvana up almost $7. That's a 4% move in Carvana. UNH up $8, helping the Dow, although the Dow is still down 200 and change. It just rallied 100 in my speech. Tesla up 6. Your beloved Apple, which you traded pre-market, Sadnov, is trading 174. You bought it around. Oh, you sold it just now.
I sold it at 173.
Good job.
I bought it at 169. I made 2 points, which is pretty good. Nasdaq's up 78. Thought the Nasdaq looked good. There were some certain stocks that opened this morning and surprised me. I mean, I looked at buying some NVIDIA pre-market today. Mm-hmm. It's opened up $2. It's up $3 now. Apple's up $2. Reddit's up $260. Remember we both bought some Reddit yesterday afternoon?
Yep.
I still have it. I'm not selling it.
I scalped it good yesterday. I still have it in my portfolio, but I have forsaken my own portfolio for answering a lot of these questions.
I have a few problem children today. You want to know what they are?
Sure.
I got some problem children.
Go ahead.
My overall position
and euros are up and up.
They're up $1 million,
up 1%, which is hurting the dollar. Which I think we need to get the dollar stronger.
So
we're going to try to reverse this market a little bit. Again, I think currencies and bonds are really the culprit in this market right now. But go ahead, Thomas. Sorry.
So what's killing me today is gold and bonds.
I'm so glad I got out of gold.
I wish I had got out of bonds.
I know.
I wish I got out of gold.
Yeah.
I'm getting killed in gold and I'm getting killed in bonds.
Mm-hmm.
Our biggest winner is Apple, and we need a little help from Netflix too today.
Help me, Netflix. Help me.
Well, Netflix was strong yesterday, and it's weak today, but hopefully it will turn around.
Volatility in by 50 cents, 31.64, got up to 35 last night on a big spike up there too. But listen, it is as high as been. VIX, VIX, I saw it up also huge this morning. It's trading 52 right now. Flirted with 60. That's a VIX pre-market.
I'll tell you something. You don't get VIX 50 and tradable too often.
That's true.
I mean, you're looking at a very...
Usually we're at stop limits or untradable markets or, yes.
When the VIX is 50, nothing is ordinary.
Right.
Nothing is ordinary.
Right.
Bonds down to, this is actually the first spot I bought them at last night, which is 123.22. I'm sorry, 113.22. Just a quick little mention on the bonds, because somebody wrote me this morning, they go, I don't understand why you think just because bonds are lower that the Fed can't lower interest rates. And the reality is that the Fed has to play the game of where the market actually is. You know, it's the Fed doesn't have the ability to change the marketplace on their own. If the 10-year note is trading at let's just say 444, just as an example, and the Fed wanted to lower rates, that's a very difficult thing to do until the 10-year note, let's just say, drops down to a range where they can lower it. It's very hard to lower rates when real rates are going higher. You know, there's an organic nature to pricing, and you can't come into the marketplace and just because you're the Fed do something that's not
counter to. Well, you'd get a.
Well, it's not inside the range of the current market.
Right.
You know, it's like saying, you know, your stock's trading at 100 and you're going to sell stock at 200.
Right.
You know, it's not going to happen. Or your stock's trading at 100 and you're going to sell stock at 50. Right. You're not allowed to do that. But anyway, yeah, I do like the tape action and you got to remember, yesterday Apple was the heaviest stock I've ever seen.
Yep.
It was the biggest dog. It was a pig. And we started to buy it way too early.
Of course.
Tesla was a pig. Tesla was a pig yesterday. It's rallied up $6 today. NVIDIA was heavy. I mean, my screen is all green NASDAQ wise.
Yeah, and you've got the Russell and the Dow down, and even the S&P is basically unchanged.
Yeah, when you think about China, because there was so much chatter about China last night, BABA's higher, Baidu's actually a little bit lower, so there's not that much there. And let's just see. Yeah, this to me right now, I'm looking at my watch list. This is very much.
Are we going to have to wake up at 3, 4 o'clock in the morning for the next month or so, Sada, to become that market again?
But this is very much a NASDAQ rally so far this morning.
And I think that's the product that has to rally for the market to put itself on its back. You know what I mean? You're not going to rally with the Russell being strong relative. I think if the NASDAQ's strong relative, it'll bring the E-mini S&Ps and then the rest of the market. Hey, let's go to Belgium. You'll be very patient.
I'm Tom Sosnoff. He's Tony Batista, Belgium.
And this is Lauren. Lauren.
Hey, Lauren.
Hi. Hello. Can you hear me?
Yes, we can. Thanks.
Thank you for holding. I appreciate it.
Yes, thank you very much. So my question is about buying power usage. So I've been respecting the recommended usages for years, and it's very well in the normal market circumstances. I generally would be using about 30 to 35% of it in normal market circumstances, and increased it as volatility rose. Started taking some future positions in minis and micros. When the VIX reached about, let's say, 35 to 40. So my buying power reduction went up to 65, 7%. But now it's acting like a meme stock. So right now, more than anything else, is the only thing that I'm watching. As I'm not worried about my positions as such, I'm a bit long, as most traders, I suppose, are. I'm in May and June. But losses I had to realize are ones just because I wanted to keep it below 100%. So can you tell me the exact mechanics of margin calls, how they work? To give you an example, yesterday my buying power reduction went from 70% to 107 at night, which made me sell a future. So I just need some clarity regarding, the fluctuations of BPR with these volatility moves.
Well, the BPR, are you talking about just for futures, or are you talking about for futures and options?
My entire portfolio. Yeah, so I have, let's say it's half-half.
Half and half.
Stocks, futures.
Okay, so the BPR for the listed option part of your portfolio probably won't change at all. Like that will stay very static. It is extremely rare, unless, of course, you're losing money or something like that. Right. But it is extremely rare for us on the security side to change the margin requirements for any of the underlyings. This market here would be one of the few times when they may raise the requirement for certain underlyings, but I don't believe that they have yet. So we're still at minimum requirements, so that's not going to change. On the future side, however, the requirements change between during the day and then overnight. So the overnight requirements, you have to meet the overnight requirements for holding the future. When intraday, there's intraday requirements, then there's overnight requirements.
Intraday requirements are lower than overnight.
Yeah, the intraday requirements.
And that's across the board between all brokerage firms.
The intraday requirements at Tasty are 25% of the overnight requirements. At other firms, it might be 50% or it might be 10% because the firms can set the intraday requirements, but the overnight requirements are the same at every single firm. Nobody gets any different. And the only other thing, do you have futures options on?
Yes.
Okay. So the only thing that I think might be messing you up, and this messes up a lot of people, is at night, it depends what underlying you have, but some of the futures options like NASDAQ futures or Russell futures options, or sometimes crude oil or one of the currencies, the markets get very wide, and then our platform picks up the mid price, like every platform does. Everybody picks up mid price, and so rather than having an accurate theoretical number at night, sometimes it will be thrown off. That said, our risk team will not issue a margin call based on a bad mark on an overnight futures requirement. Right. So they won't issue a margin call on that. They will only issue a margin call if there's an actual position that's underwater.
Underwater meaning that you'll get assigned and not being able to afford it, but I won't be assigned anyway because
in the futures world, A, you will not get assigned, and B, if you do get assigned, the requirement for the futures options and the future itself are virtually the same. So there's not going to be any difference. In the listed world, because there are two different regulatory bodies, in the listed world, if you get assigned, it's going to require that you put up more cash. But that is a situation where you will have to put in more money or liquidate the position, go back to an option position.
So then I'm options only portfolio. What is, let's say, the buying power reduction that I can go up to? Because I'm happy with my positions. I mean, I am in ES. I'm at 4,000 in May.
Where are you right
in June?
Lauren, where are you right now, percentage wise? What number are you at right now?
Right now?
Yeah.
Let me have a look. I'm at 89.
That's too high. So our recommendation, just so you know, based on our research, our recommendation would be tops. How big is your account?
How big?
Yeah.
Yeah. Right now, 130,000.
130,000. My recommendation would be tops at about 65%. 65, 70 would be absolute top.
The thing is, it was 65, 70, for instance, during the day yesterday, and got to 107 yesterday night.
It shouldn't move that much, but I don't know. Your intraday again.
I'm loaded with ES and MES and some crude oil. Yeah.
Well, because the overnight requirement is bigger than the intraday requirement. That's why. But what you want to do is your overnight requirement should not exceed, given your account size, 65 to 70% should be your overnight requirement. If you're at 88 or 90% of 100 and X thousands of dollars, I think your overnight requirement's too high relative to your net lick.
Okay, so you were saying I should cut some positions,
yes.
Some of these futures.
Yes.
Okay. No, that's very important, but okay, I get it.
Yep. Thanks so much.
And I appreciate you holding.
Yeah, thanks for holding.
Yep.
Bye. Thank you very much. Bye.
Thank you very much. We're going to go to Houston. Carl in Houston.
Hey, guys. Can you hear me?
Yeah. Thanks, Carl.
Excellent. Hey, well, I went through one of these things in 2019. Everything I learned from y'all set me up in the position today, so I want to thank y'all. Hang in there, guys. Every dollar you lose today, you learn to make two. So with that, I had a bunch of covered positions. Started selling calls in October. Did well. Some of them went a little sideways. Enjoyed some of this downside. Some of it turned into green. Didn't want to be greedy. Should have been greedy. So now I find myself without any covers. And that leads me to my question. Any thoughts on covering? Because if you go with Tom, you should cover. If you go with Bat, you should sit. And then at the same time,
on existing positions. On
positions you could take that I had covered. I sold to open, and then I bought to close.
Awesome.
And so now I'm sitting on some large positions that right now I'm just not sure. I don't want to cover too early because
you're sitting on some short position, some short delta positions.
Yeah, in order to take some short delta positions on some equity positions, and then I do have a question about rolling in regards to in these kind of high IV environments. I've got June AT&T 22, and so I've been trying to look to roll it. I'm just not sure. Like, am I being too greedy? Should I sit? There's not much premium in it. And I just thought maybe if y'all had any thoughts on kind of rolling still sort of deep in the money positions in which you still got time on. I don't want to give up the chance to get out early and have it shoot back up. But those are kind of my questions. Any thoughts on taking positions on equity positions to cover and rolling stuff that maybe still be deep in the money?
I mean, tough question to answer. If you've held this long, it's hard to say I'm going to throw in the towel now. And it would have been prudent to do yesterday. It would have been prudent to do the day before, and it would have been prudent to do the day before that. So nobody knows the future. I could see you closing, if you have more than one, 25 to 50% of that position, and then selling a put. Like I did that in Apple, where I basically had a position that was just long stock. And I said, I wanted to have 15 to 25 deltas. I have 100 deltas. I got to do something here. I bought my stock back. I sold a put at the money, went to 50 delta. I cut my delta in half, tried to stay as mechanical as possible. And that saved me $10, of $20 that I was going to lose if I stayed in the position. Still sucked, still hated it. But I look like, all right, I did something than in other places where I did nothing. So there are some things you can do. I think the prudent side to me would say, reduce your risk by 25 to 50%. I just outlined one way to do it. There are multiple ways to do it. And in other stocks that you haven't had positions on, maybe those ones that you change, you get your cost basis a little bit better on these other stocks that you were looking for, and you take that same money that you just freed up and you put some of it in some of those other stocks, maybe with a defined risk trade, if you're bullish on a put spread, if you're bearish on a call spread, that kind of thing. Mm-hmm. I'm just trying to reduce cost basis and reinvest the money somewhere else.
That's exactly what I'm looking for.
Sir, I wish I had the answer. I don't have the answer. And even the S&Ps were just green, and now they're down 7.
They're up 45. Now they're down.
Yeah. So you're going to get these kind of moves. I mean, we have almost a 3% move baked into the market with implied volatility here in the 30s. I mean,
crazy. I know.
It's crazy. It's going to be crazy.
Yep. I think Carl just, I think Tony's spot on. I mean, listen, we don't know, but I would tend to, in your position, keep most of those positions, but I would lighten up a little bit, just to whatever in any way possible, whether it's selling some of the stock to sell puts instead, just to free up a little bit of cash. I think right now, you just have to be careful that you don't get overextended. That's all it is.
Yep.
I have no problem being long. No problem being long. Just don't want to be overextended.
No, I appreciate that. And then the good news on this stuff these are positions I bought. For example, AT&T, I'm sitting in at around $17. So
yeah, I mean that's
I've got
the kind
a lot of room to play with here.
That's the kind of thing I don't even think like the AT&Ts of the world are not the things that give us any concern.
Yeah.
Okay. Sounds
Thanks.
Good.
You got it, man. Sadnov Gold continues to rally up 97.
It was just up over 100
new highs. Yep.
Yeah, gold is my. I cannot believe gold took me down today.
Pound is actually down. Euro is still up.
Yeah, the euro's up a lot. Canadian dollar's up a lot. The yen's up a lot. Unfortunately, the
bonds are 114.
They rallied a little bit. They're 114.08, 114.09. They traded down to the 112 handle today. Bonds are all over the place. I think bonds are way too cheap here, but listen. Who knows?
855-238-2789 or 855-BE-TASTY. That's the phone number to call. I've got 2 or 3 lines open. I see Mark in Scranton. Mark in Scranton, what's up?
Good morning, guys. I just wanted to thank you guys for flipping it up today because I do think it's very helpful. Even though I love Vanetta, I think he's brilliant and witty, but I do appreciate the phone line. And Tom, I have to say, I was shocked on your position with all the tariff talk.
Hold it, you were shocked what?
On Tom's position?
He's shocked on your position on the tariff talk. So he has the.
Oh, you're shocked at my position.
He has the opposite view of you.
That's. Oh, you have the opposite view. Yeah, that's fine. I mean.
Yeah. I usually agree with Tom, and I was shocked to hear his point of view. But my question is, it's not really a position question. I'm sorry, I hear a loud echo in the background of myself.
Yeah, it's closed. Shut off the volume on your computer.
Yeah,
or something
you sound
like that.
you sound fine.
You sound fine to us. Sorry.
Oh, okay, I'm just on my phone. I don't have. I was just listening to you through the call. But anyway,
you sound good. You sound good.
Okay, good. Okay, so in regards to hedge funds and the big institutions, I'm just curious as to how they trade in these type of conditions. Like, are they liquidating? What are they doing? Just to kind of feel where the institutional money is going.
That's a really
good question.
Fun question, because we've never been too concerned with that, because we kind of feel that, and I know this is going to probably be counter to what anybody else actually thinks, but we think that institutional money is the dumbest money out there. And so we actually follow what retail customers do, because we think that they're smart and nimble, and they represent like what's the real totality of what people are thinking. And we think institutional traders are just followers, and they're kind of Johnny-come-latelys. So we've never really tracked, what institutional investors are doing, because they feel to me like they're always late, and they're just hoping for a continuation. I will tell you one thing: I doubt that there's been too much liquidation. I just don't think it's in their models. What I do find surprising about most institutional money managers and portfolio managers is they rarely buy into dips, and most of the time they prefer to buy into rallies. So I don't necessarily think they're selling, but I also don't think that they've been aggressive buyers down here. I mean, at some point there'll be a leader, like a Warren Buffett type person will step up and commit, $10 billion or $20 billion to a bunch of different equities. But you haven't heard, usually these guys love to talk about their books, like the Bill Ackmans of the world, and all these hedge fund managers, the David Teppers and just the big name hedge fund guys. They love to talk their book. So what you usually hear them do is they'll buy something, and then they'll tell everybody, "Oh, I just bought this," after it's up a couple dollars. Right. You're not hearing any of that right now. You're not. I mean, at least I'm not.
I haven't.
I'm not hearing anybody.
AEGO is the first company that said something about buying back their stock. That was the only one.
But that was a company buying back.
I get it. Well, I mean, at least they're saying it at the lows. I mean, not at the highs. I mean, I give them some credit.
I wish these guys were a little bit more transparent. But you know what? I don't even care what they do. I would think that a lot of them are just scrambling and playing defense and figuring out how they're going to explain their first quarter results, to their investors. But I don't think they sell much.
Yeah.
But that's just my 2 cents, Mark. I don't really know. You got to remember, most of these institutional traders, they don't use options, and they don't really use derivatives to open trades. Like, they don't sell puts to open, and they don't sell calls against their long stocks. I mean, there are a number of funds that do, but it's fair. It's definitely on the minority, not the majority.
Okay, and my only reason, and I agree with everything you said there, my only reason for wanting to know what they do with their money, it's almost like, okay, we already had a big move. If they decide to move, do we have to worry? Do we have to brace harder?
I think, if
they'll be the last ones out.
Yeah, I'd be more inclined to think that they have been sitting on their hands, and I would think that there's a significant amount of cash on the sidelines. One of the reasons I think that there's the potential for a big rally is I just haven't seen a lot of buying, and we've seen a lot of selling. So I think there is a lot of institutional cash out there. That would be my guess. We haven't seen it come back into the market. Today's the first day that I've seen, certain stocks like Nvidia and Apple and certain tech stocks.
Nvidia's up 4, Apple's up 5.
Yeah, certain stocks are being bought up a little bit. Have not seen this for quite some time. So I think that's a little bit different today, but we just haven't seen that money come back into the market yet.
$20 range yesterday, so no, $5 is nothing.
Yeah. No, I understand. I would like to see this money come back into the market. I would like to see a blow the doors off rally, because I think it would be very
give customers a chance to do something. At least you could say, I could have done something.
Yeah, I think it would be helpful.
Yep.
Thank you, guys. Thank you very much. I appreciate your time.
Thank you for your call. Do appreciate it. Sadnov, you trusted the science. I'm going to trust the math. I'm going to put a slide up here for you, Sadnov, which tells you, put it up there real quickly, the VIX slide. There you go, Sadnov. The forward curve is pricing in less fear in a few months, Sadnov. So I think this is going to be relatively short-term fear in the market. Markets are predictive.
Anytime.
I'm hoping they've got this one right. It certainly could get wrong.
But let's be fair, okay? You have a 50 VIX now.
Yes, you have a 50 VIX. You got a 31 future.
You have 50 VIX.
Yes.
31 future. If you were drawing this curve right now,
how would I draw it?
It would be steeper than this.
I would draw it. Yeah, probably steeper than this.
To the downside.
But I'm an alarmist. I mean,
I understand, but if you were drawing this curve, it couldn't go the other way. You're not going to look at 80 VIX going out 6 months from now.
No. If you're thinking that this is different this time, then you would draw that.
I just told you it is different this time, but I'm not thinking. I think the market's going to rally big. My fear is not that the market rallies big. My fear is not that the market comes all the way back. My fear is that
just yesterday we talked about 6,200, and I mean we both agree that would be off the table, and it's probably on the table because it's still.
My fear is the structural damage that's been done to the way this country is perceived. I've never wanted to give.
We've been ugly Americans, Sosnoff, for decades.
I've talked about this for.
That's why they call us ugly Americans.
I've talked about this for 15 years. The biggest risk to us being able to raise capital and to our financial markets being the dominant player in the world is if we blow the fact that we are the single greatest pool of liquidity in the whole world.
And you here at Tasty, up until a couple of years ago, was America. It was your way or the highway. Stop it. If I had an opinion and you had an opinion about a bump that we were going to play, and the whole company had the same opinion as me, it was your way or the highway. And that's the way it's supposed to be when you have a leader who is strong and ends up making more good decisions than bad decisions. And I'm talking about you right now. I'm not talking about anything else or any other opinion or any other business or anything else like that. Okay. I'm talking about just you. Okay. You were America of years past because it was your way or the highway. You were the biggest gorilla in the room. You don't have a leader. You were the Microsoft.
You don't have a leader in America that makes smart decisions.
In the short term, you look 100% correct, and you may end up being correct. I'm just showing you the volatility curve that suggests something different.
The volatility curve has
Tampa, Herb in Tampa.
Hey, Herb, what's up, man?
I was wondering, Herb or Herb?
Herb.
Yes, I know. Yes, I know. Teasing.
I have May expiration, like 570 puts on SPY. They're like 80 delta.
Okay.
My question is, should I roll them now, or do you just wait till 21 days?
You certainly could now. It doesn't matter. You have the 570 puts?
580, I think you said.
Yeah.
Yeah. You could roll them. You roll them whenever you want. I mean, if you get a rally, it depends, Herb, if you're bullish or bearish. If you're a little bearish, you would roll them now. If you're neutral, you'd roll them now. If you're bullish, you hope for a 200 point.
You're going to benefit from a rally.
You're going to benefit from
whether you roll or not. So you can pick up $1 in premium, which is like spitting in the wind at your level. It doesn't matter. I would probably roll because you're going to benefit from a rally regardless.
But if you wanted to, you're going to benefit from rally regardless, like Tony said. But if you wanted to wait a little bit, and because you were bullish, you certainly could. But if you want to take advantage of a little bounce this morning, absolutely. It's not going to make that big a difference. You can roll anytime.
I would also think about selling the same strike call. You'll pick up another $1, $2, or $3 in premium, and you still want to rally, and you still want us to come back. And I think you'll have plenty of time to do things in other positions that you have to benefit from that rally. Believe me, 570, 580 level is a 70, 80, 90% chance that we won't get there in the next month or two.
Right. Now, does it matter if I roll like 1 month or 3 months, or would you just stay?
Oh, I would roll 1 month.
I would roll 1 month.
Yeah, we don't roll 3 months.
Which,
Yeah.
Okay. Now let me. I also have SPY leaps that aren't due till March of next year, and when I put them in, I sold them at, let's say, a 12 delta, and now they're at a 40 delta.
Yeah.
Would you even bother with that, or just let it ride since I got a year?
Oh, I would. You mean roll those? No, I wouldn't touch those.
Yeah.
I wouldn't touch those. You could consider selling a call with a 10, 15 delta if you want to reduce it a little bit.
I wouldn't here. Give it a chance to rally.
Yeah, I agree.
I mean, listen, I could see Herb. I have no vision into the future, but I have a gut that says I could see the S&P's up 200 points by the end of today.
But I had a gut that said yesterday we wouldn't be.
I know, but you could.
It would be up 150.
You could see them up 150, 200 points here today.
I can see them up 100, 150 points before 10.
Right. Exactly.
And I can see it back to unchanged or down.
I understand. And my point is, I in this kind of market, I wouldn't be. Listen, I haven't made a single adjustment yet today because I'm not being aggressive. I'm letting this thing play my way. Thanks, sir. We got to run, man. Thank you.
Oh, shoot. Okay, bye.
Chris in Virginia. Chris, what's up? Man, you're mean. Chris, what's up?
I don't know about you, but I'm getting killed in bonds, ZV. Mm-hmm. And I'm trying to figure out, first, my question is more general. How do you defend or address such moves in ZV? And second, of course, I'll tell you what I have, and if you have any ideas, I would appreciate it.
First of all, you don't deserve. You don't deserve.
Strangle.
Okay, you don't deserve the risk that you're taking in the bonds because that's a product that's supposed to have a much smaller expected move than the E-mini S&Ps, NASDAQ, or anything else like that. So,
what do you have, Chris? What do you have on?
Persecuted.
I have a strangle 116, 121 in May.
You got to roll the calls down.
Yeah.
I mean, you don't.
I mean, I understand that, but my question is more about, okay, what do I do with the put? With the call, I understand. I am going to roll it, but it's still far away, and it can go lower. I don't know.
Yeah, traded into the 111 handle last night. There's something very strange going on in bonds. I couldn't sleep last night because I was watching bonds until about 1 o'clock in the morning. I know that's a sickness, but and it looked like an asset dump all over the world, on U.S. treasuries. But it doesn't matter what the reason is. The fact is they're still heavy this morning. I would not be shocked to see them close unchanged today, and I wouldn't be shocked to see them close down 3 because they don't have a lot of intraday reversals in the bonds. But, I mean, we're kind of due for one. I think in your case, Chris, you can't overthink this. You have to roll the calls down. You don't touch the puts. You don't touch the puts right now, and you wait and see what happens a little bit. And you hope that that's the worst trade you make. You hope that if you roll the calls from 121 or whatever it is down to 116 or 117, you hope that's your worst trade ever, right? I mean, that's what you do.
100%.
You hope that trade comes back to bite you, because
standard operating procedure.
I mean, I don't see how the bonds can go. I have read plenty of people that think, hey, there's a chance they could crash. There's a chance they could go back to par. There's really ugly things can happen. I don't see it. I don't see it. I think the one role of the Fed is I've talked about this many times. The role of the Fed is to play the role. They serve as catastrophic insurance. And, when you give up $4 or $5 trillion in market losses in a week in the bond market, the Fed is eyeing the bonds really closely. And I don't think they're going to let too much more damage happen in the bond market.
That's their purse strings. The bonds are the purse strings.
They own the get out of jail free card in there. So let's see what happens. But if you had told me before this whole move, I would have said 115 was the floor, and they got all the way down to under 112. So I don't know. I think you just got to be mechanical about it and roll the calls down.
Okay. Do you think it helps if I roll it to June?
No, not yet. I don't think it does. It's not the same in the bond options. The liquid, it's liquid enough, but I think most of the activity is still in the front month. There's plenty. The Ivy rank was over 100 yesterday. I would sell May. What would you do?
I would sell May.
Yeah, we're both selling May.
Okay. Thank you, guys.
You got it, man. Good luck to you out there. We're going to go to, and sad enough, when 30/VX50 on the VIX, you're looking at a 3% move today. I mean, that's really what you're looking at. Downers Grove, Rob in Downers Grove, what's up?
Hi, guys. Let's keep talking about bonds for a minute. Mm-hmm. So, I guess I'll back up. my problem has always been size. I think, I've been calling in for a long time. I've talked to you guys for a long time. Haven't been talking to you for the last few years, whatever, life. But my problem has always been size. And this time I do feel like, after the other day when we completely reversed 300 points in the ES, I think I learned my lesson. Getting the back of my hand slapped for the last time. I'm not big enough for that, because I sold when they were down 100, and then all of a sudden they were up 165, and I was screaming at myself in the car on the way to wherever I was going. With that being said, I feel like I've been very mechanical this whole time. And bonds, I've been mechanical with bonds. I had a couple of strangles in there. No big deal. I rolled up the puts as we started to rally into my short calls. And then I don't know how you could even begin to plan for a move like this. I'm really, really hoping for a rally here so that I can basically lessen my loss and then completely clean house on my bond position and turn around. I mean, you tell me if this is realistic. I'm waiting for some sort of announcement or some sort of something, tweet, whatever it is, similar to what we had the other day, so that I can basically take advantage of that very brief situation that I think is going to happen before we go back into the red on the bonds and get out of my position, essentially, and maybe even turn around, but I'm not sure. In the same sense, crude oil, but I have a smaller position in that, and I don't expect anything to be said that'll reverse crude oil another, what do I need it up? I don't know, $6. What do you guys think about that as far as my hypothesis with the bonds as it stands right now before something like that happens?
I mean, I'll go first. Given the current level of implied volatility in the bonds, which is extraordinary, we haven't seen this. We haven't seen this kind of bond vol for. Let me just pull it up real fast on my screen.
Tom, the Ivy rank is 124 in ZB /ZB.
I know.
Have you ever seen that before?
Never. And
and vol is usually it's 20. It's 20. I mean it's usually in the single digits.
I mean
6, 7, 8.
The expected May. My bond positions are in May. The expected move in May is 550.
We've done that in the last 3 days.
No, I know that. But
over that.
Yeah, no. I understand. That's why, I'm not going to panic in my bond position. I think I've never seen, 5.5 point expected move, in bonds. I've never seen, I've never seen 124 IV rank or plus 20 volatility in there. It's kind of extraordinary. So I think you could be absolutely right. I think you could see a move of, I think you could see a move that would knock your socks off, which might mean like up 3 points, up 4 points in the bonds.
Yeah, but you don't want to put that.
No, I don't want to put that. I'm not playing for that, but I think you could see that.
Well, as somebody in my position, I am playing for that. I have to. That's the only way I can reduce my size is if I get some sort of relief and then just wash my hands of it. Is that? I mean, I'm not going to roll down my calls. I need in order for my position at the 119 strike in April and the 119 120 strike in May to happen. That's not going to happen, right? I'm just wanting, it to go up a few ticks or whatever 2 or 3 points, so I can just wash my hands of it and then. Reduce my size, because that's what I've done in the past.
It's just an incredibly difficult situation. It's an incredibly difficult trade to wait for, a insane, what could be 30 seconds to 3 minutes to 6 minutes, type move to give yourself a chance to get out. Right. I mean, that's a big ask.
I mean, thank God I have the entire day with nothing to do, and it's supposed to rain today, so I'm not doing anything outside. So I'm going to stay here watching this.
I'm crossing my fingers. I'm crossing
the opportunity to do what you want to do.
I'm crossing my fingers. I'm crossing my toes. I need the same move you do, so let's hope. Maybe we'll get it.
With all that being said, just to comment on your what you guys started out today, I agree with you, Tom, but I've been angry for a while because nobody can trust us anymore, period. End of story. We have backed out and betrayed every single agreement that we could possibly make with the world. And you're right. They are all, the world is moving on without us.
Yep. And
we've got a guy that thinks that he knows better than the rest of the world, when in reality, he is doing everything that somebody who would want to destroy our position in the world would do. So the bonds, are being destroyed by China or the rest of the world or whatever it is, and that's why I wouldn't trust any rally in the bonds for even a second longer than I have to, because the rest of the world is moving on without us. We're not playing ball, fair, and now they're all saying, okay, well, I guess we're just going to do this ourselves. And that started with what, actually, when it really started, it was when that pitiful display of how we treated Zelensky in the White House. That was the start of it, I think, when everybody said, okay, you know what? The U.S. isn't the leader in this anymore. We're going to take the lead as a collective group, the EU, whatever it is. And then we start doing all these tariffs, and all of a sudden, for what? To pick a fight? Yeah. Like you said, he's a bully. Yeah. So you either punch a bully in the face or you walk away from him. And
Rob,
that's exactly what the world's doing.
I hear you, Rob. Thanks. We got a lot of stuff. I mean, couldn't agree more, but we got to move on.
We're going to go to...
Thanks, man.
Thank you, Rob. Appreciate your time.
Thanks.
We're going to go to Miami. I got Andreas. Andreas in Miami. What's up?
He dropped, Tony.
Oh, no worries. No worries. Who's our next caller then?
Giuseppe from New Orleans.
Giuseppe, New Orleans. What's up, brother?
Hey, guys. This is a sincere call, so I'm not going to pick on anybody. And I just want all the listeners to hear, in all my years of trading, the warmth and the sincerity and the love that y'all have for y'all customers is just, y'all need to be commended. And I don't think there's any words can explain what y'all do, and people should really appreciate y'all. And God bless y'all, and thank you for all the extra work y'all doing. And I just don't know what else to say.
Thanks, man.
Thank you, my man. I appreciate it.
Just the whole staff. Not just y'all two, the whole staff.
Yep, so, it takes a village. No doubt about it.
Takes a village.
Thank y'all for everything.
Yep.
Yeah, and thank you for everything. And Tom, I would strongly suggest leaving Tony alone for the next couple of days, because he's been a champion now.
Thank you, brother. Thank you.
Hey. You know what? Tony's
like Tom said, I finally came to work.
Tony's like the markets, like market volatility. Every 5 years, he shows up to work.
Thank you, Giuseppe.
Just show a little grace and don't be like Donald Trump.
Yeah, thank you. There's a lot of similarities in Tom and Donald Trump, Giuseppe. Would you agree or disagree?
There's no similarities.
Tony. Now, I was calling it a sincere conversation, but now you're pushing it.
I'm sorry. I digress. I was wrong.
Thanks, man.
Bye, guys. Love y'all. Bye-bye.
Be well.
Thanks.
Be well. How about Bob in South Carolina? Bob, South Carolina, what's up?
Hey, guys. How's it going?
Hey, Bob.
Can you hear me?
Yep.
Yeah.
Can you hear me okay?
Yep.
Okay. Hey, so I got a question for you guys. My situation is maybe a little different, and you guys would probably say half the stuff I do is crazy, but I've been trading super actively since the 90s, late 90s, so kind of seen all the stuff you guys have seen maybe. and do things a little different perhaps. But what I've got is a specific question about risk that I'm curious your opinion on. And for perspective, I trade full time now, so I've been retired for about a year and a half. So I have a large bond portfolio, mostly TLT, and I've been doing this. I get a big, and for perspective, about $3 million portfolio.
Okay.
And I get a nice yield, about a 4%, 4+% yield on the TLT, and then I super actively or constantly cover calls and short puts when it goes down and all that kind of stuff. So I work that, so I get about a 10% annual yield on that bond. I'm not worried about TLT right now. It's doing what it's doing, and I'm good with that. My question is that I also then trade around with my margin. I do another probably 2,000 trades a year, and I generate, again, you'd almost call me Johnny Trader for what I do, because I generate about another 5% yield on that. But I usually generate around a 15% yield on a pretty significant portfolio, which is fine for my lifestyle. My question is this. So I always look in terms of, I tend to be very risk adverse. When I roll things out, I roll them down and out, and I try to keep myself, not too far where I'm pretty close to the money on my positions. But now I have a number of positions which I'm kind of stuck in. And I tend to look at the notional value of those positions. What would be the cost if I was assigned on those? And so I just want to hear your opinion if I'm crazy in terms of risk when the way I'm thinking about this. So again, the portfolio is about $3 million. If I was fully assigned on my extra positions outside of TLT, and this is mainly like SMH, XBI, some ETFs right now. Also have some RUT positions, but those, of course, cash settled, so not necessarily assignment, obviously. But if I were to be assigned, I would be the notional value or full value assignment would be about $1.2 million. And so that really gets to the root of my question.
Yeah.
Would you say that's crazy, or would you say that seems reasonable? My buying power in the account right now, as it stands, would be 6.7 million. Excess liquidity is 1.3. Yeah. I don't feel squeezed.
No.
I'm curious about your thoughts on if that's a lot of risk.
Can I ask you one question, Bob?
What's your Social Security number?
No, Bob. What percent of the $3 million is your liquid net worth?
So I don't. If you're asking, do I need? I don't need the money. So it's probably 75% of my liquid net worth.
Okay.
Well,
fine.
I mean that's
fine.
all my liquid net worth. I would say actually my liquid net worth, and then I've got additional net worth on a home, etc.
The reason I ask that is because it goes into the way I think about total allocation. If you were assigned on everything on a $3 million account, and your notional amount of then, capital usage at that time with no margin or anything would be 1.2 million, I would say you are on the conservative side, and I would have no issue with the number. That means you're probably using right now, I'm guessing you're probably using a little less than 20% of your account, maybe even 15 or 18%. Is that a fair number?
That's a fair number based on what my excess liquidity is right now.
And so I think if you're somewhere between 15 to 18%, that is on the very conservative side. I would think that you wouldn't start moving into like moderate until you got over 25 or 30%. So you're below that. You're on the conservative side, and I do not think you are overextended at all. I mean, 15 to 18% with basically a third if it was fully committed to capital is not overextended.
Yes.
Not at all.
Okay. Yeah, it's just this is a situation where things are a little, again, been through a lot of this stuff, but this feels a little rough right now, and I don't like big drawdowns.
I get that because you're feeling the heat from, this bond move obviously and other positions, so it just feels like it's heavy on you, but you're not overinvested, right, Tony? I don't think there's
I don't think there's to say it's not my money, but I would be comfortable with those positions for sure.
Yeah. Okay.
Comfortably.
Okay. Well, I appreciate that. Yeah, I was up last night seeing TLT hitting 85, it's like, wow, there's some crazy stuff going on there for sure.
Yep, I agree. Thanks, Bob. Appreciate it, man.
Yeah,
Cool.
yeah.
Thanks very much, man.
Really do appreciate it.
Bye, guys.
And if you've sent me an email, I'm behind. I'm getting to them as quickly as I can. So I do appreciate all your support and all the phone calls too. I lost my place here. I think we're going to. Is it Bob in Bob in South Carolina?
Yes, it is.
Bob in South Carolina.
That's what we just had. That's what we just had.
Oh, we just had Bob?
Yeah.
Carolina. I'm sorry. Charlie in Los Angeles. I apologize. Los Angeles, Charlie.
Hey, guys.
Hey, Charlie.
Hey, guys. Long time no talk to.
Yes.
How are you?
I've been with you. Good. Been with you guys since the thick and swim days.
Love it.
It seems like it went by real fast.
Life is too fast. When it's all said and done, this stuff moves. It's crazy.
It is. I mean, even the S&Ps are moving 15, 20 handles at a click.
But life is fast.
Right.
Yep.
I know. Tell me about it. So the question I have is this. I haven't, the down move was so quick. I just let my strangles, and I was mechanical. I've moved basically everything into straddle. I've got one thing that is inverted. But I've got 136 deltas.
Mm-hmm.
And my question is, when do you roll from the 37 days to the next month? Or should I just stay here and wait to see what the market decides to do?
Well, I mean, our mechanics, we're pretty consistent about rolling at 21 days, but if you wanted to roll earlier, if you roll, here's how you think about it. If you want to roll earlier, you will reduce your fluctuations and your risk by like somewhere around 25 to 30%. So if you go out an extra 30 days, you take about 25 to 30% of your delta risk and your portfolio fluctuations out of the equation. Let's say 25% in this market.
Yep.
So you can really roll anytime you want. Like, we're going to wait a little bit, but you can roll anytime you want.
Okay. Now, the next question I have, if I wanted to hedge my deltas, I've tried going in and looking at doing the SPY, but then I exceed the rules that I follow that you put out, and my portfolio is just about 50%. It would go up quite a bit if I was to use SPY or ES or something. So how would I hedge that?
I would hedge the individual what's the biggest individual underlying you have?
Biggest delta you have?
Biggest delta.
The biggest delta would be the XLY at 21.
Oh, okay. What else do you have?
The next one would be FedEx at 25.
Yeah, so I would hedge those individually. Let me just see.
XLY, I mean, it's a $180 stock, $178 stock.
Is there any liquidity in there?
Markets are about $1 wide.
XLY, yeah, it's not my favorite trading vehicle. I'm just thinking, just looking at the markets.
I think that's where you have to hedge.
I mean, yeah, Charlie, I would hedge FedEx and XLY individually. I don't think hedging using SPY, A, is cost effective, and B, gives you a tight enough correlation. XLY is kind of that's the consumer discretionary or consumer. That's the consumer one.
Consumer discretionary.
Discretionary.
Yeah, that has been somewhat non-correlated to the rest of the market. It hasn't done as bad as everything else, and I would hedge that. I would not hedge that with the SPY. I would hedge that with its own options. I mean, it's up big today, so you can probably, offer a call somewhere above the mid price because the markets are kind of wide in there, and let it come to you. It doesn't trade a lot. And FedEx is kind of the same thing, but FedEx, I would hedge with FedEx. I think those are way better as independent hedges than they are.
And they won't use much buying power.
And you won't use any buying power.
Right.
You won't use another penny in buying power.
I think that's the key for me.
Yeah, 100%.
Well, that's something I never thought about doing, but I appreciate it, guys. So I'll let you get to the next caller.
You got it.
I want to thank you for all your stuff because I've been following you since the beginning.
Yep.
Thanks, Charlie. Call it anytime.
Okay. See ya. Bye.
Thomas. I see a bat signal.
Not yet, Tony.
Not yet, Tony.
Stand by. You said stand by. I thought he was standing by. We're going to our phone calls. I'm sorry. We will go to Jules, get your act together. We're going to go to Ryan, Seattle. Ryan in Seattle, what's up?
Hey, guys. Thanks for taking my call, and thanks for being there.
Thanks, man.
Bat and Sauce, I got stuck in kind of 2 iron condors, and I need your coaching on how to kind of adjust them. So one of them I had to kind of roll in order to try to get a credit, and so I ended up rolling it, and now I'm in the ES June 20, and on the put side, I'm long the 4325, and I'm short the 4950. And on the call side, I'm short 5425, and I'm long 5750. That's one of the condors.
Yeah, so you have a big,
you got a big, wide, long delta.
Big, wide, long delta iron condor. And it sounds like you've already rolled down the calls, right?
I've rolled down the calls, and I rolled it out a couple months to try to get a credit, like last week.
Okay, so what's your question here? Would we do anything with this particular trade? Is that the question?
Yeah. So I guess that's the question for both of mine. Just some coaching of how you would handle it or what you think about it right now.
I mean, you've already rolled. Would you roll out to June?
Yeah.
Okay. So you've already rolled out to June, which has reduced a little bit of the risk, but I understand the concern because we got under your short strike on the whatever it was, 49.50, right?
Yeah.
So we got under your short strike last night, overnight, all that kind of stuff.
Well inside the range, 600-point range.
But yeah, here's the deal, Ryan. You have a tight wide strangle, but an absolutely huge credit, and you've got like 125% IV rank right now.
You need time to go by.
Yeah, and you've got a 600-point range, like Tony said. You made your bed, dude.
You're probably going to get tested on the downside
and the upside,
the middle of that spread, and the middle of the upside on that spread. You can call in today looking at the downside. You're going to call in another time and be looking at the upside because you're so tight.
I mean, how big is your credit right now? Like a couple hundred points?
Oh, I'd have to look. Sorry, I don't have my account open.
That's okay.
It's got to be. I'm thinking it's got to be like. I don't know.
It's irrelevant. I mean,
got a lot.
I think we sit with that position.
You got a lot of wiggle room. I sit with that position.
You need 2 things. You need the market to calm down inside your range, which I think is going to be the hardest part of it, and volatility to contract. Volatility contracts, you will start getting paid even if you're closer to one side of that iron condor. So I think you made your bet. I think on entry, maybe the ES is too big. I think people forget about how big ES really is because of span margining on entry. But I sit.
Well, you've already made the adjustment by rolling out to June.
You did
I sit tight.
Yep.
For now.
Yep.
Okay. All right. Thanks, guys.
You got it. Good luck to you. State College, Pennsylvania. Justin, just in time. We got to you. What's up, my man?
Hey, what's going on, guys?
How's it going?
Hey, Justin.
My first trade with this platform a long time ago was right at the beginning of the Ukraine war, and I followed Tom into through his wish list into an iron condor and an oil stock, and it took me down. So I've been around long enough to know that Tom always takes you down. But one of the things.
Welcome to my.
I missed it. We haven't harped on that long enough. Thank you for bringing that up.
Welcome to my world.
Yep.
Right. So I think. It's easy to say, the politics thing is frustrating, but the Ukrainian war, they could have pulled back at any time. The ship that was stuck in the canal could have gotten unstuck at any time. We were waiting for vaccine news to drop. And I think when you get tied up into the specifics of one volatility event, it blinds you a little bit. So, when things get complicated, I try to make them a little bit simple. And the best thing that you guys taught me is if you're uncomfortable with whether it's a put credit spread or a covered call spread, that you can always just sell the other side. And if you don't want to give up your position entirely, you're hoping it'll come back. You had a direction for a reason. You can always just cut your deltas in half and get back closer to, the assumption you had when you put on the placement, because volatility means that all these positions have widened out. It's like a bigger soccer goal net instead of a hockey net. And I think, when things are complicated and confusing, knowing a rubric like just cut your deltas in half and sell the other side, and if you want to also roll it out while you're cutting them in half, has really helped me stay calm in a complicated market.
And
that was it. I just want to highlight my favorite teaching from you guys.
Thank you, man. I appreciate it. And sometimes, we get caught up in the moment too here and talk about bullshit we don't know anything about, and really just should be sticking to trading. So I appreciate you bringing us back.
I'll speak for yourself.
Except for Tom. Tom knows everything as we do. Hey, and Justin, well said.
I'm always mad about all that stuff too, man. But when it
emotions
comes to
get high,
managing the money, cut the deltas in half and roll out once.
Yep.
Hey, I just did it again in gold. It's my third trade today.
Yep.
Third roll up. So yeah, I got you. I hear you loud and clear.
Awesome, man. Great. And for that trader who was looking at ES, and for other people who trade futures, we did a great cherry picks yesterday with a nice downloadable PDF file that gives you all the notional value of all of the futures, so you can really see how big these futures are, not only the price but the multiplier on them. Really interesting stuff. So please remember, gold futures are like 300,000 in notional. I mean, even the S&Ps are 260,000. So
they
what's that?
Yeah, they're pretty close.
$260,950. $950 off. With the move today, I'm probably a little bit low. Freaking love him, man. I freaking love him, but you do make me drink. Chicago, Vera in Chicago. Vera?
Question. Yes, can you hear me?
Yeah, we got you.
Yeah, thanks. Hi, Tom and Tony.
I've
been with you guys for so long, from the Pinkos swing times. I have two questions. Like most of us, I'm in underwater in ES puts. So my question is, like, I rolled the untested side, which is calls. So I was just fighting the good fight, but yesterday spooked me off because, like, I was losing money on the calls as well. So my question is, like, how long do we do I rolled the calls today, but like now again it is showing that I'm losing on the calls. So do you constantly adjust the calls that like roll down the calls, or like is there any time that you stop, like, no, I just put the call until it breaches, now I'm not rolling down the call?
Sure. There's times when we the two times we back off, Vera, one is when Ivy rank drops, which is not the case today. Right. And the second time, sometimes when we have market environments like we have right now, the expected move is so great that, like, I feel like I don't even want to put myself in a world of hurt if I roll everything down aggressively. So I've been like much slower than I usually would to roll down calls, because I kind of feel like, well, we could have a sharp rally here. Who knows, and exactly. So I do think there are times when we take a little bit of a subjective view. We try to be very mechanical all the time, but I think when you get a move of the magnitude that we've just had over the last couple of days to the downside, I think that there's something in the back of our heads that says, you know what, I'm going to be a little less aggressive rolling down calls here. At least that's been my case. I can't speak for Tony.
It's been my case, and it hasn't paid.
It hasn't paid.
And I don't think rolling down the calls was going to pay that much either. I've been looking at prices of calls.
Exactly. And you don't want to lose on both sides. So that was my concern. Like, okay.
Yeah.
Yeah. So now the question is to Tony. Like, okay, this is like trade related. If you have a couple of seconds, like, so I don't understand. Like, I know that when you, if I remember correctly, when you said when you voted for the Trump, you did it because you wanted to the balance of the power. So I'm a software developer. So talk about a single point of power. Let it be Trump or someone else, XYZ. I don't think we can call XYZ because somebody has a company XYZ. Let's say ABC. It's not the Trump or whoever. Like, is it make sense to have one person to have a power? Like in software terminology, we call it single point of failure. Like to have that kind of power to do anything that will tumble the whole global market. So like, should we not have any checks and balances that, okay, when the decision he makes, which is capable of affecting the global market, then there should be some checks and balances, like whatever it is, like somebody from the Treasury Secretary or whatever it is, like somebody else should, okay, endorse that, okay, this decision is good or not, because like, it doesn't make sense. The Trump keeps saying that, okay, they will pay money, but like if I understand correctly, if you're tariffing 104%, if a company in America is paying $100 for a good, now they need to pay 104 plus 104, which is like 204. So if America is paying, so why Trump keeps saying that, okay, other companies are paying or whatever may be the case, but like if a decision that can affect the global markets, then does it make sense to be a single point of failure, like one person, let it be the President of the United States, should have that, or someone else should have checks and balances?
That's a mouthful. I'm going to let Tony repeat it.
I didn't catch most of it.
It was hard. It was hard for us to hear it, but appreciate you sharing.
Tom, it's a simple terms like a single point of failure. I'm talking about a single point of failure. Does it make sense to any one person to handle the power that can actually destroy the global markets or that can hurt the global markets?
I don't think so. Like, I think that's a tall ask.
Yeah, I mean, like, so now that, like, see, we always said we got a pandemic, so the next time we are preparing for the pandemic. So once we are having this tariff stupidity, now is it make sense to prepare for the next time, whoever the president comes, he should not have, like, okay, he should not have that power to increase or decrease or do whatever, so that there should be some other checks and balances so that we don't get into that situation again one more time.
Yeah, I mean, I think we all agree there. This is, I would argue this is a ridiculous abuse of power, yes. And we have checks and balances usually in place, but it's not working. But listen, Vera, we've got to run. We got too many people on. Thanks, man.
Yes, thank you very much.
You got it, man.
Very much.
You got it. Saznov, it's brilliant. I know what you have to do, but you only have another day or two to do it because I'm going to get my hearing aid soon. Anytime you disagree with me, whether it be on a trade or anything in this world, speak to me in an Indian accent so I can't hear it. Because whatever tone it is, it just doesn't register in my ear, but you only got about another 48 hours to do it.
I don't think you could have picked that up with perfect hearing. It's hard for you.
No, you're good. You're going to see, Saznov. I'm going to hear everything you say, and I'm going to be very disappointed in you. Let's go to Los Angeles. Baharam.
Tony's always with it.
It's a tough one.
I'm sorry, man.
Okay.
It's been a tough freaking month, man. Go ahead.
I know. Yeah. Real quick. So I didn't hear anybody else mention this, but intraday margin for futures disabled, right? It's been like 2 days. I called yesterday. They said the risk team has decided that overnight requirements is what it is, so you don't get the.
Oh, did they? I wasn't aware. Did they change the intraday to overnight the last 2 days?
Yeah, if not 2, maybe 3, but for 2, I'm sure.
Yeah, I wasn't aware. I mean, I haven't noticed it myself, but you're probably right. I mean, sometimes when markets get crazy like this, we do change the intraday to overnight just to protect the firm. You know,
there's no point in trading futures if there's no intraday margin aside from the options, right? There's no capital efficiency. It's 1-to-1, right?
You mean if you're trading futures options?
No, futures by themselves. Like you might as well just, right?
He's saying you're not getting any buying power. Really.
You're not. Hold on. What are you saying? You're even at the overnight requirement, you're still getting a huge. It's still huge leverage. But what are you saying?
It is. No, it's just the same number as its price. So I thought it was like 1-to-1. That actually messed me up 2 days ago too.
They sent me a link. I guess I didn't understand. I'll go read the link again. Let me mention one more thing. Yeah, go ahead.
No, go ahead. No, to you.
I was going to say, I think there's a bug in your IV 5-day change. Go look at silver. It says negative 241. How could that be?
Yeah, you got to look at SLV because /SI futures keep rolling. So
Yeah,
you get
because
different futures. Look at SLV, the IV rank.
But you get what I'm saying? The IV can't drop more than 100%. It says 241.
Right. You look at the IV. You look at the IV IDX.
He's looking at the IV chart.
Here. So if you look at silver, SLV is the equivalent of /SI at the ETF. The IVX 5-day change in silver is up 7%, and the IV rank is 76. That is more accurate than looking at /SI, the futures options, because it picks up different futures and it skews the number. So look at SLV for your 5-day change on silver volatility.
Okay, so then it's similar thing with Bitcoin future.
Any future. The IV rank and the IV index 5-day change will not be accurate. Look at the equivalent ETF.
That's why we use. That's also why we use ETFs for the delta valuations, just to keep everything consistent.
That's correct.
But then so you're saying go by the ETF numbers, but if you still want to trade the future,
still trade the future. Go right ahead. You can hold confidence knowing that volatility in silver over the last 5 days is up 7%.
Got it. The one thing I was going to ask was, could you guys, everything is great, but the API, if you have a problem, apparently there's no one to talk to. You got to email, and if you search on YouTube or Google, there's a bunch of scammers putting out stuff that, hey, I made a bot, hook this with this service that I bet you guys don't find kosher. So it'd be nice if you guys, if it's a legal thing that is not stopping you, put out some code that's like or samples like that. It's just your API, and with like getting options history and stuff, it could be better.
Do you mind sending me a quick little email on what you mean about the API? I don't know. I don't follow the API. Are you saying there's some scammers in the chat?
No. On YouTube, they go, hey, if you want to make a bot, come sign up with this. It's like too many of them.
Oh my God! I delete them. So on my option trades today, every Tuesday and Thursday, I try to answer everybody who puts something in there because I just want to be diligent. I have 92.
I don't think you guys can delete it. Yeah.
Yeah, I can't delete it.
Email.
I have 92 people talking to me on there about. Can I move my money to Binance? Send me a telegram with money. I just can't keep up with it. I finally stopped last week. I just finally stopped. 92 in one chat.
I had somebody yesterday, an employee here, come over to me and say, hey, why are you asking for my home cell phone number?
Yeah, right.
And I'm like, that is not me. And it looked like it was crazy, and so
I bet that guy can sit in for Jacob.
Yeah, it's crazy. But all right, man, we got to run.
Thanks, man. Appreciate
one last thing. How would it be impossible to have a liquidation buffer number? So, I know it's up to a person when your buying power is negative, and they go like, okay, now we're going to liquidate you. Wouldn't it be better if you're looking at all these, any scam site, they tell you like the buffer, so you have some sort of, but like when I called it and it was happening, it was totally like up to a person. But like I bet they're going by some number, right? That's some hard numbers.
It's not impossible, but it's so imperfect because liquidations, like we don't want to be held. We don't want somebody coming back to us and saying, well, you told me my liquidation number was this, but then this happened.
Right. But Tom, like when they do it and you have no idea if you're going to do it and it's up, that's sort of worse than like maybe a range. You're like, hey, between this and this percent, you got room or.
I don't hate that. That's why we put the buying power usage on the platform because we want.
If you go look at all these, I said like all the shittiest exchanges in crypto or whatever, people I guess would be used to that. I'm sort of used to seeing that. So yeah.
But those guys don't. There's no. Yeah, they do have it, but they're one trick.
I know for you guys it's different.
They're one-trick
just
ponies.
have that-
They're literal one-trick
right.
ponies. There's nothing there.
No,
It's
I know. It's just that feature is useful to have. I'm not saying your system's similar. Just to have an idea of like, hey, you have 10 and 25%.
All right, man. Got to move on. I appreciate it. Appreciate the phone call.
Got it, Brown. Thank you.
And I would stop the phone calls. I'm going to get to Boynton. I'm going to get to Indiana. I'm going to get to Los Angeles and Connecticut.
You don't have to go, Scott, if you want. We just finish up.
I put Scott away already. I made that executive decision. Thank you, Trump. Jim Hughes, Boynton Beach.
Hey, Tom and Tony.
Hello.
Hey, Jim. What's up, man?
Hey, I still have. Remember those dog tags you guys did? I
100%.
have an original dog tag.
I just found mine, and I don't have one, Saz.
I have one.
I have blank, which you don't have. Because it was the first
I got
prototype.
a number on the back. It's somewhere in the 100 range, or the 200 range, something like that.
Yeah, it's good.
Yeah, and you don't have one. You couldn't find it, and I will give you $100 if you just tweet out a picture of it.
Go ahead,
Hey,
Jim.
Jim, go ahead. What do you got?
Hey, everything's okay. I'm keeping my size small. I just have some leftover legs that originally started out as an iron condor, and I've been rolling it since January, and it was making money. I was okay Thursday, Friday, and then it got pinched like Monday night.
Mm-hmm.
So the legs right now, the calls are 529, and the short puts are 522.
Mm-hmm.
So I aggressively rolled down the calls, but I haven't gone inverted yet.
Mm-hmm.
Okay.
And this was the question. I have one more put out there than I have. Oh, I'm sorry. I have one more call out there than I have puts because it used to be an iron condor. So at much better prices, I took the spread with a long put, and I took that off. So it's a little bastardized, out of balance strangle.
Understood.
Right?
Yeah, got it.
I don't know if I should add that leg back on deep in the money on the put side.
I wouldn't do anything deep in the money.
Yeah, why would you sell it deep in the money?
Right, like if you want, it doesn't matter. Like the market doesn't care where you have it on. You took one off. You did a great thing. It saved you some money, made you some money. It was a good thing. You lost less. It was a great thing. If you want to sell another put,
out of the money.
Out of the money.
Yeah,
is my answer. But whether or why you do that is 100% up to you.
Yeah.
Yeah, the other option is I can just go inverted, roll down.
I would rather you not go inverted.
I mean, you could do that too. It's your call.
Okay.
I mean, it's your call.
Is this thing kind of dead as far as just nursing it? Like my decay is only 80.
Yes, it's probably close to dead, if not dead.
Yeah.
I mean, closing it and reestablishing, that would be buying the guts and selling the wings. Yep. You could do too. If it's already at full max loss, or minimal amount of money left to lose, holding it wouldn't cost you any money either.
Or roll, at this point, rolling it out just to give yourself a little bit, just to take advantage of all the time decay that's coming up soon.
Yep.
Yeah.
Yeah, because the call side, I should have some time decay on, right?
Yeah,
and I
yeah.
should have maybe a third of the intrinsic left.
Yep.
Agreed.
On the put side. Okay, I just didn't know if I had my time. Thank you, guys.
You got
Appreciate
it. Thank you.
Thanks,
thank
Jim.
You
Good to hear from you.
Yeah, thank you so much for your time.
Yes, sir.
You're welcome. Is it Eric in Indiana, or are we just there?
No, you're
Eric in Indiana. Eric in Indiana. Thank you so much for calling. Appreciate you holding.
Guys, thanks for taking my call. And Tom, I wrote an email to you like last year, and you wrote a really nice long reply. I was talking about algo trading, so I really appreciate your personalized customer service here. In any case, I'm just calling because you all can roast me. I'm just like a long stockholder. I sort of retired last year, working on my own small business. I have like several years of cash, which is great, but I'm sort of freaked out about the current market conditions. And I've always sort of wanted to get into more market neutral strategies, but right now I'm just long in everything. So I sort of wanted your take on what someone like me should do now when I'm sort of freaked out about the market. I've always ignored and avoided panicking in the past, but right now with all the structural change, I'm sort of wondering what to do. Like, does it actually make sense to finally, cash out half my position or something and just wait to see what happens? I'm sort of confused.
Yeah, well, it's always tough it's always tough to deal with something while it's happening, as opposed to being, a little more proactive. In the future, you'll be more proactive. I think the way you can start, like you said, you're long a bunch of stocks, right?
Yeah, it's like my portfolio is like 3 to 4 million. It's all stock, basically. Indexes, whatever.
The one nice thing right now is I probably wouldn't touch any of your long stocks because you're, like
So
like
in
you
the word,
said.
you haven't done anything at this
Yeah,
point.
you haven't done anything
We're at
yet.
recent lows.
I'm not-
Who knows where we're going, but yeah.
I'm not going to puke anything out, that kind of thing. But what I would do is, because volatility is just so high here,
sell some calls.
I would sell some calls I would sell some out of the money calls.
And if you don't like it, I'm sorry to interrupt you, Tom. And if you don't like it in your individual stocks, if you have the buying power, and it sounds like you do, you could do it in SPY. You could sell call spreads.
I don't like that. I'd like to see you sell some calls against the individual stocks in May and June, out of the money. Just take advantage of this incredibly high volatility and start to take in a little bit of the credit. And, maybe you want to sell them up around kind of your purchase price or something like that, just something out of the money, and just see how that works for you and see if you can take in, a few $1,000s. Maybe you take in $5,000, $10,000, $15,000 on your portfolio, and at least that'll break the ice for you and give you kind of a game plan and some confidence going forward into the future.
That's pretty interesting. Thanks. What do you sort of long term? What would you say about? Would you recommend someone like me who's actually interested in options trading and sort of philosophically in line with market neutral? Does it make sense for me to sort of get rid of a ton of this and just allocate like half my portfolio to more like your kind of strategies, or what do you? What do you all recommend?
You've probably done really well by being long stocks over the last, however many years. And so you might want to mix up your approach by, selling some puts to get long instead of just buying stocks to get long. And, you might sell puts instead, just give yourself a higher probability of profit, some maybe a little bit easier money, and see how that works, just to mix it up. You got to mix things up. You're too one-dimensional right now. So I would start off by selling calls against your long stock, and then I would mix in, after you've had some success with that and you've proved concept, I would mix in some short puts in the future.
Awesome. Really appreciate your advice.
Thanks, Eric.
Good luck to you. Yep. We're going to go to, I apologize, Eric in Indiana. Eric?
No, we just had him.
Paul in Los Angeles. Good
morning, guys.
Good morning, sir. How are you?
Paul.
Everything's good. Listen, I'm one of those people like, I don't know what I don't know, so that's why I'm calling you guys.
Okay.
Tom, there's a couple of videos from many years ago, and I don't even know if they're still up on YouTube, but you did a couple of talks where you went into the danger or the risk of having so much of the world's capital invested in just a handful of positions that were controlled by, or these huge funds that were controlled by, like just a handful of people.
Yeah, we did a bunch of things on concentration of risk, Paul. You're 100% right.
Yeah, so now the chickens have kind of come home to roost, huh? Because you've got, a handful of people in the world that have shaved, trillions of dollars off the market. And everybody's looking for Jerome Powell to come in and rescue us. And Jerome Powell can, if he says the word might, or if he says the word should, there's like a real big difference in the market. So I'm wondering, given everything that's going on and the pain that people are feeling right now, and I don't know what the pain is to the firm tastylive. I don't know if you really want to talk about that, but is there a need for some kind of reform here to keep this kind of thing from happening, or is this the way it was designed, or is it time for a new design? That's my question. And my comment is, I hear a lot of people talking about, the patriotic thing to do right now for the good of America and the good of our children is to go ahead and withstand the storm, and, maybe you're going to lose a little money. But then you talk to those same people about repatriating American dollars that share of taxes, and they go nuts. They want to go grab their muskets and, see the whites of their eyes. I just think that's a paradox right there. That's all I got, guys.
Thank you.
It is a paradox, and I'd love to cover that. We just don't have time because I feel very strongly the same as you do. But let's talk about like the firms and your money and things like that. As far as like Tasty and other, firms like us, brokerage firms like us, we don't manage money, we don't make markets, and so firms like us we're totally safe. There's nothing, there's been no risk at all, and I don't think there will be. There wasn't even any risk
to the balance sheet.
No risk to the balance sheet. Nothing like that. These firms are as strong as ever, and that's not the issue. What scares me
we're not Lehman, is what.
No. We don't take positions.
And other brokerage firms like us are not Lehman.
What scares me about these moves, though, with respect to the industry and to the customers, is that anytime, most customers lean long. That's just the nature of the bias is to the long side. And anytime that markets go lower and anytime that customers lose money on overall, and this is for every firm. This is for Schwab and E-Trade and Robinhood and every other firm out there.
Keep going. Every
time customers lose money, I don't like it. It gets me upset because I feel like, sometimes it's necessary for it to be organic, and sometimes I feel like it's not necessarily organic, and that pisses me off. But if you're talking about risk, like firm risk and systemic risk and market structure risk, I do not see any of that. In fact, liquidity right now is as good as it's ever been, and I don't see structural risk at all. Let's put it that way.
Thank you. I have one more phone call I've got to get to.
Paul, we got to get to the last call. We're going to run out of time because listen,
Thank you so much.
here.
I'm going to go to Connecticut. I got Jack in Connecticut.
Last caller.
Hey, thank you. I just want to thank you guys. After I'm new to this, beginning of the year, I had blown up an account 25 years ago because I was not following your most important rule, which is managing size and risk. So I'm not freaking out, even though I could certainly be in a better position here. Quick question: how do you manage a credit spread that has gone pretty deep in the money with about 37, 38 days to go? Do you just sit tight? At what time do you worry about assignment?
Assignment's not going to change your risk on an in the.
Is a deep in the money credit spread is short.
Oh, deep in the money credit spread? I'm sorry, I thought it was just naked.
No, deep in the money credit spread.
So it's not going to change your risk at all. So if you're obviously, I believe it's a losing trade. That's why you're worried about.
Yeah. It's a losing trade.
You will get assigned, and the very next day, regardless of how much money you have in your account, whether you can hold the position or not, you will be able to exercise your long against what you just had, and you will realize max loss, which you have already now. Whether you want to admit it or not, you have max loss now. So nothing is going to change for you. Maybe there'll be a small commission in there, but it'll be a de minimis amount of money. It'll be nothing. So your risk doesn't change. If you're worried about assignment because of risk of losing or making money because of that assignment, it's a nothing event.
But you could roll forward and buy yourself some more time if you wanted to. I mean, if
you could roll for credit.
Yeah, if you could. Or maybe even a small debit, whatever. But, unfortunately, given the size of this move, a lot of people are short in the money vertical spreads, and they're deep in the money at this point, and you're kind of just hoping, maybe hoping for a rally or something. There's not much else there, right?
Yep.
I mean, I wouldn't sell it at the money call spread against it, that's for sure.
No, I think you just sit.
I wouldn't make it worse.
Okay. All right. Thanks. A little levity. You know what I really found out? I sucked at trading 25 years ago after blowing up an account.
What?
Was my cat ran across the keyboard and hit some hotkeys and made me $2,000 in China. So at that point, I knew that I probably needed to go in a different direction.
That's a good one.
Yeah.
All right. Take care.
Thanks, man.
Jack.
Thank you.
Appreciate your time. Sadnov, I do. Here's the bright spot. Apple up $5.40. I mean, Apple's been crushed with everything that's been going on. Maybe whether it be price of the stock or maybe environment changing, Apple's up, but everything else is pretty much meandering around.
Nasdaq's flat, but the S&P's got hurt.
Around unchanged. Well, even the S&P's down 31. They were just up a second ago. They've been down more, obviously. Nasdaq was up a lot more. It was down a lot more, obviously wrapped around change. The Russell actually got to unchanged, Sadnov, while we were talking. It's down 2/3% right now, down $30, and the Dow is down 300. We didn't get to all the slides that everybody had made for us on the research team, but I appreciate them doing that.
Let's thank all the callers today, and also let everybody know, because we take these calls completely random. So there's no, we don't
screen it.
Yeah, we don't.
Right.
Mm-hmm. Yeah. So thanks so much for calling in. And Liz and Jenny should be on the floor of the SIBO today.
They should be, and I think if you want to see all the action down there, nothing better you want to hear something, talking about a squawk box, you want to hear something, watch their show. We'll take a quick 90-second break and come back. We got more Tasty Live, immediately following these messages with Liz and Jenny next. Peace.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number one for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
The Liz and Jenny Show is probably my favorite hour of the day. It's somewhere where I get to be with one of my best friends that I've known since I was 14 years old and do something that I love.
Liz and I always say to get a trading buddy, and we are each other's trading buddies, and I wouldn't know what I would do without her.
People get to take a look at how our minds work as ex-floor traders now transitioned into self-directed investors. What is wonderful about being on this show is that you see the good, the bad, and the ugly, because not every trade is a winner. If it were, the game would be rigged. So you get to watch us manage our winners, and you get to see how we look to get out of a trade that might not be going our way.
My biggest piece of advice to beginners is to jump in, but stay small.
Putting it out there and doing it in small increments, you will learn more than ever reading anything in any book.
So stay small, but jump in.
Top kid.
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tasty Trade. Genius loves company.
To my favorite day of the week. It is Wednesday, and it is time for the Liz and Jenny Show live from the SIBO floor. My name's Liz Deerking. The beautiful brunette to the left of me is Jenny Andrews.
We have the SPX pit behind us, and it is crazy today. I can only imagine how it's been. It would have been nuts to be down here yesterday with that. I am losing track of my days. Was yesterday the big reversal?
Yesterday. No, the day before. Every day is a reversal. Every day is a reversal day. It's been up, it's been down, we've been all around. Even today, this morning, I was telling Jenny, I woke up at 5 a.m., SPOOs were up. Not a lot, but up. Then they crashed, then they rose like a phoenix from the ashes. Now we're down again. I mean, we don't know what's happening.
She wakes up a lot earlier than I do. When I woke up, SPOOs were down about 100.
Yeah, that's true.
And then they were up while we were taking the train, trying to place trades. Good thing we waited on some of them, because now we're down. All those SPOOs are only down 20. We were down 40 as much as I saw.
Yeah, I mean, here's what I love about being down here right now. You can actually feel the energy, and every trader that walks by, we're trying to talk to, they can't talk to us because we know this. When they're busy, they're busy. So you're not going to get the stories, you're not going to get people chatting. Look at that. Look at that. It was right that way.
I know people ask us to grab some traders and get them on air, but like Liz said, when they're busy, they don't want to leave the pit. A couple guys were walking by, and we tried to grab them for some info. We got a little bit of info.
Okay, we can't say who it was, but we're saying it was so crazy last week that some deep in the money puts for people to get out of them had to sell them $16 underwater.
Okay. If the customer sold them $16 underwater.
No, they had to give up money in order
to get out of them.
To get out of them. It's a fire sale.
But if they were trying to take profits, if you're trying to take profits, if you were long those puts and you're trying to take profits, you'll give up money trying to take the profits.
Yeah, but no, but keep in mind, I mean, it's a bloodbath out there. People are trying to get out. People are selling all assets. The bonds right now are the big story, I think. So if you want to take a look at the bonds.
Yesterday, there was a drop in the bonds, and yesterday we got in, we sold a put spread in ZN. And then they continued to fall after our show. If you take a look, ZN, ZB, whatever you want to look at.
No, so we're in ZN right now. That's what we put on yesterday. We sold the 111, 110, and the 111s were the out of the monies. Significantly out of the monies. Yeah.
And now we've got ZN trading 110.20, and if you look at that chart, if you want to pull up the chart, you can see the massive move that they've had. I mean, it's crazy. The move they've had in the last.
And I know there is, like, all eyes are going to be on treasuries today because there's a bond sale today, so we'll keep an eye on this. There's a treasury sale today.
We'll keep an eye on it, and I think their FOMC meeting minutes coming out later today too.
I did not hear that. I'm going to check with Frank the Great because he usually tells us.
Go check on our
2
calendar.
p.m. FOMC minutes, March meeting. So the March meeting, just the minutes are coming out. So the meeting's over. I think it's been digested, but people that want to look into it can look really far into it.
Okay, so
are you going to read the minutes?
I might surprise you. I might surprise you.
Have you ever read the minutes?
Don't you remember the last time I watched the entire talk?
And I call her. I was like, "Who's in the background?"
Who are you listening to?
It's my friend JP.
Funny. Okay, we have a busy show today. We actually we've got a study from Jacob, and Jacob did a really cool piece looking at just zero DTEs over the last couple of weeks. So that's a good piece in the SPX zero DTEs. What else do we have going on today?
So we do. Now we're gonna, similar to what the boys did, we're gonna take our regularly scheduled program and maybe close it and throw it out. I do want to look at not unusual activity, the most active, because I think that's pretty poignant. You're gonna hear a lot of noise back there today, I think.
So far it hasn't stopped since we've been down
So far it hasn't stopped. And you'll notice too, and tell me if this is wrong too, you'll notice even the people that are walking by walk faster on a day like today. Instead of like that guy, rapid pace.
Someone even knocked over a water bottle behind me right before the show started. It's mayhem down here. Although it's interesting because the SPOOs, I know it might sound like on a normal day, down 100 to up to down 50, might sound like a crazy range, but it actually not as wild, since the market's open, not as wild as we've seen. We've been in a tighter range since the open than we've seen.
Let's look at this. I just went to SPX because we are in the SPX pit, so they're all the same versions of the same trade. Look at these 4 bars, Jenny. So the top to down move, and these 4 bars underneath here. So yesterday it was high of 5,052, low of 4,948.
That was crazy town.
That's a big move. Right?
Yesterday. You're talking about yesterday.
Yeah, I'm talking about yesterday. But if you look at those bars that are right down there, these 4, they all have these wide moves. So you asked which day was the flash crash? Yes. Right?
I want to give a shout out to the Tasty Trade team. We give a shout out to them of how accessible they are. They're answering questions. They're helping viewers. They're helping people with accounts. They're helping customers. I just got a message that they had the risk team look over my son's account.
Oh. Yes.
I thought that was really nice.
That is nice.
Yeah, that was nice.
That is nice.
I just got the message. The risk team looked at my son's account.
Now, who messaged you? Was this from A, Logan, or B, the risk team?
The risk team.
They said we're looking at your son's account.
They took a look at his account for me. They took a look at his account.
Did they liquidate anything for you?
No, I emailed them and expressed a little concern of just want to make sure he's not negative.
Okay.
And they said they had the risk team take a look at it for me.
Okay, good.
Now, are you going to email them and ask them to look at your son's account?
Yeah, I mean, I'm on it.
Because guess what? When they run out of money, they don't have any money to put in there. If they get a margin call, they don't have the cash to put
Okay,
in.
fun fact. My son's account isn't even linked. Like, your son at least has his checking account linked.
Yeah.
It's linked to mine.
Funny.
Yeah.
So if he has to send money in, how can it be? I think it has to be linked to a bank account that's in his name.
It's not.
It's linked to your account?
No. I'm sorry. It's not linked to any account, but he doesn't have anything in there. I just took money from my account and put it in his. I transferred it.
Well-
It has to be linked to an account. You're right.
Okay, but anyway, Logan's account is linked to his checking account. His checking account, he's a college kid. His checking account has very little money in it.
He's not loaded?
So I just wanted to make sure nothing crazy was going to happen in his trading account.
Yeah. And in this market, I will tell you, to your point, I know the risk team looked over your son's account, but I will give a shout out to Tom and Tony. They've been taking calls. Because guess what? What other industry, let's talk about this, what other trading platform, and I know there's a lot of trading peoples around here, can you call people and ask questions live on air?
Yeah, you're right. And
can't.
talk to the creator.
The CEO. Yeah.
I mean, he's not technically the CEO, but
What is he? Well, you could talk to JJ if you wanted to. You could call JJ.
But yeah, you can call in and talk to the creater, and they've been taking calls every day.
They haven't taken calls every day. Yeah, it's kind of crazy.
If we had a phone here, we'd take calls too.
The phone is ringing over there. We'll go get it.
Yes, okay, what are we...
One thing I want to do before we get into Jacob's study, this is topical, Jenny. I'm going to go to our positions. We put in one earnings trade yesterday. It was Delta Airlines. Everything tanked
after our show ended, and the market tanked, and I thought, boy, am I glad we didn't get filled on. There were a couple trades we looked at that we didn't get
filled on. Delta, we did. Now, if you take a look at it, Delta Airlines was down a ton on the close last night. So we are literally only up $17, even with the 0 DT or the 1 DTE, 2 DTE. Let's take a look.
I would say leave that till Friday and let's get our full $70 because it's expiring in 2 days and it's $3 out of the money.
Look at this. This means things are keeping their wings up. We sold it for what? $80? Something?
$68.
We sold it for $68?
Trade price, yeah.
Trade price. We sold it for $68. It is only up $7. Delta is still $3 away from it, and it's keeping its wings up.
So maybe these earnings trades aren't going to act. Okay, there comes a time, and we've seen this before. There's a time, you've heard us for years, we'll say like, we don't like to sell neutral strategies over earnings because the vol keeps its wings up because earnings are coming. Well, earnings vol means nothing now compared to market vol. Like market vol trumps earnings vol.
This noise trumps everything, right?
Yeah, so I guess if you're thinking, earnings vol, news comes out, the vol's coming in, it's not because the market vol trumps the earnings vol right now.
It does, and it's so funny because what we thought yesterday during their show, I never would have put on a Delta. A lot of times people do their earnings trades at the end of the day. We were in a free fall yesterday at 2 o'clock.
I know.
So there's no way I would have been like, I'm going to sell a put in Delta Airlines. But yesterday we were like, when the market was up, we were okay. It was like a lull. We're like, we're just going to sell puts in every earnings.
Yesterday, I had an appointment at 1 o'clock to get my hair colored. So when I went in to get my hair colored, everything was fine and dandy. I got out. She finished coloring my hair. It was like $2.55. And I went in my purse to get my money to pay her.
And she almost passed out.
And I looked at my phone. And I was like... And I almost walked out. And I started walking out.
Did you say, I can't pay you today, ma'am?
No. I started walking out, and she's like, Jenny, you forgot to pay me. I was like, oh, I don't have any more money to pay you.
Yeah, it was crazy. So you left a little early. We were in the studio yesterday. I was sitting there talking to Tom when everything turned around. We were having a nice chat about, the wedding and all this stuff. And then the next thing we know, it was like, Spoozy on 20. I was like, 20? That's I was like, they gave it up because they were up 200.
I know, it was bonkers day. And it happened so fast. Okay, so if that's going to be the case, if earnings vol isn't really going to matter and everything's going to keep its wings up, what do? Do you not do earnings trades? Do we only do them on Thursday because Friday's the last day? Like what
well, I'm not going to lie to you. I'm going to pick and choose. I think earnings trades are a level of engagement when there's no volatility anywhere else.
Yes. Now and now that our old rule of like I'm not going to go out and sell a strangle out in May because earnings are in between. That doesn't apply anymore because you're not selling earnings vol, you're selling the market vol. So I think it's okay to do whatever trades you want to do out in time.
Because the earnings don't matter anymore. Because take a look. I'll go back. VIX is only 51. I saw it as high as 58 this morning. The VIX is only 51.
Only 51.
So, but take a look at this. Delta, which had earnings, it's still got an IVR rank of 81. So everything is keeping the IVR up, right?
Right.
So now I'm going to go back to VIX.
So I just said, let's just keep. Whatever. It's not that much money. We can close them. But I guess the real question
I'm going to close it only because I don't care that much about Delta Airlines. But I wanted to see where the high in the VIX today. Was this today's? Today's? Oh, man, that high. Red numbers. I think I'm going blind. 59? Is that a 59?
The interesting thing, and I'll take a look. Oh, I can. 57.96.
Let me get out of that.
57.96 today's high in the VIX. The crazy thing. Do you remember on Monday? On Monday, I said you could have bought the 29 calls in the VIX that were the morning expiration
of this.
Were morning expiration, and you couldn't. They were $1
today.
They were $1.
Well, they expired.
Friday.
They expired this morning, but it's $10 at right now at $35.
Yes, to this morning. So they were the 29 calls. They were $1 on Friday.
Yeah.
And on Monday, they were still only pricing about a 35 VIX. So there was no fear. There wasn't on Monday. On Monday when VIX was trading 45, these Wednesday morning calls were trading for a 35 VIX.
Because what happened? Let's talk about this. And Kai did a great study. They did a good cherry picks yesterday. We're going to be talking about that for the next 2 days.
Yes.
But Kai was talking about how these events, these spike in VIX, have only happened like 0.01% of time, and then it comes right back down.
And usually you get the big spike and it comes back down, and it comes down quickly. And
because remember my volatility talk. This too shall pass. It's like you fall down, you skin your knee. Even if there's a fire in your house, this too shall pass.
What do you know? And I don't know.
See, people are running.
Don't trip. No running. I feel like a mom. No running in the house. Someone's gonna fall down the stairs. Okay. Do you know what's the longest period of time that VIX has stayed above like 40?
Above 40. No. I think it's like a 10-day period. No, maybe 2008. Yeah. But I'm actually, I love doing this to Frank. Maybe if we can get your nephew on, Frank, I need you to tell me how long the VIX has stayed above.
I don't know. I mean, you could go back and look at 2008, but 2008 was not just like a 1 week time. It was a period of a long time.
Yeah, 2008 was bad.
It wasn't just like boom.
Yeah.
I don't know. Okay.
But I am going to close our Delta.
Yeah, go ahead.
I'm going to take our $21 and run like a thief in the night.
I just can't believe ZN and ZB and the bond move. Are you gonna jump in front of this bond move and try to get longer? I know we this is a small account, so we don't really add positions. But if you were already in some bond positions, are you gonna jump in front of this move and try to add to it?
No, I am not. No, I got out of the TLT zebras. That's the one thing we might look at. So the TLT's down to 86. Let's take a look on this chart. Now, the cherry picks last night, which came out last night,
and it's
showed
amazing.
that ZB and ZN is how many TLTs?
So one ZB, just so people understand the magnitude of these futures, one ZB future is equal to like over 1,300 shares of TLT.
1,300. So let's take a look at this. So right now, and the zebras we do are 1 lots. That's 100 shares of stock. Look at this. Look at this TLT. This is a smaller nugget, so you can dissect it and do something in here. TLT's got an IVR of 135. This is a myrtleization of bonds. Is that a real word? Myrtleization. Is it a word, Steve?
I'll accept. If we were playing Scrabble,
You'd accept?
I might challenge it, but I'll accept it.
I feel like you would totally challenge. Oh, I had to look up a word in Jacob's study today.
We'll get to it. Okay, so do you jump into TLT?
So let's take a walk down memory lane in TLT. Okay, Jenny. So I'm just going to scroll by. The last time it was down that low was not that long ago, right around my birthday in 2023.
And it didn't stay there long. Right?
No, but don't you think this is different? So bonds have always been our flight to quality, meaning when the market is in turmoil, even when you're looking at the COVID lows, bonds didn't do that bad. They were where people would put their money. It's bonds and gold. And now it doesn't look like that's happening.
But I also think, everyone thought that they were going to lower interest rates, or they were going to start lowering interest rates, so the bonds were going up, right? When we saw TLT down in these lows not that long ago, and then they just started rallying, and everyone was jumping on the bandwagon, thinking like interest rates were going to start getting lower, and everyone was jumping on this bandwagon. But now, I don't know. I don't know what will happen.
But to your point, act like you've been here before. Take a look at this. This is this myrtleization. Here's a myrtleization right here. If you just look at that up there. There's two myrtleizations. That is the peak to trough on both of them. I don't know if this is the trough, but that first one, that's peak to trough. That was a bond myrtleization too. And I remember you being like, I'm gonna get in when I'm gonna get out when it gets to what, 87?
No, I got in probably like 80. I was getting in like 80. No, I was going to get out at 90.
Okay.
I got in around like 85, 86, and I was going to get out at 90.
Well, if you wanted to get back in, now's your time.
Then I was mad I missed it when it ran up above 90. Now I might get back in.
Yeah.
It's not bad here. The buying power, the nice thing about so many products getting cheaper, the buying power is much better, right? So you look at a TLT Zebra, it's only using about, a 70-cent put is only using $967.
Are you looking at a Zebra or a put?
Oh, not a Zebra, a Jade Lizard.
Okay, I already had the Zebra half in when you said that, so I'm just going to price it out.
When the val's 137, I don't want to put in a Zebra.
No, I hear you. I just wanted to price that out too. So for apples to apples comparison.
You're using $1,000 on a Jade Lizard.
Okay, so you have $1,000 on a Jade Lizard or $800 on a Zebra.
And that's a lot for TLT.
Well, a lot for an $86 product.
Again, I don't think those the zero extrinsic back ratio or the Zebra, I don't think with this vol is the time or place for them.
I agree. And you have the vol, so you can sell. All I'm saying is if you want to get a 1-for-1 bounce for the bounce, that's what the Zebra is. I priced it out because you said Zebra originally. I'm going to go, I actually like the Jade Lizard type thing. So you're going to go 79, 91, 92. So you're selling an out of the money put and an out of the money call spread for 97 cents.
That's
it's using $1,000.
That's using $1,000.
Yes.
That's if we want to jump in front of this down move in bonds and risk that it's going to settle down. Now, in TLT,
I'm not going to lie to you. I flip my cards over sometimes because let's talk about like synthetics. So if I've got a short call spread and a naked put, and that's what a Zebra is, sometimes I'm going to flip the cards over and just do a ratio spread to the downside. Where if it if I want to take a dollar, take a dollar and I'm willing to take that naked put, what if I bought the 85, sold 282?
You got to make it pretty narrow, I think.
No, $2 is not that bad in bonds though.
Oh, and then not define your risk at
all.
No,
you don't need to. If you're willing to take that.
But but that's using so much. That's using
1,400.
And you're taking in how much?
82 cents. And my break even is right around where it was.
Sure. That's
so sometimes I'll flip the cards over instead of saying I'm gonna, because this doesn't cap the upside. And if we pop up, maybe I'll butterfly it off.
And what if? And we talked about this yesterday. What if you look at? No, I was trying to look at Tony from Mexico's 111, where you could buy the 85, 83, and then sell the 80 or 81. Anyway, you've got that naked put, but one's more downside, one's more bullish, one's more bearish.
I like the 111. I think is downside protection.
Downside protection.
And the ratio spread kind of is too.
Right.
This is a broken wing ratio spread.
The 111 is a ratio. It's like a laddered ratio.
It's a laddered ratio spread.
So I don't know. I don't know if we want to jump back into TLT, but it does seem. If someone wants to play this move as a short term, like
Jenny, I'm jumping in at 81 for $1.
Just the 81 put for $1. Yeah, sure. Sure. And if buying power is an issue, because the 81 put for $1 is using $1,155. If buying power is an issue, bring it to the 82 and buy the 74. Then you're using $700 instead of $1,200. I don't know.
3 days.
What?
I'm hopping this in. I'm gonna go with the 81 for $1.
Yeah.
Shipped, sent. Okay, now let's go. I'm going to pop into, that's working. Let's go into Twitter first. We'll get to Jacob's study, I promise you. But let's go to Twitter first, okay?
Sure.
And we're filled in that.
Okay, we're
So
filled.
I'm going to go top down.
I think as far as big movers today, that's just like, the glaringly obvious big mover today.
The
And
bonds.
oil. And oil.
Bonds, oil, and did you see gold? Gold is finally a safe haven too. So gold is up.
Gold is up to 3,100.
Yeah, so it's back up to 3,100 because it did take a little move down. It's gapped back up. It's now doing its job as the flight to quality. Is Bitcoin up? I want to take a look at that.
It's up, but it's only 77,000. So
it's not up.
We
just don't know when it. We just don't know
what time it resets. But take a look, and I'm just going to say MCL because it's the micro. But take a look at MCL, and this is the mini oil.
That looks like bonds.
This is. It looks worse.
Yeah.
It looks worse, and so I'm tempted to. I don't know. Again, who wants to step in front of the train? But I'm tempted to sell some puts in MCL too.
So MCL is low. You can go all the way to the expected move. Look how far the expected move is. The volatility is 73% in the 30s, or 72% in the 36-day. 121 IVR. Your expected move for this cycle, I listened to somebody today and they said take the expected move times 1.5.
Oh, I heard that.
Yeah. So I thought that was pretty interesting because you can sell the 48 put
for $1. That's what I was looking at. 48 put for $1.60.
So, and if you only wanted $1, I'm gonna see how far I can go down because that would take it by 1.5.
Honestly,
45 put. And you're putting up $428 to do it.
I would say, and again, I don't know what's going to happen with this, and this is a naked option, and there is risk, but I would almost say this is a better use of capital than TLT.
I agree.
Because in TLT we were using $1,000 for $100. Here we're using $500 for $160.
And then we can just take delivery on our mini oil.
Okay, get our mini oil tanker, can pull up.
It's a little tanker like this.
What do you think that oil has had such a fall?
We've seen it go negative, Jenny Andrews. I feel like we're one of those SNL skits. I have seen it negative.
I know we've seen it negative.
And I'm telling you, my biggest loss to date is in CL, but MCL I can handle.
MCL, a mini. I'd like to see Dr. Data's sheet right now.
You know what?
Tell me
I'm not
big...
going to lie to you. I feel like my biggest loss to date has been altered.
Yeah, that's the olden days. In the olden days, your biggest loss was in CL. Fast forward to 2025. What is it now?
I don't think there's one product. I think it's a culmination of all of them that are taking me out. With the vol exploding and the short puts that I've been adding in, it's not doing that well.
I don't know what my biggest loss is. I'm going to look today.
I know what yours is.
What? Tell me.
Boeing.
Not anymore.
Oh, you have bigger ones?
That was long. That was a decade ago. And I got into Boeing. I was looking at all of the defense stocks yesterday.
Oh yeah.
Well, I looked at Lockheed. I was talking with my son, so he bought some shares of Lockheed Martin. Bought some shares
What
of
is
Boeing,
happening with teenagers? Well, your son's 21, but so I got a phone call from 3 18-year-olds saying, "What defense stocks should I buy?"
Really?
Yes. Is there like a memo that they all
Maybe
get?
they see it on what are they
TikTok?
on? I don't know what
These days.
I don't know what they're on, but whatever they're on, they saw something because they're all calling me about what to buy.
Yeah, so I got 3 phone calls about defense stocks.
And you know how I told one of them, American Airlines, I looked at my text, I accidentally sent him AA instead of AAL.
No.
Told him by Alcoa.
Alcoa is the way to go.
I made a long list and accidentally I wrote AA. Funny. So are you going to sell those micro puts?
Yeah.
MCL?
Yes, I am.
I'm actually glad you're the one pushing the button today. So if the wheels fall off tomorrow,
when I get the margin call, who this?
Margin call, who this? Let's push the button.
Fortune favors the brave. I'm gonna do it, but I'm going
I'm going to
conservative.
guess your biggest loss is in the Russell this year.
No. I've actually done okay in the Russell, ironically. No, don't get me wrong. Not good, but not as bad as a lot of the other stuff.
Okay. All right. So you sent the so far.
So I'm selling it for 107. Okay, that's in. We're filled.
Okay.
What could possibly go wrong?
Hey, look. This is what. I don't know what to say, but
TLT, GTC going in.
Fortune favors the brave, Liz.
That's what I said.
Tesla's up to $9 right now.
Yeah, it is. I'm long Tesla. I'm long Tesla because my son's long Tesla, and I got to keep an eye on his account.
Yeah, and coin, I'm long. Like one of my bigger products that I'm long is coin, and I say bigger products loosely because it's only $155 now. But that's up too today, so that's good. And you know what else is up? Intel. Making a growing comeback.
Oh, look at that. Okay, 80 cents. That's a big move for Intel.
Yeah.
All right, now I'm going to go back into Twitter. We're going to go top down and get to all this stuff. Like I said, we will probably get to Jacob's study. If not, we can do it tomorrow. Oh my gosh, this is so funny. Jimmy, bye, 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 bye.
Look at that cat.
So cute. Okay, thank you very much, Jimmy T. I believe you're a new tweeter, and I think there's a lot of people that are dipping the toe in the water and trying to buy in this. But
everyone be
trade
careful.
responsibly. Like, put little bits in at a time. I understand that people are looking to buy the dip, but we don't know what this market is going to bring.
We don't know when the dip is going to be, and I say this all the time. But someone called and asked me, should I just buy SPY? My response, because it's burned in my mind that in COVID, SPY got into the 2000s, low 2000s. So we're nowhere near that.
And
so
only 5 years later.
I only pick products that are already at the bottom of the. I go back to COVID lows. I'm like, okay, this is back to COVID lows. I'm in.
Yeah, and there's a lot of stuff that's already back to COVID lows.
So be very careful. Be very careful, and also, and we talked about this yesterday. Be aware of the notional value versus the margin required to put on that trade.
And keep in mind, brokerage firms have to protect themselves. Margin requirements can at any time.
That's why whatever the stock is, I assume I need half that value. So if I'm selling puts in a $100 product, I want to make sure I've got $5,000 allocated to that in case I have to end up owning it.
In case you need to own that product. All right. Do you know who's not afraid? Jack Tucker. So Jack Tucker. This hit so quick, let's do it again. So what Jack does, and what I love about this, Jack, is that it was kind of what our study is on today.
That's what I was going to say. Jack, did you get an early copy of Jacob's study? Because you look at this,
10 minutes?
got in it in 10, 12, 20, and out of it at 10, 12, 49 seconds.
Well, Jacob was 10 minutes, so Jack, you're better than Jacob.
Let's jump. Why don't we jump into Jacob's study because it's relevant.
I do. I want to. I just want to go to Liz and Jenny Forever first before, and Jack Tucker's back underneath here.
He
Then we'll
collected
pop in.
$10,550.
Yeah.
But he got out of this in 40 seconds.
But I'm not going to lie to you, Jack. I'm picking up what you're putting down. Look, he got out for a small profit.
No, this is open. When he says this hit so quick, it's open. He didn't close it.
Oh.
He opened at 10 lines.
I thought he took 35 cents 10 times. I was like, congrats.
I thought you took 35 cents 10 times. But no, he's holding out for the 10,550. He opened 10 and opened 10. He's just saying how quick they both hit.
Okay, so we will go, and that's what's great. Look, this is liquidity at its finest. These SIBO guys, these SIBO market makers are your liquidity providers, right? And the markets. Okay, so take a look. Liz and Jenny Forever. Good morning, ladies. Good to have the dynamic duo back. Thank you.
I'm glad Liz is back too. She had a wonderful time on her cruise, but I'm happy to have her back.
I'm not leaving again ever until I go to Germany next week because the market tanked while I was gone.
Oh, what's it going to do while you're gone? Again?
I mean, I thought I was going to go up, but I'm leaving for Germany. I'm going to be in Germany over Easter.
Yeah, you're
in Austria.
Yeah, you're only missing.
My daughter is 16 going on 17, and we're taking The Sound of Music to her.
She can sing that song.
So I'm going to make her sit on that bridge and sing I am 16 going on 17.
Going on 17. What a good idea.
I know. Uh-huh.
You guys are so SMRT.
SMRT. She's going to love that. Just like the pictures I made him take on the beach.
I saw those.
Oh, no, the one where, so the photographer's like, hold hands and walk in the water. They're brother and sister. He just grabs her by the wrist and drags her in the water. They're the funniest pictures I've ever seen.
Okay, so can we discuss market intervals? VLOD, ADD, and tick.
Honestly, that's Tom at tastylive.com. I don't know.
All right, Vlad has been very effective at foretelling the market. I'm sure it probably works better than the crystal ball we used to have on our desk.
Look, Noelle is sleeping like a baby because she put all of her money market in March and sleeps like a baby.
The black cat is lurking.
Funny awesome stuff. Okay, so Jacob study? Let's go through that. Do we have time?
Yeah, let's do Jacob's study because it's relevant. It's looking at SPX. Well, I'll read it. I'm not going to summarize it. I'll read it to you.
Fastest losers on a bad day for zero DTEs. Now, Jack, we hope you win. He talks about wins and losses. These are the fastest losers. It's a light piece.
I don't know
Jacob.
if he didn't have enough room to write fastest losers and winners because there isn't just losers in this study.
Well, and he he teased us today saying it's a light piece. I had to Google 2 words that were in here to know what they meant.
Speaking of the amount of characters, I played Trivial Pursuit against my daughter and her boyfriend, and one of my questions that I got wrong, and I was, shame on me, it was and originally, what was the limit of characters that you could write on Twitter?
28 characters or less.
I don't know if that's right.
It's 100% correct. 28 characters or less, Twitter.
I don't know, but I got it wrong.
128 characters.
I think it's 128.
120. It's because it's in that song. Twitter versus the rap battle on Tasty Network. The rap battle. It's 120 characters. 120
I think that
characters
cost me
or
the
less.
game, and I couldn't get over it. I couldn't sleep that night. Okay, fastest.
I'll take you teenagers out.
Get you guys this time. They beat me every time.
Well, they're the smartest kids at the school.
Fastest losers on a bad day for 0 DTEs.
Okay, here we go. Because of the extremely short time until expiration, 0 DTE options, which you can see around us, option prices can change quickly in response to the move in the underlying or volatility.
Okay, recent days have seen historically rapid movements in the SPX and 0 DTE options have responded accordingly.
While buying power regulations ensure that retail traders almost exclusively sell defined risk positions, let's look at some of the breakneck velocities in the 0 DTE markets.
Was it breakneck velocities?
I got that. That was a word I knew.
Using 2 weeks of data in 0 DTE SPX options collected every 10 minutes.
10 minutes, 10 minutes. That's what I want to say.
Yeah.
I love hearing the noise. Okay. SPOO's down 5.
And all this action and SPOOs have had a pretty tight range while we've been sitting here.
Yeah. They have been.
Okay, examine selling straddles or 20 delta strangles at every opportunity, both at open and at every 10-minute snapshot.
So 2 weeks of data. So that's what they're doing. Totally topical. Since I've been on my cruise, he's ferociously looking at this data.
Liz has been sailing the high seas, and Jacob's been at his computer working tirelessly on this study.
Using a word that I've never heard before in the takeaways. Okay, for each such trade, found the 10-minute increment with the largest change in mid-price. Okay, they have to put parameters around it. And then
picked out the most extreme examples, and as a treat, also look for the most successful scalps. Trades closed exactly 10 minutes after they were put on. All were straddles from the same time frame.
Okay.
So the only winners that came off in 10 minutes were straddles.
Yes,
but that's
correct.
crazy that the premium's coming out in
10 minutes. Okay, and he gives us this. So most sudden losses at 20 delta strangles. He gives the date. So look, it's in the last 2 weeks. So he's picking the most extreme examples of losses.
In 10 minutes.
In 10 minutes.
So be aware. Beware.
So he gives the call and put strike, and then the worst loss in the 10 minutes was on 4-7.
Yeah, this is a 20 delta strangle. So you could see a 20 delta strangle in 10 minutes changed by $9,000, lost $9,000 in 10 minutes.
Here's what I think is the real kick in the teeth. Is that if you did that, so if you're like, oh, I'm going to close this and re-establish it, look at this. If you did it 10 minutes later, you're losing another $4,300.
And if you're, and this is where there's an issue with some stop losses or trying to say, oh, I'm going to close this at 2 times loss. You couldn't get there. You talk about the one guy paying $16 through the market. You couldn't get there. So if you sell this and you're thinking like, I'm going to close this at 2 times loss, sometimes you just can't get there.
Okay, and so here's what I was going to say. Even when you have a stop in, it goes to a market order. Now I know there's another way to do it. There might be stop limit orders, but 9 times out of 10, when they're triggered, it becomes a market order. And like he said, $16 through.
And if it went to a limit order and you had a limit on it, you'd probably never get it.
You'd never get it.
You'd never get it.
You'd never get it. Okay, so these are on here. Everybody can go back and review these. We want to get to the positives. Okay, these are all.
Most lost on straddles. Look at 12,690.
I mean, you are. I was going to say like Indiana Jones or some risk taker. If these days when the SPOOs are going crazy and
you're just on it.
Who does that?
I don't.
VIX is up 60. I know what I'm going to do.
But if you look at them, go to the platform and take a look at the SPX 0 DT straddle right now. They don't look bad.
No, but today
we've been in
today is calmer than it has been.
Okay, you go to the straddle. Let's just go to the 49.85, right?
Okay.
And it's $100. So you've got $100 to the downside or $100 to the upside. And if the SPOOs stay within the range of $30, $40, $50, you're making
But the range for the day is $100. If you look, what the volatility is pricing in is $100. There is no gaming in the system.
No,
they're
the range
telling
is
you.
$100, you're getting $100. The range is $70, you're getting $70.
Yeah.
But normally on the show, when we were doing the show before, it would be a $25 range or a $30 range.
On a normal day, yes. But he's doing the last 2 weeks in this.
So there's a lot of risk in these trades, and you see this. In 10 minutes, the price of this changed by $12,000.
Yeah, $12,000, which actually isn't that bad.
I mean,
that's not as bad as I thought it was going to be.
Now, how?
So you can take a look at these. These are he's picking the worst times, which is funny because we always said wait till 9 a.m. to put on your trades.
Worst time?
9 a.m.
9 a.m.
Okay, now I'm going to go to slide 5.
And honestly, look at 215. That was the least.
Least of the worst.
Least of the worst.
Because these are the worst. This is the smallest of the worst.
Yeah.
At 215. Okay, now I'm going to go to slide 5. Fastest losers on a bad day. Again, he gives another one. These are top straddle scalps.
This is if you buy the straddle. No. This is selling it. It's selling it. I reread this. It's selling it. Top straddle scalps means selling it 10 minutes later. What made the most money? So
okay, so on the open on 4/8.
If you sold it in 10 minutes, you made $1,600.
Wow! Congratulations.
But you can't go, how can you cherry pick a time? But he's just looking at the best and worst performers.
He's picking the number 1, number 2, number 3 performers.
So they're at 12.35 and 4.7. You sell a straddle, in 10 minutes that straddle made $1,500.
Yeah. And then 4.4, you can make $1,200. So yeah.
At the 2.35. It's weird. We have had some big moves at the end of the day.
We've had a lot of big moves at the end of the day. What I do like about the study is the fact that he took relevant data from 2 weeks, and I like that he's using 10-minute increments, because if somebody's selling a straddle, you can't hold it for more than 10 minutes.
So to take SPX down to a smaller scale, you can use XSP. I'm not selling naked positions in SPX. If I'm going to trade it, if I'm using the 0DTs, I'm doing defined risk. But are you doing defined risk in XSP,
no,
or are you not?
I'm not.
It's kind of like, if you want to trade XSP, are you okay with 100 shares of SPY? If you're okay with 100 shares of SPY, then you could trade XSP, one lot of XSP, not defined risk.
Not defined risk, right. And that's the one, and I remember Mike and Nick talking about this. They were so happy when that product came out, because it's something you can roll forever, or you can go on vacation and it cash settles.
But again, it's like 100 shares of SPY.
It is 100 shares of SPY. Okay, and let's get to the takeaways. Because
I'm not getting into 100 shares of SPY until it gets back down to my 305 call.
I'm at 400 in XSP, which we could get there tomorrow.
I've got that 305 call burned on my brain.
I'll be out $95. Okay, so last Friday and this Monday were amongst the most turbulent days in history. Even the bounce on Monday morning was painful.
This resulted in some 0DTE positions losing money at almost an unbelievable rate. A short straddle lost almost $13,000 in 10 minutes on Monday morning.
Yes, it did. And of course, the realistic 0DTE trader had long strikes and defined risk. An excellent reason to appreciate our buying power requirements.
While 0DTE trading is some of the most available. Is that the word you looked up
Yes.
today?
I saw that this morning. I had to rub my eyes. It's 5 a.m. I was like, is that a real word? Finish this and I went to Webster's.
Okay. Available to retail traders. Sticking to defined risk positions means that as long as we don't replace losers with fresh trades, there is only so wrong a day can go.
Yeah.
And in this market, we've had such movement in both directions. Are you able to, if you sell an iron condor, take one side off and then the other?
I don't know, and we'll talk to him about that. But this is an actual word. I typed it into Webster's dictionary, and it says having great power or influence. Okay. So now read that sentence again using having great power or influence.
Well, 0DT trading is some of the most
powerful and influential,
and some of the greatest power available to retail traders. That makes sense. That the 0DT SPX does give the retail trader great power.
I mean, I am never playing Trivial Pursuit with him.
And with great power comes great responsibility.
Correct. Trade responsibly.
Jacob, thank you very much.
I know, so I loved it. Okay.
All right, so I think that was a good study for people to see, especially we've got a lot of people out there trading these 0DTEs. So I think
we do, and I think, and you'll notice too. So I want to also make a statement, and you can correct me if I'm wrong. Maybe somebody else over here can correct me. When you hear them, that's over a 200 lot.
Because everything else is electronic.
Most little stuff like mine, we were kidding when we're like, did you fill us? Most little stuff, baby stuff is electronic. So most of our viewers in the SPX, I would imagine, even Jack Tucker, who's our biggest, trades in 10 months.
And we like one time we joked, we put a trade in, and then we heard them yell, and we're like, they filled our order. And then one of the guys came over, they're like, girls,
we're just kidding.
Yeah, but like the smaller orders are just electronic. You never hear them in the open outcry.
Yes. So when you're hearing like the low mumbling, those are big orders. Those are really big orders.
Now, I put on Friday, I did, let's just price it out. Let's just price it out. Let's go to 0DT SPX.
Okay, let's look at it.
And go, if someone said 1.5 times the expected move.
For an iron condor, 0DT.
Yeah, so let's see how much we get.
So it's 100, so you'd go 150 down.
So we go to 150 down. So 49.70 to the 48.30, right? So 48.30. Let's make it $10 wide. 48.30, 48.20.
Wait.
If I'm going to $150 down.
Oh, you're in SPX?
Yes.
The expected move for the cycle brings you to 48.50. Okay.
I just went double the 1.5 times.
Yes, 48.50. Oh, you're going to 48.30. Let me tell you.
I was just going right 150 down. 49.75, 48.75.
Do you know what I was going to tell you?
25.
It's pretty close to the standard deviation line.
Oh yeah, it's right by the 16 delta. You're right. Okay, so wherever you want to go, but I just did $10 wide down,
Okay.
$150 down. And if we go $150 up,
51.50. 51.15. Is that 150?
Wait, 49.80, 50.80, 51.30.
51.30.
51.30, and we do $10 down, $10 up. We're getting, so we're $150 away on the puts, $150 away on the calls, and we're getting $190.
Correct.
For a $10 wide.
So you have to keep in mind though when you're doing this that I watched. This is 150 point move. Spoos are right here. VIX is right here. I watched a 250 point move while you were getting your hair colored.
I'm going to put this in just because I'm not afraid.
I don't mind.
No. I put this in on Friday, and on Friday we had such a wild move, it blew right through it.
It blew right through it.
But there were plenty of times to take it off for 50% before it blew right through it.
So you guys put this on Friday.
We put this on Friday. If we would have put a GTC and take 50% out of it, it would have hit. Because the whole topic was like you could throw in SPX and then walk away. You don't have to do anything.
Okay.
If I would have put in it, so I would say, let's try it again. $190. We put in a 50% GTC.
And you say fortune favors the brave for my TLT and MCL puts.
Hey, I think this is.
We could lose $700 overnight.
I think this is a safer trade than those MCL puts.
Let's do it. You know what? Then when risk management calls, I'll say, Jenny,
they're not going to call $800 on a $10 wide iron condor.
Filled.
That's what Jack Tucker is talking about.
Yeah. So
did you hear it? It traded over there, Liz.
So now I'm going to put a GTC in for this. I'm taking it for 50%.
Yeah.
Keep in mind, I watched these GTCs yesterday, Johnny. Here's the one thing I'm going to tell you too. I had, thought I knew something yesterday on the close when we were down so much, so I threw in a Jajun.
Oh.
And I watched the Jajun be 100% profit down to 10% profit without the markets moving. That's how wide the markets were in there.
Oh.
When you're watching,
did you get out of it?
I got out of it.
Oh, good.
For a scratch. Because I got scared and changed it to a GTC.
Oh, funny.
But I'm out of it. But I was watching the markets move.
Did you put the GTC in?
Yes.
Because that
10 minutes.
And honestly, for me, if I'm going to trade 0DTs, I'm trading them with defined risk like that.
And that's what Jacob's point was, is 90% of our viewers can't not put GTCs on with defined risk. I'm actually going to go to unusual activity report real quick, Johnny. Not unusual.
Oh,
the most active.
The most active.
Because we only have 10 minutes left. I think it's pretty topical to be down here and look at this. What I find crazy is it's not that active as it has been. If you take a look at this, and you can see there's only 42, 38. I'm just looking at the numbers. We've seen hundred thousands of things.
Yes.
So as far as this goes from a volume perspective, it's not what I would have expected today. Yeah.
Right. Interesting.
Yeah, but you'll see it's the VIX, the VIX, the VIX. Now, I want to take a look at this because those seem to be calls. The VIX 30 call and the VIX 60 call.
Where are our little SPY puts that we got out of the other day?
Oh, let's take a look.
We got out of them on Monday. What were they? They were... I'll pull out activity and see.
Yeah, pull out the open activity.
Our SPY activity over the last few days. And we got those from the unusual option activity. They were the 455 puts, April 11.
450.
April 11, 455 puts.
Okay, I'm on it. April 11th, 455 puts, and we paid.
We paid 29 cents for them. We sold them for $5.27.
They're now worth $177.
Nice work on our sale. What you? Like my hand is gonna be red all day. That was some real force.
I tell my kids if you're gonna high five like you mean it.
Really?
Yes.
That's a life lesson?
It's a life lesson. If you're going to do anything, do it like you mean it. Okay. So, yeah, that is... They're still keeping their wings up, but we got out.
Hey, we got out.
I think we painted the top.
Yeah. All right.
So I wanted to look at this. So VIX, May 21st, 30 calls. I just want to see what those are. VIX,
Okay.
May 21st. Now it's quiet.
May 21st, 30 calls. So someone thinking that we're still going to be down in May.
They could be getting out of it.
I'm surprised there's so much. I'm actually surprised there's so much. I thought they'd be cheaper.
So take a look at this. They could be getting out of them, too, because there's 127,000 there.
Could be.
It could be.
Today's earnings are just Constellation Brands and KMA with CarMax. So nothing that we're going to look at for earnings.
Here, we'll take a look down here.
I don't think there's anything. Tomorrow, Thursday, we're going to have JP Morgan, BlackRock, Wells Fargo, Morgan Stanley. So there's a lot. There is a lot on Thursday.
There is a lot on Thursday, but I don't. We're gonna do this. This is so funny. You got to go to this cupcake. This was perfect timing from Liz. Everyone's so busy, and then the two guys in the middle are just chatting, and one guy's checking his phone. It's cute.
Oh, that's funny.
They're looking at orders from people. I have no idea.
Oh, okay, Samantha, I'm very happy she sent this. We were joking when we say fortune favors the brave. That's from a commercial.
Where are you? Oh.
She says fortune favors the disciplined. And yes, and honestly, I want everyone to read the cherry picks that came out. We're going to talk about it tomorrow, talking about risk, talking about the different futures, talking about their notional value. Be aware of everything you're trading, the notional value.
And Samantha, I'm glad you put that in because we are kidding when we say that.
Yes.
Kidding. We're just paraphrasing the Bitcoin commercial. Who was it? Wasn't it your guy? It's Matthew McConaughey. Don't you love Matthew McConaughey?
I mean, I liked I've read his book, Greenlight. I
thought you loved him as an actor. Isn't he on your list?
No.
Oh, because I don't like Matthew McConaughey, but he's the one who I think says, no, it was either him or Matt Damon that says fortune favors the brave. For a Bitcoin commercial.
Maybe, I don't know, but maybe 25 years ago.
You knocked him off your list?
Yeah, I still know. Okay, so be aware. If you're selling puts in something, be aware of the notional value. I just want to give that warning again. Make sure everyone knows the risk in a trade. And I always say when you're selling a put, your risk is getting long 100 shares at your strike price. If you're selling a call, your risk is getting short 100 shares at your strike price.
For sure. And I want to go to Jack Tucker too because he's doing very defined risk. He's doing 10 delta, 16 delta. So that's good. I mean, he's defining his risk. 10 delta calls, 16 delta puts. So he's kind of being...
well, Jack, he's doing the same $25 wide.
No. He's doing $10 on the call, 16 deltas on the puts. So he's giving himself a little bit more. He's a little bit skewing it.
Well, he's got $20 wide call spreads.
No, but if you go underneath. Keep going. It's underneath Bob on fire.
Oh,
right
okay.
there. He's giving the deltas.
Oh, I see.
He's giving the deltas,
Staying
which
strong.
I kind of like.
And setting GTCs for 40%.
Yeah, that's what I'm saying. So it is.
Yes.
You're right. Discipline is the best strategy here.
Okay, so we have a little bit of time. I know people sent in trade ideas for what's your assumption.
Yeah.
I don't know if you want to take a look at any of those.
What time is it?
10:53.
We have 10:53. We could take a look. Let's go to
see
it.
if any of them.
So we vetted these on the train. The JP Morgan earnings trade is fine if we wanted to do it, but it is an earnings trade.
Let's look at it tomorrow. Let's look at JP Morgan tomorrow.
So we'll take a look at that tomorrow. K-Web, I don't know.
Chinese stocks got crushed. IVR's through the roof now. Thinking Chinese ETF was slight upside bias.
Oh, this is the one that was...
Oh, ratio spread. A downside ratio spread. K-Web's not that expensive. We could probably...
So he wanted the big profit at 25. It was not that expensive. So
How
if you
crushed
go
did
to,
they get?
Hold on, let's see what's
if you take a look...
May.
K-Web went from 34 down to now it's 28 this week.
So they want the most profit at the 25 level. So I could do, hold on.
If you're thinking there could be more downside, I would make it as wide as you can without collecting anything. Or was
he bullish?
Or did he want to? Maybe he was.
So either way, let's take a look at this before we go. So, I mean, it's a $25 stock, so a dollar wide isn't that crazy out of control. You can get 89 cents for the 25, and that's where he said to put a short strike. 25-26 ratio spread brings your break even to
23,
which is the same thing as selling that 24
or 23 and change, or the 25-27 gives you a little more downside profit potential, but moves your break even, but you're only taking in 60 cents.
Yeah, but he wanted his sweet spot to be at 25. But what we were saying here is this is holding up more buying power than it was on the train.
Is it?
Mm-hmm.
You know what was holding up one of the trades was holding up a very small amount of buying power.
Yes.
That was
This is holding up more.
All right, okay. Let's move forward because now we have to be picking and choose. We have to pick and choose on how we're going to spend our buying power.
Starbucks neutral.
The Starbucks put was holding up a very small amount of buying power.
Okay, if everything's going to hell, people still need their coffee fix. Thinking about selling the 65 put and whatever call strike you like, Jenny. It says Tom.
Okay, so here's here's the nice thing about all these underlyings getting very cheap. Starbucks, a month ago was 115, now it's 78. You can sell that at 65 put, and it is only using $600 in buying power. Again, what's the risk here? Getting long Starbucks 100 shares at 65, which that would really be $3,000 in buying power.
Yeah.
But a lot more products are accessible to smaller accounts, which is a good thing because a lot of accounts are smaller.
Are a lot smaller than they used to be.
Right.
But yeah, so take a look at this. So you can get 192 using $600. Return on capital is good. In the words of TP, you're getting $6.29 a day in theta. I'm sorry, 6 cents a day in theta.
I kind of like this trade.
Now, I will tell you, sometimes I'm a little bit more conservative when, things are going crazy. It's $5 down, you can get $1.21.
Sure. Even that. And you're only using $600 to get $1.20.
It's the same buying power, but it gives you $5 in room.
Yeah.
For not much less.
I'm in.
Is that okay?
I'm in.
How are we doing on buying?
When did I think I'd be able to sell the 60 puts in Starbucks?
Today's your day, Jenny Andrews.
I'm finally, you know how Starbucks got me so mad? If you go to the chart in Starbucks, and I'm going to show you this, what it put me through. So I was short puts in Starbucks.
At where?
Okay, so like 90, if you go to December, end of the year.
Okay, want me to go to December?
I think if you look at the chart. No, if you just look at the chart. You see that move in December. I think it was then, could have been, oh no, I think it was worse. Oh yeah, go to that. If you go
right
to
here?
April, right here.
Okay.
Okay. I had short puts on earnings then. You see that?
Congratulations.
Dropped down, blew through my puts. Not a happy camper. Then at some point I got out of my Starbucks.
You got out about right here.
Right about there. I was like, oh, I'm just going to get out of this.
I'm not going to be long this thing anymore.
Forget
it's a dog.
Forget it. And then it skyrocketed, and I lost so much sleep over that position. I'm going to finally get back in.
I'm telling you, I think it's the losses. You remember your losses, but it's these where you're just like throwing the towel and it skyrockets. Those really make me mad.
So Starbucks was at selling the 60, 65 put. I'm thrilled.
Yeah, you're in.
I'm okay with it again. I'll get back.
You're in. You're in.
Okay.
Now I'm going to go back.
10:57. I think we're out of time.
I think we are too. I just wanted to make sure we got to everybody on Twitter. I'm going to go to that real quick.
The defense stocks are up. I'm looking at it. I'm only looking at it because our boys wanted to buy it. So yesterday.
So Boeing is a defense stock, right? Boeing's up.
Boeing's up. Or well, Lockheed Martin's up 445.
1%. Yeah, they're up. I mean, it's an expensive stock. What stock would you have told them when they said defense stocks? I said Boeing. Because I said it's a multifaceted stock.
I mean, they do, right. They do, and they did get some, like,
that's what I
contract.
That's what I told the kids.
But like, more exposure. So I did have him buy some Boeing, but more exposure, I had him buy Lockheed Martin. Because
that's
I
pure.
know it's
Well, that's a pure defense stock.
But I know it's $448, but they only need half of it.
Yeah.
$200 and whatever. So it's $200.
Yeah. Yes. No, that's good.
But either way.
All right, it's prediction time, Jenny. Where do you think the market's going to end? And I mean, the world is your oyster. You can say anything you want. Let's go. Let's talk in SPX terms. Talk in SPX.
Okay, SPX terms.
XPS is $49.69 right now. We're doing the SPX because we're right there. $49.72.
I think we're going to end around 49.30.
You think $40 down?
I don't know.
I'm going the opposite. I'm going to go 5,027.
Your lips to God's ears. My account will look a lot better if it's higher than lower. But I'm just preparing myself for the worst.
5,027.
What is that? Prepare for the worst?
Expect the best. Prepare for the worst. I don't know.
Yeah,
Prepare for the worst. Whatever. One of those.
Well, anyway, everyone, be careful out there. And in the words of Samantha, fortune favors the disciplined.
I love it. All right, everybody, have a wonderful afternoon, and remember to trade small, trade often.
Laugh with us, learn with us, and watch the Liz and Jenny show. We will see you all tomorrow.
Everybody.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Shake it up, stop when the clock hits 13. Sing 1, 2, 3, 4. Cause no one can do it like we do it, like we do it, like we do it. Cause no one can do it like we do it, like we do it, like we do it.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade. Good morning, everyone, and welcome back to the show. This is Option Trading Concepts Live. My name is Nick Batiste. I've got my man Mikey Butler with me as always, and if you want to come join us, hop over to YouTube, type in Tasty Live, come to our channel, give us a like, and subscribe to our videos because it helps us immensely. But more importantly, just come chat with us live because we'll be taking questions throughout the show. Whatever you got questions on, from strategies, concepts, trade ideas, trade management, whatever. Just come hang with us for the next hour of the day. My favorite hour of the day. I get to spend it with my buddy, Mikey Butler. How are you, sir?
Doing well. Doing well. Weathering the storm here. It's weird to see the market not moving.
It's
after so much time of the market just not moving, it's now weird to see it not moving.
That's fair. Since the open, it hasn't really moved, but there was certainly about a 200-point intraday range. We got as low as 48.71 in the overnight session. So there has certainly been some movement in the overnight session, but I agree it's been relatively muted since the open. I mean, probably like a 60, 70 point range, 30 or 40 points to either direction, which is nice to see. I would think that's probably a positive here. Volatility itself has remained bid, which spooks me a little bit. You've got VIX futures 32.25, and the VIX itself still at 50 which I tweeted this out, and if you didn't get the cherry picks from yesterday, if you're not signed up, you need to sign up for that. If you haven't looked at it, go look at it. Because we gave you a great futures cheat sheet. But two points. The VIX at 50 represents a 3% up or down move on a day-to-day basis. So
150 points.
Yes. So that's, there will be big movements, likely, for the foreseeable future until until VIX comes down or, we kind of stabilize here. So don't get crazy with anything. And if you're trading futures, we have harped on just the fact that, and if you didn't do it into this move, maybe you'll think about it going forward. You have to keep in mind the size of these positions. The margin requirement is very, very leveraged. lot of juice in there. You sell something for $1,000, $2,000. You only use, $5,000, $6,000 in capital. It looks like a no-brainer. These things can get really, really big. So you need to keep in mind size. The futures cheat sheet that we sent out yesterday, it gives you all the notional values, the tick sizes. We gave you another piece that outlines the actual dollar move in the futures that we've experienced over the last couple months here. So you understand, one contract, it's still very, very big. And it goes to everything we say about, selling puts and that being kind of like our core strategy of sorts. It's all about size. It always comes down to size. You need to be able to weather the storm.
Yeah. And I think it's interesting to see. So, we've been talking about the short put in SPX. Like if you had $1 million account, blah, blah, blah. So if you did, so you're down, obviously. You'd be down like $100,000 with an open short put position from 6,000 to 5,000. Right? Yeah. But
if you're at the top, if you're selling
sold the put at the top,
yeah,
you're down $100,000. But something to consider is, like we're saying, the sizing means everything, because a 6,000 strike put, if you didn't do anything and you just we're on vacation for the last month and you come back and you're down $100,000 on your short put in SPX, the buying power requirement for one contract is $99,000, $100,000. So that's why we say, the importance of sizing is everything, because if you had done 5 of those contracts, you have a $500,000 buying power requirement. If you were selling them at the money or out of the money. Like if you didn't have the ability to notionally hold that, you are now in a margin call.
Yes.
20% sell-off. So this is the reality of sizing. It's not about how much you can make or lose. It's about how much you can withstand and keep the position open. Because a 20% sell-off, like if you can't withstand a 20% sell-off, you eventually will get blown out if you're sizing too big.
Yeah, because these are going to happen.
They happen every year. Not in SPX in particular, but in equities they happen every year.
Yeah.
In SPX they happen every 5 or 10 years. So this is the real situation we're in, and why sizing is so important. Again, it's not about how much you can make or lose on a month-to-month basis. It's about being able to hold this through this, and eventually, if the market recovers, you're collecting that premium over time. Blah 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 blah. You make that money back, the intrinsic value that you're seeing as a loss now.
Yeah.
So sizing is the only thing that will keep you in the game.
Yeah, and the other piece of that pie is that, if you're not sizing correctly and you're over leveraged and you don't have cash on the sidelines, you can't pop into opportunities like this.
Yeah.
Like the puts we were looking at with E-minis at 6,000 that were, at 500 points out of the money. Those same puts, 500 points out of the money now with E-minis at 5,000. If you were looking at the 4,500 strike, those are 20x the value that you were looking at with volatility much lower and the market higher. And that's a reflection of, risk and volatility and all that sort of thing, playing into the market. So, I get over the years, so many questions of aren't you wasting money, by leaving it on the sidelines? Why not have more capital in play? You get this leverage. We're never going to get to that point, blah, blah, blah. This is a perfect example.
Yeah.
And I think for the most part, which is great, I think people have listened a little bit. I think COVID helped, but
I think
the Japanese yen, I think people have realized the leverage and the risk and have lightened up positions and had more realistic expectations. I think overall it's been better recently.
Yep.
So, That was my quick soapbox.
Yeah, we gotta bring it to the light every day. These days, every day we gotta talk about sizing.
Yes.
But yeah, this morning I closed that GLD call diagonal spread.
Nice.
Got a nice gap higher.
Nice gap higher of 4% on gold.
In gold.
Yeah.
But yeah, that was nice. Put that on yesterday after Thomas's analysis, gold versus copper. If you missed that, you can check that out on the tastylive website in the archives. But took $200 out of that.
Nice.
And this is we've talked about this before too. This is a market where we're going to be nimble. We're not looking for 50% profit. We're looking for the moves that give us 20, 30% profit in one day, and then you take it off. Like that's
or less. I mean, like when things are moving, man.
Yeah, because 3% moves are projected every day.
Yes.
Which is we are at an abnormal level of the VIX, and we are sustaining this abnormal level of the VIX.
Yeah.
So no longer are we worried about theta decay. It's literally delta. Like everything you're getting paid on right now is delta.
Yes, 100%.
And then I put on that Q's downside diagonal, and that is interesting. It's up 85 cents from the continuation of the sell-off yesterday, but the Q's are actually up 4 points today, and it's flat. And that's because the short-term premium in May was and is still a substantial value relative to the purchasing or the cost of the option I bought in June. So I have the long 420 in June, short the 400 in May. Position is flat right now, even though the Qs are up, because there's so much premium implied volatility value priced into May relative to June. And that'll be the case. Like this could be a profitable trade if we just chop around here at 420 and we do that for a week. Like this will be a profitable trade, even though it's a downside bearish trade. And that's a function of near-term IV being higher than the back month. So I like this as a hedge at this point. I should have liked this as a hedge at 6,000, of course. But
you were up only mode.
It was up only mode. But yeah, these are the kind of hedges that we like in these portfolios, because you can, even in the highest of IV, you can still get them on. Like this is a 20-point diagonal that I paid $9 for, $10 for. If it goes in the money, you close it and you reshift it to the new at the money strikes.
Yeah.
And I think that's important to bring up, because you don't want to have this thing go in the money and then wait till expiration, because if it does, it becomes from a $1,000 hedge to a $2,000 hedge or more. And on the
because
way
it gets bigger.
Because it gets bigger. And you don't necessarily...
Because the profit's on the table.
Right. And you don't necessarily want that on if it's on as a hedge. You want to get that gamma move to the downside for a downside hedge.
Monetize it, close it,
and reduce the size of it. Because if it goes in the money and then you reestablish an at the money spread, that spread's going to be significantly less than what your old one was. You're still going to make money on the downside in terms of a hedge, but if you get the reversal to the upside, you're going to lose a significant amount less than if you left that current one on.
Yes.
So that's the idea with these downside diagonals, is if they fill up, close it, shift it to at the money, and just reduce the size of it.
Yes.
But yeah, we'll see where the market goes from here. But again, 150-point moves projected every day. Craziness.
E-minis right now up 16, near the higher end of the session here. You got NASDAQ up 200, the Dow up 100, the Russell lagging the group down 15. Oil has just gotten murdered. It's down to 57.33. In the overnight session, we got to 55.12. A crazy move in oil, crazy move across the board in basically everything. Volatility futures down 45 ticks here. We got as high as 35 and change. The VIX itself at 49.44. We've had 3, 4, 5 days of sustained volatility. Bonds, the bond move has been just absolutely banana land. I might have to look at getting long bonds, even though I don't trade these all that often. Down 2.5 points here, 2%. I mean, these are astronomical moves. Bond volatility in the 20 handle, I mean, this is as high as I've ever seen it. Typically, you see these with a single digit volatility. They are just through the roof right now. as Mikey alluded to, gold has had just a massive surge to the upside, $115. This is the high of the session here. Silver bouncing a little bit, but not moving as much there. And then Bitcoin as well, kind of moving in tandem with the market here. It's gone from red to green all day long today. It's up 1,100 on the futures, spot up 1,100. It's been a wild ride today. There's just a lot of price volatility. You got to be nimble, as Mike was talking about. A lot of the, and this goes to like, I continue to get the, should I wait to 21 days? Like, you got 50%, VIX at 50. You should be looking to do, manage positions quick and roll positions and just, do something, I think, is the best course of action, because even if you're wrong, meaning you roll down call spreads and the market goes back up, you're going to get helped by volatility. Or if you roll out put spreads and, the market bounces, volatility is going to help you there. Like, you got to do something here. You can't sit and be, sitting on your hands here. I've done a couple things I wanted to outline, one of the adjustments that I'm sure I'll get a lot of questions on, and I tweeted it out with a little thread yesterday on spreads specifically, and the pop in volatility that we've seen in equities, in the market, in everything. A lot of these spread trades that you had that went 20, I was, my Apple position, I was short the 205, 190 put spread. I mean, this spread is 30 points in the money. And while obviously we could have a 30-point bounce, we've had a 30-point sell-off. You're having an 8-point bounce today in Apple. 30 points, when you're looking at this from from expected move or just from the value of this, it's telling you that it's on the table. But from a move perspective, that is a massive move in 30 days, 30, 40 days. If volatility were to contract, let's say vol goes, gets cut in half, regardless of what the move is, maybe the move is 10 points or 15 points to the upside or whatever the case may be, this expected move is going to come in significantly. It might only be 10 points. So these spreads right now, this in the money spread that's, net long 20 deltas here, it might go to 40 deltas on a 10-point up move and a contraction in vol. And that's because right now there's a lot of extrinsic value getting pumped into all the options. On the put side, on the downside, extrinsic value super, super high. If you do get that contraction in volatility, this 30-point expected move goes to 10 or 15 points of an expected move. And if you didn't get that other, 20-point move to the upside, this spread is going to lose money on that, even on a 10-point up move. And that's because volatility is going to contract significantly. Will I miss out on a 30-point up move? Sure. I would have made more on this spread than if we do get that 30-point move. But I rolled it to an at-the-money short volatility position. This position, this in-the-money short put spread, is the same as being long this call spread. An out-of-the-money long call spread with volatility at, highs of forever, basically. I don't want to be long premium into that. I want to be short premium. So taking this position, buying it back, selling out an at-the-money put spread, of course, it's going to be dumb for a debit, and it does lock in a loss. But if we stay here, or at the very minimum, volatility comes in a little bit, this trade will get me back $200 or $300 versus this trade that I will lose $200 or $300 over the next 30 days, assuming we don't get that huge move to the upside. And in a lot of positions, these could be even worse. Like if you're at the 215, 200, you've got $300 or $400 of risk left on this trade. If I told you a month ago that you had an Apple spread that was 40 points in the money, it would probably be trading at parity, right? I mean, that's the situation that we're in here. So I think a lot of the trades, if you are in a similar boat, it stinks and it is like the last thing you want to do. But rolling and managing these positions this way will greatly decrease your P&L volatility if we kind of stay right here. You have more risk to the downside because now I'm doing this roll for a debit, so I'm putting more risk on. But if we chop around here or go slightly higher, or vol contracts, or we kind of chop in this range, this trade is going to make me more money back than keeping this kind of tail type trade that I need to happen here. I mean, I need the stock to go back to 210 on this trade.
Yeah. And it's obviously a lower probability than staying where it is.
Yes, but that probability appears high because of where volatility is. Mm-hmm. If we have, the market stabilize a little bit and Apple goes up $5 and volatility comes in 20 points, this spread, the delta on this put is going to be 95 as opposed to the 80 it is right now. And this put is going to go to a 70 delta.
Yeah.
It's going to go to parity. It's going to be an intrinsic value position.
Yeah. Yeah, lots to consider in these markets for sure. It's crazy actually to see Apple up $8 and the 2-day options are only up like $1. Like the calls, like even if you're playing for this in the 2-day, you're not getting paid because implied volatility is so crazy that this $8 move is expected.
Yes,
that's where we're at.
And that's the point that I'm making in this spread too. That you're getting the value you're getting here is not from buying the calls, which my spread is synthetically long the call spread. It's coming from the puts. It's coming from volatility contracting. It's coming from the downside puts. And so, on that same 10-point up move, this spread loses, if it's 10 points wide, this loses $1.50. This spread, you only make 50 or 60 or 70 cents.
Yeah. I hear you. NASDAQ up 10x relative to the E-minis. Tech sector doing well. E-minis getting dragged down by other...
Percentage-wise.
Yeah, percentage-wise.
Yes.
Yeah. But it just goes to show that the other sectors that the E-minis are exposed to are getting dragged down relative to tech. Some of these tech stocks doing okay today.
Yeah.
If you want to join us on Tasty Live, you can do that. We're streaming live on the YouTube channel. You can throw in your trade ideas, questions along the right-hand side chat. I've got the Cherry Picks newsletter pinned to the top of the YouTube chat. So go sign up for that for free. Is there an actual newsletter? Don't receive them after I sign up.
Yes, you should be getting one. Check your spam
or something. It's definitely sending it to you.
Yeah. If you just signed up, you'll get the most recent one that we sent yesterday. And yes, it does tend to get pushed to the spam folder.
Yeah. You can just whitelist Tasty Live. All things tasty.
Yeah.
And you'll get it in your inbox.
I'm trying to get long bonds here.
Yeah, it's crazy. I was actually looking at the implied move. So the implied move for the next 8 days is $3.60. The implied move for the next 135 days is $8. 8 points. There's a huge implied volatility differential here in the M contract in isolation. It's very wild.
Yeah. I just did TLT. I did like a poor man's cover call, but I'm selling the 88 in the 8-day. I mean, this is a shorter duration type trade here, May, April. Just to play for a little bit of a move in bonds. I mean, historically, how these crashes sort of get dulled is that you have equities puke, and then bonds, usually rally a little bit, and the net, is a little bit lesser than what we're seeing right now with everything just getting nuked. Usually something works in your favor. I know gold is working here, but usually one of like E-minis or bonds, they do have that typical inverse correlation into high volatility events like that, but you are not seeing that today or recently at all.
Yeah.
You had the one little and then just nuked.
Yeah, TLT has dropped 8 points in the last 4 trading sessions.
Insane.
Which exceeds implied volatility through the June cycle. So, yeah, lots of realized moves here. Craziness. And the IV rank of TLT is 140, which tells you just how high this new implied volatility is significantly higher than the last high print we saw in the last year.
It's as high as it gets.
Yeah. And this includes the Japanese yen unwind.
Yeah.
Which was our first 60 spike in VIX that we've seen in quite some time. So that tells you a lot. All right, popping over the questions now. Yesterday, I think you mentioned if you sell a naked put, you shouldn't close it if it's deep in the money, accept assignment and sell covered calls against it. But closing it is the same as selling the shares back after assignment, and then you can leverage capital again. So maybe it's okay to close the naked short early for a loss. My point with the naked put is if you're going to close a naked put for a loss, where your worst case scenario is that you take 100 shares at a lower cost basis, just define the risk up front, because you will save yourself in the long run. The lack of premium the premium you're giving up to define the risk with a short naked put and turning it into a defined risk spread, that premium you give up over time will offset the losses that you would be booking if you get a big move like this. Because when you're defining the risk, especially with a wider put spread, you're giving up 10%, 15% of the credit received on the short put, and eventually, if a move happens like this, that's going to come into play and save you hundreds of dollars. Let's just call it. But my point yesterday was if you're selling a put, especially in a market like this, if you're selling a naked put, you have a much higher probability of success in the long run if your intention is to take the shares and ride with it. You could just roll the put forward in time, and in the money put is just a covered call risk profile, so you don't necessarily have to take the shares. You can just roll the put forward, and it's the same idea. But at a certain point with an in the money short put, if there's very little extrinsic value in rolling that short put forward, you're actually better off taking the shares, because you turn your variable delta short put, where let's say you have a 90 delta put, if it goes at the money, it reduces delta. If you have a 90 in the money put delta and you convert it to shares of 100 delta, you have 100 delta all the way up. So you can make more money if you have the shares compared to the short put. So there's things to think about, but I don't like selling a naked put in this environment with the markets down 20%, some equities down 30, 40%, and then closing it if it continues. You can, but I would rather just sell the spread and ride through the variance.
Mm-hmm.
That's just me, though. But it all comes back to size. If you want to participate in a product and you can't afford to take the shares, then you should do a spread anyways.
Adam, send me an email, support@tastylive.com, and I'll send you the newsletter and check out and make sure that you're on the list if you didn't get it.
5450 straddle and micro e-minis in the May 16th expiration collected $9,300 so far. I'm thinking of not doing anything for now. What are your thoughts?
In the May?
May 16th.
5450?
5450, 9305 credit.
Yeah. You see, these
markets are crazy.
Awful. You got to be careful with these. I really know everybody wants to get small, and the leverage that you get with micro e-minis is great. They're not that tradable. So I would rather you do wide spreads in ES, than these. And I assume most people are trading more than one contract of these, or even if you're trading one, you can see these bid-ask spreads are just awful, awful, awful.
Yeah. So you basically have a $500 credit here. So if you have 9305 in credit.
Yeah, but you're the 500 credit. It's impossible. I mean, you're 400 points in the money. So this should be 400 points. So you're probably trading more at 500 points is probably what this marks at. But it's this is just goofy.
But yeah, I mean it's tough with this credit received. You can only really invert by a little bit, and these markets are so wide. I would just let it. I mean, if you're comfortable with the risk, you have a window just by opening a new trade in that cycle at 54.50 and typing in 93.05, your expiration break evens are at 53.50 and 55.50. So you have a 200-point window to the upside, which is within the expected move.
Yeah.
So I think that's something to consider if you're comfortable with this risk. I would just let it go and see if you get that rally to the upside. If you get a move to 54.50, I would just close it. Hopefully the markets are more liquid if that happens. But yeah, I'm seeing these bid-ask spreads just flash around like crazy.
It's awful. It's untradeable.
But yeah, you're within the expected move at the very least.
Yeah.
Let's see. What do we got? Question regarding bonds. Fed officials expect tariffs to impact inflation and employment, and bonds are falling, which somewhat makes sense. But why is the market now expecting several cuts in this year? What gives?
Recession fears.
Emergency cuts.
Yeah.
There are segments where Chris and Ilya talked about this, the difference between emergency cuts and cuts in a calmer market. They're not the same, but just looking at the CME interest rate cut probability tool, we are looking at before this all happened, there was a big probability that we would arrive at a 25 basis point cut in June, and there wasn't really one priced in May. Now there's a 40% chance that we get a 25 basis point cut in May and a 60% chance that we stand pat. So this has shifted a lot, the May one. The June one looks pretty similar, except now the tail, the 37540, so a 50 basis point cut is now a 40% probability. So the market is pricing in potentially a 25 basis point cut in May, a 25 basis point cut in June to arrive at 37540, which is crazy.
Yeah.
Big shift based on current cycle. And the highest probability now in December is a whole point. 325350 is 37% probability. Crazy.
Yeah.
But yeah, to answer your question, I would say it's likely an emergency cut being priced in this situation. But lots can happen in the next month. 210-205 Apple put spread. May expiration. Do I have assignment risk?
No. And
simple as that. No.
Pop in volatility like this, there's so much extrinsic value across the board, and I cannot stress this enough. Assignment does not matter on spread trades. It simply does not matter, and I know everybody is worried about it. It will change your buying power for the moment that you have it, the day or the week or whatever. As long as that long option is open, the risk profile of the position doesn't change.
It actually improves if you get the rally.
Exactly, because you now have static delta that isn't dynamic. It'll stay 100 deltas no matter what happens with the stock. And so obviously, if you don't have the capital to hold the stock, you will have to do something about it, meaning close it out, which will be no different from a risk perspective than if you had the option position and you just closed out the option, the spread trade. But with the volatility, just to give everybody an idea, what was the high in Apple? 260. If you were at the 250 puts, like if you top tick this and you've been rolling this, or the 240 puts, you're probably not even getting assigned on those options.
Yeah.
And that's because of volatility. When you look at the out of the money calls, that's how much extrinsic value is in your option. So, even if you're at the 220 or 225 or 230, there's still extrinsic value there. And that's because of this pop and vol.
Yeah. When someone converts an option into stock, they light extrinsic value on fire. They throw it into the bonfire. This option, the 210 short that you have, has $200 of extrinsic value. So if you were assigned on this Apple put, your position would actually improve.
You'd make $100 back.
You could literally, if you were assigned on the 210 put, and this is why it doesn't happen all that often, because if you get assigned on the 210 put you could just resell the put, close the shares, resell the put, and you would pick up more credit.
Yeah.
But it's likely not going to happen because the counterparty understands or should understand that they're lighting $200 on fire if they exercise that option. So even though it seems very far in the money, implied volatility being so high means there is still plenty of extrinsic value to prevent you from being assigned here.
Yeah. And that's also why I made this adjustment, is because this spread seemed very far in the money, but is not a max, is not trading at parity. And to go further with what Mike means with the lighting on fire is that if you were holding this long put, this 210 or this long spread, let's say I just took the opposite side of your trade, if I were just to sell out of this spread or sell out of this long option, I would do it for $250 more than what it would cost me to just ship you the shares.
Yep.
So there's an advantage to just closing the trade.
Why would a calendar spread in SPY using a 0-day option take up double the debit paid in buying power reduction?
But why don't you give us the strikes?
Yeah, you might have an overlapping situation.
Yeah.
If you have an overlapping strike where you're closing out one thing and you're not realizing it, that might adjust it. But a calendar spread in SPY is just a debit spread.
Yeah.
But I wouldn't use SPY at the end. I would use something else. I'd use SPX or XSP because SPY settles to shares, and you won't be able to hold that to expiration if it's on the dance floor.
Yeah, and expiration risk. I mean, we've seen 100-point moves in the overnight session. So, if you have this short duration calendar spread, and the market moves 100 points in the overnight session, you could get assigned on your puts and not know it, and then you're long stock into the next day.
Yeah. So yeah, if you're using 0-day stuff, cash settled products are much less of a headache. Can be much less of a headache. Drone and special, Tesla, April 22nd. Earnings report. Put ratio in May.
Okay.
The 210, 220. 210, 220. Put ratio.
Did I quiz you on the one? Don't look yet. On the 100 strike Tesla puts?
Yeah, we looked at it the other day. They're $1.
Yeah.
Or they were $1.
Yeah, they're like $2 now.
That's crazy.
$1.60.
That's wild.
It's nuts.
That's pure implied volatility premium right there.
Yes.
That's crazy.
Yeah.
But yeah, the 210, the 220, 210. So like in this environment, if you're doing this put ratio, I would rather just sell the put once, pick up a little more premium, and just be purely directional to the upside. If you're playing for a downside move, because this implied volatility is so crazy, I would sling the short strikes down, or the short contracts down to like 190, 195. Like, look at the difference here. If you do the 220, 210, your break even's at 190. If you do the 220, 190, your break even's at 155, 157. Yeah. You're still making money to the upside, but you have a significantly wider profit range to the downside that exceeds the expected move. So in this high IV environment where the tail premium is higher, I want to sell that tail premium versus the strike that's right next to the long.
Mm-hmm.
I think it just sets up, and you can see in the pop skyrockets from 68% to 82% just with that adjustment. Of course, you're giving up upside profit potential, but you have the ability to take shares at 157.5 instead of 190, and that's substantial.
Yes.
But I like the idea.
Yeah. I'm leaning directionally long. I have a iron condor here that's, I think it's probably out about $100. I sold the call spread against it yesterday, so that's helped a little bit. But yeah, I don't mind the trade. I'm leaning directionally long across the board.
Yeah.
So, Mr. Market, no more down, please. Had enough.
People in the YouTube chat saying the bottom's in when we're quoting the Bible. Just everyone's quoting Bible verses. Maybe. Save us.
Yeah. I don't know if the bottom's in, but
no,
there's opportunities out there.
Sure.
And if you've got more than a 1 day time frame, there are a lot of things that are very juicy and interesting.
Yeah.
Especially if you don't think the world is ending.
Yeah, and we can always go back, even regardless of what your assumption is, we can always go back to volatility and the curve.
Yeah.
We have between the J and K, there's a 7-point backwardation. Between the K and M, there's a 4-point backwardation. In COVID's crash, we had a 15-point backwardation between the front and back month. Mm-hmm. So we're not there yet, but this is substantial. Anytime you have a substantial backwardation, it tells you that the market truly has fear priced in at the current time.
Yeah, but the backwardation, it's one thing to have a 25 front and an 18 back. It's another to have a 50 front and a 35 back.
Yes.
It's still very, very high. I know that, volatility is certainly juiced right now relative to the back, but it is high. It's high.
Good question here. Has TLT ever been below 80? Selling an 85 put makes the break even pretty close to a historical low that I can find. The lowest I can find is June 1st, 2007, 1 year after I graduated high school. That is a low of 82.20. So, yeah.
I mean, it depends on rates. It's not
yeah.
TLT, it's just based on rates. So,
but yeah, if you're fading this move, I like a diagonal spread here. I'll do it. I'm going to do it right now.
Yeah,
I'll jump on the train here.
I did the poor man's cover call. I think that sort of thing, diagonal, poor man's cover call, stuff like that.
I'm going to buy the 85 in June and sell the 92 in May. 85 in June is trading for $4.60. The 92 in May is trading for 90 cents. Total package on a 7-point wide diagonal is $3.60.
Very nice.
Instantly filled. Don't know if I love that, but $300 debit risk to make $300 if we go back up to 92. Even on just like a short covering, or even halfway there, I'll close this before we get there. But again, just trying to trade these extremes regardless of assumption.
I'm with you.
Let's see. Is it a good strategy when you have a put spread on, and when the market comes to the strike, close the current spread and go to the next expiry and sell the same premium? So basically rolling down and out. You could. It's just tougher to do with a spread.
Yeah.
Because with the spread, you're purchasing protection, so it's harder to move it out of the money and collect premium. But let's just take a look. Like, if we go to SPY, let's just see like the 500 490.
You thinking, yeah.
Currently trading at 360. So where can you move it in June for 360?
Yeah. But that spread hasn't even moved today. Yeah. That's the thing. Is like, I know the market's up a little bit, so.
Yeah. So yeah, the spread. So if you had the 500 490 in May, you could move it to the 495 485 in June for scratch, 5 points lower. If it was a naked option, and this is the power of naked options and not having to define the risk. If you had a short put at 500 in May, you could buy back the 500 short put, and
485.
You could roll it to 485 for a scratch. So that's a big differential. You're still not able. What's really interesting about this market is because the near-term volatility is so juicy, you can't
go as far.
You can't go as far and down and out.
Yeah.
And in a lot of cases, it makes sense to just hold May until the premium goes away. If you held May, so like May to June, you can move at 15 points. April to May or April to June will be significantly more. So like if you had an April 500 and you waited till right now, you could buy back April for $1,700 and roll to May. The May 480 gets you a 60-cent credit. So that's a 20-point sell-off. That's another 5% to the downside, just from rolling from this 8-day to the 37-day. And if you went out as far as June, you could roll it to the 460 another 20 points. So that's a 10%, almost a 10% reduction in intrinsic value risk from where we are now. So that just goes to show that May currently still has a ton of premium relative to June. And you can see that in the actual IV as well, 45.8% versus 42.3%, with almost the same expected move. It's obviously more in June, but relative to time, it is not. 50 points over 37 days versus 60 points over 70 days. There's your implied volatility boost right there. But yeah, you could do it. You can move it down a little bit, but not that much. And we'd probably stay in May at this point because of the premium there. And even if it goes in the money, it's going to be a half the width loss. So if it's a 10-point wide, it'll be trading for $5. Even if it goes like 10, 20 points in the money, it'll probably be very similar. Who do we have winning the Masters? Jordan Spieth. That's it. Short and sweet.
I'm still waiting for my little leverage picks from you. You're a little late this morning, sir.
Hey.
I need some leverage picks so I can make some lineups.
Yeah. You gotta get in there.
I'm waiting for your picks.
Yeah,
get in there.
It's Scheffler or bust, but if it's bust, I would love to see Jordan Spieth win. I don't see the rally sustaining an Apple.
You don't, or they don't?
Baxter doesn't.
Ah. Yeah, I hear you. I mean, nothing has really sustained a rally, so why would this time be different? But, you know, part of the reason why I rolled my position is to lighten up, you know, the need for these big moves. I want to play into that long delta but short vol, so that instead of the 20-point move, 30-point move, a 5 or 10-point move would be just fine.
Yeah.
To get some of my cash back.
Yeah. Sunflower talking about MES trading in and out pretty easily. You can still trade it.
Yeah.
There's still activity here. It's just if you're a beginner trader, you're probably going to get smoked because you're going to be routing orders at levels you shouldn't be routing orders. But if you have an understanding of where your market should be, I'm sure you can get filled at decent prices.
Yeah.
It's just harder to see the bid-ask spreads flying around in that particular expiration.
Yeah. And you're still at risk of margin expansion here, too, because it's much smaller than the E-minis, and it's half the size of SPYs, but it's still, you know, a $20,000 contract at these prices. So, like, again, I would rather you go into E-minis and sell a 20 or 50 point wide spread than be naked here and have something happen where, you know, margin requirement goes to 10 grand and you're in a $7,000 account. You know, you can still have your 50 point wide spread in the E-minis. It's just, you can't be naked futures options unless you have the capital, you know. And by capital, it's like one E-mini future per 100 grand, you know, is probably what you should have if you're selling naked premium.
Yeah. Thoughts about a zebra or poor man's covered call on XOP?
XOP.
I'm already long oil. I have a micro crude oil contract at 67, which is 10 points higher than we are.
Oof.
But
painful.
That's what, again, sizing. I can hold this even if it goes to 0. I can hold it. You know, I'm not super leveraged in here because I have one contract on a $5,700 product. But yeah, this is not fun. But yeah, I like the idea.
You don't want any more.
I don't want any more. I refuse to buy more. But you could, if you had a larger account, you could dollar cost average into another contract. But yeah, poor man's covered call in XOP is interesting because IV ranks high, of course, but again, it's the same story. If you buy June and you sell May, the May implied volatility is 10 percentage points higher than June. So like if you're playing for a bounce, buying the 100 strike in June, selling the 110, the 115, even the 120 in May, you're basically getting a big cost basis reduction relative to the strike. What were you just filled on?
June 105, I did the 108 in April. In the 8-day. So I did this at $6 and change. I just want to play into this vol. Obviously, if you have an explosion back to like 115 or 120, I'll miss out.
You can buy back the 108 and roll it to May.
Yes, so roll it up and out. I figure that, maybe a $2 or $3 bounce here would be perfect, and then I can roll.
Yeah, because the 108 in April, which is a very strong theta decay, $2 over the next 8 days.
95% implied vol.
Yeah, but the 108 in May is trading for $5 currently. So if you get a move to 108 next week, you could buy back that 108 for maybe $2 and then roll up and out another 10 points for a scratch.
Yeah.
So I like that. I like it.
Trying to find some opportunities.
Yeah.
I like it. Whoever sent that, thank you.
That would be Smack Lovin'.
Smack Lovin'. Should have known. It's my man.
Is it possible to be profitable long-term with only defined risks due to capital limitations and not the ability to do naked puts and hold them when tested? It's much easier to trade if you have a larger account and you can do short premium where you can roll it forever. Hands down. But you can still be profitable with defined risk trades in a smaller account if you are selective, patient, and you can still roll a short put spread. Like if you have a short put spread and you get tested, you can still roll it out in time. But that's pretty much it. Like you're kind of limited to that. But that's why we trade smaller in defined risk trades, because we know up front that we don't have the same defensive mechanics that we can deploy when compared to a short naked put. But yes, you can still be profitable. Like if you were selling puts in the last 5-year bull run, like you're doing great.
Yeah, and
today you're tested, but you're defined risk.
Yeah, and yes, and if you keep capital on the sideline, you have you can jump into opportunities now. I think it obviously comes down to size, but I think people in general are trying to like max everything, right? So trying to use all your capital, trying to hit sort of unrealistic targets. I mean, sure, you can have some upside, some higher than just, average returns. But I think people get really caught up in trying to max everything out, and then you hit periods like this where, now you're screwed.
Yeah.
I think of, people ask me, how much can I make doing XYZ over a year? And it's like, well, if you're over leveraged, you can make a lot. And then if you have a downside move, you lose it all. And so there's got to be some sort of happy median there. And I think people kind of shoot too high a target for themselves, and they shoot themselves in the foot at times.
Yeah.
Yeah.
That's why we say, 1 to 3% of the account size in trade size and leaving 50% in cash on the table.
Yeah.
Helps you avoid over leveraged periods in times like this.
Yeah. And sometimes
you get hurt, of course.
Yeah.
But at least you're not, blown out on a 10% move. That's going to happen at some point.
Yeah.
It's all about thinking about sizing is all about how much volatility can I withstand? And that's it. If you think about it that way, you can, and you're sized proportionately, and you're sized to a point where if you're trading SPY or SPX or whatever, and you can absorb a 40% move in either direction and still be okay, then that is the correct sizing, because that is within the range of possibility.
Mm-hmm.
Like everyone's going nuts with this market. The market's only down 20%. We could go down another 20%.
Yeah.
It's in the cards.
Yeah.
Elisa. 2 MCL strangles expiring in July, 68 days out. 57.5 and 77 for $1.66, and then a 56.77 for $1.60. So let's call it 57.77 for $3 total. What are your thoughts? The 77s are
you're just short
play.
the puts.
So the 77s are worthless. I would consider moving the 77s down.
Yeah.
To even like the 67 It's still outside of the expected move for that cycle, but you're picking up a lot more premium that's going to offset your puts.
Mm-hmm.
But yeah, you're not in the worst position.
Yeah. And
Slightly
oil
money.
vol is super, super high right now.
Yeah, so rolling down those calls will pay.
Yes.
And even if you get tested to 67, you will have a period of time where you were at a scratch or a small profit, I would assume. Because you're going to go from 57 to 60 to 61, 62. Like, I don't see oil gapping from 57 to 77, but I guess we've seen crazier things.
Yeah, we saw negative numbers on oil one time.
Yeah. But, yeah, not in the worst scenario, but I would roll those calls down or consider at least close them if you want to lean exclusively long.
Yeah.
A couple minutes left here. Would you consider a reverse call ratio here for a bounce? Sell 3 25 delta calls and buy 4 20 delta calls in SPX.
Well, you're naked. So
Yeah,
I won't be doing that but yes, I mean, like that sort of thing, call diagonal spreads, I think would be a way better, and I shouldn't say better, should be a much more efficient way to use capital. But yeah, these sort of setups are very, very interesting because the volatility just tells you that premium extends much further than and value extends much further out the distribution. So, any sort of ratio type trade is going to really play into that. Just to look at SPY, if you're going to May, let's say, and you're buying what was the delta they were buying, 25? And selling 3 of the 20s?
Buying 4 20 delta calls and selling 3 25 delta calls.
Oh, so you're selling closer at the money calls and buying?
Yeah. Reverse call ratio. It's tough.
Yeah, I don't know why. That's.
It's just the problem with it is you're playing for a lot of different things, but your issue is that even if you get the move up, your spread's not gonna fill up because you're gonna get hammered on those shorts that are closer relative to the longs that are further. I would rather just do a straight up call ratio or a diagonal spread.
Yeah, or do like 1x3. I mean, these are even the 1x2s in May. When have you ever been able to do a call, an upside call 15 or 20 points wide ratio and do that for basically nothing? And that tells you that there's just the premium on the far ends are just, huge. So I'd rather do that.
Yeah. Last one here. With the VIX so elevated, considering a VXX diagonal May-April, what do you think of buying May 80 put and selling a 75 April put for around $9 debit?
I mean, if you're still in backwardation, there's you're playing, if you're short any of these products, you're playing for the curve to flatten out, if not go into contango.
Yeah.
If backwardation stays, this drifts higher.
Yeah.
Or stays flat.
Yeah.
So.
And really, that's what we saw. We're seeing very similar moves in VXX and the upside volatility products like we did in COVID.
Yes.
In COVID, because the backwardation was so crazy, and backwardation will cause, like Nick said, the VXX to drift higher. Contango will cause it to crumble down lower over time because the fund seeks to replicate percentage changes in current volatility. And if we're in backwardation, you can sell out of the near-term cycles for higher price and buy more of the next cycle for a lower price.
Yes.
It's the opposite, where you're selling out and then you're buying less and you get a drag on your performance. Here, you're getting the opposite. So the market's up 56 points today. VXX is down $1. But yesterday, VXX went from 67 to 87. On yesterday's move, which was a 200-point rally that was just reversed.
Yeah.
It was a bigger move, but that just goes to show. So in other words, when we are in backwardation, VXX, even into a 50 or 100-point rally, VXX kind of like plateaus. If we get another 100-point sell-off or 200-point sell-off, VXX explodes.
Yeah.
And it just keeps doing that. So I don't mind the debit here because you're defining your risk, but you need
vol to flatten out soon.
Yeah. And this is it's a 5-point wide spread that you're paying $9 for. So that's another consideration. I
mean, you got the 120, the 100 strike calls are trading at 110.
Yeah. It's tough.
So much vol.
I like the idea. I personally like SVXY better.
Mm-hmm.
It's the same idea. SVXY, you're buying it, hoping for a vol collapse. And here, you could just buy straight up shares in SVXY, or you could do a call diagonal spread, something like that. Same idea, but if you buy SVXY shares, you just have a longer time frame for SVXY to go from 34 to 60, which when volatility goes back to contango and markets recover, blah, 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 even if they don't recover, as long as volatility just flattens out, SVXY will start to drift higher. So it's tough. It's tough.
That's it.
That's it. We're out of time. Thanks for tuning in. If you got any further questions, you can find us on the Twitters. I'm at Trader Mikey B. Nick's at Trader Nicky Bat. What a day. What a day, people. We did play some trades. We'll post them to the follow page shortly here. But stay tuned. We got plenty more content on the Tasty Live YouTube channel as well as tastylive.com. We appreciate you all tuning in. Sign up for those cherry picks pinned to the top of the YouTube chat. And we'll be back same time, same place, Masters Thursday tomorrow, 11 a.m. Central. We'll see you then.
Peace.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number one for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
I want to play a game. It's a relationship game. So I'm going to ask you each a question.
Who loves the hardest?
Yes, yes, yes. So are you ready?
TikTok game.
Who's more stubborn? Who's more public? Who's more patient?
These are two of the least. These are the least patient people I've ever met.
I'm going to say him just because he's a little older than me.
Who calls or texts more? And who do you think takes longer to get ready in the morning? Who's a better driver?
I drove a truck in New York City.
I can fly an airplane.
Who loves the Fed the most? Who's the bigger spender, do you think?
Me. Yeah.
Who's the alpha in this relationship? Who is more spoiled?
Oh, him.
Who do you think is funnier? Who is the better debater?
Well, I'm gonna give it to him.
Dylan, you think you're the better debater? Are you the master debater?
No, he's he's good because he doesn't answer the questions, which is great for debating.
Move with the rhythm. Shake it up, stop when the clock hits 13. Sing 1, 2, 3, 4. Cause no one can do it like we do it, like we do it, like we do it. Cause no one can do it like we do it, like we do it, like we do it.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and Tasty Live web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market. dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
We are back. It is Wednesday, April 9th, 2025. This is Futures Power Hour, sponsored by CME Group. I'm your host, Chris Vecchio. He's Thomas Westwater. Thomas, welcome to the barrel.
Yeah, we're here getting some buying the past hour. It's looking good, but, we're reminded in the past couple days, capitulation the last hour. So everyone's nervous going into the end of the day.
Everyone is nervous going into the end of the day. Stocks may be not the center point of attention in this session. Bonds certainly drawing everyone's interest. We have a lot to talk about there. What a reversal, but what a sell-off nonetheless. We also see a big move higher in gold and silver. Thank goodness for that, at least speaking my book. We have problems in oil, though, Thomas, and I think that's where we want to start today. As we think about all of the ramifications of Trump's trade war and how it may reorient the U.S. economy in the long term, that's point B. We're currently still at point A. And point A right now is for potentially a short-term dislocation of the economy in many regards. This is that J curve that so many economists talk about, where things get bad quickly and then they revert back to the mean. In this case, we are looking at a decline in oil prices beginning to spill over and potentially impact U.S. production. Thomas, a few weeks ago, the Dallas Fed put out one of their energy surveys, and they gave us a chart with a number of break-evens on it. Basically, if oil falls below these levels, it's not profitable for companies to put new wells in, let alone draw it out of the ground. You sent me this chart today. Have we killed drill, baby, drill here? Are we about to see layoffs and a decline of production in the oil sector?
Yeah, so this is the Dallas Fed Energy Survey chart. It's showing the cost of, where prices of oil need to be with new wells. So if you want producers drilling new wells, they want prices at least at these levels. We're seeing it range from $61 to $70. We are now well below that. A couple weeks ago was a different story. So there's been a big shift in the oil market. We've seen it in copper as well, things that are seen as economic indicators for economic demand. Right now, this is a demand story in crude oil. It was a supply story going into 2025. We do have OPEC Plus saying they're going to release more oil. That decision is, I would say, in jeopardy following the move we've seen. We might see a reversal on that. This is really bad for Russia's economy, I would say, because a lot of their coffers have been supported by higher Brent prices, which we've seen a notable pullback in Brent as well. China, the U.S. trade war there, this is largely reflective of those two major economies. But the drill, baby, drill narrative, you're not going to see drilling, and you've seen that in the comments as well on the Dallas Fed survey. They highlight comments from CEOs, founders of these producers. They're saying, what they're saying in front of cameras, going into Trump's term was pretty positive because deregulation and everything. But now we've seen the tariffs cause, this economic stagnation. And you are not going to see much drilling with prices sub 60, especially looking at this chart. The producers themselves are telling us that, these are the prices they would need for new wells. That's not going to happen.
I think it's worth revisiting what was discussed here. Check the tape on March 26th when the Dallas Fed released this survey. The top line item in the survey, I think, is important from what the executives in the industry are saying. To quote directly from it, the key word to describe 2025 so far is uncertainty, and as a public company, our investors hate uncertainty. This has led to a market increase in the implied cost of capital of our business, with public energy stocks down significantly more than oil prices over the last 2 months. This uncertainty is being caused by the conflicting messages coming from the new administration. There cannot be U.S. energy dominance and $50 per barrel oil. Those two statements are contradictory. At $50 per barrel oil, we will see U.S. oil production start to decline immediately and likely significantly, 1 million barrels per day plus within a couple of quarters. This is not energy dominance. The U.S. oil cost curve is in a different place than it was 5 years ago. $70 a barrel is the new $50 a barrel. We're now in that territory, Thomas. And that sets up a really interesting dynamic when we think about the shape of the energy market now after this big decline, after we've seen now this spike in volatility. If you get to a place where you actually see new wells, they make public announcements that production is not going to continue, or they're going to start to take some things offline, that perhaps puts a floor in place, at least in the very short term. But before we get to energy, of course, and the implications that has perhaps on the broader market, we need to talk about stocks here, which are having a nice little bit of a bounce here as we make our way on the other side of the Treasury auction here. 10-year auction was just out. We're going to get there with bonds in a moment. But it's another day of relatively high vol, 91.4 IVR. We've settled in a little bit, I suppose. The trading range today isn't as extreme as it's been the last 2 sessions. Yesterday was the second largest nominal point range in the S&P 500's history from high to low, only preceded by what we saw on Monday. There is the old adage, of course, Thomas, that tops and bottoms are marked by what? Spikes and vol, and that is certainly something that we've seen here. Momentum remains putrid, though. So square the circle with me here. You speak of a concern that while looking at a rally here over the course of the session, ultimately it's one with which we still have to stare down the second half of this day now. Markets may close in 2 hours and 50 minutes in the cash equities, 3 hours 50 for futures. You're telling me that feels like a lifetime.
Yeah, I mean, a 41-point jump, it's nice, but considering the sell-off we've seen, it's really pales in comparison. You think if there's a lot of FOMO coming into the market, we'd be up a lot more, We've attempted to carve out a bottom here. I think it's a pretty weak one. What has changed since Liberation Day? We've only seen escalation, so this isn't really a place where I want to load up more on equities. I am long one call spread in SPX. Taking a little pain there, but today's helped a lot. I'm only got 8 days left. I'll probably take it off if we get more upside, take it as a scratch, sit back and keep out equities for a little bit here. I want to see volatility come in a lot. VIX still trading very high, showing a lot of uncertainty in the market. I think this is a lot of traders taking pot shots at, getting long. I don't think it's going to have a lot of conviction, especially after what we've seen yesterday, the capitulation to the last hour. I think the last 60, 30 minutes of the close today is going to be very telling.
We did see that pop here a little while ago, right as the show began. We did have a 10-year Treasury auction, which was among the best on record. We have to discuss that in a little bit, but it did give us a little 40-point bounce here in ES that has since reversed. But in terms of the Treasury market, that is a very welcome sign, a very much needed welcome sign as we make our way through the middle of this week, now into the first full week of this new trade war reality. Thomas, it's a 91.8 IVR. One of the items of interest that came across my feed today, looking through the news, we see that the House Republicans are using the rule for the budget resolution to turn off privilege for any resolution dealing with the April 2nd trade emergency. It hasn't been voted on yet. It's going to be voted on at 3:30 today. But if it passes, this would make it impossible for anyone to file disapproval resolutions on tariffs through September 30th. That to me is something that we got to keep an eye on for today's schedule. Of course, we have the FOMC meeting minutes coming out here shortly at the top of the hour. But depending upon how this vote goes, it's going to give us an indication for how long this experiment in restructuring the global trade order on the whims of one person's arbitrary feelings, is that going to continue for the foreseeable future? If not, it's a small fig leaf, right? If the House, which is controlled by Republicans, turns down this resolution, thereby leaving open the privilege for any resolution dealing with the April 2nd trade emergency, it has that window of an off-ramp, right? But if this fails later today, we talk about the futures market close on the after hours when cash equities close. That's just something that could, you have to be very weary of that kind of news in an environment like this.
Yeah, and this is interesting because there's a handful of Republicans, not much, about 7 or 8, that have recently, pushed back and say they want more authority given back to Congress on trade and tariffs and things like that. Jeff Hurd, Don Bacon, I believe 6 or 7 other legislators signed on to this bill. And then you have this other faction, which seems to be larger, which wants to give, keep the power in the executive for tariffs. It's important to note that originally, the levers for tariffs were more under the legislative than the executive. That's shifted in recent times. But this is going to be important. If it does, if they do continue this or pass this resolution, which gives the executive more authority to levy tariffs, I think the market would take that as a bad sign. I'm not sure how many people are watching this, but certainly it's going to come into headlines if it does pass more than just a resolution to introduce it. But yeah, definitely something to keep your eye on.
It's definitely something we need to watch here. Markets are still gaining some footing back after this auction. It really red hot, as I've seen some people describe it on Twitter. Bid to cover ratio was 2.67. I feel like it needs to be discussed right now because it may help us, help contextualize the equity market action here in the short term. But the 10-year auction results, we stopped through by 3 basis points, which is really, really strong. It's the second strongest stop through in a 10-year auction ever. Plenty of demand here. We see ultimately that the dealer takedown was 10.7%, which is the lowest award on record. Lowest award since February 23. But what that shows is that there's a high degree of demand for U.S. debt among a broad swath of market participants right now. So we get this spike up to 4.5% in the 10s, 5% in the 30s. People are happy to line up still. And I think this is a really important sentiment checkpoint here for today's action, at least perhaps over the next hour or two. Markets initially took higher after that auction. We see a little bit of turn to the downside. We're now firming back up once more. NASDAQ up 2.32%, S&P up 1.3%. Russell just floating into positive territory here, which I suppose is perhaps the best barometer for all of this, Thomas, right? At the end of the day, who's going to struggle with the higher costs for cost of goods sold? Small and medium-sized enterprises. The big tech companies, they have large cash balances on their balance sheets. If they need to tap their balance sheets in order to survive higher cost of capital for a year or 2 or 3, they could do so. They can weather the storm. They're not going to have great equity returns, but they're not going to go out of business. But small, medium-sized enterprises, they don't have that luxury. It's why the small cap stocks struggled so much in 2022 under the burden of higher interest rates. It's in part one of the reasons why the Russell is still down. I think over the last 5 years to date, still in negative territory, Thomas. How do we square up any bounces in the Russell here? Do you think that on rallies, perhaps if we want to stay long stocks, we do it through ES and NQ? But if we have sell the rip opportunities, we look for that short delta exposure in a name like the Russell?
Yeah, I think you're spot on. I mean, I think the Treasury Secretary, what he said disagrees with you. He said it's Main Street's turn to enjoy some growth over Wall Street. I'm not sure how he squares that with tariffs. Smaller businesses do have those smaller margins. And that's kind of, when risk is on, we're seeing the S&P 500 up. You're still seeing the Russell in negative territory. So certainly if there was a rip in the Russell, I think selling it would be, the thing to do versus selling the SP 500 here. But, what price action is showing us is that these small companies are still going to, take a lot of these tariffs on the chin.
And they are, and you're seeing the news roll in across the country, and across social media here, companies pausing operations, various manufacturing facilities, Michigan, California, Iowa, Texas, Nevada. It's just the reality. We can't do a lot of the small components manufacturing here in the United States right now. We just don't have that in our supply chain. And it's not readily available in any of our allies' supply chain either, although, are they allies still anymore? You do see that the Russell's taking an immediate step back, now down by 1%. I'm pressed to think that we just saw a headline come out here because the stocks, which were up 2.5% of the NASDAQ, are now only up by 1%. I'll keep an eye out for that, Thomas. But it's that kind of day, and it's been that kind of week. And, I'm not a scalper by any stretch of the imagination. I've never held myself out to be. But if you're taking any positions in this environment, and here we go, now we're swinging back higher. The Russell's up by 0.8%. Something must have just come out.
Yeah, I'm looking right now. I'm not seeing anything yet, but there has to be something out there.
Trump raises the tariffs to China to 125%.
At this point, why not go to 500%? I mean,
excuse me?
Yeah, I mean, one thing is we still got a few weeks until we see some hard data on the labor market after these tariffs went in place. So I think, the next jobs report, we're still a few weeks away from that. But this is going to be a really big jobs report coming up for the market.
President Trump, Truth Social's quote, based on the lack of respect that China has shown to the world's markets, I am hereby raising the tariff charge to China by the United States of America to 125%, effective immediately. At some point, hopefully in the near future, China will realize that the days of ripping off the USA and other countries is no longer sustainable or acceptable. Conversely, and based on the fact that more than 75 countries have called representatives of the United States, including the Departments of Commerce, Treasury, and the USTR, to negotiate a solution to the subjects being discussed relative to trade, tariff barriers, currency manipulation, and non-monetary tariffs, and that these countries have not, at my strong suggestion, retaliated in any way, shape, or form against the United States. I've authorized a 90-day pause and a substantially lowered reciprocal tariff rate during this period to 10% effective immediately.
Oh, there you go.
NASDAQ up 5.69% right now, folks. There is a tariff pause in effect. Throw away the playbook. Forget what you were doing previously. This market is on an absolute ripper right now. There's no other way to put it. This thing is moving to the upside. Forget about that 3:30 p.m. vote. Looks like that bond auction came through at the right time. S&P 500 now 5.47% higher, 5293. The NASDAQ up 5.66% here right now. We have, again, a 90-day pause. President Trump himself tweeting out on Truth Social, he is now ring-fencing China, 125% tariff against China effective immediately. The countries that have declared and called into the United States for tariff negotiations all will have a 90-day pause and a substantially lowered reciprocal tariff rate during this period of 10% effective immediately. Thomas, holy cow, this is the best news that the market could have received today.
Yeah, I mean, this is really big. You're seeing a lot of buying right here. This just shows you you're only one tweet or one headline away from ripping the other way. Strategically, I'm wondering if the market reaction, the pressure from CEOs and everything got to the administration. You saw China retaliate. They said they wouldn't take the tariffs off. Now there's a pause. So that's some certainty coming into the market. Now it's definitely risk on. So that's a pretty insane move, though. We're up 4.2% on the SPOOs. Yeah, we're ripping here.
There's a lot of technicals that can be discussed here. One such as the fact that we could be actually putting in that bottoming candle today. Yesterday's high comes in here at 18,357.25, and we're quickly approaching that high. It would also bring us back above our 1-week moving average on a closing basis for the first time since Liberation Day came into effect. The volatility crush is real right now, folks. If we take a look at what's happening over in the VIX. It's now down to 41.71. It's off 10 full points today. We hit a high earlier in today's session at 57.96. Just taking a step back here for a second, I'm relieved, not just because of what's going on in the market and obviously the equity positions that I hold long term, which quite frankly are feeling much better here today, Thomas. I'm relieved for all the people who aren't going to lose their jobs now. That is the most important part of all of this if we're talking about a potential recession trade. A 10% reciprocal tariff is absolutely something that businesses can digest. It's absolutely something that consumers can deal with if part of it is passed on. It will not lead to a sudden stop in the U.S. economy. I've been alarmist the last few days here. Plain and simple. VIX now at 39.07. I've been alarmist here, plain and simple, because this would lead to economic calamity. And the market is a voting and weighing mechanism of all future earnings and growth. The fact of the matter is this crash has been driven by the idea that margins would come in, that the cost of capital would go up into the future, that would be looking at a world where you'd be looking at lower demand, higher unemployment, strained budgets in the future. Because if all these people are laid off, they're going to go on unemployment benefits. We're going to shrink the tax base because these businesses are underwater. It's going to strain the country's finances. It's a disaster. This may put the toothpaste back in the tube to a large degree. And the pauses in operations that we're beginning to roll out, they're not necessarily going to happen. Without a doubt, this is very good news for the broader economy. NASDAQ up here 7.13% right now, Mr. Westwater.
Yeah, I'm trying to take off my my ES position right here. It's up really nicely. Gold doing amazing. The yen falling back down a little bit. Typical risk on across the market. We've seen gold go up with stocks, so that makes sense there. But yeah, like you said, businesses can stomach that. I'm sure a lot of supply chain managers are, recalibrating right now. Everyone's taking a deep breath. So it's good news. Good news for the stock market, good news for the economy.
Good news for the stock market, good news for the economy. A lot of individual names here are moving very quickly today, so we're going to take a brief detour. We did get a comment earlier today, and I said this to Mike and to Nick, and I sent you the chart too, Donald Trump CMT, saying that today was a good time to buy. The only other time I remember an American president suggesting something like that was when Obama did it on March 9th, 2009. And to Mike, I told you that one of my long-held theories is you buy when the people with their hands on the economic levers pull it. Lesson learned again. It doesn't happen that often. ARM here up 16.1%. Delta Airlines, which got crushed in recent days, is up by 15.7%. On a sector basis, you're looking at XLK right now up 9.22. XRT, the retail ETF, which has been slugged in recent sessions, really all year long, now up 8.39%. The banks are finding some relief, up 5.29. All of the growthy stuff is leading this charge higher to the upside right now, Thomas. This is a significant relief valve that the markets have been desperately looking for and provides a path forward. At least we can see that vision coming through, that Fortress perhaps America, Fortress West, to really ring fence China. It's quite something to see this action here unfold in front of us right now.
Yeah, this is, a trader's dream. You got to be watching the screen, though. You got to react fastly. But like you said, Trump tweeting the time to buy, that was definitely, looking back, he was sending a signal. Discreet signal, but it was a signal.
Was it discreet? He said it's time to buy and then use the hashtag DJT. Either way, though, this rally continues. The S&P 500 now 53.85 here. We're looking at that bullish engulfing bar that would mark low. We do have that VIX 3-month ratio, the VIX divided by the VIX 3-month contract that did spike above 1.24 yesterday. It's now coming back in as well. So that's consistent with other historical episodes of short-term bottoms in the market. As we flip back over to our equities here, again, for the recap, for people who are just tuning in, who missed the initial move and are wondering why this market's doing what it's doing right now, a few minutes ago, President Trump just truth socialed that there would be a 90-day pause effective immediately for the 70-plus nations that have called in to try to begin negotiations. To that extent, there would be a 10% tariff applied across the board in a reciprocal fashion. On the other end, the tariffs against China will move forward at 125%. So the screws are still being turned there. That is obviously perhaps the escalation behind de-escalation, if that ultimately is the tactic. Commentary from Chinese officials and various apparatchiks over the course of the day through our Western media have suggested that there's still broad appetite for a deal. The Chinese government would prefer to do it from bottom up, where it culminates in a grand Xi, China, U.S., Trump signing ceremony. That's obviously a ways away. But the relief valve that markets have been hoping for, that have been praying for, Thomas, it's finally arrived. It's a bit of good news right now. Stocks up 7%. Volatility crashing in right now. IVRs, which just a few days ago in the NASDAQ, sitting up near 135, back down to 67.
We're up 6% now on the SPX. Pretty insane here.
It's an absolute insane move. This has been an absolutely insane week thus far. Hopefully those who were able to put on some short put exposure, long deltas in equities, were able to ride some of this out. I'll tell you, Thomas, I had that short put spread that I put on for March 14th that I've still held on to. I'm not too upset with how today is starting to unfold. I will absolutely be able to close this out at a much, much, much smaller loss. Unfortunately, we've got to talk about bonds, because bonds have proven to be something of an absolute nightmare today. There is a reversal here, one for the ages that's playing afoot, just as we are seeing here in the equity market. What was a low print overnight of 111 and 17 ticks, we are now a full 3 points higher at 114 and 21. Likewise, what do we see here? This gigantic reversal candle off the lows, buttressed by this big, beautiful 123 IVR. For those that are new to the game, IVR is we scale volatility over the past year. If you're at 50, you're at the 50th percentile. If you're at 100, you're at the 100th percentile. When you go above 100, we are now 23% higher than the highest reading that we've seen over the past year. Volatility in the bond market is, well, rare. We're in rarefied atmosphere. Moreover, now that the relief valve has arrived, what might be the potential for a more significant turn? Thomas, if we're not choking off global trade, if we're not putting up these aggressive trade barriers, then we're not going to lose the dollar's role in global supremacy. And if we're not losing the dollar's role in global supremacy, then there's still a good reason for people to come to our treasury auctions and buy our debt and continue to take the dollars that we send them, and then they send it back to us to finance our government, to keep our economy pumping strong. This is a significant turning point here for the bond market, I think. After all the overnight hand-wringing, China, basis trade, this, that, all the other things we planned on talking about, I am going to ride out the volatility now. It's been a hell of a drawdown. I almost threw up around 1:30 this morning, but I'm good now. So we stick with it.
Yeah, so if you didn't have a position on here in bonds right now, I'm thinking sell a put spread in ZB or something like that. It's what I'm looking at. I think I like that. But yeah,
it's the most reasonable thing to do.
Yeah, it makes sense with the volatility here. You know what I'm afraid about is a reversal from this, but that would be, I guess, harder to do. If you walk back this kind of statement, then you really risk losing confidence in not only the market, but people probably in your own administration, Congress, etc.
Not even sitting by. This is, again, a huge turn of events, right? This wards off the worst case scenario that we were cratering into. This is a momentous turn of events here during the course of this session. It feels like something big is happening right between 1 and 2 p.m. every day here, folks. We do need to go back over to stocks here because that's where the action is. The NASDAQ is now up 8.11%. Looking at the board here, Thomas, and just doing a little bit of quick scratch math, this might be the largest ever intraday trading range in the S&P 500. Monday's range was about 400. We're talking about, what, 454 points? Low to high today? Yeah, this is the largest single day trading range in the S&P 500. So, taking a step back here, right? High volumes, a big update on some of the largest volumes that we've seen throughout this move. We've seen it in stocks. We've seen it in bonds. Volatility is highest at the turns. We've now seen the vol spike, and we've seen the collapse. I know it's easy to say now they're up 8.11%, but as a technician, there is a lot, obviously, depending upon today's close. You could say the low's in. And you could trade this market like it's going to go to the upside now moving forward, which I can't believe that's where my head is now at from where we started this 35 minutes ago.
Yeah, I mean, you're seeing the things like copper up 5.5%, crude surprisingly 2% up. I thought it'd be a little bit more than that given the risk on in the equity market and things like that. Gold 3%, NASDAQ now 8.21%. I've never seen anything like this. Gone through COVID, everything like that. It's pretty insane here. This is a day to remember. You'll be telling the grandchildren war stories about the past couple weeks.
Yeah, they'll say, what happened during the trade war? Did you liquidate your portfolio and get out, or did you stand by chicken shit, deer in headlights, and ride it out? And it's like, well, I wrote it out because long-term holdings don't get touched, right? We dollar cost average in and accumulate. You dollar cost average in and accumulate. You don't panic. Sell call spreads against your, if you have enough Apple, Amazon stock, whatever stock you have, sell call spreads against it. But we now have a NASDAQ up 8.76% here. The S&P 500 up 7.27. Our beleaguered little Russell putting in that bullish engulfing bar candlestick now, 61.2 IVR. Decimation collapse there right now. Talk about taking a move off the lows. We can go out to 51 days. You line up the recent swing lows here in the futures market, RTYM5, close to 1,700. We could do something in the neighborhood of like a 1,750, 1,700 short put spread. If you're feeling like you need a little bit more than that, you can adjust the risk to reward. But those are the lows that we can operate around depending upon your risk tolerance and still find something in that, 60 to 70% probability of profit range. NASDAQ now up 9.23% here, Thomas, as we continue to rally on this wacky Wednesday, as one Victor Jones might say. Again, things are moving fast. The worst economic crisis that may have been inflicted upon the U.S. in our lifetimes is now on the back burner, which is good news for everyone. Thankfully for everyone, it's good news. But the bond market, where our attention lies, we talk about that auction, Thomas. We are seeing a turn here. We are holding the uptrend off the lows. Unfortunately, this move has given me one last thing to discuss here because I had some trade ideas in ZN and CL to talk about down at those levels, but it's still an 87.7 IVR. So if people are looking to get in and think that this may be the significant turn, right, we're going to have lower growth because of China trade, but we're not going to see the runaway problems with the debt, the deficit, with layoffs. We're not going to see that type of lack of demand for U.S. Treasuries moving forward. This is a compelling place to sell some put spreads against if you're operating in ZN right now. I still have the Iron Condor that was put on yesterday's show. But even so, if we were thinking about like a 107, 108, and we'll change this here, go 1.5 points wide, you can find something that you can trade in this where you're looking at a short put spread and get a decent risk to reward. This is a 2-to-1, right at 66% probability of profit if you go 1.5 wide right now at 44 days to expiration.
Yeah, I like that. I just got filled on my ZB, waiting for my SPX order to fill. I thought that would get filled a little quicker here, but it's not. I really like long bonds right here with what's happening.
And it's just seeing all these events go across the screen. Lots of green right now on the screen. the long bonds now, it's all about that, typical tasty methodology. I saw someone tweet out this morning, either bonds are going to continue crashing. We're looking at a, sub 110 figure, or this is going to be the best vol selling opportunity in the history of markets. It's looking like it's more of the latter in that regard. So if you were selling in the hole last night or riding it out, you certainly have some things to hang your hat on here. But the volatility contraction alongside all of this is ultimately what you like to see. We think from the technical perspective, Thomas, recent swing lows throughout March, we peaked below them today. We ran into the February high. We have now bounced off of that level here, that former outside engulfing bar key reversal at the highs. The worst of the bond move may be over. And I know it's difficult to say after what's been a bloodletting the past 3 sessions, but between the news, the technicals, and the surge in volumes, we have a low that we can trade around. Again, from the long delta perspective, with a good deal more confidence than we have had in 72 hours.
Yeah, absolutely. I mean, I'm thinking I'm going to get long ZN2 here. Got long ZB, long ZN. Volatility still has a ways to come in. It takes a little bit of time, more than half an hour. There's still trades out there. I mean, looking at the platform, it's just a lot to take in right now with everything. But you're going to probably see some insane volume finish for today. And, we've seen really elevated volume the past week. It's been pretty nuts.
Just because we have to do our duty here and keep an eye on the markets that are moving, I would point out what's happening here in our NVIDIA chart right now. There was that longer term trend line that we were fighting off as the stock sits up 12.5%, right? Former swing lows here. We can start to look at all this in a different form or fashion. It's beginning to shape up like a little bit more of a bullish falling wedge at these levels as you start to poke into your 1 month moving average. You can get through 110. This looks like a pretty interesting area for a potential turn. Name like Microsoft today, which was a little bit sturdier than some of its counterparts for what it's worth during the decline. This likewise is beginning to show signs of potentially looking to turn and break its downtrend. Apple here too, seeing a big contraction in vol and a big push to the upside here. Apple's very sensitive to the China stuff. Let's be clear. Very sensitive to what's happening in China. They can't simply shift the production over to India. And, as Dan Ives over at Wedbush Securities was talking about earlier yesterday with his team's modeling, if you want a $3,500 iPhone, it can get built in New Jersey. Otherwise, this is going to be a serious set of circumstances that need to be resolved. Other names that are moving to the upside here, Amazon is up 7.2% right now. Tesla, of course, which, would be very harmed by those tariffs themselves, despite the fact that Elon's tried to do a very, diligent job of sourcing parts and components for his vehicles in each domestic market where he sells them. Shanghai Gigafactory, Berlin Gigafactory, yada, yada. We see here 13.2% to the upside right now. Walmart, which was warning today, withdrew guidance because of the impact of tariffs. It's erased its declines for the entire month of April with its 65.8 IVR. It may be breaking its downtrend that's in place here. That's going on at least since the middle of February right now. Can just draw this up on the chart real quick. So lots of technical turns, big volumes, momentum indicators. There's your divergence, Thomas, right? A higher low in stochastics as we break the downtrend here. And the news that we really needed to see, the official announcement from President Trump that there is an off-ramp for the tariffs right now. And that's, quite frankly, the best that we could hope for, because it means the prospect of economic destruction here on our shores is much, much lower than it was just 40 minutes ago.
Do you think this was the strategy all along? Come out hard, swinging for the fences, then come out, announce a pause, time to negotiate. You kind of set up the room for a deal. If you're going off inside of Trump's head, it's interesting. I mean, the market is definitely enjoying this. It didn't think that was the strategy. Otherwise, we wouldn't have been down as much as we were. But there's also still some work to do. You don't expect to see the NASDAQ rally 20% in one day. But the finish through this week is going to be, assuming nothing changes from here, it's we're probably looking at, S&P 500 getting back to 5,700, 5,800 around there, I would assume. That would be my end of week target. Follow this move through maybe a 2-3% up day Thursday, Friday. And then you get this recalibration in markets. I'm not sure if we go back to new all-time highs from here. We're still, a bit away from that. There's still time to see what happens, but like you said, vol selling, this was the time to do it. Probably no better time in a very long time, or perhaps ever. So there's probably a lot of happy people right now. There's probably a lot of people that are not so happy. If you liquidated right at the bottom and there was the liquidation trade going on, you're probably hitting yourself in the face right now. But for investors, this speaks to don't sell if you have a long time horizon. For traders, this is you need to be ready to capitalize on extremely high volatility. You get the reversions to the mean. It always happens. There's no reason that this time is different. It's just when is it going to happen? So you structure your trades in a way that gives you time, for an event to play out like this. For day traders, it's probably a little bit harder to do that. But this is crazy. It brings me the scene that pops up in my head is from The Big Short when Ryan Gosling is in the bathroom and he's talking to Mark Baum or Steve Carell, and he's jacked. So this is I can see a lot of people are echoing that sentiment right now.
Besant's out here saying that countries who do not retaliate will be rewarded. Mexico and Canada are going to be included in the 10% tariff, saying it's not a trade war. The rest of the world is working with Trump while China's heading in the other direction. He insists that the pause isn't because of the market reaction.
Okay.
Okay.
Yeah.
Okay.
All right.
Yeah, the market just told you that you were going to destroy the economy if you went along this current path. And we're certainly not out of the woods just yet, right? But, technically you have lows in now on a, again, we get the close above yesterday's high. You have a move through the 5 EMA. I know Tom and Tony were out here yesterday with me on Let Me Explain. We were talking about the potential lows and specifically, citing how it's not like the 2023, 2024 mindset of just buying out of the money calls, although that would have worked fabulously today, but it's more about capitalizing the vol in that wedding crashers mindset, right? Owen Wilson runs up at the end of the movie and he says, I'm not asking you to marry me. I'm just saying don't marry him. And that's kind of what you're doing with put spread selling. You're saying, I think the market's going to stop falling and not necessarily go up. Today is obviously a very big up day. And that's great if you've been on that side of the table, but an 8.1% gain now for the NASDAQ. Again, if you've just been joining us, or if you already have, now you will. President Trump has declared a 90-day pause on the tariffs against countries that have come forward to negotiate, about 70-odd countries or so. He is increasing the tariff on China to 125%, which, as the WTO actually just said about 10 minutes ago, based on the figures, that would lead to an 80% decline in trade between the two countries. So the market is now largely interpreting it as, more of a stick than a carrot. I'm not thrilled with the 10% tariff either way, Thomas. I don't like paying more for stuff, and I don't know what 10% tariff will do to help reshore things, but it's not the worst case scenario here. So we're going at 8.5% right now on the NASDAQ as we round into the final 2+ hours of the trading day here.
Yeah, I mean, if the goal is reshoring, if you're going to negotiate rates that are relatively low, was that the goal all along? What was the end goal?
Feels like a lot of this could have been avoided, maybe not. We move off of our bond section here, Thomas, to talk about some other things that are finally happening. And I think, gold's not up as much as it was before, Thomas, but it's a day that's sorely needed here after what's been a brutal 3-day, 4-day stretch here for my favorite position that I've held. It's finally back on the up and up. Last week, prior to the tariff announcements, we had rolled out gold long exposure, both in further out of the money, but also in duration, just to account for the potential circumstance of this. There's still 70 odd days to expiration in the trade. I still feel very good about holding gold. We're basically where we were a week and a half, 2 weeks ago. The uptrend seems to be in place. This is a beautiful Morningstar candlestick cluster pattern that's coming together here today, which signals a bottom. And where is that bottom occurring? Right up against the former highs. We're back above the 1 month, back above the 1 week. Volatility has expanded throughout all this. Very comfortable holding on to long metals exposure. If it's gold, if it's silver, silver's got a lot of work to do to make me not feel like such a sucker. But this is a very good step in the right direction. Chart's frozen here because the chart has been marked for the close silver settlement during the futures trading day, but here technically in the metals after hours, 30.70 now, and that puts us back above our 1 week moving average here likewise. So you're seeing, again, the big exhaustion, the wipeout to fit big swing lows here on enormous trading volumes, and now you get that catalyst of an announcement because all of this has been on the whim of one person. Do we feel like, Thomas, revisiting an idea, if the Russia sanction ends, do we feel like the world is going to use Western banks as their counterparties? I would argue not. I would argue that Russia is going to move that money outside of the West into hard assets. Do we feel like the U.S. is a reliable counterparty at the end of all this, despite the fact that maybe we're moving in a more positive direction? I think other people are going to be a little less eager and be happy to hold diversified assets moving forward like gold, silver, copper. So yeah, gold and silver at the end of this, I think, are now very well positioned to take advantage of this environment. I will lean long deltas here. It's been a pain, but it's been, I think, it will be worthwhile in the end as the market evolves in a manner consistent with long-term what should be good.
Yeah, I'm already long gold. I'm going to get long silver here. Copper is interesting. You know, copper, I think it might be an overreaction with the Chinese tariffs still on because China is a 40% to 50% global consumer of copper per year. You know, we see a long tail on that copper candle. Maybe the market, you know, the algos bought, and then people say, wait, tariffs still on copper. We had a very, very, very low copper-gold ratio with the move over the past week, and that makes sense. Copper deteriorates, gold's a safe haven. You know, the Z-score for copper on a 60-day look-back period was negative 3.2, so 3 standard deviations from the mean. That's pretty, that's way outside of what is normal, it's showing you. So copper, very cheap relative to gold on that ratio. Now, is it the time to buy? I'm not sure yet. I'd say my conviction in copper is still pretty low if these Chinese tariffs are staying on. But gold and silver, I'm all for going ahead with that.
Certainly, we got to drop back towards the yearly open here the past few days in copper. We're now back up to 437, and that again puts us north of our 1 week moving average. Perhaps the worst of the decline is over. You want to pop on over, you see a 78.6 IVR when you look over at the Copper Commodity Index Fund. We need to pop on over to energy, however, which none of this is valid anymore because all of the news has occurred since we started and went on air. But metals are shining. Bonds are no longer decimated. Stocks have sustained the historic volatility. We're now up 8% on the NASDAQ. Energy no longer struggling. And this really sticks in my craw because when I was going to come onto the show with you, we had our whole intro about break-even rates, how we're now below the place where their new wells opened, how we're getting to the existing point of $50 a barrel where existing wells can stay open. It actually was going to be a great time to sell a put spread. I'd love to have sold the 50-52 put spread here on the show. Unfortunately, fortunately for other positions, we now see ourselves surging to the upside. So now at 61.28 here, why is oil doing this? Could there be greater scope of recovery? I think we got to say the answer is yes, Thomas. A stat that we love to cite here on Futures Power Hour, you go back 30 years on a quarterly basis. The correlation between demand for oil and global GDP is a robust plus 0.92. If we're not going to have the worst trade war and the highest tariff rates that we've seen since William freaking McKinley was president, then we're probably not going to see global trade grind to a halt that warranted a 25% pullback in crude prices in the span of a week. 68.3 IVR, there are definitely places to operate around here still. I think this is I think there's still a valid trade here, just not at the levels that I like. What are your thoughts on the energy market now as we wind this down?
Yeah, I mean, if this tariff pause is on, I think we definitely stay above $60 a barrel. You go back shifting to OPEC, are they going to increase supply, things like that? Is the economy still going to enter some type of slowdown even with these tariffs off? Probably, but not so much as whereas if they were staying on. Looking at selling a put spread on the contract 36 days out. I don't know, selling the short around 60, 59.5, I think makes sense. Some of the legs don't have much volume or open interest in them, so I'm going to take a look at this right after the show and try to structure it in a way that most makes sense.
Most makes sense, 61.63 here now. Oil up 3.41% as the rally continues to stick around, spreading to other asset classes. Bitcoin up 6%, Ethereum up nearly 9.5%. Natural gas, likewise, Thomas, 7.45% higher here, potentially making a very important turn. Natural gas, of course, we have plentiful amounts of it here in the U.S., and so if we're going to put these tariff barriers up, it could potentially lead to oversupply in the short run. We only have 1 minute left because we're going to be heading into truth or skepticism shortly here. We see big reversals across the board in currencies. The yen, of course, having the biggest one on the day, up near 0070. So close to those calls, now back negative by 0.28%. But big relief across the board, particularly in the China-sensitive stuff. The Australian dollar, big bullish outside engulfing bar here. And we're moving back into the range that we had that defined most of trading from December through April. Again, signs of a turn, signs of a major low. Canadian dollar, likewise, higher by 1.03%. Could be on pace for its highest close of the year. Trade war, from this perspective in FX markets outside of the yuan, winding down in very, very, very short order. Thomas, this was the craziest episode of Futures Power Hour that we've ever had. We're going to wind this up because Sosnoff needs to get on here and explain all this to the good viewers of Tasty Live. Tomorrow is Inflation Day. We have FOMC minutes coming in 5 minutes. There's a lot to do. There's a lot to discuss and delve into. So I'll be back later on with Ilya, with Radigan, to talk about all this on overtime. Be sure to join us at 4 p.m. Eastern, 3 Central, right after last call. Otherwise, stick around here until then. After a brief break, Sosnoff and Radigan, they're here. It's time for Truth or Skepticism, only on Tasty Live.
How we respond to the most difficult situations is ultimately how we learn to build on our successes.
It takes the guesswork out of retail trading.
If you missed the live show, here's our cherry on top weekly recap.
I had the, what do you call, the hot girls dinner?
Oh, you had girl dinner.
Cheese plate?
No.
Popcorn and wine?
Crackers?
I went snorkeling.
You went snorkeling?
But I said the last time I went snorkeling.
And the fact that you've ever been snorkeling is pretty amazing.
That it also implies a future time that you will be snorkeling, right? Not because you didn't say the only time I went snorkeling. You said the last.
The last time. It kind of has the implication.
What did you say? The fact that I've ever been snorkeling is amazing?
Yeah.
Why?
Because she studies physics and it's not supposed to work.
It just doesn't, yeah.
Wait, you're going to Vegas?
I am going to Vegas, yeah.
Ooh, for what? For just funsies?
For my birthday.
Oh, wait, I didn't know it was your birthday this weekend?
Yeah.
Oh, happy birthday. birthday.
Yo.
I didn't know you were an Aries.
I am an Aries.
Yeah, that kind of
So
tracks.
Something. What is your sign?
I'm an Aquarius.
Aquarius?
I'm Aquarius, yeah. Tom's a Pisces.
Pisces.
Yeah.
That makes a lot of sense.
It
actually,
does.
yeah.
It really does.
That kind of tracks.
I don't even know what that means. Whatever.
I think it means you like fish.
What happened, girl, during last call?
I lost my
You want to talk about it?
I lost my beret.
You didn't lose it.
I found it.
So you got.
I'm thinking of getting rid of it.
Oh, new look?
I'm thinking of the new look.
You should do a faux hawk.
Oh,
What is
I think you nailed it, Vanessa. I don't know.
No,
What is it?
cornrows.
I could see rocking some cornrows.
Yes, cornrows.
I think you should go to Flavortown and just get the Guy Fieri spikes.
Boom, platinum tips.
Platinum, yep.
Is it true? Did you skip the beret yesterday?
On the clothes.
Oh, it looked like it looked like a decrepit old grandmother. It was so gross.
It's like that old monster from Tales from the Crypt.
Get the full scoop by checking out the archives at tastylive.com.
Beat the opening bell. Get trade ideas and market insights before the open. From the creator, Tom Sosnoff, and our chief market strategist, Tom Preston. Every weekday. Sign up at tastylive.com/newsletters.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade. It feels good to get smart. Get even smarter with the ultimate how-to guide. Learn 31 different option strategies, covered calls, iron condors, jade lizards. Become a trading mastermind. Get the guide at tastylive.com/guide.
Hello, everybody. We are back. I'm Tom Sosnoff here with Dylan Radigan. Mr. Radigan, how are you?
Very good, very good. Just enjoying yet another lovely day in the global financial marketplace. We had a nice discussion this morning with my man Rich McDonald in London. I've become a semi-regular with the London crew, and I had the opportunity to I don't know if did anybody send you the videotape by chance of the discussion this morning?
No, they did not.
They didn't. Well, I'll try to get that over to you. I called you the Jack Bogle of the 21st century.
I don't know if I like that.
That's what when I after I said that, I said Sosnoff's not going to be sure if he likes that I said that, and then I explained why.
Yeah.
But anyway, I was using it more through as a compliment to your evangelism, even though your religion is actually the exact opposite. But you are of an equivalent or superior evangelical characteristic. So I was that's why I was saying this is the anti-Bogle. So anyway, it was intended to be both complimentary and slightly irritating, and I think it was effective. I was hopeful you could see it.
No, I didn't get to watch it. I was doing the show with Tony this morning. We were talking to all these people about, there was a chance one guy called in and he said, I have this S&P position on, I need the or I had this NASDAQ position on. Is it possible that the Qs could get a rally up to some crazy number? Listen, anything can happen in this market. They could have a rally of 1,000 or 2,000 points in the Qs in the next, Tony said, I go in the next day or so, in next week. And Tony goes, it could happen in the next 15 minutes. And it happened 15, like an hour later.
Here we are.
Yeah. I think this is an incredibly dangerous road. We are kowtowing to the whims of a madman, plain and simple. I mean, anybody can say whatever they want about, oh, this is genius and this is that. This is none of the above. This is somebody with an IQ of 90, which is considered dull. And this is somebody with an economic IQ of 90 and an economic laziness on a scale of 1 to 10 of about an 11. And this is what happens when this is the worst possible scenario for marketplace integrity. Nothing could be worse. Nobody wants to see down 5% a day, down 5% for 3 days in a row. Nobody wants to see a crash followed by a V bottom, and nobody wants to see a bonds implode followed by, it's not healthy. It scares the children. There's nothing.
No kidding.
Good about it.
Because you're taking the largest and most stable assets on earth, $1 trillion marketplace. This isn't GameStop. This isn't Fartcoin. This is the U.S. bond market. This is the largest publicly traded enterprises on earth. And they're being thrown around right now like a bucket shop, like Stratton Oakmont is spinning pump and dump.
Yeah, no, this is pure. It's destabilization at its finest, and it's executed at its worst. And it's like this is a destruction of wealth. Like, I know what they're going to say. Well, look at this. The Dow was up 2,600 today, biggest up day ever. This is a mass destruction of wealth in the process. And because you know the rules, Dylan, if you make $1 million and you lose $1 million, you're actually down $1 million. You're not even. And this was a mass destruction of wealth. This was, people lost money. They got margin called out. They got forced to liquidate. This was the worst possible thing. And it's kind of sad. And it's all about manipulation. It's all about one person's ego. And I don't, if you have a personality disorder or you're mentally, there's something wrong with you mentally, then I'll give that person a break because that person is who that person is. And I will blame everybody else around that person who enabled that person and who supported that person. So Trump is what he is. And he didn't do anything that would surprise anybody that I know. This is what he is. He's been like this for 30, 40 years. It hasn't changed.
Sure.
He is what he is. He's this despicable character, and this is what he does. But the people that enable him, those are the people I blame. This is all about the Elon Musks, the Mark Zuckerbergs, the Jeff Bezos, the Charles Schwabs, the different firms, the interactive brokers, the Robinhoods, everybody that put up the money, the Coinbases, the Brian Armstrongs of the world, who I like, who I thought I liked. But, these are all the enablers out there that funded this. And it just drives me freaking crazy. It really does.
Do you think the Trump family is trading ahead of these announcements?
No. He's too stupid and they're too stupid. No, not a chance in hell. Plus, it's not worth it. They don't need to. The grift is on for hundreds of billions of dollars. They're not going to trade in front of this stuff. That'd be the dumbest thing ever. That's traceable. No, not a chance. The Trump family's not. Why do they need to trade?
Because you're saying they're just monetizing it all through the crypto backdoor, $500 billion at a time.
Crypto backdoor and among every other deal possible. You don't need to. They're not going to sell they're not going to buy S&Ps. No. There's no chance that they are in any way, shape, or form monetizing this through the markets. Not a chance. I don't even think they trade anything. I mean, other than their whatever stocks they own, DJT, whatever DJT is. I don't really trade it. Nobody really trades it at all. So I'm not sure where that thing trades. But I guess my point, no, they're not. Yeah, the stock.
So how do we recover? I mean, let's just set aside our various opinions, and we're going to have a lot of agreement on this thing, whatever. how do we protect, how do we, the participants in the stock market, and both of us are above average participants by virtue of influence and visibility. And there are people, there's another, let's say 10,000 people that are highly visible and have some degree of influence, from Warren Buffett through Bill Ackman through all the way down to everybody at CNBC and Bloomberg and the whole financial press, Wall Street Journal, all the tasty traders, on and on. How do we protect the integrity of the market for our, obviously Trump does not value the integrity of the American marketplace. Obviously the people around him, I would include the entire Republican Party, by the way, do not value the integrity of the U.S. marketplace. But for all of us, and it's not just for like you and me, it's for tens, hundreds of millions of Americans, and for billions of people around the world, actually, the integrity of the U.S. stock market is foundational to the health of the world. And to compromise the integrity of the U.S. financial markets is to put billions of lives in jeopardy of varying degrees of degradation.
There used to be, one of the reasons we had regulatory bodies, and one of the reasons we had agencies in Washington like the SEC and the CFTC and FINRA and things like that.
OCC.
Well, OCC is clearing, but yeah, one of the reasons we had all these things, Dylan, was in an effort to make sure that markets were not manipulated. But the first thing that this administration did was basically either fire everybody or make sure that everybody quit. And so, at this point, there are no lawyers left at the SEC. There are no lawyers left at FINRA. I mean, it's slim pickings, and there are no regulatory boundaries anymore, almost anywhere. So, you can almost get away with anything or do anything if you wanted to, and that's essentially what they're doing. Market manipulation is something that we've, it's the lack of the lack of market manipulation, I should say, is something that has protected, the integrity of everything that we do for the last, 5 decades, whatever you want to say. And it's all out the window now. Now it's just a game. Trump has gamified markets so that with a single tweet, you can move the markets. You can move a stock like Tesla $35 or a stock like Apple $20 or, it doesn't matter. Meta $50.
You can move the NASDAQ plus or minus 5%.
Yeah, the NASDAQ's right now, as we're talking, the NASDAQ's up 1,600. That's a, let's call it an 8% move, whatever you want to say. But it's crazy. Down 20% from top to bottom, up 8% on a single, uptick. They moved 1,200 points yesterday afternoon. That's not healthy, and it's not healthy for a couple different reasons. One, it becomes very difficult to raise capital because nobody really can put any, it's very difficult to put valuations around anything, and it's very difficult to get investors to buy into an IPO or any kind of a capital raise. That's number one. Number two, it destroys the valuations of private companies, and there's a huge private company market. So when we said last week that this sell-off, lost about 5 to 7 trillion in equity market cap, and probably another 5 trillion in the bond market. One of the things that we didn't take into account was the OTC market, where it probably destroyed an equal amount of money. That's the non-public, equity marketplace, and that's the over-the-counter bond marketplace. And so it's probably was more like double whatever the number was. But people don't talk about that. And I think it's reasonable. Okay, so you get a guy, whoever it might be whoever went out and talked to Trump yesterday, whoever Treasury Secretary is, and some huge donors, and they say, listen, get your crap together and call this crap off. Call it a win however you want to, but call this crap off. The thing we've been saying all week is he's going to say it's a win somehow, and he's going to call this crap off because that'll make his donors happy, and that'll save face. And that's exactly what they did. It was according to script. I wrote this script. I wrote this script last weekend. This is the script. This is the playbook. This is the most obvious, lamest, it's an embarrassment, and it doesn't help our standings on a global scale. On a global scale, we're a laughing stock, and we've been exposed.
And we're a pariah. I mean, the incentive for everybody in Europe, Asia, and the Middle East to create basically a non-USA trading region has never been higher. And they I hereby change my opinion tweets only increase the incentive to avoid the United States whenever and wherever possible, so that you can have a counterparty that is predictable.
I couldn't agree more. I mean, this is the wrong playbook, and this is a dangerous playbook. Makes me feel the most uncomfortable that I felt. And listen, and I needed a rally today of this proportion. So, I mean, I'm not talking my book like this is a bad thing. I mean, this is if we close here today, I'll have one of the best days of my career. All right, just because of this rally, because I was long. But I don't care. It doesn't mean anything to me. That's all. I don't care.
Do you think there's any solution to be had here? Like, in other words, when Liz Truss, who's the closest comparison, was the brief Prime Minister of England and was exhibiting asserting insane economic policies, she was quickly removed for insanity.
Yep.
In a parliamentary system, which America does not have, someone exhibiting this behavior would be removed immediately for obvious reasons.
Yep.
I don't see a world where this man is removed in the near term.
No. I mean, if you're talking about the 25th,
there's no such thing as no confidence vote. There's no impeachment. There's no mechanism of reducing his power.
This is America. We don't do that. There's a 25th Amendment, which allows you to remove somebody from office if they're, if they're impeached or whatever. But that's about it. There's not, it's a very difficult process. And I don't think that's even being considered. It should be considered because there's definitely, there's a mental acuity question. There's a dementia question. There's a lot of questions about, competency and ability to rationalize or anything, but I don't see it happening.
So what is your advice to all of us in terms of maintaining a level of engagement with the financial markets in the face of the fact that now the puppet master, apparently delightful, I believe Trump delights in the appearance of his extraordinary global power to jerk around the global bond and stock markets and to jerk around all the countries of the world?
Well, you read the tweet, or however you want to call it, whatever you want to call it. I mean, it couldn't have been any more clear. It was like the king was talking to his subjects.
I hereby announce.
I mean, I don't know if Dylan Ratigan uses the term hereby very often. I
have not yet used it. I mean, maybe I'm still too young. Maybe when I get older.
I might try
to do a hereby.
I might try with my wife tonight. I hereby announce that that I don't. At least he didn't. I mean, at least I was worried. I was worried for a second we were going to get My Fellow Americans. I mean, I'm not sure.
But I mean, all jokes aside, I mean, do you believe that we are in for 4 years of this? And what does the market look like? I mean, we're 3 months in.
I mean, yeah. I mean, we're a year and a half from the midterm elections. But yeah, sure. 3.5 more years. Yeah.
And if he can basically tweet every day and spin the market, I mean, I feel like there's a point where people disengage from the financial markets, I guess is my concern.
You're going
to stop playing as it were.
You're going to see it already. It's not even, it's going to happen now. Like it's not even, this is not something that
you're saying the damage is done.
Yeah, this is happening now. You're going to see there's going to be a huge trend away from there's going to be a change in the way people interact in the markets because we talked about this a little this morning. You can throw out anything you use traditionally. Like traditionally, a Dylan Radigan, you were originally hired out of college to talk about fundamentals, interview people with, different kinds of analysis and things like that. None of it matters anymore.
Meaningless.
It's meaningless. Exactly. So what are your buddies at CNBC going to do now? I mean, you're going to sit there and try to predict, when is Trump going to make his next tweet?
Because interviewing the CEO of FedEx or Joe technical analyst is useless in a world where the entire market is as held on. And do you really think, I mean, where are we with Scott Bessent, Howard Lutnick, Elon Musk? I mean, there must be someone who
you're talking about
walk into the room and be like, stop this, stop.
Howard Lutnick and Scott Bessent are two of the most tone-deaf people I've ever seen in my entire life. Elon Musk is not tone deaf. Elon is a different type of creature. He's on the spectrum. He's not afraid to call somebody out as he did, as he did this week with Peter Navarro. Yeah, I mean, he's not afraid to call somebody out. He is a different kind of creature. But the problem with Elon is, Elon didn't know who he was getting into bed with. And it looks like he's made that mistake many times in his life. That's why he has like 15 kids. but he didn't understand the implications of getting into bed with a taker, a pure narcissist who doesn't really care what you think. And in the case of Elon now, he's done a really good job at destroying a lot of his own wealth. People talk about Tesla it's 260 now, which is just on a $40 rally today, which is huge. So he's made back some money, but the SpaceX valuation got crushed. The XAI valuations got crushed. Everything got annihilated in this down move. So it was way more than just Tesla. I mean, he got lucky today that they bounced back, but this is what I expected, a huge, huge rally. I wrote about it on Sunday. I talked about it this morning. I said, we're on the precipice of a massive rally that is going to be caused because they're going to call off the tariffs and they are going to make up some phony win. And we talked about this. This was the playbook. This is a Soviet playbook. This is a Chinese playbook. This is a North Korean playbook. Like, this is the worst kind of democracy, and this is the worst kind of market manipulation we've ever experienced from a U.S. president. It's sad. And listen, I love this business. And I love what we do. And I think individual consumers should have an opportunity to build wealth through the markets. And I
feel like there's a lot of people who when the markets sell off the way that they did in the last week, there are plenty of people, says the older retired people, who sell because they don't want it. They're afraid they're going to lose their retirement.
Yeah, of course, Dylan. Yeah, absolutely.
And then the market rips back up, and then they want to buy back in, and then maybe they buy back in, but they do it at a much higher price, and they lose a bunch of money. It's super damaging.
100%. It's damaging. It's scary. It's like, this is stuff. It's almost like a good spy novel, and it's like, it's almost too perfect.
Like a James Bond, the Mad King has taken over the American. But do you think there's a possibility that this temperament migrates to the Pentagon?
It's a concern for everybody. I mean, what scares me is that, and I discussed this morning, is that the U.S. has been exposed. We are vulnerable. And we're vulnerable to the rest of the world. That's why you saw the bonds collapse last night. That's why you saw stocks down so much. And whenever you get vulnerable to the totality of everything else, you have to try to reassert dominance in some way. And I'm not exactly sure how you do that. As Russia will learn, it will take decades for them. As China has learned, it's taken decades for them. I don't think it's an easy thing to do. And I think that, we need to respect the fact that we're on the cusp of blowing that.
What's your opinion of the U.S. dollar in this mess?
I've hated the U.S. dollar now for the last year. So none of this, as far as U.S. dollar goes, is a surprise to me. I think the U.S. dollar has been grossly overbought for, whatever you want to say, 7 years, 10 years. I don't like the U.S. dollar at all. I haven't. It's not going to change my opinion on the U.S. dollar. I'm going to stay. I'm going to stay short the U.S. dollar.
Do you think the U.S. reserve status is at risk because of this situation? The dollar reserve status?
Not yet, but is it at some point? I mean, how could it not be?
Mm-hmm.
How could it not be? I mean, we have to think about things like that. And I got to say, at some point it could be, if the whole rest of the world says F you.
Do you think this is a huge opportunity for London or even Frankfurt or Milan or Hong Kong to try to step up into the void of confidence in American capital markets?
What's weird is I'm not so sure that any of those places are capable of it. Is it an opportunity? Yeah, sure. It's an opportunity. I don't think they have the skill set or the market structure.
The only one. What about London? Of all,
not a chance. I have been.
It's still English language. Big community. No,
not a chance. We have been listed on the London Stock Exchange now for the last 4 years. It is, in my opinion,
it's a ghost town.
It's a ghost town. It's not capable of anything. It can't even be competitive. If you're going to talk about competitive marketplaces, I'm not even sure there is one yet. I think that there's an opportunity now more than ever for a competitor, for a disruptor to step in. I don't think that exchange exists yet. And I think that's what decentralization is all about. And I blame, the New York Stock Exchange is just as responsible for this as an enabler to Trump's psychosis as Bezos is or as Zuckerberg is. I mean, the New York.
How are they enablers?
Because they're supporters. They're fundraisers, that this is what they wanted. They got what they wanted. Same thing with the Chicago Mercantile Exchange. Same thing with different exchanges all over, that basically, this is the person they wanted to essentially lead the regulatory bodies.
Volatility's got to come in the short term.
Volatility
having days. We can't keep having days like this.
Volatility today has the potential to have the largest down day in volatility in that I can remember. I mean, right now the VIX futures are down $11 as we're talking. And when you think about VIX futures down $11 on, let's call it, 25% right now, but it's going to even be more than that. I'm not sure where we're going to end up today, but it's going to be one of the largest down days in history in volatility. It's going to come in massive numbers today.
Is there a world where this becomes predictable, sort of like the old oil trade from last year, where when there's saber rattling between Iran and Israel and oil rallies, it was a good short? This was not a call. He didn't call off the tariffs, obviously. He announced a 90-day pause on the countries that were nice to him or whatever he said.
Yeah, I mean, the crazy thing about this.
My point is, are we going to have another? It's going to either be predictable. We're going to get another big sell-off at some point in the next few months. When that happens, you should buy him because he's going to kick these. This is going to become a predictable routine.
Well, the crazy thing about all this
force.
Yeah, I mean, it's nuts. But the crazy thing about all this is it's kind of exactly that. What's going to stop? That's why I said we're going to. When I first got in this business, 1981, I think it was 1980. Let's say 81. I don't remember exactly. And there was a group of guys that I worked with, and I didn't know them. I just met them when I got onto Wall Street, and they would sit around, and they were a bunch of technicians, and they would sit around and they would try to guess when Joseph Granville would write his next newsletter, basically either going the Black Monday route or the, close your eyes and buy them route. Okay. And their whole business was like 4 guys, and their whole business was trying to predict Joseph Granville's next newsletter. Like, that's the business they built. And they had like a cult-like following that would follow these guys to try to predict Joseph Granville's next Monday newsletter. I don't know if you remember it, but it was always like, what should a new subscriber do? And I kind of equate what we're seeing right now to that same kind of thing. That is going to be the future of CNBC, of Bloomberg. It's not going to be, hey, we're interviewing
CEO this, earnings that, rates this.
Do I really need to talk to the economist at to the lead economist at JP Morgan anymore? Who the hell cares? I mean, I love our mechanics at Tasty because that is, that'll never go away. But what's the point of talking to the lead economist? What's the point of talking to a Fed governor? Only person you need to talk to is Trump. When are you going to do your next thing?
And I don't know. And what we know, but I'm just saying purely from a trading standpoint, setting aside all the obvious issues, we know he's always going to have a next thing. We know his next thing's always going to be some sort of threat of economic catastrophe. And we know his next thing is going to be some sort of a reprieve.
Yeah. Like, I can guarantee you with what happened today, when it all boils down to it, they'll figure out that it's just another one of his, just complete scams or whatever. That's all it'll come down to. But when it all boils down, they'll figure out, oh, you know what? There's really nothing here. Like, the 75 countries probably didn't have any tariffs to start with. There was no trade.
Of course.
It's going to be the most ridiculous thing. It's going to be like the reciprocal tariffs that he introduced last time, when it turned out that was all just made up AI bullshit. All of it, from the formula to the countries. And this is going to be the same thing. We're letting 75 countries. Oh, really? Okay, let's see how that plays out.
And so from a trading perspective, can I get short the rallies on Trump tariff relief and long the dips. Is he so psychotically predictable?
Yeah.
That you can short this rally soon and wait for it to roll over once again?
I think so. The answer is I think so. I don't know. I think so. But I'm not selling them today. That's for sure.
No, I'm not saying. I know, I get it, but I'm just saying that there's because obviously, if this is a rational actor who wanted to confront China on their trade practices, that would be a specific bilateral engagement. You wouldn't declare global economic world war like a 2-year-old, and then do I hereby retract my threats from the people that were nice to me, which includes the Penguin Island.
Of course,
but I mean, the entire behavior is to call it unprofessional is an insult to people who behave unprofessionally.
Yeah, and the other thing about it is probably done from a golf cart in Florida,
in Boca.
Yeah, whatever. Yeah, I mean that's the joke of this whole thing. It's probably is looking at his distance to the hole and deciding, all right, just wave this, do this, let's do this, whatever.
Hey, Dan, write this tweet for me.
Yeah.
Let me see it. Let me read it. Okay, send it.
Yeah. It's a very interesting. It's an interesting world.
Do you think of let me just to try to step away from the stupidity of this? Does this guarantee a recession? Should we be invested? You be in trading around it, regardless of whatever ups and downs at this point. The fact that the world knows that the American economic leadership is juvenile and clownish and unpredictable massively increases the probability of a global recession. Regardless, at this point, is that a tradable fact?
No, it's not tradable, and I don't think about things in those terms because recessions are something that we figure out, later in the next life. That we had a recession in the last life, and recessions by definition aren't tradable. These are much more tradable. What we're seeing happen right now is, in my opinion, more interesting because it is more tradable. Anyway,
I mean, is there an evident trade to you at this exact moment?
No, not at all. I mean, I have been buying stuff for the last couple of days nonstop. So, I mean, I'm like I said, this is a great move for me today. I'm not complaining one bit about the move itself, but I think that I care deeply that, I live a different life than Trump and all his whatever. I care about the hundreds of thousands of customers we have that had to take a lot of pain during that sell-off, and like every investor at every firm. So I don't care if you were at Tasty or TD or E-Trade or Schwab, Fidelity, Interactive Brokers, whatever company you were at, Merrill Lynch, Morgan Stanley, every individual investor in America got beat up bad on that down move. And if you didn't take any action at all, which is a miracle if you didn't do anything at all, I would say most people did something. Because we had sellers. Most people lightened up. Most people sold something against their position. Most people hedged their stuff. Most people did a lot of different things. All of that served to lock in losses. But people had every right to be scared. They had every right not to trust the judgment of somebody that obviously has no idea what they're doing. And then just to reverse it, which doesn't surprise me at all, it's like you don't get that money back. You get a portion of it back if you're lucky. That's it. You don't get it back.
It made everybody poorer, especially made the small and mid-sized investor poorer by a lot.
Tony and I were buying stock yesterday afternoon because we thought we were both buying stock yesterday afternoon, a couple of different stocks, Apple, Reddit, NVIDIA, and we were sitting there looking at each other going, are we the stupidest investor? Like, are we the dumbest humans? Because last night, the S&Ps were down another 2%, and these stocks were.
It was a 5% day, and then the bond market. I mean, it's horrible.
And the bond market, everything else, and we're sitting there going to each other, how dumb are we? Like, how could we be the only people buying here? Nobody's buying. Like, why are we buying anything? And then so, but we didn't buy that much. We just bought enough to because we felt like it was oversold. We had to. And then they were down more this morning, so we bought a little more this morning, and it was like, but the average consumer does not do that. That's not in their blood. I'm just a sick trader who's been doing this for 40 freaking years, and so I don't care. Like, that's just the way I think. I'm going to do the opposite of everybody else is going to do. But nobody else thinks like that, and I'm glad they don't. And I just think that people got beat up. I know people got beat up, and so this does not make it even. You go down 100, you go up 100. You're not even. Does not work like that. And so,
is there safety or opportunity in moving money out of America via even using ETFs into your EZU in Europe, the EWW in Mexico, whatever the UK, nothing.
No, there's not enough stuff. The rest of the world is lame. The one thing about America is that we have amazing liquidity, great products, great markets. They don't have these anywhere else in the world. You struggle to find things, you struggle to find ways to trade. You struggle to find ways to participate, whether it's India, UK, China, South Korea, Russia, it doesn't matter. You struggle to find ways to build wealth outside of whatever it is that you do yourself. It's next to impossible. America is the marketplace of opportunity. Everybody comes here. Everybody trades here. Everybody invests here. Everybody raises capital here. To mess with the integrity of that system is anti-American. It's anti-democracy. Okay? It's not what we're about. And does not support the consumer. But again, I'm not even blaming Trump, because although he drives me crazy and I can't stand him, he's not even at fault here. It's almost because he hasn't changed his stripes. It's all the idiots that enabled him that drive me crazy. It's the people that are supposed to be smart enough. It's the Bill Ackmans of the world. It's the CEO of Blackstone, it's the BlackRocks and Blackstones and the Charles Schwabs of the world. Those are the people that drive me crazy, because those are the people that, you get what you paid for it. Now here you go.
And we all expect more from them ultimately in terms.
Of course.
Even if you have a different point of view on morals or values,
of course,
we expect more from them on just basic integrity of the American financial system.
All they thought they were getting was a reduction in capital gains tax and potentially, lower income tax brackets. So they thought, hey, you know what? How do we lose here? Well, you lose 40% of your market value. There you lose.
Mm-hmm. And you have a permanent impairment on the integrity of the U.S. market, or at least an impairment that will last for the next 4 years.
And what's your legacy now? Elon, what's your legacy? Half the world thinks you're the biggest jerk ever. What about you, Zuckerberg? Half the world thinks you're the biggest jerk ever. Same with you, Bezos. You could have gone on top. Now everybody thinks your ex-wife is you're a piece of crap.
Right. Right. And then they have all these small fry like David Sachs and Chamath Palihapitiya.
Of course, those guys are absolute pieces of shit. I cannot stand them. Their hypocrisy, their total nonstop bullshit that they
and the arrogance
drives me out of my mind. I totally agree. Every one of those things, I freaking hate them.
Are you kidding me? They wouldn't
do one thing to help one person. Tony and I spent 3 hours this morning just answering questions from people calling in from anywhere. You didn't have to be our customer. No, we'll just answer your question. Hey, you want to know what to do with this position, or hey, you know what? You're nervous. I understand it. The market's crashing. You're nervous. Here, we'll give you some peace of mind. Those guys, they wouldn't help their mother.
It's true. I was talking to Vecchio and Spivak the other day maybe yesterday, about how at least back in the old days, the rich guys were more charismatic, if nothing else. That the old kingpins from Los Angeles or Texas, T. Boone Pickens or New York or Chicago were vastly more appealing. Like this generation of oligarchs from San Francisco is just despicable and disgusting group of men. I mean, every last one of them is just the worst.
You know what's funny? We used to get all over the case of these really rich athletes because they were kind of like, jerks and stuff. These guys look like gods to me as compared to these billionaires. These athletes that make, $100 million a year or whatever, $50 million a year, they're so nice.
Yeah.
They're in a different world. They understand, hey, it's we're nothing without you guys. But these other guys, they don't understand that. You think Zuckerberg understands that? Think Bezos does? Musk doesn't, for sure doesn't. No clue.
For sure doesn't.
And they don't understand. You're nothing with all of us.
Nothing.
Without us. I'm sorry.
Yeah. No, it's remarkable. So what are your 2 cents from a trade? Is there anything to be done here? On the back end of the super rally? Of the momentary rally, or is it?
I'm trying extra hard to roll up puts right now to stay delta neutral to a little bit long. Hopefully I think this got more legs than this, I would hope. But I don't think it's going there's a lot of internal damage in the market. I think that we have to realize that. But I think today's rally, I would think it's too strong to sell off, but who knows? I said that yesterday.
It could be amazing. This thing could come back. We have another. I could be talking to Ilya and Chris in an hour, and we could be down 5% when it turns out that the 75 countries exclude all of Europe, they exclude 90% of the trading volume. It's absurd.
It's not beyond Trump and his merry band of grifters to have the 75 lowest participants in there that make up 5 or 10% of all the tariff wars, and it is probably well within their brainless formulas. So let's leave it there. Dylan, thank you so much for letting me rant today. I'm Tom Sosnoff. He's Dylan Radigan. This is Truth or Skepticism. Don't write to me.
The beauty of Thinkorswim was that we were different. From the name to the front end technology was clearly what we wanted as traders. Second time around, I think we did a better job. Yes, we are known for our ability to support complex derivatives traders, but we also have the tools for somebody who's brand new who wants to come in on the first floor and work their way up to the top of the building.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it. We get it.
The amount of time I spend interacting with our customers via email or anything else is pretty much my entire life.
To be so powerful and so valuable, and then to be that approachable, just amazing.
Where else are you going to be able to email a CEO, get response back? But you know what? Before he even knew who I was just some idiot trying to learn how to trade. And he still would email and help me learn and everything like that.
Some people say it's nuts, some people say it's insane. That's what I do.
Got trader's block? We've got the cure. Get data-driven trade ideas with Cherry Picks, our weekly newsletter that gives you insights into the market. Sign up at tastylive.com/newsletters.
What is going on, everybody, and welcome back to today's assignment. Another extremely volatile day in the market, as you can see just by off of Dr. Jim's reaction here. Before we get into all that, Dr. Jim, we made it. We're on the other side of it so far. How are we doing?
Man, I mean, just a quiet little, 1,800 points in the NASDAQ just to kind of tide things over, just to get you by to the next day. Man, yeah. What a day, man. Like the last 96 hours or 72 hours, like it still is amazing to me. Obviously, the market move today is pretty incredible, but it's amazing to me that, dude, it's only midway through the week. Like we still have the close today, and then all day tomorrow, and all day on Friday. Like I can't take it, man. Like I can't take it, and it's been crazy.
No, this definitely feels like a longer week. It feels like we've been through so many things already, and like you kind of just said, I mean, we're in the third day of the week. We still got the rest of this close. We still have Thursday. We still have Friday. We have PPI. We still have some binary news events to go through. So I know we're going to break down the market a little bit so far, but I mean, Monday I was talking about how I've never experienced a market like this before. Keep in mind, I was in the market briefly during 2020 as well. And Monday I was saying that. And now today on Wednesday, I mean, I see an absolute face ripper to the upside that I've never seen before today. So I don't know what your reaction was to all of that, but I know we had the 90-day pause on some of the tariffs, except for China, if I'm not mistaken. And then also just the tariff wars going back and forth. I want to get your thoughts on that. Just a quick update, Dr. Jim. How we doing? Is it overwhelming? Thoughts on the news before we get into today's segment?
Well, 2020 was 2020 was crazy from a pandemic standpoint, of course. But 2020, from my vantage point, just personally, I wasn't actively trading 2020 only because my youngest daughter, Amelia, was born on March 9th, 2020. Okay. And so she was, we left the hospital. Yeah, we left the hospital on March 11th, 2020. So like while the market was like, limit up, limit down, VIX got up to 80, like super crazy stuff. I was actually with a newborn child at home. Like I was off of Tasty. Like obviously with the pandemic, we had all gone remote anyway, but I was out of commission for a couple of weeks. So I was just watching like end of day type of things. I wasn't in it like I'm in it now. And so it's, the thing about the pandemic, though, the VIX got to a higher level. It only got to almost 60, I guess, or maybe it hit 60 in the last couple of days. I'm not sure. But the thing that was different about the pandemic was it was so back and forth. Like, yes, there may have been a day or two that were worse than any of the singular days that we've had the last 3 or 4 days. But, I mean, you're talking about Thursday, Friday, and then Monday, and then Tuesday, and coming into today, the kind of cumulative nature of the sell-off this time, I think, was more severe. Yeah. Because it really, yesterday was the craziest because it looked like, all right, we're back, it's over. Like we're getting through to the other side, and then they just reversed it completely and sent it way lower. And so that was pretty crazy stuff. And now obviously it's even crazier.
Yeah. No, I didn't recognize you had a COVID baby. I didn't recognize Dr. Jim had baby in left hand mouse in the other. I didn't know that's what was happening. But you traded through 2008 as well, right? What is the difference in terms of reaction, or even just being aware of what's happening in the market when something like this, when things hit the fan? Like, what is your natural reaction in terms of managing positions, putting positions on? Are you looking for opportunity? How do you take that in?
Yeah, so I mean, and I think we talked about this last week, but I'll bring it up again today because it's so important, right?
Right.
Like, you never really have a good feel for your position size until something like this happens. Now, it doesn't have to be to this degree, but I mean, if you go through something like this, and now we're seeing it on the upside, like now you are legitimately seeing a melt up market, probably for one of the first times in your career. Now, I know you traded through COVID, and I know you had some limit up days there too, but this is like, I mean, you're talking 10% on the NASDAQ. I think this is like the greatest, obviously notional value increase in the history of the markets, right? And so normally it happens on the downside, but it can happen on the upside too. And of course, I mean, everybody kind of knew the last couple of days that it's like, all right, we're sitting on a stick of dynamite right now. Like, if we get any type of, a pause, a headline that's like legitimate, whatever. I mean, something like this, everybody was kind of expecting this to happen, but we didn't know if it was going to come because, I mean, Trump just kept doubling down, tripling down, whatever, and he kept sending it even lower and lower and lower. And so, you get your position size gets exposed. That's just the best way I can put it. Your position sizing gets exposed. Your capper allocation rules and protocols, it's all out in the open. There's nowhere to hide. And then you get to see, all right, was I really small?
Right.
Like, was I really, really small? Yeah. Now, again, should you trade for 10% collapses and 15% collapses and things like that? I don't think so because they're so infrequent.
Yeah.
You can't, because then you would just never leave your house. Like, then you would just never get off the couch, right? But still, this is why the position sizing parameters that we have in place are in place. 1 to 3% defined risk, 3 to 7% undefined risk, 25 to 50% on the extreme up end for overall capital allocation. That's going to allow you to navigate most markets that come your way.
No, most definitely. And I know you've always been a proponent of position sizing. We've talked about this so much on this show, but I think especially this market environment, kind of just like you just mentioned, and we can go ahead and jump into this platform at the same time. But like you kind of just mentioned, it'll expose you. It'll expose you a little bit, especially if you're trading directionally. Like, are you managing your risk? Are you sizing correctly? One thing that I've noticed trading directionally is that the outcome, you realize the outcome a lot quicker than you would have in a time like last week or a month ago or 2 months ago because of how volatile the market is. You're going to get to your profit target or your stop loss a lot quicker this week than you typically would have. So it's really important. And I know you never want to be in a position either where you're sized in too large and then you're kind of freezing because of the reaction of the market, and then you're put in a tough position. But today, Dr. Jim, we're going to be building our own today's assignment watch list. But before we do go into that, I just want to get your thoughts on the overall market and just some of these positions that we have on right now. Some of them are expiring soon, but we're doing the best that we can. So over here, Dr. Jim, QQQ, that position is cooked. 8 days left till expiration. We had an absolute face ripper to the upside. And I mean, we're still sitting out of the money, or we're still sitting in the money on some of these puts that we sold on there. Pretty much same story on Meta. Meta got hit very hard over the last couple weeks if you had any type of long delta on. So even with this face ripper of a move, we're still, some of those strikes are still sitting in the money. So maybe we get another limit up the next couple of days and we can take this off for break even or a little bit of a profit. But until that happens, we have no choice but to just sit on these two, at least because they expire in about 8 days. This is one I've been fighting with, Dr. Jim, and I want your thoughts on this one. We're sitting at around break even on this one. It's a strangle, sold the 43 puts, sold the 57 calls, wanted to get some undefined risk exposure on in IBIT. The market's been so volatile. It was down on me near max loss earlier, and now I'm sitting at about break even. What do you do when you're in a position like this? If you still agree with the overall sentiment of your positions, will you leave it on? Or if you get a get out of jail free card like I got today on IBIT, are you going to just redeploy that capital elsewhere? But that's really the only position on right now where I'm kind of going back and forth. I was able to take advantage of NASDAQ a little bit today.
Bro, talk to me, Goose. I'm seeing what everybody else is seeing. Talk to me, Goose.
I gotta let you know.
Dude, come on, dude. Like,
okay, so
no more secrets, bro. No more secrets. I need a step by step, dude. I need the step by step. I need the whole deal, because you're taking out thousands out of the micros. The micros, dude. Come on.
No,
now.
I mean,
come on now. Don't leave us out there.
I don't know who put a bid in the market, but I was able to take advantage of that today. It's been crazy. The last couple of days, I mean, like we talked about so much, size down, size down, size now. I've only been using one contract, and I know the last couple of days I was able to snag some points here, snag some points there. Called it a day, and I was like, I'll wait for the next day, snag some points here and there. That kind of happened this morning as well. And then for my other position, I was like, what? I'll risk about $50 to $100. We'll get in this long position. I'm getting some other work done. I'm swiping through tabs. I switch back to the Tasty platform, and we have an absolute face ripper to the upside in less than like 10 minutes. And I'm like, what is going on here? So, I mean, I was looking to manage the position, and then it ran a lot more to the upside than I thought it was going to run, just off of one contract in a very short amount of time. I mean, I couldn't have seen this coming, Dr. Jim, but we were able to take advantage of that a little bit. So hopefully that'll provide a cushion for the rest of this week and into next week, depending on how I size some of these positions. But we were able to capitalize on the massive move after you putting in the bid in the market for us, Dr. Jim. So we do appreciate that.
Yeah, that was me. No, that was 100% me. So that was a long trade, and it was part of the face ripper. Was it a situation where, like, it happened so quickly, like you didn't even have a chance to put your take profit in? So it ran like way beyond what you even were looking for?
Well, so, okay, the take profit, it did run further than I would have expected. So if I was actively watching it, I probably would have gotten out a little bit sooner, and I probably would have had maybe 30% less of what I realized on the position, because it did run further after what the profit target was set initially. But real quick, so we can get a good idea. This was what was this? This was about 109. So again,
man,
you can just see
look at you. No, go back. Dude, look at you, still using market orders in a market like this one. Dude, that is a power move, dude. No,
I will admit,
you think what Trump is doing is crazy, bro? What you're doing is crazy.
There's only about 4 market orders. And I believe the market orders were all exits. So none of the entries were limit orders, because at the beginning of this week too, and I saw Nikki Bat's tweet talking about make sure we're looking at market. No, absolutely. Because one of the positions that I was looking to get filled, I mean, the market was skipping around. I mean, you'll catch some slippage on a market like this. So I believe the only time I was really using market orders was when I was exiting the market, like on demand immediately, because the market was too volatile. I wanted to get out at any price available right there at that moment. But the rest of them, all the entries, I believe, were all limit orders. Because again, you can get slipped 20 to 50. No kidding. You can get slipped 20 to 50 points easily without even realizing.
Easy.
Yeah.
Man, look at that. 109. You get in at 17,579.
Right. There we go. 109. It was what, 20 minutes?
Yes. Yeah, 19 minutes later, you get out at 18,612, and that was still 400 points off the top.
Exactly.
Which or 500 points off the top.
What is going on right now?
That's insane.
Right.
It's crazy, man.
But again, like if you were to be short in this position, if you're not managing your risk, right? And if you were short, just imagine how much the market can rip against you if you have no risk management in place. You know what I'm saying? So this market environment really is nothing to play with. The opportunity in terms of volatility is awesome. It's exciting. It's not something that we get every year, but at the same time, it's always like remembering, we do have the risk portion that we have to be paying attention to, because it can work against you just as quickly as we've seen the market work in my favor in just about 10 minutes, So I don't know if you got any thoughts on that, Dr. Jim. That was the last position for today, but I'm just glad that's going to be able to at least hedge the Meta, Microsoft, and whatever the outcome of this IBIT position is going to be. But that's what we are looking at today, just really trying to manage these extremely volatile conditions and
the only
sizing
thing,
down.
Yeah. The only thing I'll say is that most of the time, it's nearly impossible to know where the extreme risk is in the market, other than the fact that most of the time, the big moves, like similar to what's happening today, happen on the downside. The exception to that, and again, this is, I think everybody kind of knew that this was a strong possibility. The exception to that is going to be when you've already had a pretty big drop, You already have, VIX in the high 50s, volatility futures in the 40s. You already have like lots of things that are weighing on the market, just weighing on the market. And not only that, but it's a very specific catalyst. Like this time it was, everybody's saying stocks are overvalued. They were this, they were that, whatever. But clearly, the tariffs and the macro situation with what was going on there was the driving force. Now, is it also, PEs needed to come down? Okay, I think it was. I do think it was. But the point I'm trying to make is this. When you're in a market where there appears to be a fairly clear asymmetry with the risk profile, where in terms of a huge melt up or a huge meltdown, that's when you've got to be really, really careful being on the other side of that market. And so, playing the market from the long side, it's not without risk. Nobody knew that today was going to happen, of course.
Right.
But, you could still get beat up pretty badly. But probably, after the down move, probably not something that's going to totally put you out of business. Not after everything that's happened if you've been able to survive the last 3, 4, 5 days. But if you were caught short trying to pick up, a couple more percent on the downside, in the face of something like this, that's very, very dangerous. Very, very dangerous. So now what does that mean now? See, to me, now I feel like the deck just got reshuffled. So now I feel like, okay, both sides of the market are back open for business now, because who knows what happens now? How does China respond? How do the other countries respond? What happens in 90 days with the pauses? We've got obviously the most important CPI of our lifetimes tomorrow morning. So it's like, man, it's like now I feel like both sides of the market are back open for business.
Yeah, no, I hear you. And you mentioned the volatility index just a second ago. And Dr. Jim, I could almost kick myself for not getting on some more long delta or selling some more premium when we're sitting at 50. It's one of those situations where, like, for example, if you're a long-term investor, right, dollar cost averaging might not be the worst idea whenever we're selling off like this and there's so much uncertainty. But it's like now, as a premium seller, I could almost kick myself for not selling more premium when we're sitting at 50. Obviously, in hindsight, based off of what we've seen over the last hour or two in the market, in hindsight, now you're like, wow, I should have definitely sold some more out of the money, put spreads, for example, especially with the face ripper now and then volatility coming in like nobody's business. It's almost like I could kick myself, but it was just one of those positions to where I was like, man, volatility is so extreme right now. I'm having a hard time putting on more risk at these levels. And that's kind of what happened, why I don't have more premium positions on. But it was just one of those situations of 50 VIX. It was just very crazy for me. And, in hindsight, even just an hour later in hindsight, it's like, man, I should have, would have, could have. But anyways, today's segment's going to be about, building that watch list. But that was pretty much where I was at pretty much the whole week. Monday, Tuesday, volatility is at levels that I was praying for over the last year. And I didn't take as much action that I wish I would have, Dr. Jim. So that's where kind of my psychology is sitting at the moment.
Well, let's build the watch list. But the only thing I'll say is, see, now the VIX is getting down to kind of that sweet spot that we talked about, where 20 to 30 is a great level for premium sellers and high volatility. 50, 55, 60, that's really, really difficult to manage for a lot of people. So you're not alone.
Yeah. No, 100%. But it is just so crazy. I know we've seen an insane face ripper to the upside, but to see how quick volatility can really come in, it's really no joke. But today's assignment, that's the watch list we're going to be building for today. You don't have any stocks on a no watch list, do you? I know I was talking with Gus. I know, some people have a no trade list. You got any of those in your back pocket, Dr.
Not necessarily, other than the fact that I don't typically do anything with anything under $10 because there's just not much to do. Yeah,
you don't want to buy the whole float. You don't want to buy the whole market cap.
No, I don't. Yeah, I don't want to own the whole float. Not necessarily. So it's like because under $10, usually the premiums are super super low. So then you're buying stock or you're selling stock. That's really all you can do. It just really limits what you can do strategically. And so like Snapchat, like Rivian, like things like that. I've messed around with them a little bit, but it's not usually my go-to. So any stock that's under $10 is probably, it's automatically going to be kind of not really something I'm interested in.
You don't discriminate based off of a specific underlying. You just have a specific set of criteria: price, liquidity, volume, all of those kind of things. That's really what it is for you.
That's right. Yep.
I got you. I was looking at.
What about you? You got anything?
No, Oil, actually. I think oil would be the only one. Again, about 2 or 3 years ago, got burned by oil. This was when oil was going near negative. That was not 2 or 3 years ago. That's how you know time flies. That was like 5 years ago now. But I remember oil went negative. I got burned on oil, and I literally barely touched oil since. So I'm still open to trading oil. I'll trade USO most of the time whenever I'm getting some exposure to the oil market. But other than that, I'll trade pretty much anything.
Okay.
But the first one I want to add is Tesla. I was looking at Tesla, wanted to put a position on in Tesla. Again, Gus and I, every Tuesday and Thursday, we have the show Risk Reward. And every Tuesday, beginning of the week, we'll put on a new underlying to put some risk on. And I wanted to choose Tesla yesterday, but we had Tesla earnings coming up soon. You know, again, in hindsight, that long would have worked coming into today. But the first one I want to get on in there, though, it's Tesla. I just think Tesla is going to always have a lot of volatility. I think there's a lot of uncertainty around Tesla, and I think volatility is a trader's best friend, whether you're trading volatility itself or you're trading directionally. Volatility is a trader's best friend. So when I think of volatility, I think of Tesla, regardless of how we feel about Tesla. And then just with Elon getting into different networks and social circles and getting himself in places that I never would have thought I would see him, I think it's going to create even more volatility for Tesla, which I see opportunity. So the first one I want to go with is Tesla. Whoops, let me see if I can.
Well, I think you're right on the money when it comes to the fact that, I mean, with Tesla, there's pretty much always something to do. Like there's always something to do. Like even when like the IVR or the implied volatility is lower with Tesla, it's still going to move a ton. Like it's
absolutely.
still going to be a main player. So there's so many things you can do.
100%. I hear Trump's talking right now. Not sure if that's true or not, but we'll keep an eye on with the overall market to see if we swing back another 1,000 points to either direction.
Man, I'll tell you what. If the Nasdaq gives up like half of this rally, that's going to be crazy, man. Like that's going to be super crazy.
100%. I'm gonna throw in an oil name, right? We're gonna throw USO in there because again, I don't discriminate, but oil was one that left a bad taste in my mouth about 4 or 5 years ago. But I'm still get an oil product in there. If anything pops up top of mind, let me know, Dr. Jim, because I'm gonna pull
Starbucks is one of my favorites to trade, just from a personal standpoint.
Okay, Dr. Jim getting his Starbucks in every morning. We know.
Yeah, I'm getting something in. And it's I mean, Starbucks is a great stock to trade just because it's fairly stable. I mean, obviously it hasn't been the last couple of weeks, but nothing has been. But it's it usually has decent premiums, and I mean, everybody understands Starbucks.
Right.
Like everybody understands Starbucks. Like they understand
what do you mean by that?
Business model. I just mean like everybody understands what they're trying to accomplish.
Great point.
And so like we're all about product indifference. We're all about it doesn't matter. We're all about just getting there and slaying them. Like I understand that. But for a lot of traders out there, there's a lot of comfort in kind of understanding like what the underlying stock actually does or doesn't do.
Yeah, no, great point. I mean, 90% of the underlyings I've traded.
Yeah, exactly.
I don't even know.
Yeah, exactly.
Yeah,
and I think that's fine. I think that's totally fine.
Yeah.
But I think for new traders especially that are brand new to like the world of options, it can be kind of nice to have a sense of familiarity when you get in with a Starbucks, you get in with an Apple, you get in with like a McDonald's. You're like, okay, like I understand this company, and maybe you have strong feelings about this company. You know, whether they be positive or negative. You can definitely build an option strategy around however you might feel about a company. And so I think Starbucks is kind of, everybody understands it.
Yeah, and like you kind of just said, you can build an option strategy out of pretty much any company. Any company we're pulling up right now looks the same too, Doc. I mean, at this moment, everything is looking the same. I know correlations all move into one when things hit the fan, but just looking at where a lot of these underlyings have been, it all looks like it's telling the same story over the last couple of weeks. So we got Starbucks in there. I was just keeping an eye on the market as well, just in case. I got an eye on that.
Yeah, it's up a little bit. It's up. I mean, the Nasdaq's up about 100 points.
All right, let me know. Let me know if I'm missing anything. But I think we're also going to add in. Oh, and like I was saying, we're going to use this watch list, and I'm going to pull from this, and then I'm going to put on a lot of the positions that I have on in the portfolio from this watch list too. So
nice. Okay.
I'm going to go ahead and throw in Meta. Just because we got to, I'm going to go ahead and throw in Apple. Those are just some of the blue chips that I always end up trading anyways. QQQ, Old Faithful.
You got to put NVIDIA in there. You got to do it.
Oh, NVIDIA. I haven't heard that name since 2024. I have not heard that name since 2024. That was NVIDIA's old news, Dr. Jim. It feels like NVIDIA was the talk of the town for months. It's like,
I mean, it's up 15
the past
today.
now. Yeah. NVIDIA, we can also throw in some SMCI, a little bit more of that
man, they're
industry
still in
will get in
business?
there.
No, there's no way.
Supposedly.
Yeah, they're
I think
barely hanging on, though. They're barely hanging on.
I mean, it
I'd be
hasn't seen
curious
as much
to know-
volatility.
I'd be very curious to know what stocks are red today. Are there any stocks that are red today?
Let's double check that real quick.
I'd be curious. I'd be curious to see, like, is there anything that's red today? I don't know if there's a quick way to check that.
The volatility index.
Those are all, but that makes sense. No, that makes sense. I mean, the bond index.
Okay, let me go ahead and whoops. Let me go. Okay. I mean a handful.
Oh,
Again,
look
I
at
know
that.
this morning
Look
most
at T.
underlines
AT&T. Look at that. AT&T is unchanged today.
resilient.
Wow. That's crazy. I can't believe
J&J
that.
is down 1%. I hear J&J.
J&J. Oh, that makes sense because Trump came out talking about the pharmaceutical tariffs. I think it was last night.
Okay.
But AT&T, look at that. Wow. Okay.
Yeah, I think it really is a tale of two stories, especially today, because if I'm not mistaken, again, I believe most underlines were underwater this morning.
Oh, certainly. Definitely.
Right.
Yeah.
Right. So we really can't be calling the game from the first quarter, especially not in this market environment.
That's fair.
Yeah. Especially with the last hour. I don't know, but let me find today's assignment. There we go. We'll get a couple. Let's get one more in there. We could go some Tesla. We got in there. Apple, Meta, SMCI. You know what? I'm gonna go with some U.S. Steel. U.S. Steel was Old Faithful.
Okay.
That was a cheaper underlying, right? I don't put on too many undefined risk positions, but that is a cheaper one where I'll predominantly go only undefined. So we got a good start on the watch list. We'll add to it as we go. And then, by the time we hop on here next week again, I'll have some of these positions on. I know it's earnings season coming up too, so look out for that. That made me pause on some of the positions I wanted to put on. But we are coming to a close here, Dr. Jim. Anything else we want to add before we hop on out of here? Always look forward to hopping on here with you.
Oh, of course, man. No, it's great. I can't believe it. It's a historic day. This is a historic day from a market reaction standpoint. It's crazy, man. It's crazy stuff.
Crazy stuff. We'll see how the market closes. We got about 45 minutes until the market closes. Will we close green? Will we close red? We'll see.
Oh man, no, don't even say that. There's no way.
But no, thanks for taking the time to hang out with us today. Make sure we're managing our positions, sizing down. I know that's going to be on top of mind for myself at least. But Dr. Jim, we always appreciate having you here, and we'll catch you guys next time. Peace.
Peace.
Called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're #1 for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
So you're an active trader, looking to increase your return, decrease your risk, or quite possibly both. Sure, you've heard of the Greeks. Your deltas, your thetas, your vegas, your charms, your vamas, etc. And you're wondering, hey, how do I use these guys to improve my risk-return relationship? Well, join me for a 10-episode crash course, and I'll show you exactly how to do it with all the gimmies and gotchas, one Greek at a time. We'll see you there.
Got the need for speed? No problem! At Tasty Trade, you can turn smart ideas into real trades with just a few clicks. Wow, that's fast. Tasty Trade, make your move.
Hey, what a day, huh? Time for some gratitude to the trading gods or Donald J. Trump or sweet baby Jesus, anybody. Here's my thank you. Thank you that this announcement of Trump folding, of him wilting, of him being as weak a man as I always knew, came during market hours instead of in the middle of the night. Thank God. Let me explain why. I ended the day yesterday incredibly short, like insanely short. I did not sleep well because I was worried about something happening during the night. If the announcement came before the open that, we're going to suspend the tariffs for 90 days, which he did, that would have been very bad for me. Instead, what happened is we opened red, and I looked at the charts and the intraday charts, and I wrote about this and said, I think the bad news ain't working anymore because things are not down as much as they should be. I think it's time to lighten up. So I did kind of 3 phases today. Phase 1, lightened way up on shorts. In phase 2, and if you follow me on Twitter, you saw this. If you don't, you should. Slope of Hope, at Slope of Hope. A couple of 3 hours in the trading day, I said buy XOP and buy EFA. And about 20 to 30 minutes later, Trump wilted and gave up on all the tariffs he's been going on and on about for the past week. And the markets absolutely exploded higher. I mean, thousands of points on the Dow, hundreds on the ES, thousands on the NQ. And so those were instantly like giant profits. So phase 1 took profits on shorts. Phase 2 got profits on longs, and I dumped them. Maybe it'll soon, I don't know. But it was kind of instant money. And phase 3, which I've been doing frantically over the past few minutes, is getting short again. Now, let me be clear. I'm not going bananas shorting. It's selective, no options, just good old plain simple short sales on a few ETFs. So nothing crazy. But if I'm going to point to one error on my part, and here's I say this every time, I'm not an Elliott wave expert. I know the basics, and even those I get wrong sometimes. But my perception was that we are in wave 5 now, kind of the final leg down. Nope, I was wrong. We are still in wave 4. And we may be getting close to the end of wave 4, or it may go through tomorrow. But wave 5 is coming, which is very exciting because wave 5 is going to be a lot bigger than I thought it might be. So I was wrong on that. I had said recently that, if memory serves, 5537 was the target on the ES. We're getting closer. We're at 5439. And so tomorrow morning is the CPI, which tends to be important stuff. Let's just say the CPI is cool. That would get people more excited and would augment this rally and maybe get us up to 55.37. And so my short's a little early, it's true. Lose some money on that. But the thing is that, above all else, this is a very chart-friendly market. Unfortunately, it's kind of a full-time job. Some of my readers actually work for a living, and they're going crazy because they're off to meetings and doing this and that. And you got to be like this all the time, to make the most money on this crazy market. So that's the tough part. That if there's so many wild swings, it's kind of a full-time job, kind of a 24-hour job too, because you can worry all the rest of the time. Okay, so that's my kind of preface. That's where I think we're at. It's been a really exciting day. The past week has been amazing in terms of trading activity. And I've got a little fewer symbols than normal. And I compiled this list before the announcement. So, let's see how it goes. Here's the spider. Absolutely explosive move. On Monday, I guess it was, we got pretty close to the major trend line. We're blasting higher now. What would make a nice terminus to this rally would probably be this gap. This was the big gap on the second. That was Can you believe it's only been 5 days? I think that's right. Let's just check. This is an important point. Wednesday, Tuesday, Monday, Friday, Thursday, Wednesday. Yeah, this was Liberation Day. And so going back to the low of Liberation Day last Wednesday would be a nice, clean place to end this rally. So I'm probably a little early on these shorts, I'll admit. But that's not a bad target. The diamonds cracked below their trend line, and they're getting kind of close to this particular gap. So there's sort of two gap possibilities. This one here. So I'm already short the diamonds, and I could get stopped out of that. If we just keep going, the next one is up here, which again aligns with Liberation Day. That gap. IWM, the small caps, this was the target. I'll eventually get rid of this. I'd just like to acknowledge that was the target. We totally nailed that, but we're rallying, and there's really only one meaningful gap right here, which is like so. Yeah, and we're at the highs of the day right now. So I'm almost certainly too early with the shorts that I did put in on the ETFs, but there seems to be a little more to go here. Now, a big driver of all this was bonds, because there's been a lot of chatter about the basis trade and how the hedge funds, bless their hearts, have been losing an incredible amount of money on that, and that's really why they folded on this tariff thing, because the hedge fund billionaires were screaming at Trump, and he finally raised the well-worn white flag, and so bonds are rallying mightily today from where they had gotten battered. So that's kind of interesting. But you can only suspend the tariffs once, right? The only other good, and this, again, one of the reasons I'm so excited about this is that there's an enormous amount of uncertainty that just disappeared, which is why the VIX is plunging. It's same old, same old. Print trillions of dollars of new money, go deeper into debt, same old, same old. All this nonsense about Liberation Day and a brave new world and let's tough it out and Hank tough, can't even spell Hank tough. Nonsense. Absolute nonsense. Know your enemy. Weak, vacillating, flop. And so it's happened again. The only uncertainty out there now is, okay, what does China do? Because if they surrender all of a sudden, that would be more good news, I suspect, for the market. But this whole will he, won't he thing is kind of gone now, because we've got this 90-day shtick. So it makes things less stressful, a little easier. We can maybe sleep at night again. EFA, which was one of my tweets about buy the EFA, is up massively. It's up over 7%. The gap on this one still has a little ways to go. But yeah, it's just been so interesting from a charting perspective. Major items which are rallying toward important exhaustion points include things like Apple. And so I'll just sort of touch upon what I think is the appropriate targets for these and the reversals. Halliburton. So oil's rallying, of course, tremendously here. Hilton, and some of these have already, this one actually, that's not a gap, silly, it's up there. So Hilton's up, like so. Honeywell. So a lot of these wipeouts they're healing, they're coming back, they're restoring, those lost prices. Seagate, this has ways to go. But these are the kinds of things, I'm not making this up. I sold all my puts when Seagate was down here because it was just stretched too far. Obviously, I did not know this announcement was coming, but it was just so deep. It's like, all right, just take your profits. There'll be a better price in the future. Nike, it's working on some repairs there. Still got a little way to go. And Meta, another good example. This one's actually exceeded its gap. It's gone just blasting higher, so it's even pushed past this gap. But it is getting into this thicket of overhead supply, which should slow things down. So you get the idea. XLF, which I was short and covered at a pretty good price, is getting near its own price gap, like so. So let's get rid of this. There should only be one line here. So the gap is right there. So I just got to drive this home. So much damage has been undone so quickly. Because even earlier today, just hours ago, we were sitting there, the gap was way up there. There was so much repair to do. It's like, will it take weeks to get? No, it's taking a couple or 3 hours to undo all this. I mean, there's probably huge short positions getting covered, people falling all over themselves, buying stocks, etc. So there's been a lot of, unwinding of that. So it's happening very quickly. And specifically Bank of America, BAC, rallying as well, obviously. And Lattice Semiconductor, here's another good example. Here's the gap. We were way down here yesterday. Look how quickly it's moved. Look at that, 22%. 22% gain just today. So these are massive, massive moves. All of which is to say, I think it's setting itself up for another fall. As I say, hopefully wave 5 where we take out those lows from Sunday on the futures. XLU, also huge rally. This may be ready to short again right now, right this second, because we're at the broken trend line. We've got this here. This might be a good setup right now. And the next era in EE, which I covered earlier today, thank God, is rallying too. But again, back up to, it's just opportunity after opportunity after opportunity, just on a silver platter, I think. I mean, if we just keep going higher and hit new highs, obviously all of this is wrong. But as things stand right now, it's just like silver platter, it's a gift. All the setups are returning. It might not be till tomorrow. The CPI will be instructive, but it's pretty cool. Gold has had another tremendous day. Look at this, $117.50 up on the front month. So it had been falling for days, bang, 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 and it unwound most of that damage swiftly because the government is an inflationary creature. The printing presses are worried again. Silver up almost 4%. Terrific day for silver, although it's not near lifetime highs like gold is. Oil also rallying terrifically and getting close to this broken trend line, which is just beneath this right triangle pattern. Setups are appearing. And XOP, which I'd also tweeted about, at a great price, is up over 12%, and its own gap is right like so. So it's pretty amazing stuff. Let's close with this chart. This is the ES chart. I think I showed you this yesterday. This is the ES chart with the Fibonacci's, and I put tints on them. And we have moved very quickly. And so if I may clumsily offer my own updated Elliott wave idea, it's like wave 1, 2, 3, this big one down, and then 4. We're in the midst of now. When will it end? I'm guessing something like, as I said, over and over again, 5537, which could well come tomorrow. So that is the long and short of it, as they say. So anyway, like the old saying goes, better be lucky than smart. Definitely got lucky today. Very, very lucky. And I hope you're doing all right. Even having fun, dare I say, with this market. It's an exciting market and a lot of opportunities. So I'm going to say goodbye and see you post CPI tomorrow. We'll see how that all works out. Okay? So take care and see you then. Bye-bye.
If you missed the live show, here's our cherry on top weekly recap.
Well, we got Nova Vanetta today. She's out on a secret mission. Is this correct?
She's on a secret mission in New York City. But yeah, we're doing a funny little promotion and we're going to see how it goes. And there's an outside chance, very small chance,
she gets arrested.
Yeah.
So you guys sent me to New York to deface a national treasure, and I did not get arrested. No, in partnership with a testicular cancer charity, we mounted cherries onto the back of the Charging Bull on Wall Street, and it was awesome. We did a test run last night at midnight. People went nuts for this. Some guy yelled at us, and this other guy was like, oh, he's just cranky. But it's all for a good cause. We're out there for a couple of hours. It took months of planning. It takes 2 people to hang them because that bull's ass is pretty tall. So that's why I'm in New York.
Those cherries got some good hang to them.
Mm-hmm. Yeah.
Friday might be interesting. I'm not allowed to work on Friday. I have committed to my family because the Golden Prince is getting married.
I know. Congratulations.
So I have committed that I have to do family stuff, like take pictures.
I'll take things that Tom excels at for 100, please.
I'm just going to be a good,
attentive husband and father to the groom.
I'm never a good attentive husband. What I'm probably best at is
dancing. I watched you at the last wedding. You really excel at dancing.
I excel at picking up the tab.
My big question for you, and you know Slappy as he's gotten older.
What do you want to know about Steve?
Do you think after dinner, it was his 60th birthday?
No. Don't do it.
Beth knows Tony better than I know Steve.
Do you think he...
I have no idea what you're talking about, and I am just going to move on from this conversation. I'm with Beth. No.
That was like Minority Report, like a pre-crime Omaha. You know, like she knew the Omaha was coming. Like she got the little ball that came down and was like, okay, Tony's going to go there.
Get the full scoop by checking out the archives at tastylive.com.
Steve in Atlanta, thank you so much for holding.
My pleasure, guys. And let me go on record as saying I think you've got Tasty Trade is the best brokerage, and you guys have the best content, and I'm not here just schmoozing. Y'all are the best on the planet, period, for what you do. Go on record as saying that. Tom,
Thanks.
You were the great disruptor when it came to forming Thinkorswim and then Tasty Trade. You're an innovator.
I appreciate you calling in. Good stuff as always. Thanks, man.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and Tasty Live web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
In the world of investing, a beast lurks between the numbers, ready to pounce. Some traders hide from it, some ride it. If that's you, join us on Tasty Trade. Genius loves company.
Ring the alarm, boys. Turn up the charm. Listen up, y'all. Get out the damn stall. It's the last call. Hey, the last call. The last call. The last call.
Tomas, we're back, my friend. I just did a Tomas trade. I just bought something instead of selling something. I have to do the opposite trade now, Sosnoff. Give me one quick second. I apologize. Can you do me a favor? Who is our best math guy?
Me.
Besides you, who is our best math guy?
Jacob.
Okay, can you have him count down 90 days now, please, for us?
Sure.
Okay, beautiful. I need you to do that. For me, okay? Can you do that?
Sure.
Sure. That's the next thing that we have to worry about. 90 days, Sosnoff. 90 days.
That's humor. I got
yes,
humor.
Yes. That's humor.
Yeah, I don't really care about that. I think that there's so many stories today that kind of write their own. I think since Sunday, I talked about we were on the precipice of a huge rally. I just didn't know it was going to come after 2 more debacle losses and then have it. But I think this is the scenario that you and I painted from the start. And I just want to be really clear about this, that there was going to be a huge rally in the middle of all this. It wasn't going to get people back to even, that's for sure. But there was going to be a huge rally because they were going to say, whatever, called off the tariffs, whatever they did. Who knows what it actually is going to turn out to be when they break it down 2 days from now. I think what's more important is the decline in volatility today, which is, I'm going to say it's historic, but I don't really know if it is. Like, I don't have any context to tell you. I'm not exactly sure if this is a record day in volatility contraction. Maybe you'd know. I don't know.
I will try to find out for you, but man,
I don't know. I will say, what did the VIX actually do? The VIX futures
/VX is down $7.60 to 24.45. Now, VIX is going to be down significantly more, almost $20, 32.85.
Yeah, and the /VX in the J contract, which is the next month out, is down 12.20. Just so you know, so it's a crazy. And yeah, I mean, do you ever remember the VIX being down $20, the VIX?
Sad enough, I don't remember a crash up like this in my entire life. I mean, you're talking about 10% move, 11% move in NASDAQ, 9% move in even. Yeah. And it was so quick. It was so quick, Sad.
Yeah. I agree. But do you remember a VIX crash of 20 points?
No.
Okay. So
not in a day. I mean, not in a day.
Of course.
Right.
So I've been, I'm sure you've been doing the same thing, but I actually haven't had time to look and see what you're doing. But I've been selling all my long deltas into this. I don't know if you have. I've been selling.
I started getting. I didn't start getting long. Yesterday really screwed me up. 5,000 on ES. I thought, I didn't think we were going to see it in the month of April. And I thought that was the line in the sand. And we got 150 points under that. And we were moving 20, 30 clicks at a time. It was frightening. I said it was frightening. I said the truth. But yes, today I've been able to lighten up today.
It's the first time I've ever seen you scared. So I knew that was that's why I bought futures last night. Because when you said I'm scared, and I wasn't there to I was going to send you. I was really going to do this last night, but I didn't know how to do it because I don't have Amazon Prime. But I was going to send you one of those dog snugglies, thunder coats, where they wrap you up in a thunder coat. So
Well, I'll tell you. Well, you did send it, Sal. It was 450 spook points and almost 2,000 NASDAQ handles. So you did send it. You did.
Yeah, well, I needed that.
You say we can talk about what we want. Listen. Every phone call that we got today had a little bit of different circumstance.
Yeah, sure.
People that called in and said, I've been waiting this, but I'm scared. We didn't say to be scared. We said, if not now, when? You've been waiting for this. Good on you. And for people who had too much long delta and were getting hurt and getting really scared, we didn't say puke it all out. Don't do that. No, we said, hey, you can buy back your deep in the money put, sell an at the money put, reduce your delta by 50%, sell a call out. You'll be happy if we get back up there. And you were. So I think we handled this with a lot of integrity, besides the bullshit that we talked about.
I said get smaller. But here's one call I just have to go back to. Do you remember the guy that called in this morning that said he had a position on in TQQQ and it was trading for $34. And I said the expected move is $8.50, but you never know what can happen in this market. We said maybe you get a crazy move. It's $52.
Yes.
So he's right back on the dance floor.
Yes, but you here. I like that. I don't really like it because TQQ under any other circumstance.
I agree with you. I agree.
A 10% move. That stock moves 50 cents. You know what I mean? And you it's not a good use of capital. In my eyes.
I completely agree. I'm not arguing. In fact,
but I don't want people to go to TQQQ because you say something like no, that's not.
Of course. There were some interesting turnarounds in the commodity markets, but I don't think they're, other than I think everything is about stock index futures. We could talk about crude oil, but nobody cares because
we could talk about crude oil, but nobody does care except now they're going to raise my prices at the pumps that they never lowered.
That's right. Now they can raise them because
Look at oil. Like I said, look at oil.
I mean, gold was up crazy all day. It's up 120 today. That was insane. That was my biggest loser was gold. My second biggest loser was bonds, but bonds came back actually.
Listen. Sadnov, sometimes you got to throw something to the trading gods.
I threw him gold today.
Okay, good. Okay, then that because you're not making money on the way up, you're not making money on the way down, you're not making money on the way up, you're not making money on the way down. You just got to leave it away. The volatility in there is too low for the movement that it has. But go ahead. I'm sorry.
Yeah, I think that's right, and I think that hopefully bonds made a low last night, and we'll see if that holds. I think that one point that I made earlier that I want to make again is that as much fun as this is, because it is kind of fun, and I did make
it's more fun when you make money.
It's more fun. Well, today we made money, but in fact, today we made a lot of money, but we didn't make back. I did not make back as much as we lost the last 4 days. But what I will say is that for the entirety of the trading world, this is something that you have to put it into perspective. What we saw the last week or the last, let's say, whatever, 6 or 7 trading days, everything. Don't expect that. This is not the norm. This is something that's going to happen once every couple, maybe every 5 to 10 years. This is a once every 5 to 10 year event, and you have to understand the context around that. It's going to be, you're going to be seeing a 20 or 30 handle move about a month from now in the S&Ps, and you're going to go, this is worse than watching paint dry. I liked it when they moved, 1,000 poents, but you're not going to have that. This is not, this kind of movement's not sustainable. But there is
1,000 points, 2,500 points in the NASDAQ futures.
No, that's NASDAQ. I'm talking about S&Ps. S&Ps, between last night and today moved about, 800 points, something like that.
From 48 to 54.
Yeah. Okay. Well, it's 600 points.
Yeah.
The one thing that this is going to, and we talked a little bit about this morning, but the one thing that this is going to throw a huge wrench into it. Everybody's spent a lot of time building bots. I can think of the guys in my office that used to chart stuff, all the analysts, I just hope that the future of this business is not sitting around waiting for a tweet from the office of the president. I just hope that that's not the future of trading, because that will not be a good thing. However, what is good about this kind of move is it introduces a lot of people into a couple of really important concepts. And these are really hard concepts. Concept number one, Tony, stay small.
Of course.
One way to protect yourself through this entire crazy move, if you got hurt bad, it was because your positions were too big. Period.
Yes. Yeah.
Period.
And it's not, getting hurt is one thing. Losing twice as much as you make on a positive day is another. Losing 3 times as much as you make on a positive day is the same. But when there's a zero behind that, it's 10 times, 20 times, 30 times. That's when you have problems. And that's when you got too big.
Yeah. So one is staying small. 2 is you cannot throw good money after bad, because some of these down moves like this one, nobody thought we're getting to 4,800. Like, you could have made an argument when this whole thing started, okay, maybe they go down to 55, 53, 52.50, whatever. But you're not thinking 4,800. So when you double down,
no way, and that's why I was scared.
Right. And so when you double or triple down, you're not doing yourself any favors at all. So stay small, don't double down, don't add good money to bad. The other thing is, sometimes my third takeaway is sometimes the inverse relationships, like in this case bonds, don't work.
Yeah.
And so you can't go too big.
Even if it is an intelligent play, 9 times out of 10 or 99 times out of 100. It doesn't work sometimes. Yeah, you're right.
The next thing, number 4, is no matter how much you love listening to this newsletter writer or that newsletter writer, or this, or you love this strategy, maybe it's from somebody at Tasty, maybe it's from somebody somewhere else. Nobody has a secret formula. Nobody has a strategy that can that will save you in this kind of a market, no matter what you do. You know what I'm saying? Like this is not something where, was there a magic strategy? Yeah, sure. If you were short, that's it. But there's no magic strategy. The other thing that's really, and then my fifth takeaway is, if you think that there are these easy to recognize tells or levels, or like Tony and I both bought stocks yesterday afternoon, like you said. Not a lot. We just bought a bunch of stocks, and I bought stocks this morning too, but I had no idea. Like I was just pissed because they were down so much. Yeah. I think last night I bought futures, and I also bought bonds. The bonds, they were scratched, but the futures worked. I guess my point is, you're throwing a lot of darts against the wall, but you're staying small, but nobody actually knows. Like there isn't.
No. Nobody actually knows what the future price is going to be. Of course, right.
Yeah. There's nobody sitting around today going, you know what? I think at 11:32 today they're going to come out and the SPOOs are going to rally 700 points. I mean, like that's or 400 points. That's not something that is predictable. So there isn't. So next time somebody says, oh man, this was a layup. I knew this was going to happen. No, they didn't.
I knew this was going to happen. I knew this was going to happen 3 days ago. I mean, to be off by 3 days in most places is okay. It's not good in trading. I mean, that's the great thing about this, and that's really why you really have to think about the strategy you're employing. We talked about it yesterday and the day before that, and because we went down the few days after that. I was talking about, buy the at the money call, sell the at the money put, that synthetic stock, and buy a put below to give yourself long delta on a trade and use significantly less buying power. I mean, there's strategic ways to go about it. And today you could have gotten paid. And the 2 days prior to that, if you would have done it, you would have lost money. But at least you would have had a strategic play on and not just too big, using too much buying power and not being able to do something else the next 2 days.
Yeah. And then the other thing, my final takeaway is that, and I didn't like it this morning when somebody mentioned it, so I'm not going to say it as the same way, but none of us like learning experiences. But all of us need to have certain takeaways from this kind of a market move, because when you survive this environment, when you get through it, like whether you got nicked, a little bit bruised, whether you got some back today, whatever it is, there is some takeaways that, hey, you know what? Is this the best you got? You know what I mean? Like, is this? Yeah. You hit me with your best stuff, and you wobbled me, but I didn't go down, or you stung me, but I didn't go down. And I think that
I never went down, Ray. You never took me down. What movie? You never took me down, Ray. You never knocked me down.
I forget the
Raging Bull.
Raging Bull. I just couldn't think of the name. Raging Bull. Yeah.
Come on.
Yeah. Anyway, this is, you get extraordinary stuff like this happens, and as long as you're still standing afterwards, you're in a pretty good shape. Now let's talk a little bit about looking forward. You got a massive move tomorrow. I mean, today, the likelihood of it turning around tomorrow and going the other way.
Oh, please don't even say it. Please. I mean, the magnitude of an 8 or 10% move, it's probably slim or none, but it's a lot higher than it was a month ago.
Okay, I'll give you that. Okay. I was going to say the chances of them going down tomorrow, I don't know.
Please,
50-50.
please, I don't want to hear it. I don't want to hear it.
Here's what I'm going to say. The chance of them going down tomorrow, maybe 50-50, but the chances of them having a big down day like a reversal today, 0. I don't see that happening at all.
All right, well, even the S&P is going to be flirt with up 500 right now. So the NASDAQ is up 2,000, 2,100. We might as well start talking 100 increments. Russell's up 156, and the Dow is up 3,000. Sadnov, I didn't think I would see this in my day. Like I thought my grandkids might be telling me about how the E-mini S&Ps were up, 500 today, and they had 1,000-point swing. I didn't think I would see it.
You know what's weird is after the last couple of days,
it seems normal.
It almost does. Like it doesn't even. Like I'm not. I'm
Go ahead.
I'm just looking at my positions here, just going in the close, just trying to stay a little bit flat.
So I got a question for you. After 87, put stayed bid forever for a long time, and actually up until right now, because there's put skew until just a few days ago when we pointed it out. But there was put skew, so puts have always stayed bid. Do you think puts stay bid more now than in months or years prior?
I think volatility stays elevated, and because of that, yes, because the volatility will stay elevated, I think puts will stay bid. If does that answer your question?
I mean, yeah, like Chris Vecchio would answer it. Sure, yeah, okay.
I mean, volatility is going to be here.
I saw you smile. I saw you smirk just a little bit. I saw it. I
just hope he's listening.
He's listening. He always listens. I love Chris.
I think volatility stays bid for a while, at least into the summer. I'm not too concerned about volatility, disappearing. I think that, you might get. I think you get some follow through tomorrow. I don't know that we close higher tomorrow. I think we are higher at some point. I don't know that we close higher.
Well, it's a 50-50 shot on that too, Sosnoff. I mean, that's like saying, if you want to score goals, you should be on offense. I mean, yeah. I mean,
it's like saying if you want to go to heaven, you got to raise the hell.
Chances of being green by a penny are 100%. Yeah, okay.
Hey, listen, I've given you a lot.
I don't know what happened to you since you married off your son. You've become half the man I know. Seriously.
I've given you a lot of words of wisdom today. I'm not sure what else I can do here for you to help you. I mean, I'm just like throwing out tidbits here, left and right, and blah blah blah. I mean, how
about people's deltas changing with the lower implied volatility now? Let's talk a little bit about that real quick. We got about 7 minutes.
Yeah, that's a fair question. I mean, I will tell you something. I made like 140 plus trades today. The last 40 trades I made, all I've done is roll up puts.
Yeah.
The last and here I came in the longest I've ever been this morning, and it didn't. And you
still need to roll up puts. I understand what you're trying to say.
I sold out a lot of stock. So I will say I sold out Reddit, sold out Apple, sold out Microsoft. I sold out a lot of stock. But because when they're up 450 points, what are you going to do?
Side enough, I said that when they were up 350 points. I mean, yeah, I agree. I agree 100%.
Yeah. I mean, the only stock I've got left is Microsoft. It's up $38. I mean, I kind of feel like you got to.
Tesla's up 51. Apple's up 27. Apple couldn't get itself an uptick. Google is up 14. I mean, there are stocks. These numbers are just. I guess nothing's off limits anymore, Sadnov. I guess that's what it comes down to. You look at some of these, and to give you some quotes here, I mean, it's completely broad based. 4.4 million SPX options. Way more calls than anything else. Volume will be high, but it probably won't surpass Friday's 1.1 million. Big volume in the E-mini S&Ps, 2.5 in the E-mini S&Ps.
I thought we did over 3 the other day.
I think we did too. To be in ES, you're talking about ES options.
Yeah, no, yeah. ES futures. Didn't we do over 3 million? I could have sworn. I'm not 100% sure.
I don't know about ES, but I'm talking about SPX.
Okay, got it.
It was 4.4. I don't know. Anyway, it's a silly statement when the SPUs are up 500, 480 or whatever to say it's broad-based. So I'm not going to say
it. Yeah,
it's a broad-based. I caught myself.
The difference between a broad-based rally like this, when the VIX is down by $20, is that it doesn't even matter if you're inverted or what you have on. Everything gets killed. On the way when it's going the other direction, we're selling off. Everything explodes. So this was the gift that keeps on giving today.
You know what? Kudos to the Tasty Trade platform. You got to pat yourself on the back there a little bit, Sadnov. I mean, it kept up. It hummed away.
In fairness, the platform, I'm I'm getting fill speeds right now that feel like they're like sub 20 milliseconds.
I am too, but no problem with seeing quotes, getting quotes. I heard reports from other people writing into me that had other platforms, they couldn't get quotes and stuff like that. So, I'll take a little latency.
I think there were platforms, some platforms were down today. A lot of platforms were really slow. Tasty was rock solid, fast as hell, and we still have never had a minute of downtime. So one of the reasons people come here is just because we're stable and fast.
Yep. Thank you. Yep. All right, Sadnov, words of wisdom. I know you said there's a chance we could be up and we could be down tomorrow.
I'm exhausted. You and I have been going since 7 o'clock in the morning, and I got a crazy day tomorrow. I don't even know what show we're going to do in the morning.
I was going to say, what are we doing tomorrow morning? Calls, show?
I mean, I got to think you got to talk markets here.
I think so.
I mean, I'll let you make the call, but as much as you want to do, a couple pieces of research and stuff, the reality is here, there's too much going on.
There is way too much going on. I mean, we just took out the last 3 days move. I mean, we're back to 50.
Sick. This is sick, man. It is sick. Yeah. It is. So I think we got to talk markets tomorrow.
Okay. Sounds good to me.
Can you believe bonds back to 115.17? The torture they put me through last night till 1 o'clock in the morning. You mother effers.
Now bonds are not back from their last 3-day move.
No, but you want to know something? Did I lose? Did I make? I broke even today in bonds. I worked my freaking ass off. Oh my God. The only stock I got killed in gold and AVGO are the only two stocks I got killed in today. Other than that, there's actually, I take that back. There's a few more.
Yeah.
But other than that, it was a good day in the stock world. Wow.
Very good day. And you know what? This was needed for retail investors. I mean, this gives people, and this is what we were hoping would happen 2 days prior to this, but at least it gives people options on doing something. If they want to lighten up, they can lighten up. If they want to change their strategy.
It takes the margin calls off the board.
Does take the margin, but boy, some people are going to be very disappointed that they traded too big. Because if they held, you see, this has always been my philosophy with somebody who trades with a margin call, who gets margin calls. They're trading too big because they're a little bit behind the 8 ball and they want to make a big score. If it's almost like I'll use my dad. It's almost like my dad. I wish if he would have used his brain for good and not bad and evil, he would have been something with somebody. The same thing with the people who, end up getting margin call. They're just trading too big for the size of their account. If they would just pare it down a little bit, I think they're risk takers, and risk takers can make money. They just do it too big. It hurts to see. I'm sorry, Sadnov. I still have a conscience after 40 years of trading my own money.
It didn't say a word. I
can see you looking at me. I can see you looking at me. I can see you looking at me.
No, I was trying to figure out your analogy with your dad.
Well, my dad was a brilliant guy. I mean, I thought he could have been somebody, but he wanted to take the easy way out. He wanted to take the shortcut all the time, and way smarter than me. Anyway, that's it. It's his birthday soon, so I'm thinking about him. We're going to take a quick 90-second break. We're going to come back. We got the Overtime Crew coming up next. Sound good to you, Saz? Peace.
I'm AJ Rudolph. I'm a senior product manager here at Tasty Trade, and I just qualified for the World Poker Tour $5 million free roll in Las Vegas on Friday. So I've been playing poker for about 20 years, actually. I started just with friends. It was like 2005, I think it was, where everybody was like, yes, let's go play poker. There was a huge boom around poker. And I actually feel like that is coming back around again. Right now, there seems to be a lot of interest, and the fields are growing, and everybody wants to get in there, and everybody has a chance to win. That's kind of the cool thing about all of these big events. I feel really privileged that I have the opportunity to go and do this. This particular tournament is only 2,000 people. You cannot buy your way into it. You have to win in order to win your seat, and that's what I did. And so I just buckled in and played my game and really focused and won my seat. I'm a very aggressive player. I do rely very heavily on reading the players at the table. I think that's super important. To be a balanced player, you want to make sure you're doing the math, you're reading the people, and you're doing all of those things in combination with each other, so that way you're using all the tools that are available to you.
Thinkorswim will always be my baby, but this one, it's different. We built ours literally from scratch. It's a much thinner, it's a faster, it's a slicker application. Everything's on one page. So you're always looking at the core page and then bouncing around from there to get to whatever you want to get to. We're here to support whatever you're looking to do. We have the tools that you need to be a successful trader.
Wolf! The first half of this year's market has been giving the good guys the business.
It's certainly been back and forth for sure, Pete, and I'm getting whiplash over here.
With good mechanics, we can see Team Tasty stay strong in the second half.
Absolutely. Let's check out our starting lineup.
James Blakeway, Carthage College. Number 25, my percentage profit target for straddles and big lizards.
Tracy Aljo, Ohio University. Number 21, because that's how many people have asked me if Tom's hair is real. It's real, ladies.
Katie McGarrigle, University of Illinois. Number 44, because I like to trade underlines with an IV rank higher than 44.
I like the looks of that lineup.
Well, being mechanical is always better than just trying to run plays and see what sticks, Pete.
When you got skin in the game, you stay in the game.
That's right. Now get off the couch and get into the game.
Watch Tasty Trade.
We're going to go to New Orleans. I got to be in New Orleans. What's up?
Y'all three guys, just the whole organization is just phenomenal, and it's changed my life. And I wish more people would just sit back and listen to y'all and take it seriously, because it will change your life if you enjoy trading. I don't know if I could ever repay any of y'all for this free advice and free teaching y'all do. Is just remarkable. Tom, I got your hat on, and ever since I got it on, I've been blowing the market up, so make sure you don't give one to Tony or Scott, because I don't want them to benefit from us.
That's okay. Good job out of you.
It feels good to get smart. Get even smarter with the ultimate how-to guide. Learn 31 different option strategies, covered calls, iron condors, jade lizards. Become a trading mastermind. Get the guide at tastylive.com/guide.
How about that ride in? It's Wednesday, April 9th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan, as we are here to take you through the most remarkable day in my lifetime in the stock market. S&P 500 up by 9.3% right now. NASDAQ up a paltry 11.1%. Your Russell 2000 up 8.39% in today's session. The bond vigilantes have won, ladies and gentlemen. Liquidation overnight gets Trump to tap out On Futures Power Hour today, we were privy to that announcement. If you joined the 1 p.m. Eastern show, you saw us react in real time to the news that the tariffs would be lowered against the 70-plus countries that have come to the table for negotiations. There's a little caveat
and
there,
did not retaliate. The ones that were nice and obedient servants of the king.
Those that kept their fealty to the empire will be rewarded. In turn, we see that Chinese tariffs will be increased to 125%, which sets up a pretty funny bit of math, which we're going to have to look into here shortly, about what the U.S.'s effective tariff rate will be moving forward. And here's a hint. It's higher than it was then this morning. Nevertheless, it's the relief that the market needs. If we're not cutting off our trading partners, they will continue to buy our debt. We had an excellent 10-year auction today, the second best bid to cover ratio in history. Minutes later, we get the announcement from President Trump himself. Bond yields get off of their highs, which was a scary night overnight in Asia.
My God.
I was trying to get out of my positions and was not getting filled. And I'm here sweating. I told Ilya, it's like 1 o'clock in the morning. I'm almost throwing up.
Oh yes, there were many frantic texts as both of us were looking at our bond positions, going, oh no, wait 2%, 3% on what? And it certainly got really hairy going into Europe. I was pleased that my exposure was in TLT, so all I could do was watch in despair and couldn't actually do anything, because if I had the freedom of managing my positions, Lord knows the damage I would have done.
Well, the damage wasn't too terrible for me. Today was a relaxing day.
Yes, this is a whole lot better than it looked at the bottom of that wick.
Yeah, ZB only fell 23 ticks, but really, the story now is of what Trump said himself. Jamie Dimon told him he was going too far, as he just said at the White House. Bonds were going too far. Markets are getting a little yippy, in his exact words. We found real proof, ladies and gentlemen, that the put is not in the stock market, it's in the bond market. The Trump put is in TLT, not in SPY. Do we have a level to trade around now for the rest of the year, ladies and gentlemen, in ZB, right around 112? Those lows that you have at this.
What a low.
What a low. They will not let yields move back where they were at the start of the year. That is a very important observation here. But you know what? That's not just the day-to-day. We have to talk about the basis trade, what Japanese fund may have blown up overnight. We also have to talk about the move in gold and silver. Gold up 4%. Thankfully, silver getting some of it back. Dylan, you're the laureate around here. You're the one who has the best market memory. You've lived through so many crises and have come out on the other side better, stronger, harder, better, faster, stronger, as they might say. What do you make of what you've seen this week? Did Trump just show his cards with the bond market comments today?
I mean, I have two thoughts. One, I had a conversation with Rich and the guys at IG in London this morning, and we had this exact conversation, which is where is the discipline for the Liz Truss that is now called Donald Trump, the sort of idiot politician making unilateral economic policy, and the obvious answer was the bond market. So the two couple thoughts. First, obviously, the bond market is the most powerful thing on earth, more than any president, more than any trade alliance, more than any currency. The U.S. bond market is the most powerful lever of power in the material world. And I'm really wondering if Trump has become so predictable as to be the 2025 equivalent of the 2024 oil trade whenever there was saber rattling in Iran. And basically every time you get a rally like this, he's going to start to wind up tariffs again. Market's going to sell off. When it sells off, he's going to then back out. Basically, it's like an idiot child with a real economic nuclear bomb who doesn't understand and thinks it's fun to scare everybody. It's like somebody with a machine gun in a nursery school swinging the gun around and thinks it's funny, who's drunk. And so it's kind of a sad state of affairs for the world, to say the least. But it does make me wonder if this has actually become somewhat predictable, and that he's always going to threaten something to get he feeds on attention. He doesn't have there is nothing else. And so he'll do whatever the next thing is to get him the most attention. And so he needs to make threats to accumulate attention. And then he needs to relieve the threats to make it to continue to accrue attention. The difference between this and past crises is in the past, financial markets would adjust their levels based on some real external event, whether it's the global pandemic, a financial crisis, too much leverage is almost always, one, right? No one has ever seen a situation where the global financial markets are in a full panic, crisis, crash, rally, whatever you want to call this.
Sure.
Because of the idiocy of one political leader. It's a sad day for the world. Today only makes it worse, honestly.
Well, that actually is I think the key takeaway to all of this is, I think, exactly what Dylan said just now. Why didn't the markets freak out about the tariffs in November? Because the tariffs themselves are not the reason they freaked out. When we got into the beginning of this year, it's the implementation of the tariffs being erratic and the uncertainty therein, and not just the tariffs, but also the Doge thing, the immigration thing. The rollout of everything has appeared so chaotic that you started to see it in consumer confidence and in business confidence. That's what the markets didn't like. Tariffs, no tariffs, whatever. All of these things were perfectly digestible depending on how they would appear as a concept when the election occurred.
Sure.
It's when business confidence fell away and consumer confidence fell away that the market said, okay, this is a cyclical risk now. This is a risk to growth. And then when Liberation Day comes, notice, when it's initially the confusion that it's 10% across the board, the markets rally.
Oh, I was feeling good.
They rally because they have certainty.
Right.
This is not about anything other than uncertainty around implementation and what that does as a dampener on economic activity. It's only when the foam board with the many rates comes out and you start to go, wait a second, these are going to be bilateral negotiations until the end of time. We're never going to get any certainty. You're going to negotiate these things from Bahrain to Botswana one by one? What? This is going to take forever. How could you ever have any certainty? You notice then that the thing that happened today actually adds more uncertainty because it shows that the thing can swing this way, it can swing that way. When it's time for the season finale, today was implementation day, there is a cliffhanger of some kind at this point, almost guaranteed, it seems. And so the show goes on, but do the markets have any more certainty? No, less. And
other than that's what I'm sort of speculating, Ilya, is whether the certainty is that he will always make the play for attention and he will never go through with anything that he says.
Guys, he's a real estate guy. The rates went too high. He's a real estate guy. If the whole plan is to refinance the debt and lower rates, you can't have a 4-year yield goes from 3.85 to 4.5% in 36 hours because of mishandled policy, right?
No, definitely not.
He tapped out.
But also look at the upshot. Look at where the S&P stopped. Just as a benchmark.
Hold on.
Does this change the recession that's probably coming?
Yes.
No.
Yes.
I don't think it does.
Yes.
And I think what you're about to tell us about net tariff rates is why it doesn't change it.
That is, yeah. Do technicals matter in this market? There was an astute observer the other day who pointed out that how can you follow technicals in this market? Fair point, right? This is uncharted territory. Technical analysis itself is predicated on the idea that past price action can help in some degree be informative about what the future may hold. After all, it's price. Price is a reflection of human psychology. Human psychology has not changed in any significant matter in 2,000 years. We're still running around with the same meat bag machines in our head that make us make the same decisions and feel the same emotions as the people in the Roman Empire did. So past performance actually in some way may be indicative of how the market may unfold moving forward. In this environment, do we have many corollaries here? No. So what do you do, right? Technical analysis does not necessarily hold. But where the market decides to stop today, perhaps in Ilya's parlance, let's just drag up the underside of the recent S&P 500 range here. That's fascinating. So it's right around Liberation Day where things really start to fall apart. You can see similar type of price action in the NASDAQ. And there's some funny thing about this math. So let's set the stage. Donald Trump today, Truth Socials, and I quote, for those that weren't here, by the way, on Futures Power Hour, you witnessed this in real time. For those that haven't seen this yet, quote, based on the lack of respect that China has shown to the world's markets, I am hereby raising the tariff charge to China by the United States of America to 125% effective immediately. At some point, hopefully in the near future, China will realize that the days of ripping off the USA and other countries is no longer sustainable or acceptable. Conversely, and based on the fact that more than 75 countries have called representatives of the United States, including the Department of Commerce, Treasury, and the USTR, to negotiate a solution on the subjects being discussed relative to trade barriers, tariffs, currency manipulation. There we have it. The trade barriers, currency manipulation, non-monetary tariffs, and that these countries have not, at my strong suggestion, retaliated in any way, shape, or form against the United States. I have authorized a 90-day pause and substantially lowered reciprocal tariff during this period of 10%, also effective immediately. Thank you for your attention to this matter, as if we haven't been paying attention to anything else. Okay, so let's work through some math here, folks. Very plainly, we take all of the tariff rates that were presented to us last Wednesday when he held up that ridiculous whiteboard of doom in the Rose Garden. The U.S. effective tariff rate would have risen to 21%. Now, this is variable here because we don't know if this 10% tariff rate applies to Canada, as in it's now 10. Is it not applying to them, so it's still at 25? Is it a combination of 25 and 10, so it's 35? We don't know that yet. The White House has been reached out to by several officials. White House officials have been reached out to by several reporters. Those reporters have not received a response yet, so keep that in mind. But assuming that these are the numbers in Trump's Truth Social post, with China going up to a 125% effective tariff rate, the effective tariff rate that the U.S. economy has right now is no longer 21% from when we started the day. It's now 25%. Tariffs are higher now after all of this is said and done. After the 12% rally that we see in the NASDAQ today, the effective tariff rate for the United States is higher now than before Trump's announcement at 1:18 p.m. Eastern. This is the only question. This is the only question in the world that matters here right now. Sell the rip or buy the dip.
Sell the rip. Sell the rip. So I was, as you know, selling put spreads at the start of this week because in my mind, there was a strange thing in the price action on Monday. Where the news didn't get better, but stocks stopped falling. And so I looked at that price action and said, let's take a shot. Why aren't they falling? They should be. Or at the very least, nothing about the reason why they were falling has changed. But they've stopped. today, we get this reprieve. Obviously, the markets storm higher. I've booked out of this. I'm done. I'm closed out. And it's because this does not change the fundamentals of what any of this means for the economy, which is why the markets decided to be afraid of it in February in the first place. Again, the markets could care less about this drama. They care about what it means for economic activity. And this uncertainty is prolonged. These tariff rates, as you've just eloquently illustrated, are net higher. This is a bigger hit to growth, not a smaller one. Break-even inflation rates are falling to tell you that whatever uplift to inflation the Fed was so afraid of, if you read the Fed minutes today, that's going to be overwhelmed because demand is going to fall out of the bottom.
Mm-hmm.
The markets are looking through the one-off adjustment to price from the tariffs and saying, right, yes, one-time adjustment. And then the next thing that happens is the economic impact of your one-time adjustment, which is a deep and horrible recession that so overwhelms your one-time price adjustment that inflation expectations are sinking.
Okay, but let me give a counterpoint to that, perhaps.
Sure.
Dylan, at 125% rate for China, we're in the territory where trade effectively is dead between the two countries. We could go up to a 200% tariff level right now.
I mean, 500. These are funny numbers now.
Yeah, right. Like I see the feed here, which I really appreciate the people participating. Right. There's no TDS in this comment, I promise. But there is a certain point where when you rise to a certain level, you're killing trade, right? So at 125%, for example, we saw numbers that were released today by the WTO. At these tariff rates, 80% of trade between the US and China would stop because it just becomes too expensive to do. And so at that point, you go to 130, 150, 200. The impact is already there. It's already priced into a certain degree. And it's such a ridiculously high number that the market says to itself, there is no way that this is actually going to happen. It's so outlandish. You're really going to take the world's two largest economies. You're not going to see some bigger escalation between the world's two largest economies. There's no precedent for that. I don't know. Dylan, China is the country that
War of 1812, I guess. I don't know.
Well, I would point to World War I, but this is a country that endured the Great Leap Forward and decided to stick with the CCP. Yeah. It seems like the tolerance for what the CCP wants to accomplish historically is very high. No.
The tolerance on that side seems probably greater than the tolerance on this side.
Well, that's regardless, though, it feels like a funny number, right, Dylan? Like this is so astronomically high that it clearly has to be a ploy to bring them to the negotiating table.
But I mean, obviously, he's going to bring that number. If you think that he's not going to back off of that number,
right?
There's a bridge to be sold in New York, right? I mean, come on.
I mean,
this is a joke. This whole thing is a joke.
And that what makes this such a double-edged sword right now for traders, because you obviously have this rip-roaring rally. The tariff levels are being lowered and eliminated for most trading partners, which is a good thing. And quite frankly,
more than that, the president is proving it's all bark and no bite.
That is part of it, that maybe he's not going to follow through if equity markets and bond markets
it's not so much what he announced, it's so much that he announced anything indicating that he actually has zero credibility.
And the tariff hit is actually bigger.
No, but
this whole tariff discussion is a carnival sideshow that's never going to happen.
I think that, Ilya, I think we have to weigh these two factors here, right? If you're placing your next trade, do you care more about now that the tariff rate is actually in reality higher than it was before we started today's session? Or do you care about the fact that because the barriers against most other people that we care about, our allies, our strategic geopolitical partners, all of the people who are going to need to fill in the gaps of the supply chains that we have out of China if we were to do some global reshoring among allies? Maybe the factories don't come back to the U.S., but we drop tariff rates between, say, the U.S. and all of South America. And so you can't probabilistically say this is going to be a fade. This is definitely a buy still.
You don't have to make the decision between those two options. It's option 3, which is what Dylan said.
Which is?
Nobody knows because the whole thing is still erratic. It still changes on a dime. And businesses are ultimately still not going to have the confidence to put together a 5-year industrial build-out plan on the basis of this, because this policy is fickle and changes too quickly for anybody to output capital and take it at face value. And so the growth remains.
The hit to growth, and I would say the hit to growth remains, as well as the marginal disinterest in doing business with the United States.
Yes. Because nobody can still look like, if you're a purchasing manager anywhere in the known universe now, are you going to take this and say, okay, my supply chains with the US now look like this. I can project out a year, 2 years, 3 years, what my inventory levels should be, what demand is going to look like, what employment's going to look like. Are you any wiser for having heard this today? No. So sentiment in markets has improved, of course, because the markets were getting hit in the head with a tire iron, and now the hitting has stopped. Well, that's great, but your head is still bleeding.
And you still have, and you have somebody in the room with a tire iron who'll swing it randomly at any time.
That's right. That's right.
Yeah, but didn't we just learn today that if Bill Ackman cries enough on Twitter, like, he'll just. If Jamie Dimon, Bill Ackman, if Scott Besson we talked about this yesterday. Scott Besson flew down to Florida apparently on Sunday.
Oh no, the interview that Besson did with CNBC yesterday.
Well, he's beclowned himself. Besson's really embarrassed himself throughout all this.
I'm saying the one he did yesterday in particular. If you watch it, the level of apologetic, I'm sorry, everyone, I didn't realize it would come to this. That was the undertone to the whole affair, was just so transparent that it did look like the administration would eventually blink and at least some cooler heads would prevail. Frankly, watching that Besant interview made me happier buying risk yesterday because it looked like the facade was melting.
We are halfway between, effectively at the underside of the range here. If you're talking about SPY, where we bounced from starting in mid-March, March 12th, prior to the breakdown from Liberation Day, you still have IVRs that are in their mid-50s here. The lows are probably in for the foreseeable future. Whether or not that means we're going back to the highs is a completely different question. But while there's still volatility to harvest, there's a good, at least I think there's a decent opportunity for traders to examine directionally neutral strategies, short iron condors. I prefer short iron condors to short strangles personally because of the defined risk nature of them. But this feels like that kind of environment that we should be playing in. I don't think we're out of the woods by any stretch of the imagination with equities, right? It's probably going to be choppy here moving forward. Disciplined long-term dollar cost averaging, right? Earlier this week, Ilya, if you have a very different mindset in your trading portfolio versus your long-term investing portfolio. Long-term investing is just accumulation. You buy stuff, you put it in there, you stash it away. You don't plan on touching it. Your 401k, your Roth IRA, those type of things. This is a great environment to get down in. Monday, we talked about what we'd go on for discounts, right? The Metas of the world, the Googles of the world. You were looking at IXUS. We were talking about, Dylan, the second generation AI names. IXUS is up 7.39% today. Meta here is up 14.8% today. The AI super cycle isn't over, Mr. Radigan. We still got another fight left in us. I think we can trade around the lows now. Trump showed us his cards. The Trump put is real. It's not in SPY.
But would you get? But would you? Where would you sell the rally as much as you wait to buy a dip?
I'm much more confident selling against the lows in TLT than I am in SPY. But on dips around this trade situation moving forward, even if the market digests the effective tariff rates and says, hold on a second, tomorrow we get a little bit of a pullback, I think we have enough of a low where our wedding crashers trading mindset, right? Selling put spreads against the low. I don't necessarily think you're going to rally. I just think that you're not going to fall. That's still the right way to do this. I'm not convinced on the bull side from here after 12%, right? Directionally neutral from here, maybe buy the dip on a pullback, but if you get a further rip from here, it's an opportunity to sell. I don't think you need to be directionally married yet, even if you came into today like this. But the bond story is really the most significant part of all this. Last night, Ilya, it was melting down. I'm in futures, and I'm out far enough where there's not a great ton of liquidity in ZB futures at 1 o'clock in the morning Eastern time, and this thing is eating dirt. But we do stage a turnaround. It seems overnight that we have a Japanese fund or two that blows up regarding the basis trade. Basis trade is a fun trade. If you're really looking to make money, free money when it's easy out there, if you're an institutional investor, you work at a hedge fund, you go into the market, you buy the cash futures, the cash bond, and you also then sell the futures contract, the synthetic futures contract, right? Why are you doing this? You're trying to capture the differential. Less trade costs, less transaction costs. They have to converge. So if you hold the cash bond position until expiration day and you're short the futures, they will converge at a point and you're guaranteed to make the difference. It's called the basis trade. You lever that up 50, 100, 200 times, you're starting to print money in good markets. 2 times in history has this broken down before. Long-term capital management, 1998, during 2020, March of 2020 during COVID. There was just no liquidity in the system. It's drying up. It looked like it was drying up overnight last night. The basis trade was blowing out for people. You see 10-year, 20-year swap rates in the interbank market moving to some of the most extreme levels on a one-day basis in history. And it spills over with these Japanese funds that are ultimately being liquidated overseas. We get through our trading hours here. ZB is back up to 115 and 12. Casually where we were at the end of March, like nothing's happened. Same thing for ZN. This is now only a 0.62% loss on the session, but hey, we're holding up against former support here. I feel as compelled as ever, given where Trump just tapped out. If you are a bond trader in these markets, if you're trading TLT, ZN, ZB, the swing lows that we just established today are the Trump administration's pain point. They want to bring down yields. They want to bring down housing costs. In the midst of a tariff war, you're going to have to bring down mortgage rates. But they want to bring down the cost of financing a car. They want to bring down revolving credit rates, like for consumer credit cards. You're going to need lower rates across the curve. And the second we see bonds cross that threshold of moving out where they were prior to the announcements, bond market rings the bell. Trump himself said it today. The bond market, he's paying attention to the bond market. And he says the bond market is now beautiful again in typical Trump parlance. That's your line in the sand. Today's lows in ZN and ZB, you can I will be trading around them like they are as good as gold. They're going to be rock walls for me. If we're below them, obviously none of this matters. But that to me is our defined level of risk. That's the tap out point. The Trump put is in TLT, not SPY, this administration. Ilya.
I'm long. I mean,
long the bond.
I'm long TLT verticals. I have quite a bit of duration in them still. And they're probably the closest following to ZB. So if we take a look at ZB here, even the current contract, it was obviously an absolutely insane night. The wick on it looks just crazy. But I think, first of all, there's clearly a pain point for the administration here, to Chris's point. And secondly, even just more near term, if what that was an unwind of the basis trade and a bunch of other things, inherent in it is why that happens in the first place. Why do people freak out? Why do these trades suddenly start to unwind? And Chris, this is the image I was sharing with you earlier. When we look at that insane bond rally or a yield rally, bond sell-off on Monday this week, what we find is that inflation expectations are not what's doing it. It is a massive surge in term premium. That is to say, if you want duration in this market, you got to pay for it. Because nobody has any idea what's going on. There is a ton of uncertainty. If you're going to be borrowing money with any kind of time on it, people want to get paid through the nose for that extra time because of how unhinged and uncertain the environment is. And that then ripples out into failing basis trades and closing hedge funds and all this kind of thing. People panic because the fog is so dense. And the way you see how dense the fog is by looking at the term premium and watching it surge. So then two things. Number one, the term premium unclenches here if the put is really in the bond market, as I think Chris suggests, and as I would agree. Moreover, we have CPI tomorrow, and we can see from the minutes that the Fed just published that they were so concerned about inflation, and we can see that the market is telling them now since the beginning of April, which is obviously after they had the meeting. The net impact of the tariffs on inflation is negative because the growth hit outweighs the price adjustment. Fed knows this now. It can see it. They have their answer. If the FOMC minutes tee up the question, the price action since has given the answer. The Fed no longer has a barrier to cutting rates. Their barrier has fallen away in practice. They told you what it was, and you can now look and say, is it still there like it was when they were talking? Nope, it's gone. So you get a soft CPI number, and the expectation is we're going to get the first 3% core reading since 2021. You get even a little softer. And, I mean, the Fed is already priced in for a cut in May.
We want a lot softer because if the tariffs do what they're going to do, they're still going to lead to inflation jumping up, right? I mean, that's the whole thing about this.
The markets have looked through it already.
Today feels.
At least that's what the break-even rates are telling us.
Well, yeah, I mean, that's the funny thing. If you look at different measures of inflation expectations, Dylan, there's a very clear cutoff. That cutoff seems to be like December 2026. The market seems to be convinced that no matter what happens between now and December 2026, we're going into a different regime thereafter. Yeah, the market's up 12% today, and the S&P's up 9.7, and I've read the chat. I'm reading it here. I'm entertained, so I appreciate everyone participating. But people saying that the market's now, 12% today, what do you have to say about tariffs now? We were at 6,200. We were at 6,200 a few weeks ago. What do you hear yourself? We still erased like $8 trillion worth of equity market value. Yields are higher than where they were.
And permanently obliterated credibility.
We've damaged our relationships with our trading partners all over the world, right? We didn't get any respect back out of this. There's a great analogy here. If we're all playing a game of poker and I lose a hand, and in response to that hand that I lost, I take my hand and I swipe it across the table and wipe everyone's chips off. And everyone calms me down and is like, okay, all right, I'm sorry, everyone. I'm sorry I did that. That was unbecoming of me. People are going to treat me differently sitting at that table with them. They're going to have in the back of their mind, okay, when Chris has a losing hand, he's going to start to get angry and he's going to try to flip the table again. They will treat me differently thereafter. They'll also read my emotions differently because they'll see, oh, he's getting angry. He has a bad hand. I better take my chips and protect them because I know what comes next.
And maybe I don't invite him to the next game over at Ilya's house.
That's right.
Because he's a fruit bird.
I mean, that's the other side of this here. Like right now, a lot of countries are relying on us, and we rely on them for various things. It's a nice symbiotic relationship. We're taking the mafia enforcer approach, which is one way to do it. Not my cup of tea, but maybe it's accomplishing something. I don't think, though, people can turn to today's action and say, see, it all worked out. It hasn't worked out yet.
Definitely not.
It hasn't worked out yet. We have a relief valve today, for sure. But the effective tariff rate now at the end of today is higher than when it started this morning at 12:01 a.m., when all of the tariffs went into effect. And so if we're talking now, listen, the goods components manufacturers, all those small manufacturers, all the layoffs that were coming, that is not going to happen immediately. Those that are relying on China have a real problem on their hands now. But because we're not cornering out Thailand, Malaysia, India, Vietnam, right, because we're not closing off the entirety of the supply chain, there is an opportunity now to find new sources. The fallout is not going to be as severe as it otherwise may have been. I'm not ringing the alarm bells I was ringing this morning or over the past week on Twitter anymore because we're just not in that world. But we're also not out of the woods. Fed's not going to cut in this environment. If the Treasury market starts functioning appropriately again, we don't see this basis trade blowout rankling things in overnight hours. Credit markets aren't blowing up. The Fed's not going to come in with support. This modeling today, we can simply take the CPI basket. We look at the imported goods component of that basket. We take all the countries out of that basket and we tinker with the new tariff rates one by one. China 125, Canada, Mexico 25, this country 10, that country 10, yada, yada, yada. Shove it all back in, compress it. Where's inflation going to rise to over the next year? Ceteris paribus, all else held equal. You're now looking at a 1.8% year-over-year rise in inflation from where we are right now. That brings headline CPI to 4.4% at a minimum. So we're not out of the woods right now. If you made money in the long side, again, this is a speed dating market. We're not looking to marry it. We're not looking to marry anyone here. Ilya, you speed dated this week.
Oh, very much so.
And look, you're feeling like a king. Because you're taking your
feeling much better than I did when I dipped my toe in. I'll tell you that much.
It is still bizarre world that you were pressing the longs harder and faster before I was today. Doesn't make a lot of sense to me. So Dylan, what's the next move here, though? I mean, like, we know that there are economic realities on the ground that still exist. The second Great Depression isn't staring us down, but we still have rocky seas ahead.
Yeah, I mean, boy, I think the safest assumption is that the China tariffs also won't happen. So because the same way Iranian retaliation in Israel is predictably theatrical and not lethal.
Sorry, Trump just said he didn't realize that the tariff pause would have that impact.
Oh, great.
Come on, man.
Great.
That the Trump withdrawal of whatever threats is basically as certain as the non-lethality of an Iranian missile attack. And so the only factors in place are, one, America's run by an erratic and unreliable leader who has absurd tendencies towards extreme statements and takes pleasure from making the whole world bow to his will. All of the growth will slow down and confidence will be reduced as a result of that fact. But also that Amazon, which is probably the most directly related to the China trade, like if Trump is going to shut all trade with China, that would, I would think, would hurt Amazon. I would think that would hurt Apple. There's probably a decent list of 10 companies, Nike in Vietnam, right? I mean, I don't know, maybe Vietnam was one of the friendly and subservient nations that it was given a stay of execution today. I don't know. But I would buy the names that benefit from when Trump withdraws his China tariff threats. And I would still continue to harbor into the defense of the consumer discretionary telecom, all that jazz. And it sounds like you want to own the bond.
I mean,
because it sounds like rates are going to come back in for a minute because now the bond market has established primacy over Donald Trump. And so if the bond market has established primacy over Donald Trump, it does clear a pathway for higher bonds and lower rates, maybe.
And so we're back to regular recession.
Right.
Just regular recession. Not a
regular
meltdown.
recession caused by American policymaking.
Yes. Yeah, so we're in a better position than we were this morning. In a sense. We're still in a much worse position than we were a week ago.
Oh, 100%. 100%. We are now going into a regular recession whereby if the bond market has a conniption, there will be a reprieve, but the growth hit will not be countervailed. The certainty
but also
will
the tariffs
not be
won't
had.
happen. Right.
Well, maybe they will, maybe they won't. We're going to keep doing the great and powerful tariff show probably for the next 3 years. And so the markets ultimately will have the recession that they're going to have because there's no certainty and businesses don't spend money if they don't know what they're buying.
Trump says that he didn't realize the market impact here. Understandable. Self-proclaimed smartest man in the world. Bond market's difficult to get. That's why so many of us are figuring it out. But legitimately, I was very fearful of what would happen to supply chains. Like I know this. I shared this with Tony yesterday. He's complaining about people being multiple tariff and COVID experts at the same time. I happen to sit at the nexus of that by virtue of trying to start a manufacturing startup during COVID. So I'm intimately familiar with the import-export laws of this country and what needed to be tailored to actually build the certified masks in order to get them out the door into hospitals. We are away from the worst case scenario of the entire economy facing a sudden stop. That is a huge relief. And if you were shorting the stock market or the bond market for the past week, you can say thank you to yourself for saving the economy. Bond vigilante saved the day. So if you've been making money short SPY, TLT, if you're making short ES or ZB, we have to thank you for turning the ship around.
I know I did my bit.
I'm not joking. I mean that very sincerely. If the market didn't punish Trump for this wouldn't have come to some sort of change of direction today. So from the bottom of my heart, because I've talked to all the small businesses in town who are like, yeah, we have like 3, 4 weeks, 6 weeks of working capital. And like if the tariffs go into effect, we have to shut down. There's no way to source our supplies for the hardware store. Right? That business is going to stay open. Thank you for shorting the heck out of this market and keeping small businesses in America open. And thank you for giving us a defined level to trade around here moving forward, because we know where the tap-out point is for the Trump administration now. The Trump put in TLT hereby resides at 85.57. I will be trading around that level. I will be trading around that level for the rest of the year like it's ironclad until it breaks.
I mean, I took the news today to say I know that ZB looks bad right now and TLT does, and I'm a bit upside down on these longs, but I've just been told to stay long. So, okay, I will until I am told otherwise.
Dylan, what's the play now going into tomorrow?
Come on. I mean, the madman play is to get short.
I might do that, just not yet.
But it would be awfully soon to do that, though. Gosh,
Yes.
The madman play is to get short. The prudent man's play is to stand by and watch a minute. And the sort of moderately risk-seeking fellow might buy some bonds. How about that?
Apple has a real problem on its hand here, folks. Apple's up 15.3% today, which is just wonderful. Love that. What's not wonderful about this is that if Apple wants to shift its supply chains immediately, it's probably going to push up the cost of an iPhone to $3,500. Let them eat cake, of course. No one's entitled to iPhones. Sure, okay. This is America. People and their definition of freedom is buying stuff. You want to work so you have excess money so that you can use it however you want. For many people, for the median voter in this country, that's what freedom is. That I can do my job and that I can do whatever the heck I want with the money that I've just earned. I want to go paragliding. I want to go to a theater. I want to go on vacation. I want to buy new power tools for my wood shop. So be it. When inflation's too high and the cost of living goes up too much, people can't buy their crap. Me included. Makes them angry. Apple has a problem coming down the pipeline because we're not going to be able to buy the Apple crap. I have half a mind right now to go out and do I need a new computer? Yeah. Does my wife? Yes. She's at work right now, so she's not listening to this, but should I go buy her a MacBook today? They still have them in stock at the nearby mall. All that's going to change. So there are real supply chain functions that are going through here. Today is a relief rally among relief rallies. I would also remind people that we have seen some very, 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 very vicious bear market rallies over time. Bear market rallies have been fast and furious. We've seen them evolve from all sorts of places and circumstances. Biggest bear market rallies of all time in the S&P 500. And I have to pull this up here. There we have it. Biggest bear market rallies of all time. Financial crisis. From November 2008, you get a rally of nearly 25% from the low, right around the Troubled Asset Relief Program.
I have a particular scar from that one. It nearly gave me a heart attack because I was long dollars, and of course that was basically just inverse of the stock market. My God, that one was bad.
.com bubble, summer 2001. You have a 20% rally in the NASDAQ. You got a 20% rally immediately after Black Market, the Black Monday crash in 1987. During the oil shock, you have a 15% rally off the low. During the China slowdown, there was initially a 20% rally before continuing on to new lows. The point is that the stock market is going to find relief valves or can kind of clear the deck of risk and reset the table. And we've reset the table here today. We've cleared out the risk of the worst case scenario being priced in two markets now. It raises the question, as Nick and Mike were talking about today, though, what happens after a rate cut? The Federal Reserve, I'm hard-pressed to think it would cut rates given the inflation outlook. But if it is cutting rates due to the inflation outlook, you're talking about rate cuts for recession reasons. And rate cuts for recession reasons aren't good. Since the early 1980s, when the Fed has done these recession rate cuts, the average return of the S&P 500 1 month out is minus 2.2%, 3 months out minus 14.3%, 6 months out minus 12.8%, and 12 months out minus 11.6%. Got to be really careful what we wish for here. Unless you're in gold and silver, because my goodness, I'm going to definitely talk up my book here. The U.S. is an unworthy counterparty. It is an untrustworthy counterparty. It is flippant. It is capricious. If this was not my home country and I was watching this from the outside, I would be dunking on it so hard. This is not serious policy led by serious people. The excuses being trotted out don't make any sense. Bessent told us today he went down to Florida on Sunday and he said that it has nothing to do with the bond market reaction. Trump turns around and tells us that the market was getting too yippy and that the bond market is really beautiful. So Bessent, like Kevin Hassett, has no credibility whatsoever. Peter Navarro, I like when he talks because I think the interactions that him and Elon Musk are having are quite entertaining, right?
Also, Peter Navarro is consistent.
It's like two of the worst people you know are fighting. I'll watch.
Yeah.
With gold,
I disagree with 100% of everything Peter Navarro says on economic policy matters, but at least he's consistent.
Yeah, actually, Dylan, speaking of consistency here, I've seen many people in the chat say this too. Let's just go to the heart of the matter here. Intellectual consistency is very important to me. Didn't we just have a whole round of DEI hires in academia get kicked out of their jobs because of plagiarism? Peter Navarro is a guy who plagiarized, made up sources. He writes Ron Vara in all of his books as a source. It's just his own name, an anagram for his own name. Okay, we've known this for years. He's still held in high grace. The guy is a joke. He's a clown. Elon Musk is 100% right here. The fact that he's held up in high regard when there was just all these get rid of all the plagiarists, right, in academia, and Peter Navarro ran as an anti-growth Democrat in San Diego and lost twice. Like, this guy's a serial loser. Why are we taking any ideas from this guy whatsoever? And now,
because he wrote a book. Because he wrote a book that was entitled "Death by China."
How did he get into Trump's orbit, by the way? Oh yeah,
because they Googled for the book because Trump liked the book title on Amazon. He thought it was a cool name.
And that's
so
why
they brought him in because he wrote a book with a cool name, and that's what's going on.
That's why gold's so good throughout all this. Last few days were rough, but we're away from the edge now where people are selling everything nailed to the floor to raise capital. In a world with the U.S. behaving as it's behaving right now as an unreliable counterparty at the federal level, do you feel better allocating your incremental unit of currency as a reserve into U.S. dollars right now, where trade relationships and capital flows can move on a whim? Or do you want to put it into something more stable, a little bit sturdier, something that has legacy, something that you can pass on to your kids? Gold's looking pretty good here.
What? You running a late night coin ad on me here? A little insomniac's delight, a little gold coin action at 2 a.m.
Right, yeah. It's like on Comedy Central after the Girls Gone Wild tapes, right? Like it's the remember those commercials in the 2000s?
Pass it on to your children.
Right.
Now it's time for the gold coins and various experimental collectibles.
But I mean, I think the headline, regardless, I mean, the Trump headlines are not going to change. He is what he is. They are what they are. But it was a triumph of the bond market. And
the triumph of the bond market.
That would be the newspaper headline for tomorrow. If I'm running the Wall Street Journal, I run the bond market as a lead, and then the hope is that the bond market is so dominant that it reduces Trump and his merry band of fools to a distraction as opposed to a credible threat to the global economy. Because basically they're now penned in. I know I'm saying this the last minute of the show, but your best case is that the bond market has fenced them in and marginalized them to the fools that they are. And that as a result, the market may normalize. That would be the other sort of side of this whole thing.
God bless the bond vigilantes. With that, overtime is out of time for this Wednesday, April 9th, 2025. We'll be back tomorrow, same time, same place here on Tasty Live, right after last call, 4 p.m. Eastern, 3 Central. So for Ilya Spivak in San Francisco, Dylan Radigan, Milan, I've been Chris Vecchio in New York. Thanks for joining us again today. It's been a wild week. We'll catch you later. But stick around. Ilya is back. He's here for Macro Money coming up next on Tasty Live.
See you there, everybody.
If you missed the live show, here's our cherry on top weekly recap.
I had the what do you call the hot girls dinner?
Oh, you had girl dinner.
Cheese plate?
No.
Popcorn and wine?
Crackers?
I went snorkeling.
You went snorkeling?
But I said the last time I went snorkeling.
And the fact that you've ever been snorkeling is pretty amazing.
That it also implies a future time that you will be snorkeling, right? Not because you didn't say the only time I went snorkeling. You said the last.
The last time. It kind of has the implication.
What did you say? The fact that I've ever been snorkeling is amazing?
Yeah.
Why?
Because she studies physics and it's not supposed to work.
It just doesn't, yeah.
Wait, you're going to Vegas?
I am going to Vegas, yeah.
Ooh, for what? For just funsies?
For my birthday.
Oh, wait, I didn't know it was your birthday this weekend?
Yeah.
Oh, happy birthday.
Thank you.
I didn't know you were an Aries.
I am an Aries.
Yeah, that kind of tracks.
Something. What is your sign?
I'm an Aquarius.
Aquarius?
I'm Aquarius, yeah. Tom's a Pisces.
Pisces.
Yeah.
That makes a lot of sense.
It does.
Yeah.
It really does.
That kind of tracks.
I don't even know what that means. Whatever.
I think it means you like fish.
What happened, girl, during last call?
I lost my
You want to talk about it?
I lost my beret.
You didn't lose it.
I found it.
So you got.
I'm thinking of getting rid of it.
Oh, new look?
I'm thinking of the new look.
You should do a faux hawk.
Oh,
What is
I think you nailed it, Vanessa. I don't know.
No,
What is-
cornrows.
I could see rocking some cornrows.
Yes, cornrows.
I think you should go to Flavortown and just get the Guy Fieri spikes.
Boom, platinum tips.
Platinum, yep.
Is it true? Did you skip the beret yesterday?
On the clothes.
Oh, it looked like it looked like a decrepit old grandmother. It was so gross.
It's like that old monster from Tales from the Crypt.
Get the full scoop by checking out the archives at tastylive.com.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and Tasty Live web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Dear Karen, thank you so much for the relationship advice. Of course, since you met your husband in high school, I should obviously just go back to high school. Can't wait to win the Nobel Prize for my development of a time machine. Signed, Regina.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
You're mistaking me for someone who cares.
From the smart mouths at Tasty Live.
I don't know how to do magic, but I do have a sense of how to use magic to steal money from the taxpayer. First, you need to take off anything that makes you look like a magician. That's key, Alex. The critical thing is to look like you're just a man in a suit trying to make a living. Goldman Sachs pulled off the amazing trick of making $3 billion in 3 months' time while the entire financial system collapses, foreclosures are at a record, and unemployment skyrockets, and the US dollar collapses. Shall we begin?
thefacebook.com. Mark, if somebody was to put the question to you about the magnitude of what you think you've launched, how big do you think your product or your service is?
Well, it's impossible to tell.
You said something interesting, which is not within their economic means. I don't know that their economic means should take precedent over public interest.
Welcome back. Here's a story to add to your bailout rage. It turns out we weren't told the entire truth about the banks. Honestly, you're probably not even hugely surprised by that. That's your plan for financial reform, printing presses and accounting fraud. And it's happening at the expense of you, me, and every future person in this country because of the money machine that the bankers have running to pay off our politicians. As long as you can risk as much money as you want and pay yourself for all the upside and stick the downside with the taxpayer, human nature will just leave them to screw everybody in America for as long as it's legal to do so.
Remember, it got so bad in Egypt that there was a direct correlation between the growth in the GDP and the deterioration in the quality of life of the people because the people at the top were making their money at the expense of everybody else. It's connected. I'm not here to talk about plans to deal with this till 2017. I'm saying we've got a real problem, and I'm tired of Republicans and Democrats who either want Republicans who want to burn the place to the ground, and Democrats, with all due respect, who want to offer a plan that gets it through their end of their second term of their presidency, and then screws me and my kids when it's over. And until we do that, we have to deal with the extraction that is at foot. It is the reason the financial markets are behaving the way they're behaving. That is a mathematical fact. This is not some opinion. This is a mathematical fact.
It was a great show. It was very inspirational and motivating.
I feel like you got to know each of the traders a lot better on a personal level. It was awesome.
This is my 10th or 11th live event. I thought the math would be really complicated and it wasn't, and then it just made sense.
They've opened my eyes to many different strategies.
And I realized there's a reasoning and strategic planning that you could do to be successful. I love all you guys.
Mystical reading of the tape. More trade ideas.
Sweet. Still can't believe the Wi-Fi we get up here.
The trade ideas on dough are as good and as true as my honored blade bid ask, with whose edge I gutted 100 marauding conformerons.
To the fearful bid ask.
With this blade, I pried open the gross, smelly lair of the Hydropons Hilda.
I remember that. You were covered in nasty snakes for like over an hour.
And don't forget how I used it to stab the snarling maw of the hideous Minotaur Dibitrix, his putrid breath filling my nostrils. But still, even with these thrilling conquests, these victories that have passed into myth across distant lands, I hereby deem the trade ideas on dough even more powerful.
Ah! I mean, you probably still need a sword.
Yeah. Didn't think that one through.
It feels good to get smart. Get even smarter with the ultimate how-to guide. Learn 31 different option strategies, covered calls, iron condors, jade lizards. Become a trading mastermind. Get the guide at tastylive.com/guide.
What a day this was. I'm sure most everyone has seen the headlines at this point, but man, do we have a tariff news update today. Markets rip higher as we get a stay of execution on the worst of the reciprocal tariff plan, or do we? That's where we find ourselves here on Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. We're going to unpack what that was just now in the financial markets and take a look at what it might mean once the speculative dust settles and the spotlight turns back to what this story is really all about, the U.S. economy and what these tariffs might be expected to do and why the markets have been upset about them in the first place. We, of course, are going to get exactly that sort of a check on the environment as we get U.S. inflation data coming at us in less than 24 hours. So let's break this down. We started off this week talking about where the markets landed with last week's blistering sell-off. And we noted, as the week was getting started, that the markets stopped at a very auspicious spot. And that in this spot, you were probably as the markets refuse to break past it on Monday, you might see some kind of a recoiling because it seemed as though the news had not improved, but the market had stopped selling. And indeed, right on cue, this ends up being a place where the markets turn. Let's zoom in here on the active contract for the S&P 500. This is the ES future for June, and this is the daily chart. This was a weekly one right here. So here we can see where we started the week and where we are today. Here we can see where we started the week and that stalling, that stop in the sell-off that we were just mentioning. And then, of course, today we rush back higher. No, we stop right at the underside of the preceding leg down. So just at the spot where we get Liberation Day. That's this right here. This is where the sell-off really garners steam last week. And here's the preceding leg of the initial decline, where we find a little bit of a reprieve before Liberation Day, when, of course, the tariff plan is unveiled, and the market clearly has a hard time digesting it. So, what to make of all of this? Well, the rally comes as the president comes out and says that reciprocal tariffs, which were supposed to get introduced today into practice with all of their varied rates across many economies, will not, in fact, go forward as such. It will go forward, but only with a baseline 10% tariff rate for all trading partners. But China, since it has already retaliated to the president's actions, will instead face a 125% tariff, which is an increase, and at this point, these numbers are hovering somewhere in the realm of the mythological. At this point, we might as well say it'll be a 500% tariff, or a tariff rate of a bajillion and one. It looks very much like now the stage is being massaged to some kind of negotiation, and clearly those countries that didn't retaliate, it is being shown, see reprieves occur. And so the upshot is that the tariff threat has been watered down some, but more importantly, that the amount of consternation in markets has been enough that there is, in fact, a reaction function from the White House. We've heard all through this decline last week and going into this week that the weakness in the stock market was going to be overlooked, that this was par for the course for implementing this new policy, and that the dust would settle and things would be okay. Today, we see that the level of pain grew too much, and we get a step back that ultimately speculative interest likes very much. And so we get this dramatic rally, and that makes sense. But where does this leave us? Well, the place where this move lands seems very appropriate to start that discussion. Again, we land not with a new high, but with a volatile reversal that nevertheless leaves the breakdown intact. We retest the underside of the preceding range. We fail to make it over. Does that mean we won't make it over necessarily? Well, of course not. But what we still see here is a trend lower. Lower lows, lower highs. And then we start to consider the upshot. Why didn't the markets sell off on tariff news in November when they knew that some sort of tariff regime was coming? That was here. Markets were not upset here. Why not? Because it's not the tariffs they're upset about. It is the uncertainty with which fiscal policy, as epitomized by the tariffs, has been put forward. And so it is not until mid-February, late February, when business confidence surveys like the PMIs, consumer confidence surveys like the one from the University of Michigan and the one from the Conference Board start showing that all of this policy uncertainty is starting to end up with lower economic growth expectations, weaker sentiment, and decelerating growth. It is not until then that the markets start to care, which is here. And so it is the uncertainty of execution that really seems to bother investors, not the trajectory of the policy goal as such. And so with that in mind, we look at what today's announcement brought, and it was another U-turn in a policy that looks no more predictable now than it did yesterday. Moreover, what we find is that we still have the same basic architecture of the economy before or after this. Consider, this is the GDP Nowcast from the Atlanta Fed. And again, as we've said a lot here on the show, it's not about the level. It's not about whether the economy shrinks somewhere between 0 and 1% if you discount the impact of gold imports recently, or between 2 and 3% if you don't discount them. That's not really what's important here. These nowcasts take in information sometimes daily, sometimes every several days, depending on when the economic data comes out. We will surely have an update after this incoming batch of data this week, but it's not the absolute levels that matter. Those will change as that data is factored into the model. It is the direction of the data. And we can see here clearly from February, about the middle of February, right here, the data begins to aggressively deteriorate to show not that the tariff policy is negatively impacting things, but that uncertainty about fiscal policy, including tariffs, is putting a dampener on economic activity. And that's why the sell-off kicks off here and not earlier. And with today's announcement, that uncertainty has not been in any way relieved. Consider what happened on Liberation Day itself and this upward wick on the S&P. Why does that happen? Because initially, when the president comes into the Rose Garden and says we're going to have a 10% broad tariff, market actually likes it. It is not until he comes up with the foam board with the multitude disparate rates country by country that things become not to investors' liking. Because if there is a blanket tariff, well, then at least it's forecastable. And that's all that the markets seem to want. A runway and a pathway for businesses to follow whereby uncertainty can unclench, whatever the outcome. But that is not what we have here. What we have is another sort of situation where we seem to be moving the goalposts frequently, and businesses and consumers are going to have a hard time extrapolating forward. And of course, by extension, likewise, the markets. And so once the dust settles on the speculative element of this, we are left with this. An economy that has started to significantly decelerate because of uncertainty. And while policy expectations have meaningfully unclenched as well. As of yesterday, the first rate cut was already on the menu for May. It is now back out to about July to be fully discounted. Moreover, the amount of rate cuts has significantly come down. But if we actually look at the total tally, we can see here yesterday into today, it is barely changed. In fact, it's been barely changed for about a week, where the markets are looking for essentially 5 rate cuts with some room for error to the dovish side between now and the end of next year. What's changed is that yesterday and the day before and toward the end of last week, the markets saw many more rate cuts coming in 2025, 4 of them, and maybe between 1 and 2 next year. Whereas now we have 3 coming this year, so 1 less, and 2 with some optionality for a 3rd next year. In other words, all the markets have done as a consequence of this announcement is take 4 rate cuts for this year and 2 for next. 1 and 2, let's say. And moved the cut back by a year. And said it's not 4 this year, it's 3. It's not 2 or 3 next year. It's 1 or 2. And so the makeup has ostensibly moved to a somewhat less urgent setting. But the upshot that we need 125 plus basis points, 125 basis points would be 5 cuts, and again with a little bit of optionality for a 6th. That's what we need, whether you sequence it this way or that. But the total has largely remained unchanged, and most importantly, that total is greater than what the Fed has in mind. The Fed forecasted in December and then reaffirmed at its latest meeting in March from 4.4 on the headline rate down to 3.9 this year. That's 50 basis points. Out to 3.4 the following year. That's another 50 basis points. That's 100 basis points between now and the end of next year. The markets are obviously 1 rate hike or 1 rate cut and some change to the dovish side of that. And that has not been altered. It's just now the markets see more cuts later versus sooner. Moreover, when we get the minutes from that March meeting today, amid all of the uncertainty and amid all of the swings back and forth in stock markets around the president's announcement, what we find is that the mood for policymakers in March mainly was a troubled concern with inflation. We have here growing concern about inflation persistence amid trade policy uncertainty. Almost all participants viewed risks tilted to the upside for inflation and down for employment, with the outlook for real GDP growth weaker than January. And of course, participants linked all of this and said participants observed that the inflationary effects from tariffs could be more persistent than projected. In other words, the inaction we've had from Fed officials around all of this speaks to their concern that the tariffs might be bigger and stickier in their upward in their upward impetus on price than they were anticipating. But of course, the markets have taken it a step further. What those Fed minutes tell us is they tell us what the Fed was concerned about and why they are not cutting rates, or at least signaling that they're ready. But what the markets are saying is that the hit to growth from these tariffs will be so great that their impact will be disinflationary. That is to say, the tariffs will raise consumer prices such that consumption takes a hit, investment takes a hit, growth overall is dragged lower. And the hit to demand is so severe that inflation actually goes down because whatever uplift from the tariffs is more than overwhelmed by the pull that weak demand and recession have going the other way. And so if the Fed minutes establish for us why the Fed isn't cutting as of March 19th, this collapse in break-even rates since early April is telling us the Fed's wall of worry need not be there, because the market is telling them that inflation expectations as a consequence of this are going down and not up. With that, of course, the incoming inflation report becomes absolutely critical. We're expected to see a downtick, 2.6% on the headline figure and 3% on the core. For the headline, that would be the lowest since October. For the core, that'd be the first time we see a 3% at the figure reading there since April 2021. So this is significant disinflation being signaled here. Moreover, if we look at the dynamics and the trends that the Fed likes to watch here, we can see that if we get another downtick, it would mark a third consecutive month after January and February that the trend in annualizing 3-month and 6-month changes in CPI might imply. So we see here the sort of internal dynamics of where inflation is going. What the Fed likes to do is take the 3-month change and annualize it, both for the headline and the core, and kind of get a sense of the dynamics. And what we see here is for 2 months now, the annualized 3-month rate, headline and core, lower. 6-month rate, core, lower. Headline 6-month looks about the same, but certainly not rising. In other words, at the start of this year, we start to see inflation begin to roll over downward, and this would be a third consecutive month of seeing that, even, again, as these break-even rates are telling us the inflation scare is leading to lower inflation expectations as a consequence of the tariffs, not the other way around. So the barriers to the Fed moving from here, 100 basis points, to here, a more dovish setting where the market is pulling them, might well be breaking down. And if we were to get a CPI report that endorses that, we might certainly see evidence as much. Now, of course, what that would imply, as we've seen over the recent months, is that the economic hit is already underway, hence the disinflation. We've seen that it has come mainly over the past several months at the expense of core services, which is where growth has been and what has led to the U.S. economy outperforming as well as it did last year. And so the upshot here may well be that this rally, while certainly a breath of relief for sentiment, is only that. And what it is an opportunity to get back short, looking for a more orderly move like this to reflect the economic reality of what's occurring, because that hasn't changed, even though the sentiment piece might have become less vicious. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'll be back in just 30 minutes time here for the Price of Truth with Victor Jones. I'm back with Chris for Futures Power Hour on Friday. Back with Victor and Tom for First Call on Sunday. Writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for joining. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Good luck.
I distinctly remember getting an email from Tasty that Lookback had just been released, and I was doing the most laborious back test on the face of the earth before that. And I did 2 or 3, and I saw how quick it was, and I saw how quick the data was, and basically instantaneously, like, I was hooked. I'd always seen all the stuff on Tasty Live with all the data and all the value I thought that bring, and then it was all of a sudden I could control that and basically make my own segment for myself of what fit. And that democratization technology, I think, drastically changed not only the landscape of what's out there, but drastically changed my ability to learn at such an insane rate. And that's kind of when I developed a little bit more of my own path. I was like, this is the type of trade I exactly want to see, or I'd get some type of inspiration from Tasty Live to look at that. And that's when my consistency went from like 1 to 30, and I haven't had an unprofitable quarter since.
Here's what your buddies mean when they say to catch a falling knife. Ever seen a stock make a huge move lower, and maybe you had the thought, I'm gonna buy that stock, but then it just keeps going down? That's a falling knife. A falling knife is a stock that makes a big move lower and then continues to move lower. The contrarian trader has the idea to go long that stock in the hopes for a bounce, catching that falling knife. But you gotta be careful trying to catch those falling knives. Mike, what does it mean to be assigned?
When you are assigned, you are ultimately short an option that's in the money, and the counterparty has the ability to exercise that option. So if you are assigned, it means your option, against your will, ultimately, has turned into 100 shares of long or short stock.
What does a green scratch mean?
Ooh, a green scratch refers to stubbornness getting the best of you. And when I say you, I mean me. Green scratch refers to rolling a position, defending a position, and instead of just closing it for less than loss that you're seeing, or maybe a $100 loss, $50 loss, a green scratch is when you close it for maybe a 5-cent winner, 10-cent winner, 15-cent winner. Just the ability to see that green number on your screen and get out in a profitable way as opposed to a loss.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
All right, we're back. Tasty Crypto Show. I'm Ryan Grace, and with me today, of course, Dan Cecilia. And keeping with the trend, Dan, it's Wednesday interview series. So we've been talking to traders recently off of X. We have no stranger to Tasty Crypto. We've done some spaces with him on X before. We got Boss Imp of Strike here today. Boss, welcome to the show.
Thank you, Ryan. Happy to be here. Looking forward to the discussion. I think the market have been exciting, and we have a lot to talk about today.
Yeah, absolutely. Keeping us on our toes. I think everybody probably assumed you'd get some sort of rally, a big bounce at some point in time. Last week has been challenging, I think, to say the least, not just in crypto, but across equities and many different markets. Feeling the pain and volatility at levels that we really haven't seen all that often in history, which makes it fun from a trading perspective for sure. We're going to talk alpha opportunities, on-chain options, your journey a little bit. I think you've got a really interesting story here that I want to dig into. But before we do that, let's just get right into it. How are you thinking about the markets at this stage?
Honestly, today I was talking like in Telegram and I was saying I was expecting a rally either this week or next week because for me it was kind of a bluff. Not a bluff, but like leverage this whole rally, this whole tariff discussion. What's coming is a bit more... it's a bit more of the surprise. We're going to see a rally on equities to some extent. They've been oversold for crypto. It's another story. We've been seeing like a lot of BTC dominance keeping strong. What's going to be like the risk appetite of with the ETF, with the institution in the US notably. We have been all a bit disappointed with what came after Trump, price action wise, but there have been in the background a lot of improvement. And I don't know, personally I've been seeing a lot of people saying bring Gensler back, etc., but I think they don't see how the regulation is moving and we're getting an adequate regulatory framework. There is a lot of lawsuits that were dropped, there were nonsense that were dropped. We're going to get like a really nice sandbox to potentially play, and it's the moment for builders to come and to build and to get us like those new use cases and to integrate them and to take potentially crypto to mass adoption. So we should be excited about that, not just about price action. It's more about like the whole like environment and how with the adequate policy we can push crypto overall.
Yeah, that's what I'm interested in myself, is just to see how this evolves. You know, do you get this kind of DeFi renaissance or DeFi 2.0 given a shifting regulatory backdrop? But in no way am I advocating for bring Gensler back. I have not seen that, but that made me chuckle.
No, I've seen it
bit.
in groups. It's memes, but people are really like traumatized by the recent price action.
Did you expect the move today? Did you expect kind of this pause or this like relief that we saw today? How were you positioned for it?
I wasn't expecting it today necessarily. Like last week, I think Friday, I bought some butterfly for Monday and for Friday, and the Monday one I sold at a small loss. And the one for Friday was, I think it was on QQQ. It was 450, 460, 470 butterfly. And now QQQ shot to 467, I think, something like that. So I closed that one and I opened the one a little bit higher because I think the move is going to continue. But yeah, I was expecting. So I was positioning for this explosive rally, especially after what happened yesterday. I knew like the moment we were going to get a relief, we're going to get harder. I wasn't expecting it today. I wanted to buy spreads and to get exposure to that if we went a little bit more down. I was waiting a bit. As the week passed, I was most thinking the next week. But yeah, you never know, and it happened today. But I expect continuation, so I positioned a bit for it, but we'll see.
Yeah, I would think the same. I mean, after just the size of the move here today, obviously volatility is still a bit elevated. Maybe we see some follow through. Don't necessarily think we're out of the woods just yet. I mean, we got a 90-day pause, and I think the big relief is obviously on the back of reciprocal tariffs across the board going to 10% versus some of the higher numbers that we saw on that big, I don't know what you call it, flashcard or poster that was displayed on Liberation Day. But there's still the 125% increase, or the increase to the rate of 125% now on China. So we'll see how they respond.
But that's something to put it in perspective. The US, I think, imports around 440 billion from China and they export 120 billion. So I think like that's kind of unbalanced, and if they cannot just retaliate with tariff, they need to negotiate, and once those supply chain move from China, they're sticky. They won't come back to China necessarily as fast as and giving how Trump, like President Trump, focus is against China, some country may move from China for like, I don't know, Vietnam or Philippines or whatever, and don't come back. So China has to be afraid of that, I think.
Yeah, absolutely. I think you probably have a scenario where the U.S. likely has the upper hand here. But want to switch gears. Dan told me earlier today that he saw on Twitter that you had mentioned you took a wallet from, let's say, around 1 ETH to some pretty sizable gains. Everyone should go and follow you on X, first of all, or on Twitter, whatever we call it nowadays, at BossImp75, up there on the screen. But can you talk us through, I mean, you don't have to give us all the details, obviously, but can you talk us through how you did that? How does one in crypto, where you can have sizable gains, obviously, but kind of any approach that you took that was able to get you to those levels? Can you shed some light on that?
Over risk and hope everything goes right. No, but like for that specific wallet, it was one wallet. Like I aped into some Google form project. I did a fresh wallet with 1 ETH, and it kind of 3x'd it, I think, or 5x'd it. I don't remember. It was back in April or March 2024, and I kept using that wallet, and I kept it was when it was the 404 meta, like those NFT mixed with liquidity, and I kept just buying that meta, buying the dips, making 50%, 2x on some dips when honestly, this year on chain, if you do DGM stuff, it means high risk, following the meta. We had a few meta this year. I'm not talking about Solana because I suck on Solana, but I'm talking about like Base, ETH, all the EVM chains. If you had 2 months this year or 3 months, it would be like March 2024 and November and December 2024. You trade only when there is high liquidity, high volume, and you have a clear kind of meta on chain, and you just grind the groups, you grind Twitter, you try to get into early into some projects, either early and you can get those big multiples, I don't know, 5, 7, 10x sometimes, or you get into those heated meta when you can buy the dip and hope for a 2.5x, 3x, and really don't watch the volume, and you don't want to be a bag holder. So sometimes you exit early. If you don't feel it, you exit early. You kind of protect your profit. And on the other side, sometimes there is another strategy that I used to some extent is you be patient. There is a lot of, if you find a project you believe in quality-wise, sometimes needs time to for liquidity to redistribute, for people to exit, etc. But I've done a couple of projects that they did 10x. All I had to do is wait 1-2 months, but you have to identify quality and to know the right parameters for that. So don't over risk. Try to trade when there is a lot of liquidity around. So, for example, lately I've not been trading at all on chain because I think you're more likely to give up gains. So you trade when the market is moving, when there is a lot of liquidity, when there is easier to make multiples. And then now I've been trading a bit majors, and I'm going a little bit more on equity because equity is majors are now behaving on equity, behaving like shit coins, basically going up 12% daily. So yeah, I think it's just you have to choose your moment and to get into those groups, to get into follow the meta and follow the liquidity.
Yeah, and on that point, you talk about getting in early projects or just following the meta. Is there anything specifically you do follow? Where do you find alpha?
So before it used to be Discord, I was in a few groups and I would try to get, now I moved to Telegram and I don't like this. Usually I'm a boomer, so I kind of have sometimes trouble to adapt to change, but it took me a few months to get into Telegram bots. Now I've been tracking a little, also some wallets, so mainly Telegram, tracking some wallets, doing some DD. If I see multiple wallets I'm following, buying something, I would kind of DD it a bit more, or it's basically being present. And also in some groups, I tried over time, over years, I met some people, introduced into some groups. Some are paid groups when you have to have an NFT. Some are free groups, and I try to continue the grind and to get into as many. One of my problem is getting information. It's not analyzing information. It's how I get the information. It's always been difficult for me to go to grind Twitter, etc. So I use groups and wallets as proxy for information. Some people are better than me to find information, and I try to exchange that with more knowledge around the markets, around risk management, etc. So they have win-win. Giving me access to some groups or giving me information.
So when you find a wallet that's, I guess you're following a wallet, let's say, and is it simple as they purchased a token, they're getting into something, and that kind of pops up on your radar, you start to investigate it or explore it a little bit more?
Yeah, something like that. And especially if you have like multiple wallets you're following that buying, that's a stronger signal. But sometimes you're gonna have a wallet that's just buying something kind of random, and you don't have information on it, so you cannot like. You can autocopy in theory, but sometimes it's not worth it to autocopy.
Yeah. So, sorry. Go ahead.
Especially in times like this, like if we were like in November, I would be a little bit more loose. But right now, I'm just very picky about what I buy.
Gotcha. And so, switching gears to Strike, you're listed as an advisor there, and you're pretty, you're part of the team. Can you tell us, a little bit more about it and, what you've been responsible for there?
Sure. So Strike was originally DOPEX. It was launched in June 2021. I actually participated in the public sale of DOPEX. Back then, I was just starting in DeFi, like a couple of months ago. So Strike is a decentralized option protocol. Now we are using concentrated liquidity to sell options basically on the CLAM model. So using concentrated liquidity AMM, we can sell options on any assets as long as it has a V3 liquidity pool and people to provide this liquidity. What is smart about this is, as a liquidity provider, we can optimize your yield by using by selling we kind of cut or like use your whole range to sell options, not only the active part of your range. When you provide liquidity on Uniswap, I don't know, you can provide between how much is this 1.6, you can provide between 1.4 and, or let's say 1.5 and 1.7. You will have only a portion of your liquidity that is active. When you provide liquidity to Strike, you can sell options on your whole range and optimize your yield that way. We were present on multiple blockchain, Arbitrum, Berachain, Sonic, etc. And we're looking to cover assets that are not covered by like big exchange like Deribit and etc. And also we cover ETH and BTC. And my role on Strike, I'm more an advisor on quantitative matters, and a bit of strategy. I was very involved. I was following the project since 2021, and I became friend with the team. And we felt at one point like my input was valued, and I was to be like participate in product design and work into really quantitative issue. My background is in investment banking and risk management. I worked on interest rate derivatives. I worked on options professionally on equities with risk management optimization software, which had hedge funds and market makers as clients.
So when you look at on-chain options, is there a specific chain where you're starting to see more signs of growth or a concentration of liquidity, or what, I guess generally speaking, are you seeing in terms of the maturation of the markets?
Sadly, on-chain options have not really took off until now. I think it has to be something that I've been advocate for a long time. It's capital efficiency, how you can sell options where being capital efficient and having some kind of this margin on-chain. And I think something a lot of options protocol are not exploring is potentially how to get that capital efficiency and also how to reduce fees also. For example, I would like to see a Deribit competitor, something like Hyperliquid, a Deribit competitor that has lower fees. I've been dying to try some sophisticated strategy on BTC, on ETH, but the fees are killing me on Deribit. It's 3 bips, I think, 3 or 2 bips, so it's 0.03%, and it's huge on BTC. For me to be profitable, as if I open a butterfly, I'm instantly down 20-25%. And that completely kills my risk reward.
Yeah, absolutely. It's tough when it's that wide or the fees are that high, in a sense. For anybody that's not familiar with on-chain options, though, I mean, is it fair to say that it's very similar to the experience that you might have? And granted, there's maybe a little bit less liquidity at times, and I think that will improve as we go forward. But is it fair to say that it's very similar to the experience that you would have with, say, a Tasty Trade or trading options as a retail participant through a brokerage firm? Do you have an option chain? Can you use similar strategies regardless of the capital efficiency? Is there still a way to approach the markets that way?
So for Strike itself, you can only go long options via buying them or provide liquidity. You cannot do at the moment selling like spreads or butterfly. You can on some other exchange do it, but the margin, to my knowledge, is not very well calculated and the liquidity is not present. The advantage of Strike is since you can only go long options, you have a small discount compared to what you would have on Deribit, for example, or etc. So you're gonna get that because it's a win-win situation when liquidity provider get a higher yield, but since they guarantee the payoff only if you are in the money, you get a discount. So for you, if you want to like swing and to get like this big leverage at a small discount and you kind of bullish in 24 hours or 1 week, that's the maturity we have. You can do it. On chain, honestly, for me, liquidity has been very, very problematic whenever I used. So I use Strike because it's a mid price. Whenever I use other platform, I'm gonna move the mid price, or I'm gonna get like this margin problem. So I'd rather use, for example, Deribit or Bybit, even if I'm not a fan of their liquidity. I think the liquidity has to scale, and it's hard because we need to get like some market makers, and the problem there is not liquidity, so market makers are not coming. So that's why we need like kind of a big push on options on chain to get like sex-like experience on chain.
Yeah, I kind of think that will probably, I mean, we sit in the US, so we have a bit of a US-centric approach, but should we get regulations over time that I think influence activity on chain, that probably has to happen first, but I think it will happen, which I'm excited about. And that's probably another indication of how early it is, too, that you don't really have a robust or mature derivatives market in this space. As you've mentioned, there's Deribit, but it's kind of it. So I think, again, another sign that it's early, and while it could be frustrating at times if there's less liquidity, I'm excited about the future.
I'm hoping because I want to see like this option sector like expanding. It's been only retracting since early 2023, so it's a bit painful to see. We used to have a lot more activity even on chain. I think it has also to come with people understanding perps easier, and options are a bit more complicated. I think the real boom in the US came from retail and from Wall Street bets, and we kind of have that, hopefully, that moment for crypto options at one point. And talking about Deribit, I think Coinbase put a bit on Deribit lately, so that's kind of interesting.
Yeah, that would be really interesting if that plays out.
Yeah, do you have any thoughts on that? Yeah. Like, do you think that's a good thing for the space, that consolidation or Coinbase acquiring?
Yeah. I think like if you can get for me, I'm frustrated with the overall market, option market, even on derivatives. I need to check. By the way, today, if option ETF has been approved, so I want to check the liquidity on that. I think on IBIT it's really good. I need to check on that. Maybe I'll do a little bit more options. But yeah, I think it's a good thing if Coinbase basically since early this year have been taking more risks. And I think they're going to push for being really the flagship of crypto in the US, and have them having options and pushing them to retail should impact also on-chain options, but should impact the liquidity. Maybe the fees also get more actors, be able to do all what we can do on a regular broker on Deribit. That would be very, very nice to me, honestly.
Yeah, just to that point, boss, like you mentioned, coming across the wire here, it looks like 30 minutes or so ago, SEC clears Ethereum ETF options trading for BlackRock and Fidelity ETFs. That got lost somewhere along the way, given everything else that was going on today. But that's huge. That's really exciting. And again, is another step towards I just think, again, the evolution of this space.
Yeah, definitely. Now we're waiting for staking on ETH ETF, I think, and that would push a bit ETH price higher and get like some traction from boomer that want that 3 or 4% dividend yield on their ETF.
Absolutely, yeah. And I think it's great to point that out because, we look at kind of the short-term volatility, and as you mentioned earlier, there was a lot of excitement built into kind of the post-election price action and the assumption that we were going to see immediate changes, which nothing ever happens overnight like that. But when you look at kind of the roadmap, or you look at maybe what's on the horizon, in a sense, again, a lot of indications that it's still early, right? We don't have Ethereum ETF staking. We don't even have a Solana ETF. And I'm not saying that you need an ETF wrapper for all of these different tokens, but a couple more catalysts that likely sit on the horizon that could certainly induce flows for sure.
For me, I think it's how we see the future and how potentially the newcomers what the newcomers will buy. After like BTC, ETH, Solana is a certainty for me to some extent. Who will win between ETH and Solana? I think they're not really competitors. They're like serve different audiences. But after that, what will stay? What will consolidate? What will emerge? That's the big unknown for me. For example, we can see a development of BTC DeFi. What's going to be the big trend? What's going to be the winners of the Trump administration? That's the big question, and that's something to be looking forward and to try to find it and to place the bets pretty early.
Yeah. Do you have a view on that? Is there anything that you're looking at that you think might be a winner?
Potentially BTC DeFi, maybe, but honestly, I don't know a lot about it. I need to look a little bit more about it. Something like everything that is BTC centric seems like a good narrative, and I need to do more research about it. I need to this year I've been trading a lot. I've not been researching a lot. Now I think it's the moment to take some time and to try to figure out and to be on top of the new meta, or the new narratives, I would say.
Yeah, make sure you share that with us when you figure it out, though.
Absolutely.
Will do.
Yeah, so we always ask our guests, do you have a bull prediction for Bitcoin or crypto broadly over the next year?
I think Bitcoin is easily go to 150K in the next year or something. I won't say 200K. But that's on the table. But I think Bitcoin is very well positioned. When you see, even compared to traditional market, it held very, very well. I think it outperformed Nasdaq on this drop, almost outperformed Nasdaq from all-time high drop. So I think Bitcoin is very, very solid, and it should at least go to 150K by mid 2026.
Music to my ears. Yeah. I mean, when you just look at the chart here, it does seem that there's a similar pattern forming to what we saw for, most of, let's call it the March to pre-election cycle there, or that period. And then you had the election catalyst, obviously, and you shot higher. Well, you're kind of seeing a similar, I don't know if you want to call it a fractal pattern, but you're kind of seeing a similar trend in place here. And I think if we can just base around 75, 80, that's encouraging, to say the least.
And we've been distributing a lot of market cap, even the increase from 65 to 110 was very, very fast. And that's adding, I don't know how many, 500 billion or something, 600 billion of market cap. So it needs to kind of solidify and distribute and get ready for the next. I think if we made the bottom right now, it's very bullish for Bitcoin, I think.
Absolutely. Well, before we let you go, one last question for you. Any advice for new crypto traders or investors, given you've been in the space for a long time, you got a lot of experience, and you've had a lot of success?
I think wait for when the moment, how I was saying earlier, trade when the market is really moving and is really positive. Usually there is a lag between price action for majors, BTC and ETH, and how the on-chain activity goes up. So when the on-chain activity ticks up, you can try on-chain and you can try to understand how things move. Don't over-risk initially, but what's interesting about on-chain is the asymmetry of risk. Is you can lose only 100% of your initial, but you can make multiple X, 2, 3, 4, 5X. So once you get the feel of it, try to get your risk on check and to not over-risk. You don't need to over-risk to make money. But yeah, trade when the market is good and don't try to over-trade when the market is like turning bad or going down or there is less activity. And don't greed, don't it's better to exit before the top than to hold on the way down, and there is enough opportunity for you to make money, basically. But just take time to learn, and it's not gonna be a quick dollar, but if you take time, you can potentially hit it big.
Awesome. Well, boss, we appreciate the advice. We appreciate you coming on the show, and hope everybody enjoyed this interview. Definitely head over to X. Give Boss Imp a follow on X at BossImp75, an advisor to Strike. A lot of good content on his feed. So check him out. Hope to have you back on here as well at some point. Want to do a round table. We've had a lot of traders on the show, a lot of people with a focus in the derivative space. So would love to get you back on here at some point as well, boss.
Anytime. Honestly, anytime. Thanks for the discussion, guys. I hope I didn't talk too much, and it was a pleasure, Ryan and Dan.
You're great. Yeah, thank you very much, and we'll talk to you soon. And that's going to do it for our show. We will be back on Monday. Until then, I'm Ryan.
I'm Dan.
Peace.
Explain pot odds.
Pot odds is my favorite term, but pot odds in the poker world or gambling world refers to having a greater payout than your implied odds would suggest. So let's say I have 3-to-1 odds to win a pot, but the pot is giving me 4-to-1 odds to make that bet. I would have a positive expected value over time. So in trading, let's say you have a defined risk debit or credit spread that's currently at a max loss, and let's say there's 30 days left to go. There's not really a reason to close that position because you're already at max loss. You can only go up from there. So in that scenario, that would be a positive pot odds scenario, or something that would give us pot odds to stay in.
All right, yeah, I'll talk to you. There she is. Good, you found the place. Good, you're not stupid. I dated 3 stupid girls in my life. I loved every one of them. So maybe you're the next one. Having a good day? I'm having an awful day. But then it got really good again.
Oh, good.
So I'm feeling all right. Hey, where'd you go to college?
I went to
University of Penn State Community College. You didn't know they had one of those, did you? Yep, the Fighting Rams.
Oh.
I'm one of the Rams now. Do you have any sexual fantasies?
Excuse me?
I do. My parents are watching. They're sitting on a rainbow. I'm a half man, half giraffe, and I'm dressed like Brett Favre. What does that mean?
I don't know.
Yeah, talking about it gets me pretty hot, though. Uh-oh, there it is. His pants just got tighter. I'm a vampire. Can you believe that? Does that make me more mysterious and attractive?
What?
Uh-oh, watch yourself. We don't want to get hit by a car.
Oh.
My brother did that once. He can't talk now.
Oh my God, that's serious.
Yeah, pretty serious. Are we getting serious? I think so. How many kids do I want? 5? 11?
Oh.
First meal. Here we go.
That was rude.
This is on you. So much time is flying by.
Yeah.
You're very funny.
Oh, thank you.
Does anybody ever tell you that?
Yeah.
Well, you're not that funny, so don't worry about it.
That's interesting.
Not a big fan of Sam's anymore. But now you know everything about me. I feel like I'm opening up so much. God, I'm scared. This thing's moving so fast.
Yeah.
Oh, wow. I haven't cried like this in a long time. Are these tears? Uh-oh, here we are. Front door. Big first kiss moment.
Oh.
This is just moving a little too quick for me. You're a great kid.
Shake it up, stop when the clock hits 13. Sing 1, 2, 3, 4. Cause no one can do it like we do it, like we do it, like we do it. Cause no one can do it like we do it. we do it like we do it.
Oh, yeah. Tasty Nation, good morning.
That goes down. So what? Because now you're long distance and at a better price. Oh my God.
Hello, everyone. Welcome to the Liz and Jenny show.
Jenny, I think if this show doesn't pan out, which it might not after the show, I don't know if you know this or not, this might be our last day on the network. I'm pretty sure this is our last day on the network, so Jenny will be taking her act on the road as a ventriloquist.
Puppeteer.
So my job is just going to be the evil villain sitting next to her.
Got an idea. Crystal ball, where is Ford gonna be?
Does it talk to you? How do you get your messages?
It comes right to my head. Still working to manage my far in the money put in my Namasaki's company.
Namesakes.
Honestly, the SPXs burned me once, shame on you. Burned me twice, shame on me. Burn me. What?
When somebody says tape action, what do you think of?
To me, tape action is a little bit of a historical term because that's how they used to relay the different information for all the different underlyings that you could trade. They would share like the price, the volume. So it'd be a way for people to kind of get a gauge for different markets. But now I just kind of think of it as that little line of information on your screen when you're watching your financial news outlets and seeing what all the different products are currently trading for.
What's a Johnny trader?
A Johnny trader is defined as Nick Batista and myself. We are smaller traders, smaller accounts, mid-sized accounts where we can't sling anything we want. We can't do multiple contracts of anything we want. We are really defined to specific parameters in trading in a small way. So a Johnny trader is just someone that might be doing one lots, one contract here and there, or trading smaller price products.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
How we respond to the most difficult situations is ultimately how we learn to build on our successes.
It takes the guesswork out of retail trading.
Just for a minute, let's forget about your favorite stocks. Just for 1 second, let's leave specific strategies on the shelf. Let's talk about what really matters. Your portfolio. How do you build it? What should you target? How do you manage it day to day? The answers to these questions and more are inside our newest crash course. So I'll see you there.
Forbes called us best online for options trading. With stockbrokers.com, we're number one for options and futures trading. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Wolf! The first half of this year's market has been giving the good guys the business.
It's certainly been back and forth for sure, Pete, and I'm getting whiplash over here.
With good mechanics, we can see Team Tasty stay strong in the second half.
Absolutely. Let's check out our starting lineup.
Christy Ross, St. Norbert College, Wisconsin. Number 85, because I like trades that have an 85% probability of success.
Lindsay Grata, University of Illinois at Chicago. Number 14, because that's how many times Tom asked me, where's my lunch?
Tom Sosnoff, State University of New York, Albany. Number 0? Really? You gave me 0 because I like being delta neutral?
I like the looks of that lineup.
Well, being mechanical is always better than just trying to run plays and see what sticks, Pete.
When you got skin in the game, you stay in the game.
That's right. Now get off the couch and get into the game.
Watch Tasty Trade.
All right. Perfect. I would like to buy Park Place.
No,
What?
there is no Park Place in this game.
Yes, there is. I'm looking at it.
No,
I
this
will
is mine.
take it.
It's mine. You don't get it.
Okay, alrighty.
You know what? $500. $500 to the electric company if you want to keep all of your power on all these houses and hotels. And
You can't negotiate. I landed on it. I can buy it if I want
I'm
it.
the electric company. I'm the most powerful thing here.
Excuse me, to the person who owns one property on Monopoly. This is the mayor, and I'm overturning everything, and
You're
I'm
in over
allowed
your
to buy.
head.
Excuse me?
You're in over your cute little head.
Don't patron.
With the railroads, and what do you just have? You have a bunch of hotels and houses, which in this market is ridiculous. A nice, simple house on Mediterranean Avenue. A beautiful car worth 10 times more than your dog who is gone. Got to deal with me. Come on.
Okay, I quit. If you're gonna be an asshole, I quit.
Then I win. The old bait and switch. I got you. I told you I'd never lose this game. I've always got a plan. You fell for it. Boom! Shalaka!
Oh, yeah, it's Wednesday, April 9th, a little bit after 5 p.m. Central Time, the best time. Thanks for your patience solving a little internet issue on my end. You know what that means. It's time for The Price of Truth, a little show where we like to explore the incentives that govern our world. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile applications. But if you want to be part of this little chat box in the middle of your screen, there's only one place to do it. Head on over to Tasty Live's YouTube channel and jump into the chat. I'd love to shout out everybody in the chat, but my friends, we've got work to do. And with us today on this wacky Wednesday is the big brain, my friends, and it's going to take a big brain to digest the events of today and the price action of today. More importantly, start to think through what to expect going forward. I'm talking, of course, the global head of macro here at Tasty Live, the one, the only, the incomparable, Mr. Ilya Spivak. Ilya, how are you, my friend?
I should get that kind of an intro all the time. That would be great. Anytime I walk into a room, just the euphemisms keep going. I can get used to this. It's been a great day.
I'll open up a Cameo account. I'll do that for like 40 a pop. You just put in a few shekels into the vending machine, and now I'll shoot you over something you could play every time you walk into a room.
I'll just walk around with one of those old school boom boxes on my shoulder and just hit the cue when I come in.
See, the problem with Cameo, now that I think about it, didn't AI just kill that whole business? You know what I mean? You can just get Morgan Freeman's voice. You don't really need to pay Morgan Freeman.
You could get Morgan Freeman video if you really wanted to.
Yeah, bro. Well, it is great to have you, Ilya, and we got a lot of work to do today. S&P 500, my friend, 5510. Who'd have thought?
Yeah.
NASDAQ at 19.3, the Dow Jones over 41,000. And the Russell at 1936. Let me say this to start off the show. What I find fascinating is there are two different realities. There are two different perspectives of the world right now, and of the events that just took place today. And I find it fascinating that we likely, I'm just going to take a guess, I think we likely saw the same thing. I'm not sure if we perceived it the same way. And what I'm most interested to do is go through the perceptions of what happens and how that sort of changes what you and I think about the future. I'm delighted to have this conversation. Ilya Spivak, walk me through the price action, walk me through the events of today that obviously impacted, the 90-day pause on those that did not retaliate, how that you think impacted price and where we go from here.
Well, I mean, it doesn't take a genius to look at a chart of the S&P 500 here and say that the markets liked it. This was the biggest rally, and I'll give you this reference point to the day. This is the biggest one-day rally in the S&P 500 since March 24th, 2020. That was the first big rally, the first day of the rally off the COVID low. So March 23rd was the COVID low. March 24th was the first big up move in what would be the 2-year rally, basically, that followed, going into the start of the rate hike cycle in 2022. So massive day, obviously. The markets loved it, obviously. There was a tremendous amount of consternation starting from this week, especially in the bond market. I'm sure we'll get to that in due time, but clearly tremendous consternation in markets coming out of the tariff announcement last week. For my part, I was looking at stocks at the start of this week, and in particular on Monday, saying, they're not selling off anymore. And you can see that there was a big, scary open. We were talking about it on Sunday. Big, scary open and we were saying on first call then, Asia hadn't taken a crack yet at what Wall Street did on Friday. And what it did on Friday was basically sing a swan song. So there was going to be a bad open. And so it was. In fact, it was worse than any of us expected. But ultimately on Monday, things didn't sell off, and I didn't think the news flow got any better or any worse. I don't think it changed at all. But the markets stopped selling. And I took that as a sign saying, well, if the news flow isn't going to improve, I'm going to be a seller of vol here. And so I just started selling put spreads in SPY and in the Qs. After today's rally, I'm out. Because I think this might be all the rally that this market has in it. Because when you look at the substance of what came out today, it no doubt relieved speculative sentiment. I mean, it's right there on the screen. And I don't think it's the substance of the announcement that did it. It's that the president and the administration more broadly were shown to have some level of response to market signaling when that market signaling got dire enough. And first and foremost to bond market signaling, because it really took that going haywire over the past 24 hours for the administration to really respond. But I think it showed markets and speculative sentiment in particular that there is a pain point, there is a reaction function. Things are not just going to be allowed to fall away. I think that's very obviously good news, and it makes sense why the markets liked it. I also think, based on what we talked about before, if the markets were afraid of tariffs, they would have freaked out on them in November, and they did not. They started to freak out in February because the uncertainty began to show up in economic data as a dampener on activity. It showed up in business confidence numbers for several months straight. It showed up in consumer confidence numbers for several months straight. That's why the sell-off begins where it begins. The markets aren't afraid of tariffs, afraid of a growth slowdown. And once they saw the slowdown, whether you believe it's really because businesses always wanted to retrench on activity and they're using the tariffs as an excuse, or they're not, that doesn't matter. What matters is businesses started to retrench on activity, and so did consumers. And so you have the growth scare is the thing that matters, and the uncertainty that is implied in that growth scare was not at all relieved today. In fact, it was reinforced because we have another fast reversal on policy, and we once again see that policy operates at a whim. And so there is no forecastability to it. Even on Liberation Day itself, when the president first said it's a 10% blanket tariff, markets rallied because they had certainty. And then the foam board came out and they freaked out and saw that no, this isn't a 10% blanket tariff. It's a baseline. So I think that the markets don't have any of their issues solved but for a speculative relief day, and that everything else remains as bearish as ever. So I got out of my longs today. I'll be looking to sell before long.
Wow, there's a lot there. That was a terrific way to start us off the show. As always, man, I shake your hand. I want to acknowledge a couple things you said, and then maybe unpack some of them, maybe challenge a few of them. But I agree with you that the 10%, the market rallied. I had argued, I think a lot of people's notes in the street that like the expectation was 10%. So I had argued the 10% tariff was already built into market pricing. Mm-hmm. So if the worst thing you got was the thing you already expected, you're off to the races to the upside. So yes, I agree with you. And I think
markets
that's more to do with the market had already priced it. Agreed. Number two is, you said two other things I want to either unpack or challenge. One, that what is happening is on a whim. I think that's the most interesting part of the perspective difference that you and I are going to have about what's happening right now. And I want to unpack that a little bit. But before I get there, I'm going to set that to the side. And then you said that the volatility was not tariffs, and it was not tariffs. It was the growth slowdown. I would agree with you. You and I both have acknowledged, I think, for a long time, that there was a growth slowdown happening that the market or prices hadn't seemed to acknowledge. We're now in a period, and we got to a period where you got a catalyst that you had to acknowledge it. However, I would challenge, you and I had a conversation, it might have been last week or it might have been the week before, where you explicitly said, I thought, and I'm not trying to catch you in logic, I just want to understand your perspective, that you had felt the market was reacting to an erratic administration, that you felt like the manner in which these negotiations or the tactics that were being chosen in these negotiations, that was the market was saying, I don't like this, I'm reacting to that. So can you help me understand what's the difference between you saying today, and I'm sure there is nuance because there always is with you, what's the difference between you saying the market was not reacting to tariffs, But a week or 2 weeks ago, when us having that conversation, you had said, I thought that what you were saying is the market was reacting to how this administration
was the same thing.
Unpack that for me.
It's the same thing. The markets knew that there were some amount of tariffs that were coming at the absolute latest after the election in November. They really should have known about it sooner, because the polls were telling you that the outcome was going to be what it was going to be. The betting markets were telling you where things were going. So you had a reason as a speculator to already start to consider this was going to be a Trump win, not a Harris win. And everything that candidate Donald Trump said on the campaign trail was tariffs, 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 tariffs. So if you didn't know at the latest in November,
yes,
that tariffs were coming,
got it. Okay.
You were in space somewhere.
Agreed.
The markets did not freak out then. That is to say, they are not afraid of tariffs conceptually. They are not afraid of there being tariff hikes. Or they would have reacted to that news then.
Right.
Why did the markets wait until February in order to react? Because what they're reacting to is not tariffs, but the implementation of fiscal policy, of which tariffs is one thing, the immigration thing is another thing, the government efficiency push and the unwinding of the administrative state, that's a third thing. All of those things are very clearly, if you read the PMIs and you read the consumer confidence reports, and you just take that at face value, and you see what the markets are doing with that information, all of them say exactly the same thing. There is uncertainty about how all of this is rolling out. It's all rolling out in a very shocking, seemingly erratic kind of way. This is not me passing judgment. This is what those surveys say. This is not my opinion. This is what the data is written to show. So now maybe it's the opinion of S&P Global and the Institute of Supply Management and the people they poll for these surveys. Sure, whatever. The upshot is when the markets are presented with this information, when they're presented with those PMIs, that's what they react to seeing. Not the concept of tariffs, but that tariffs as they are being presented, along with more generally fiscal policy as it is being presented, and this apparent tariffs are on, tariffs are off, we're doing this, no, we're doing that, the swift reversals and the sort of appearance of policy that's not forecastable in some sort of a longer form way, this is what's hurting. And the reason it's hurting is because businesses and consumers, when presented with this kind of policy rollout, are saying, I don't know what's going to happen next. I'm going to pull back on economic activity. And this is creating a slowdown.
Yep. I agree with that, and I think that was I appreciate unpacking the nuance. I told you I give you credit, man. And even if I don't understand, I ask the question versus the challenge. Because I've known you long enough, man, and I know you got a big brain up there. So
every time I try to say something faster, it turns out that I have to say it twice as long. So I might as well just be long-winded off top.
So what do I agree with in everything you've said? A lot. I also agree with. Unloading some long deltas here. I agree with the fact that we're now back at that 5,500 fair value.
The support.
Correct. I think, in my personal opinion, which I want to go through with you, I think Trump, the perspective of what just happened today, I think there is probably going to be some version of people who think Trump blinked, he looked for an off-ramp, and the market found his pain point. The bond market found his reversal pivot point yesterday. I think he just gained a very strategic advantage in these negotiations. And I think that because what you get from a 12% rally in the marketplace is you sort of reward those who sort of bet on positive outcomes. So that's number one. Number two is, I think by punishing those who retaliated and basically getting everybody through the first gate who made a deal without retaliating, it gives an incentive structure for negotiations with countries and counterparties. That means, okay, if I don't make a deal now in the second tranche, what am I going to miss out on? And I had read several papers about that you were going to have like these 2-3 tranches, and those who made a deal or those who cooperated early were going to get better treatment than those that ultimately capitulated or came on board later. And so that there was going to be this sort of an incentive structure for this. And I think if anyone like Europe, I think is in a weird, is in an interesting position going forward. I think what I perceived as a strategic error in retaliating so early against China, I sort of assumed, or yesterday I started to question whether or not that was a strategic error. In other words, if your whole point, if you believe that this is not random, it's not erratic, that there is a strategy in place, regardless if you agree with it, if you believe that there is a strategy, and that strategy is as follows. You create an incentive structure to try to get a quote-unquote coalition of the willing. And I think as soon as you went after Canada and Mexico, you could go, this is crazy. Why would we be doing this? These are our friends, whatever. And that is true. You probably catch, what's the saying? You catch more flies with honey than with vinegar.
Sure.
But if you ask yourself, well, why would that be? And what has happened in the past with China going to Mexico to get around Trump's previous bilateral tariffs, you go, well, that probably wasn't optimal. And you probably look at those Trump 1.0 tariffs as a big failure. So if you learned something from that, and that was clearly your objective, if it wasn't just to slap tariff on the world, it's to sort of game into a tariff-free system where you have advantages, where other people help pay to build manufacturing in the United States. And you don't have to take out massive amounts of debts. So in other words, if you want to reform the U.S. economy, but you don't necessarily want to pay for it because we might not have the money, how do you create an incentive structure that gets money in, that spreads across the obligations, that perhaps puts us in a position where we're exporting goods? It changes our debt trajectory. How do you do that? Again, people keep coming for me in the comments. They keep coming for me in emails. They hate, Ilya, that I'm trying to be objective and just see the full distribution of potential outcomes. They hate that I refuse to look at this as just a monkey pushing buttons and can you believe? They hate that. They hate that I'm...
The thing is, you can't think about it that way. If you're going to trade markets and you bring your political bias into it and you let whatever it is, right, left, you let that color what you do and you close yourself to the possibility of the spectrum of scenarios, you're going to lose money.
I get the people who say that this is not the right way to go about it. There's an optimal path. I get that.
You can think that, but you have to be open-minded to the idea that it's not random.
But the people who are angry at me because I won't accept their worldview, that this is a monkey pressing buttons and there is no plan, there's no strategic objective to what's happening. I think those people are out there, man.
Well, first of all, there's obviously a strategic objective. It's been getting painted forever and a half. You can disagree that this, and I do disagree, that this is how you get to that objective. I think Jon Stewart, actually, of all people, said it really beautifully in his conversation on Monday's Daily Show this week, where he said that what the Trump movement has done is correctly identified the issues, but is pursuing the remedy in a way that he doesn't agree with. I think that's very close to where I'm at, but I'm not going to let any of that influence the way I trade markets.
100%. And so I agree with that. I respect the point of view that, okay, I understand strategically what is happening, and this is why I don't agree with it.
Sure.
The people who get so angry at me because I go, okay, this isn't just an orange monkey pressing some buttons. That's not what's happening here. And if you can't see that, then it's on you. It's not on me. I'll have the conversation about the strategy behind it. But just trying to force me into accepting your worldview, that's not going to work with people anymore, man. That worked for a few years. It's not going to work anymore. Bullying people into accepting your view of the world on Orange Man, it's just not going to work. Now, here's what I will say. I do think, given a 12% rally, and given the fact that I still think earnings aren't going to be horrible this quarter, but I do think everybody's going to kitchen sink it. I think people still want to pay a cheaper multiple on the marketplace, and they're probably going to haircut their earnings expectations. And I still think that we're in a growth slowdown, and I still think there's volatility ahead. This is tranche number 1, and we got 90 days. And I think we continue to see the evolution of this discussion throughout 90 days. And I don't think we're out of the woods by any stretch of the imagination. No. I do think 90 days allows us to get through a quarter without this sort of volatility. So I'd like you to respond on the strategery as you see it, and then what you think that does to price, and feel free to opine on your opinion on the rightness or wrongness of the path. Feel free.
Sure. Well, so I absolutely see strategy in what's going on. I don't agree with the strategy. If you made me an armchair president here, I would identify much of the same issues, and I think identifying those issues is largely bipartisan. Not to go too deep into the philosophical weeds, but I think if you look at U.S. economic history, it's really very easy to see its evolution and how whenever we solve an issue, we create an issue, and then the next evolution is we solve the issue we've created, which then creates the new issue, and on we go. We start off being poor, growing cotton for England to mill with their new industrial revolution strength. We then figure out, we can get rich if we do this ourselves. So we do it ourselves. And what that does is, after all the world wars and Europe smashed, we're the ones with working factories. So, of course, at that point, we want free trade because we're going to get rich. We're going to sell everything to Europe now. Okay, so we get rich. There's a giant economic boom put on steroids by military spending for the war. That breeds inflation. Then the next fight is with inflation. You get what we end up with: the push to efficiency, the focus for corporations on lowering costs and maximizing shareholder value, deregulation as championed by Reagan, lower taxes, all to bring costs down in conjunction, of course, with the Fed and Volcker. That successfully kills inflation for 40 years. But what that's done is now created this huge wealth gap, and now and a loss of confidence in government ability to get policy right, and this bloated bureaucracy. It's not difficult to follow how every time we solve a thing, it works, but has a side effect. And when the side effect over time becomes intolerable, we have to solve that as the new issue, which will have its own side effect, and on we go. If you look at the policies of the previous administration or this administration, they're using old ways to try to solve the same issue. the classic kind of left of center thing. More trade, more government spending. Let's throw as much money at the issue as possible. But the problem is you have this expansive administrative state. The money doesn't get anywhere fast enough and nothing actually moves. You just end up with a bunch of inflation and not a lot of structural long-term improvement in the trajectory of all things. You now have the flip side on steroids. We're still solving for the same issues. At some stage, there will be a real solving of this with new methods to say what we need is government efficiency and clarity, and the administrative state needs to work better without losing all of the things we've learned about the benefits of free trade and low taxes and all of that. This is all very academic, and you can watch it in real time and you can track it historically with relative ease. The upshot for me, sort of practically speaking, is if the markets were selling off from, let's call it, mid-February into the beginning of March, because there was a dampening effect on economic activity and the blame was on uncertainty around fiscal policy, and there's very good evidence that that is in fact the case. Purchasing manager surveys from all ends, and even just the pathway of the Atlanta Fed GDP Now model. Never mind the level. The level doesn't matter. What matters is the direction of travel, because it tells you the flavor of the data going in the model. It's sinking. The economy is slowing. What today's announcement does is it resets to a higher value on risk without addressing that underlying issue. And if anything, if you believe that in fact there is uncertainty, it just makes that uncertainty greater, because you've just had, over the course of a week, another rapid policy reversal. That is to say, the next time you have a policy announcement, you can't extrapolate it again. Whether it's good or it's bad, you can't say, I can use this as a basis to make a factory build-out happen for the next year or two. So with that in mind, because you don't know if the tariff will stay, so if you don't know if your margins will hold. So with that in mind, you're back to square one. But sentiment has now given you a mulligan to short at a higher level. The recessionary implications of the environment remain.
I agree. I agree with that. 100% I agree with that. I think the rallies, the bear market rallies, are the sickest and most vicious of any of all of the rallies. So yeah, I would agree with you 100%.
As one Busta Rhymes might tell you, break your neck.
So I agree with what you're saying as the right mental model. I also think at a higher level, and you alluded to this, I think the tariff, and people, I'm trying to be careful not to give anybody too much credit. And yes. I think, Tom said that to me, I think last week or the week before. He goes, you're giving too much credit to knuckle draggers or something of this extent. And I think in some ways people are giving too little credit to the strategic objectives that are playing out. And I think in some ways, thinking everything is part of some master plan, that can also be a very slippery slope to fall into. But there's some part of me that thinks we were already slowing down, Ilya. You and I both believe this. We were already slipping into a growth slowdown.
Or at least the risk was there.
The risk was there.
All of the makings of the risk were there.
No. I would say we were in a bona fide growth slowdown. I would say we were in a bona fide growth slowdown. Now, you were coming from 4% to 3%, so that's not necessarily something that the market was going to get fearful of.
Yes.
But we, bona fide, were already in a growth slowdown, even though people might not characterize it that way.
Yes. The anecdotal evidence was starting to come together.
And I would argue that the reason why the numbers were so goosed is because, a couple of smart sort of games that our administration, the previous administration, might have played fiscally and with sort of the Treasury issuance.
Maybe.
I sort of think the Treasury issuance game was necessary, and that's the same reason that Bessent hasn't changed the Treasury issuance strategy. I think there's a lot of need for liquidity at the short end of the curve. I think people don't want to go out on the long end; they want to be on the short end of the curve, so they need more liquidity to make sure.
And we did term out the debt. There just appears to be a really. I mean, the debt is currently the average maturity at the highest it's been. At the highest it's been in decades. And that was Yellen that did that, but the problem is it's still not nearly long enough.
She didn't go far enough, yeah. So I believe, if you're in a growth slowdown and you don't have the same fiscal impulse as the previous administration, because that's the opposite of what you're trying to do. You're trying to go the opposite direction. You don't want to feed the beast. You want to deleverage the public sector and re-leverage the private sector, as Scott Bessent has said. Well, then you're going to go through a period it's going to get rocky. And the funny thing is engaging in tariffs at this moment in time, for his base anyway, there's an opportunity for him to keep his base, because they're going, oh, this is all just part of the tariffs and the trade negotiations. So there's like this trust element of his base that go with him. And so you're in a growth slowdown / recession, and you could end up with an American people, or at least a base of the administration that goes with him, depending on how high the unemployment goes. If the unemployment goes from 4.1, 4.2% up to 4.4%, where the Fed thinks it's going to go, well, then maybe you can keep a decent level of support with you. If it spikes up to 5%, it gets a little bit ugly. There is 0% chance you can keep the base thinking that this is some positive outcome for them. And I think that's where the political fortunes may change. But I think we're a long way off from finding out whether that's the case. I agree with you. Growth slowdown. We're in a growth slowdown. So let me ask you, the bond move was absolutely insane.
Bananas.
Let me pull it up on the screen, bro. Like,
ZB in particular. I mean, I had a TLT call vertical that I've been building basically since the bond market broke out going into March. And I've only been adding. And so it pulls back to around where I got in as this week was going. I mean, obviously Monday was absolutely insane. That Monday bar was crazy because last week everything was working as you might expect. Markets get a growth scare, they're selling off, they're buying bonds, expectations for Fed rate cuts are building. You go, okay, this makes sense. They didn't like the tariff announcement because the tariff announcement had a bunch of different rates on a board. They wanted certainty, and what they got was the ingredients for a raft of bilateral negotiations. That means it's going to take a long time. If it takes a long time, that's not the certainty that we wanted. Okay, sell off, right? The hope, I think, that markets had for Liberation Day was he was going to come out and give the plan that captures all the things, and the markets could go, right, okay, I can extrapolate this forward. I like it, I don't like it, whatever. Let's discount this in asset values and keep it moving. But the foam board told them, ha, 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 you can't discount anything. Each one of these is an individual variable, and we're going to negotiate them now. And so the market said, oh, well then, if growth isn't happening because businesses are pulling back on activity because of uncertainty, this doesn't add to certainty. This removes it. This is not what we wanted.
Yeah.
So the markets sell off and bonds rally, as you might expect. I was a very happy camper at the end of last week. I had all the things I wanted. Stocks were falling. It was good. I was short. Bonds were rallying. It was good. I was long. Everything was fine. The move this Monday was shocking. I sort of chalked it up first and foremost to term premium blowing out. And when you look at what happens in ZB versus, let's say, ZT, the front end of the curve, you see it. You don't get these kinds of moves at the front end of the curve because, in fact, the markets are still building, at the start of this week, huge Fed rate cut expectations. And they're pulling them forward. So Fed funds futures at that stage on Monday, when we come in, they're saying there's going to be 6 cuts. 4 of them are coming this year. And 2 of them next year, which is like way off from where the Fed is. And that 6th cut is still debatable, but 5 are fully baked in, and 4 of them are happening off top this year. And then next year, 1 or 2 more. So the pricing is very dovish. The front end reflects that. It's the long end that goes haywire. And I think it's the term premium in there blowing out amid uncertainty, because the Fed is basically standing there after Friday's Powell's speech with its hands up going, I don't know, maybe it's more of an inflation risk, maybe it's more of a growth risk. How we're going to balance it, we're going to wait and see. And so there is no help. And the Fed looks confused along with everybody else as to what the upshot is for their dual mandate. So, and then from that term premium and from that spook, all kinds of market weirdness activate. The basis trade unwinds. Apparently, a bunch of funds in Japan fail overnight around this thing because you get such a big move that the markets start to sell out of long exposure to U.S. debt around these basis trades that essentially just look to game the difference between treasuries and swap rates and extract a little opportunistic mislocation return. And of course, they're levered a gazillion times over because there's not big dislocations in the bond market. So to exploit them, you need all kinds of leverage because they're not big dislocations, but you need to throw a ton of capital to make the trade make sense. So you have this massive unwind and the bond market goes completely bananas. I think what you get today with this crazy long wick and this exhaustion is 2 things. Number one, the president just told you that there is perhaps a Trump put, if you will, but that the put is not in the stock market, it's in the bond market. That what the president cares about is interest rates, not stocks. And this sort of jives with the differences in his electorate, and it jives with what he's been talking about, debt refinancing and all of these things. And so the president sees interest rates spiking higher and says, that's not what I want. That's the opposite of what I want. Let's put the brakes on this thing. So first, that tells you that maybe policymakers are telling you that there is now a defensible low in bonds. That's one. Number two, some of the term premium around what the Fed is thinking and the uncertainty with what they may do in response to all of this is surely eroding. Because what we now see, we just read the minutes this morning from the March FOMC meeting. What do they say? We're so afraid that inflation is going to be stickier from these tariffs than anticipated. We think the risks to inflation are biased higher. And what are the markets saying? You all are crazy. Inflation is going down. If you look at the break-even rates in bond markets, they're cratering. Why? Because the markets have already looked through the one-time price adjustment, quote unquote, of the tariffs to their implications for growth. And they're saying that the recessionary drop in demand will overwhelm whatever uplift from the tariffs in the first spot. So if the Fed was only holding back because it's afraid of sticky inflation, the bond market is screaming at them, this is not a thing. You're worried about the wrong stuff. You get a soft CPI number tomorrow, the Fed gets permission to cut sooner. And what you end up with is a growth scare, but inflation going down, not up. As you and I have been surmising, by the way, since that March Fed announcement. We looked at the SEP and said, I buy the growth. I buy the growth, but not the inflation.
Bullshit.
I buy the slowdown, but not the reflation.
Because again, it's, to me, and I just have these mental models, right or wrong, but to me, the Fed's goal is always and everywhere volatility suppression. And if that's your goal, it's not always. Sometimes they actually need to crack a few eggs and create volatility where there isn't any. Greenspan didn't believe that, but
they are judo practitioners, as we know.
But I think if that's the goal, then what you always need to do is keep risks balanced. And if you see a growth slowdown, how do you keep the risk balanced in the eyes of the market? You throw 2.7, 2.8% inflation in front of them. You create this straw man, boogeyman. But here's the flip side. And this is what I find most, again, this is the most fascinating card game I think I've ever witnessed. And it's the most high stakes card game. And you can believe that this is all random. And what are these people doing? And I'm scared and just make me comfortable. You can believe that. Or you can sit in the pocket and try to figure these people out, figure their incentive structures out, and play cards with these motherfuckers. You could do that too.
Oh, the macro
or you can
trading right now is.
Yes.
I mean, this is, I love this as a macro speculator. I love markets like this.
Yes.
Because
I agree with you.
This is exactly the kind of stuff that I like to bet on.
Now, do I think it's foolish to look through the risk of the next few months? I do.
Sure.
Do I think the trend is still intact to the downside? I do. Do I think we're still in a bear market? I do. Do I think we're still in a growth slowdown? I do. But I'm trying to look at what the market is priced and what it hasn't potentially given enough credit to. What it's pricing is a low probability that may be a high probability. I'm trying to look at inflationary forces versus deflationary forces. Let's get back to the political favorability, because I think that's going to be a really important calculation. If what the baseline assumptions that you and I just made, that we're still in a growth slowdown, that the risk, the pressure to stock prices is still to the downside.
Yes.
And that we are not through a trade negotiation. We only took a step through the first tranche, and it only gets harder with more volatility and bigger claims and more retaliation the further this goes on.
Sure. We've only elongated the process somewhat.
So let's make those baseline assumptions, okay? So then what comes into play is political favorability. If, let's say, I've got a bunch of small businesses throughout all of the United States of America, and what they're doing is buying cheap Chinese goods. They're buying cheap goods from China and they're reselling it on online distribution here in America. And we got a bunch of those, man. And all of a sudden, those small businesses are making a bunch of orders, whether that's business or whatever. Just I'm buying cheap goods from China and I'm selling them over here and I'm making a margin.
Yeah.
Let's imagine right now, all those people, and you can see this on Reddit, you can see this online, all those people are trying to make orders and they're getting sticker shock. They're like, what the hell is this? I can't make my business work. And so in the same way that Trump, when he got in trade war 1.0, what did he do? They sent out subsidies to the farmers. And what I think it has to go into your calculation here, Ilya, in my personal opinion, is that wherever you saw the retaliation and wherever you saw the potential impact then to America, which is his base, because that's what all these people are going to do. They're going to attack his base because that's his vulnerability point. His vulnerability point is his political favorability. So you tariff all the stuff that's going to hurt his political favorability. And so what does he do? Is he either going to allow that to happen, let the natural market forces erode his political favorability, or is he going to respond with subsidies to his base that helps to mitigate the erosion of his political favorability? And I think that that's probably the next card to drop. that
Maybe.
at some level we're going to be talking about subsidization of those who are negatively affected by those who have retaliated. And we ratchet up the retaliation on others. We create disincentives for additional retaliation to us, and we continue to offset those Americans who are going to be negatively impacted by tariffs. What do you think about that potential tit for tat, about the potentiality of that sort of as we move forward here?
I think what that paints is exactly sort of adjacent to why the idea that has been circulating around, and I'll sort of kill two birds with one stone because I think these are adjacent ideas. So I'll moot them at the same time. The idea that actually what the administration is doing is it will inflict the pain purposefully. And that what inflicting the pain will do is bring down interest rates. Ultimately, obviously, that whole supposition blew up in the administration's face in this very short window of time that we've seen it so far. Who knows what will happen over time? I actually think interest rates are going lower. So I'm actually with the administration on this. I think what these actions will do is ultimately bring lower rates, not higher. But at least so far, their supposition has blown up in their face. Maybe they're wrong and I'm wrong. But the presumption has been, look, we're going to crush the economy. We're going to bring down rates. That will help us to refi debt. And we're going to buffer people we like, much as you just described, with subsidies, with transfers, through the pain of making the adjustment, because what we want is a big refi of debt at much lower levels. I'm not saying that's not the strategy. I don't know. I'm saying if it is the strategy, and if the idea is basically to wave a big hammer at everybody and to purposefully crush growth while favored sort of groups get support, I think it's a bit like saying, I have a sprained ankle, let's amputate the leg. Here's why.
Mm-hmm.
If you cause a recession, and the markets are telling you this because the break-even rates and other measures of inflation expectations are cratering. They're telling you this. This is not sort of out of thin air. They're telling you that the disinflationary impulse from recession will be greater than the inflationary impulse from the tariffs. And maybe that calculus changes if you give out a bunch of subsidies, but then your desire to reduce the deficit is set back. Moreover, in a recession, all of your outlays increase because now you're on the hook for unemployment benefits and all manner of other things at the same time that business is down, and so tax receipts are falling. So you're trying to save a couple dollars on interest at the expense of losing much, much, much more because you have a ton of money going out and less money going in a recession. So, and if you decide to give your favorite constituencies a little bit of a sweetener, that's just more money going out. So, to me, strategically, it's not logical to do it this way. That doesn't mean that that's not what's going on and that's not what's going to happen. I do think the markets are already looking through to what the downturn will be, and they're reckoning that it will be a disinflationary downturn in its severity, even with an uplift and a shock to prices from some amount of tariff. So
I think I agree with everything you just said. But I don't think that's exactly what I'm framing up. I think the part you added was that the administration's ultimate goal is to get rates lower.
Yes.
I think that's a positive outcome for them. But what I'm saying, though, is I'm simply trying to be objective and trying to figure out, do I want to bet on the long end or not?
Yes.
Last night when I saw just absolute pandemonium, and I tweeted this out as I was watching this. I said somebody just got carried out on a stretcher, meaning like when you see this type of disorderly market function, a lot of the times what's happened, this was in response to a tweet by Jim Bianco. He said, something is broken tonight in the bond market. We are seeing a disorderly liquidation. And I think when you see liquidations, well, here's what tends to happen, right? I got a shitty position I got to get out of, and the whole market knows it. They're going to take my eyeballs out. They are not going to give me fair prices to liquidate. If I've got a boat full of long bonds, I got a boat full of long bonds, and I got to get out of the position. You know what the market does? They fucking drop rates 5 points because I got this gigantic position I got to get out of, and they rip my eyeballs out. But what that means is, well, look, there's probably a decent risk reward that if that's what's happening, if this is not just a wide-scale unraveling of the U.S. financial system tonight, if that's not what's happening and this is a liquidation event, then this might be an interesting risk-reward area. It's hard to push that button, bro. But I bought some upside ZB calls yesterday. I didn't make as much money on them because you get the vol crush because vol went crazy stupid yesterday. So the direction, the delta is sort of offset by the Vega. But yeah, I sort of thought what was happening yesterday, people were panicking that it was effectively the fall of the bond market, right? We were in the midst of a debt crisis. And I go, that could be. But what also could be happening is somebody's blowing up and the market is taking their eyeballs out. And if that's true, then everybody's over-rotating the wrong direction here.
Here's how I knew.
Here's
how I knew that what you're saying is right. Everybody was running around screaming, you know what this is? This is China retaliating. They're dumping some amount of treasuries.
I thought that could be possible.
They might have sold something into the rally, but the idea that what this is a targeted Chinese policy response. By the way, it's a dumb policy response, but dumb policy responses are all the rage now. So who's to say? But what you did not see, and this was absolutely critical, was you did not see the dollar sell off. Mm-hmm. If there was an exodus out of U.S. assets, the dollar would get trashed. Yeah. And while the bonds were selling, the dollar was rallying. This was not an exodus from U.S. assets. It was a cashing out of positions. Because the money went back to dollars and stayed there.
I think you're exactly right. And one of the things, Jim Bianco pointed that out yesterday as well. Let me read this for people just to enhance the point that Ilya is so astutely making. I don't think this is China selling bonds to punish the U.S. over rates. There are no good daily statistics to measure this, but I still contend that if this were happening, the dollar would be declining. The dollar index is up since Thursday's low, suggesting net foreign buying is coming into the U.S. market. Above said, technically, China could be selling and keeping their money in overnight repo accounts. If they did this, it says two things. One, they are not afraid to dump treasuries and drive up yields and punish, but they are afraid to take cash from these treasury sales and convert it to another currency, or in other words, dump dollars. Why is it okay to crush the bond market but not the currency market? Answer, it does not make sense. Or two, if they are selling treasuries and continue to park them in U.S. repo accounts, they are not really serious about punishing the U.S. Again,
well, of course,
the most logical answer is that they are not the primary seller of the treasuries, if they are the seller at all.
This is the only place that I will diverge from Jim. Obviously, I agree with him because I just said the same thing before having seen this, and I was saying it to Chris on air yesterday. So obviously, I think Jim's right. I agree. Where the only sort of caveat is, and it's not a material caveat, but it does make sense for China to sell off treasuries and then keep the dollars and not repatriate them. Because we are still the largest trading partner, and they don't want the yuan to appreciate against the dollar. They do not want the dollar to strengthen because that would make an already very challenging export environment that much more challenging. So it does make sense. It just still doesn't make sense that that's what they're doing. Because if this was an exodus from U.S. assets by China, China doesn't have to repatriate dollars. The markets are going to sniff that out instantly, and they're going to dump dollars. So no, the same logic holds. If the dollar is holding up, that's not what's going on in my mind. There might be logic for China not to recycle their dollar cash proceeds out of dollars, but do you think the markets aren't going to notice a large Chinese unwind of their treasury position and not run that? Well, I have any number of bridges that I could sell you.
What do you, 3 months from now, 6 months from now, 1 year from now? Like, I can't help thinking, Ilya, we go through the pandemic response, and we passed the CARES Act, kind of shut down the economy. The winner in all that is large multinational corporations with tons of cash that can weather periods of volatility. The loser in all that is the mom and pop shop that sometimes has good months, sometimes has, needs to get a loan just to make it to the next month or the next quarter, or has a good year and a up year, down year. Those businesses with that level of variability, they go by the wayside. And what you end up with is less small businesses and more consolidation of large corporate power.
Yes.
And I can't, regardless of sort of how this ends up, which I think is with some creative destruction.
Yes.
I don't see how this doesn't end up with just consolidated corporate power and smaller businesses, but in different areas of the economy. Maybe it's not the restaurants this time around. It's the drop shippers. It's the people running the online stores. I can't help think that this is going to take from an area of small business in the economy, consolidate even more multinational corporate power. I wonder if you could opine on that for a bit.
I mean, I think your instinct is correct. I am less optimistic as much as that. So I am less optimistic, but I am also more optimistic, and I'll explain what I mean.
Okay.
I am less optimistic because I think in addition to hurting small businesses, and I completely agree, that's exactly right, and it's going to hurt small banks, it's going to hurt anybody at a certain level of scale below the ultra huge. Yeah. Because the ultra huge are going to be able to have the capital reserves to weather it, and everybody else will just choke on the volatility. And I think that's right. I think that's going to come. And I think that'll be the essence of the recession. And with that, probably the scariest thing is, in addition to coming for those businesses, it's coming for consumers. Consumers are going to get absolutely trashed by this. Because if what you are saying, if the strategy is as presented, you're forgetting that when you were president the first time, you did steel and aluminum tariffs, and what you ought to have learned is there are many more steel users than steel makers. And if you start to hand out, because all this is big government. This is just a different stripe of big government.
Yep, I agree with that 100%.
But this is more big government. There's a great book by one Ruchir Sharma that's called "Why Capitalism Failed," and I do not endorse it in its in all of its conclusions. I actually disagree with quite a lot there, but it's telling of economic history, and it's identifying of the fact that the Reagan Revolution never really happened. It's just regulation moved. Government still got bigger. It just moved from one place to another. That all the attempts at deregulation that Clinton did, for example, getting rid of Glass-Steagall, it just made the regulatory state bigger because now you need all these extra rules in the reform. And that what this is a theme now, really going from the fight with inflation in the 70s going into the 80s, to the 80s being sort of that fight starting to bear fruit, the push to lower prices, increase efficiency, deregulate on the surface. But every time you deregulate, what you're really doing is you're just rewriting the rules to open up one thing while you create a gazillion other confusing things around it to make that happen. And so, whereas, let's say, maybe the original Glass-Steagall Act was like 40, 50 pages, the undoing of it is like 10 times that. And so, really, the issue here is that what you have is big government, but whereas the Biden version was spend a ton of money and try to grow your way out of debt, this is big government through a tariff administrative state. But it's ultimately the same thing. It's just it's just a different flavor of the devil.
I said the same thing, Ilya. I said that if you didn't like Biden's subsidy economy or method of big government, then in theory you really should not like a Trump tariff government. It's consolidated centralized power with the power of the printer on one end, and it's consolidated centralized power with a disincentive. Instead of the incentive, it's a disincentive of the tariff on the other, but it is a mirrored opposite of each other, the flip side of the exact same coin. I agree, Ilya.
And so this is where I'm optimistic. This is where I'm optimistic.
I land somewhere in the middle that I get what you're saying. That's the most gangster point. I land somewhere in the middle that I'm still holding out that the happy path here, the most optimal path for the Trump administration, is to land in a world of tariff-free trade for the most part, with some small carve-out exceptions that are simple, clean, and straightforward. If you get anything other than that, I think what you have is something that you do not want, but you don't know that you don't want it, even if it has a positive outcome, which I readily admit have small probabilities, but I think those probabilities just increased with the play today. That's my read on it.
Agree completely.
When do you think the sugar high wears off, Ilya?
Possibly
the sugar
as
high
soon
of
as
today's
tomorrow.
event?
Possibly as soon as tomorrow. Possibly as soon as tomorrow. So for me, it's exactly this. It's most of us who are sane, I think, like you, fall in the middle and say, the problem that we needed to solve with free trade was inflation. We needed to open up the economy. We needed to focus on efficiency. We needed to bring down costs because the inflation coming from the 70s into the 80s was catastrophic. And we did that with apparently the economy that we're trying to go back to. We seem to be forgetting that what it did last time, by the way, everybody was cheering Biden initially from a certain perspective as the next FDR. Well, FDR and the very expansive with an A, government spending that started with the New Deal and then, of course, ramped up for World War II. That's how we got both the post-war boom and the inflation that it created. And nobody, I think, should be so silly as to say that the huge leap forward that was the GI Bill and the prosperity of the 50s are a bad thing. But they had consequences. And the consequences then had to be resolved. I think Reagan, if you want to pick a touch point, is the place where you start to get the shift. And you go, okay, the focus now will be lowering prices for things. And it's the Fed doing what Volcker is doing, but it's also freer trade, a focus in corporate governance on shareholder value and efficiency. And for 40 years, we managed to kill inflation and bring costs down. Free trade is a thing that we constructed to fix a problem that we made. We did it ourselves. And again, it has a cost. We did it and it worked, by the way, at solving the problem that we set out to solve. It just had, as always in economics, there's no such thing as a free lunch. And so what we had were costs associated with our fix. The income inequality, the ridiculous appreciation of financial assets relative to labor and wages. All of that is the thing we're going to work on now. And we just had an attempt by the left side of the spectrum to fix it by spending a lot. We're now getting an attempt to fix it this other way. I think ultimately what's going to have to happen is the happy medium. And whether it's this administration that does it or the next one, I think we're sort of groping our way to what is the real solution. Which is to say we need free trade and allies, and it's ultimately beneficial. But what we need to do is be good at making whole the minority that suffers a net loss. And what we've ended up with now is the flip side. If free trade gave us a majority that benefits and a minority that loses, and we need to compensate that minority, what we have now is protectionism, so a minority wins and the majority loses. We're not solving the underlying issue with these old paradigms. We need a middle ground. And the one you're describing is about where I'm at. Mostly tariffless, frictionless, free commerce, and carve-outs for specific things, like national security and crazy dictatorship-like countries who, in their mismanagement of their own economy, are going to get feisty probably because an angry beast is more dangerous than a complacent one. China has been in a deflationary spiral going on 2 years. We should start thinking about maybe they'll lash out at some point just because they're losing their grip on their own country. Much as Russia has lashed out against Ukraine because Putin was losing his grip on his country. And so
I would argue we are lashing out.
I see a middle ground.
I would argue we are also lashing out because...
At ourselves, though.
At the world, because our primacy, we are also sort of losing our control both internally and externally as well. I think there's a lot of that happening, but I agree with you.
The reason I think we're lashing out 100%. At ourselves is because we were lashing out at a system internationally that we built and that served us as intended. We didn't take care of what we should have known to be the costs, and we should have learned those costs a long time ago. Those of us that are
we did know
because anybody
just didn't do anything about it.
We didn't do anything about it. Those of us that are readers of people like David Ricardo and Adam Smith all proponents of free trade, especially David Ricardo, going all the way back to the Industrial Revolution, were telling us free trade is good for most people, but there are costs. If you're going to do it, you need to address the costs.
And one group believes that the problem with redistribution of wealth, just straight redistribution, is that the marginal propensity to consume of one group is higher than the marginal propensity to consume for another. And so what you end up getting is inflation in the economy as you redistribute that wealth. So instead of redistributing it directly as pure cash, you redistribute it through government services that improve the welfare of those that have high marginal propensity to consume, and thereby managing sort of prices in the economy. And that may be true, but I think
common sense would tell
about the redistribution at all. Like the roads.
Well, that's right.
Shit,
I mean,
buses
common sense would tell you.
Schools are shit.
Common sense would tell you, if you need a defensive capacity to build steel at home, and the problem is you're displacing steel-making jobs, then what the government should do is have a strategic steel reserve like it has a strategic oil reserve and say, you know what? The cheapest possible steel may be this other way, but we need a strategic reserve, so some capacity has to stay here and we'll buy it ourselves.
I'm going to ask you to react.
And you can do that across a whole number of things. And have a sane policy.
Too.
No, but have a sane policy where you have small carve-outs, not
I'm with you.
You're trying to fix everything with a sledgehammer this way or that.
But we only have a few minutes left in the show, and I'm gonna be respectful of the guys behind the mics, because I went over by like 15 minutes on Monday, and I just didn't even know. I don't want to do that again. I was by myself too. I want you to react to two things if you could before you get out of here. The first one is a tweet by Bill Gross. He said, "This market crash will affect millennial and Gen Z investors for long to come. What before was a can't-miss way to make money will induce caution and more conservative attitudes, resulting in lower PE ratios, higher yields, and single-digit returns." You and I have had this similar conversation, but in 2022,
yes,
I think this is not going to happen year over year. It takes some time. And what you and I said at that point is you change the cost of money, you change a lot of things. And over time, we might have pulled forward a lot of returns in that ZERP period. And if you've pulled forward a lot of returns, you've pulled forward what is there to share across the next 5 to 10 years. Your reaction to Bill Gross's tweet here?